So today I'm going to take up this professional ethics. Today we will try to cover two chapters as a part of our revision. One is quality control. This chapter we will try to revise. So once we are done with the quality control chapter, which is actually a small chapter, in a very short span of time we can complete it. So once we have completed this quality control related revision, then we will start revising the chapter of professional ethics. So then we will do professional ethics. So today we are going to do even the professional ethics also, which is very important chapter from the examination perspective, and also which is going to carry a good weightage in the examination. Okay, so these two chapters will be our agenda for today. We'll try to do quality control. Along with that, we will also try to do the professional ethics, both simultaneously. We will do it. Right. Now, having said that, so let me start my revision with the quality control chapter. So let us try to understand, let us try to revise the content from quality control chapter. So you all are well aware in your institute study material, this chapter itself is going to be the first chapter. It will be chapter number 1 actually, if you look at the study material. So first and foremost chapter itself is going to be quality control. So the name itself is telling you what exactly we are going to discuss in this chapter. See, this chapter is going to give you guidance to you chartered accountants, how you can maintain the quality, how you can control the quality in the engagements which we are doing. So as you all are aware, we chartered accountants have a responsible position in the society. Depending on our work, so many people are going to base their decisions. We all are well aware of it, right? So we give our opinions on the financial statements. On the basis of that, people will form their decisions. Then we will do various other kinds of engagements. So whatever work we are doing, whatever reports we are giving, on the basis of that work, on the basis of reports, so many people are going to base their decision, not their normal decision, their financial and economic decisions they are going to base on the basis of work whatever we do, right? So that's why there is 100% need for maintaining the quality in the engagements. So if we don't maintain the quality in the engagements, what will happen is people will start losing the trust on our profession. People will start not believing in the opinions which we give. So that's why 100% maintenance of quality is very important, and ICAI is giving the guidance to us in how to maintain that quality, how to control that quality in the engagements which we are doing, so that our work becomes qualitative and people will have confidence in our work. And for the purpose of that quality control, in order to give that guidance on the quality control, ICAI has released two kinds of standards. One is SQC1 and other one is SA220. So we have two standards which are talking about quality control, how to control the quality in the engagements. To talk about it, so they have again, ICAI has given two standards. One is SQC1 and other one is SA220. So first we have to be clear when SQC1 will become applicable, when SA220 will become applicable. How do they differ from each other? Sir, why for maintaining quality we need two different standards? So first we have to be clear about the differentiation here. So guys, as I was saying in the previous session, being a chartered accountant, we perform various kinds of engagements. Yes or no? So now I will take a few minutes of time to make you understand what and all are the different kinds of engagements we do. So we all are aware that we are going to conduct audit of financial statements. So in the audit of financial statements, as a part of engagement of audit of financial statements, we are going to conduct a reasonable assurance engagement, that too of historical financial information. So whatever historical financial information is there, whatever information which has already happened in the past, so that historical financial information, we try to obtain the reasonable assurance and express the opinion. That is one engagement which we call it as audit. And sometimes we chartered accountants will be called upon to do something called review of historical financial information. Sometimes we chartered accountants required to do the engagement where we are not supposed to do the audit, we are supposed to do something called review. See, difference between audit and review is audit is a reasonable assurance engagement and review is a limited assurance engagement. Review is a what? Limited assurance engagement, like quarterly review of the listed companies, quarterly review of financial statements of the listed companies. So like that, these are the review engagements. And sometimes being a chartered accountant, we will not just only be associated with historical financial information. Sometimes we do the engagements in which we are working on, in which our subject matter is other than historical financial information. In which our subject matter is what? Other than historical financial information. When I say other than historical financial information, it could be prospective financial information. That means it could be a future financial information, or sometimes we are all together required to do the work on non-financial information, like reporting on the internal controls and all. So like this, sometimes we are required to do some engagement where the subject matter is not historical financial information, where the subject matter is other than historical financial information. Okay. So, and not just that, there are various other engagements. See, in all the verification, in all these engagements, in audit, review, in other than historical financial information, we are doing the verification work. But we might not be doing only verification work. Sometimes the client might ask us to perform some agreed upon procedures. Not verification. Sometimes the client might appoint chartered accountant to do some agreed upon procedures like compiling the financial statements or doing some other kind of services where verification will not involve, where we agree to perform some procedures. So that services we call them as related services. That services we call them as what? Related services. So being a chartered accountant, we perform various kinds of engagements. We do audit, we do review engagements, we perform work on other than historical financial information, and we do related services. So whenever we are doing audit engagements, their standards on audit, SAS, will become applicable. Whenever we are doing review engagement, then we have separate category of standards called SRE, standards on review engagements, will become applicable. When we are doing any work other than historical financial information, then there will be a series of standards called SAE, standards on assurance engagement, will become applicable. Whenever we are doing related services, then there will be a standard called SRS. These standards will become applicable. So multiple engagements, depending on the nature of the engagement which you are doing, the standard is going to differ. So whatever it is, for every kind of engagement, we have guidance in the form of standards addressing the concerned matters. Standards addressing concerned matters. Now, don't you think in any engagement we are doing, not just audit, either we are doing audit, either we are doing review, or we are associated with other than historical financial information, or we are doing related services, no matter whatever engagement we are doing, be it audit, be it review, be it other than historical information, be it related services, don't you think there is a need for maintaining quality in all the engagements which we do? 100% yes. In all the engagements, we are required to maintain the quality. And how to maintain the quality in all the engagements, that guidance is given under SQC1. So SQC1 is a standard which is talking about how to maintain the quality control in all kinds of engagements, be it audit, be it review, be it other than financial information, be it related services. For all engagements, how to maintain the quality, that SQC1 is giving guidance. So we call it as this standard is applicable at the firm level. At overall firm level, this standard will provide the guidance. Able to understand? Whereas now this is a SQC1 is a comprehensive standard giving guidance on quality control on various engagements. From this, a standard has been carved out, which we call it as SA 220. Sometime from this entire dedicated SQC1, a carve out has happened. That means a portion has been extracted, and they have given it a name called SA 220. And how does SQC1, how does SA 220 differ from SQC1 is SA 220 is also going to talk about quality control, but this only talks about how to maintain the quality control in the audit engagements. It only talks about how to control the quality at the audit engagements only. And this is a standard which will deal about the quality control at the engagement level. For each engagement, it will give the guidance, whereas SQC1 is a standard which is going to give the guidance on maintaining quality at the firm level. Able to understand? So these are the main differences between SQC1 and SA 220. SQC1 is applicable for all engagements. It is applicable at the firm level, whereas SA 220 is applicable only for maintaining audit quality control of audit engagements, and whereas it is applicable at the engagement level. But frankly speaking, SA 220 has been built completely in line with SQC1. SA 220 has been developed completely on the basis of SQC1. Able to understand, everyone? Now, so we will try to cover how to maintain, what guidance SQC1 says in order to maintain the quality in all kinds of engagements, and what guidance SA 220 gives in order to maintain the quality control in all the engagements. So both the standards we will be covering, right? So first we will talk about SQC1. So what SQC1 says is, yes, as a chartered accountant, whenever you are doing any engagement, you need to maintain the quality control. And what SQC1 says is, in order to maintain the quality in all the engagements which we are doing, we need to have some policies and procedures. What does SQC1 say? Yes, we need to maintain the quality in all kind of engagements which we are doing. But how to maintain that quality, what does the standard says is, to maintain that quality in the engagements, in every engagement, be it audit, review, be it prospective financial information, be it related services, in order to maintain that quality, how we can maintain the quality is, the standard says you need to follow some policies and procedures in 6 different areas. What does SQC1 say? In order to maintain the quality control, you need to follow some policies and procedures. In how many areas you are required to follow that policies and procedures? In 6 areas you are required to follow that policies and procedures. So what are that 6 areas in which you are required to follow some policies and procedures? So as you could see here, the list has been given here. Number 1, leadership responsibility for quality within the firm and ethical requirements. Number 3, acceptance and continuation of client relationships and specific engagements. In the area of human resources, you need to have some policies and procedures. And when you are performing during the stage of engagement performance, you need to have some policies and procedures. And even these policies and procedures should be monitored. For monitoring also, we need to have some policies and procedures. So these are the 6 different areas where you need to maintain the quality, where you need to have policies and procedures to maintain the quality control. So what are that 6 areas? Number 1, leadership responsibilities, ethical requirements, acceptance and continuation of client relationship, human resources, engagement performance, and finally you have to do the monitoring as well. So now let us try to understand in each of this area what kind of responsibility, what kind of policies should be there. So we will address the first item, which is leadership responsibility for quality within the firm. See, as a firm, if you want to maintain the quality in all the engagements which you are doing, you cannot call all your staff and say, hey, from today, each and every one of you will be responsible for maintaining the quality. You can't give collective responsibility to everybody. So if you want to make sure that quality in the engagements will be assured, then you have to make someone a leader in the firm, and that person should take that leadership responsibility. That person should come forward and take the leadership responsibility, saying that I will make sure that my entire firm will maintain the quality in all the engagements which we are doing. So someone should come forward in the firm to take up the leadership responsibility for maintaining the quality in the engagement. And who is that someone who has to come forward in the firm to take the leadership responsibility? So SQC 1 says that generally it is the CEO or the managing partners of the company, managing partners of the firm, who has to come forward and they have to assume the ultimate responsibility. So they have to come forward and take the leadership responsibility. So who is that person who has to come forward and take the leadership responsibility? CEO or managing partners. And these people should always try to promote an internal culture. A good internal culture is required in the organization. Why? Because if you ignore the aspect on the culture, see, if there is no good culture in the firm, no matter how much effort you put, quality will not be ensured. So that's why they should work on promoting a good and internal culture. And also this leadership responsibility, by undertaking that leadership responsibility, they will contribute towards that creation of the inner culture. And not just that, people to whom you are assigning the task, those people should have sufficient and appropriate experience. So to whomever you are assigning, so as a CEO or managing partner, you will take the leadership responsibility, but you will not execute that activities. No, operational responsibilities you will execute your staff. So to those persons to whom you are assigning the responsibilities, even those people also should have sufficient and appropriate expertise. And at all stages you have to make sure that as a CEO or managing partner, at all stages you have to make sure that audit quality is paramount. It is very, very important and it is non-negotiable. And what else you can do to maintain that leadership responsibility is you have to make sure that your responsibilities are, your commercial considerations are not overriding the quality. So when you are doing the audit, you must make sure that quality is your top priority, not the commercial consideration. That means you should not compromise on the quality because of the commercial consideration. Might be tomorrow client might come and say, if you found out a material misstatement, but if you don't give modified opinion, I will give you 10 lakh rupees of fees extra. So here commercial consideration should not override the quality, should always stick with the quality. So quality should prevail over commercial considerations. And also you should have some HR policies like performance evaluation, compensation, promotion. So all this should be in line with the commitment to quality. That means you should promote only those people who are committing to the quality. You should give more compensation to the people who are committing to the quality. And the firm should devote sufficient resources for development, documentation, and even support of its quality control policies. See, for this quality control measures and all, you need to have a separate people assigning this task. It should not be treated like some miscellaneous activity. You need to treat it as a separate activity and assign the people with the responsibilities to develop these policies, to document these policies, to deploy these policies. You need to treat it as a separate function within the firm. So like this, someone should come forward and take the leadership responsibility for promoting an internal culture. So who should be that appropriate person? CEO or managing partners. So first aspect we have covered, what policies and procedures we need to have in the area of leadership responsibilities. Now comes the second one, ethical requirements. So we all are aware, whenever we are doing any engagement, we are required to comply with the 5 ethical requirements. What are the 5 ethical requirements? integrity, objectivity, professional competence and due care, confidentiality, and the professional behavior. In the next chapter which we will pick for revision, that is in the professional ethics, we'll try to get the more clarity on this. But we have to remember this: whenever we are doing any engagements, be it audit, be it review, be it related services, be it assurance engagements, whatever engagements we are doing, it is always, we always have the responsibility to comply with 5 ethical requirements: integrity, objectivity, professional competence and due care, confidentiality, and the professional behavior. And this fundamental principle should be always highlighted. Emphasized means what? They should be always highlighted by way of actions of the leadership of the firm. Through their actions, they have to show that, they have to demonstrate that leadership, they have to demonstrate that fundamental principles are very important. They have to spread the awareness and training. They have to train their staff, giving them education on the fundamental principles. And not just training, you have to monitor whether really people are complying with the fundamental principles or not. And even you should train them how to deal with the non-compliances. So in case if any non-compliance happen, like for example, if you face any threat, what actions you have to take, which we will see in the next chapter, professional ethics. So we have to emphasize them. And not just that, one of the most important aspect which we should not ignore, wherever we are giving an assurance in all that engagements, the importance is independence. Auditor or chartered accountant should maintain independence. He should be free from bias. He should not change his decision according to the wishes and directions of other person. So in the area of independence, what you should do is, so who and all should comply with the independence requirement is, the firm should comply with independence requirements, its personnel should comply with independence requirements. If the firm is taking the help of any experts, even the experts also should comply with the independence requirements. The firm, its personnel, and the experts whose assistance the firm is taking in supplying, in providing that assurance services, in all, each and every one of them should comply with the independence requirements. And what policies you need to have regarding independence? Like for example, first one, you need to communicate the independence requirements to all your staff. You have to let them know how important it is to remain independent. And you need to identify the circumstances and relationships that create a threat to independence. There will be 5 kinds of threat to independence. We need to understand, we need to identify, are there any relationships, are there any circumstances which create any threat to the independence? If identified, you should take appropriate action to eliminate them or reduce them to an acceptably low level. If you are unable to eliminate them, if you are unable to reduce that threats to an acceptably low level, you don't have any other option. You have to withdraw from the engagement. Understood? And not just that, in the firm there should be a mechanism where if any of the engagement team member is facing any trouble regarding his independence, he should come and communicate with engagement partners to the firm or the firm. So if anybody faces any threat to independence, they should not suppress it. They have to come and expressively communicate it to engagement team or engagement partner or the senior management of the firm. Such a mechanism should be there. And all breaches of independence should be promptly notified on time. If any breach of independence has happened, that should be communicated, that should be brought to the notice. And at least annually, this point is very important, at least once in every year, you should obtain written confirmation from all the staff in your office that they have complied with the independence policies and procedures. At least annually, at least once in a year, you have to get that written confirmation from your staff. And especially main focus, you have to keep it on the familiarity threat. So what is this familiarity threat? Over a period of time, you develop long relationship because of the personal association with the client. You become familiar with the client, because of which your independence can get compromised. So you have to pay more attention for the familiarity threat, especially whether familiarity threat is there or not. That derives even more attention depending on nature of the engagement. Like if it is a public interest company, like if it is a listed company, their familiarity threat should not be encouraged at all. And also it depends on length of the service, how long you are continuing as an auditor of the company. That's why under Companies Act, we have the provisions of the rotation, where a firm or individual should not be allowed for reappointment after rendering certain years of service. So to protect that familiarity threat only, we have all that norms there. So like this, we have to comply with ethical requirements also. These are policies we should have in the area of ethical requirements. Now, the third aspect in which we need to have policies and procedures to maintain the quality control is in the area of acceptance and continuation of client relationship. Where in the area of acceptance and continuation of client relationship also, you need to have some policies and procedures. See, before, whenever a client approaches us, say for example, you are a practicing chartered accountant, if a client is approaching you and asking you to do the engagement, any engagement, be it audit engagement, be it review engagement, be it other than historical financial information, be it related services, If a client is approaching you and asking you to do some engagement, you are required to take a decision whether to accept that client relationship or whether to continue the client relationship. Sometimes you need to take a decision whether to accept the client relationship. Sometimes you need to take a decision whether to continue the client relationship or not. So first we should become clear when we will take a decision regarding accepting the client relationship, when we will take a decision regarding continuation of the client relationship. Very simple, my dear students. Say for example, if altogether a new client is coming to you, a client whom you don't have any interaction with, for the first time a new client is coming to you and asking you to do some engagement, then we will take a decision whether to accept that client relationship or not. Sometimes what will happen is existing client only, the client whom you are already working with or whom you have already worked with. So sometimes existing client only, he will approach you, but he will ask you to do new engagement. The client is coming to you and asking you to do new engagement. Like for example, last year I have did the audit engagement for him. Current year he is coming to me and asking me to do the review engagement. Same client. So existing client only, but he is approaching me with a new engagement. Now I have to take a decision whether to accept that new client relationship or not, new engagement relationship or not. Sometimes existing client will approach you asking you to do some existing engagement only. Like for example, last year 23-24 for one client I have done the audit engagement. For the same year, for the 24-25, for the next year, the same client is coming to me and asking me to do the audit engagement once again. So existing client only and existing engagement only, he is coming to me and asking me to do the engagement, then I have to take a decision whether to continue the client relationship or not. So whenever a client is approaching you and asking you to do some engagement for him, at various places you have to take a decision. In some places you have to take a decision regarding accepting the client relationship. In some places you have to take the decision regarding continuing the client relationship. Now, before you say yes to the client relationship, before you either accept the client relationship or before you say yes to continue the client relationship, you have to consider some factors. SQC 1 says in the area of acceptance and continuation of client relationship, before you accept or take a decision to continue the client relationship, that decision has to be taken on the basis of some on the basis of some information, on the basis of some factors. Which factors you have to consider? Like as you see here, integrity of the client, whether your client's top level management, whether your client's promoters, whether your clients those charged with governance, are they having integrity? Are they honest people or dishonest people? You need to check your own competence, not the management's competence. You have to check your competence as a chartered accountant. Are you having enough of time and resources to complete your engagement? And the third one, you need to check whether you will be able to comply with the ethical requirements. These three things you need to check before you accept or continue the client relationship as per SQC1. So tell me, what are the three matters which we will consider? Number one, integrity of the management and top level owners of your client. Number two, whether your capability, whether as a chartered accountant or as a firm, you have the capability to complete the engagement, that we call it as competence. And finally, whether you will be able to comply with the ethical requirements. Now, you will get a doubt, sir, how will I get to know? You are asking me to consider integrity. No, how will I get to know whether my clients and top level management are having integrity or not? So what matters I will consider to determine my client is having integrity or not? So here they have given a list like their reputation. What is the reputation your client is enjoying? What is the nature of client's operations? See, so for example, if your client is into real estate sector, so the nature of the business itself might be, there are many of the people might not have integrity. So like that, it depends on nature of client's operation. It depends on their attitude, what kind of attitude they are having towards auditor or towards the financial statements, towards the business, and whether they are aggressively concerned with maintaining firm's fee as low as possible. They are always concentrating on keeping your fees as low as possible. That is not a good attitude, which doesn't show their integrity. And are they putting any limitation in the scope of your work? Is there any indication they are involved in money laundering transactions? Or have you been replaced by, are you the person who is replacing the other auditor? If yes, why the previous auditor has been removed? So if you look at these factors, then you will get to know whether the client is having integrity or not. So SQC1 says before accepting the client relationship, you need to check integrity, and SQC1 is giving guidance how you can decide whether your client is having integrity or not. So these are factors you can consider. And not just that, second factor, they are asking me to check the competence, whether am I capable. If a client is asking me to do some engagement, I need to evaluate, am I in a position to complete that engagement? Am I capable person to that? Sir, how can I determine? What factors I will consider to determine whether I am competent or not? So here they have given that factors which you need to consider. Do I have the knowledge of that industry, that specific industry which client has approached me? Do I have knowledge of that industry? Do I have experience with that regulatory or reporting requirements? Did I work with that? Did I work in that kind of regulatory environment in the past? Do I have necessary capabilities and competence? That means I have sufficient personnel. Do I have enough of resources, enough of staff? Do I have experts if needed? Are they available with me? And also individuals meeting eligibility requirements to perform engagement quality control review. So in a short while we will see in some cases in listed companies I will have to do something called engagement quality control review. If I am saying yes to the audit of a listed company, do I have resources to conduct engagement quality control review? And also whether firm is able to complete the engagement within the reporting deadline. Will we be able to complete the engagement within the deadline? So these are the matters which we need to evaluate before we accept our engagement. So integrity we have to check, competence we have to check. These matters we have to check for determining integrity. These matters we have to check for determining the competence of the engagement team. And if at all any conflicts are there, between the firm and the client, before accepting the engagement only, if there is a conflict, try to resolve it. Only after resolving you accept the engagement. Sometimes what will happen is you will come into conflict after you have accepted the engagement. See, before you have said yes to the engagement only, if conflict is happening, we will try to resolve it and then we will decide whether we will accept or not. Sometimes what will happen is at the time when we have accepted the engagement, we don't have any conflict. But after we have accepted the engagement, then a conflict has come. Then some disturbances have come between the firm and the client. Then what we should do? So if possible, try to resolve it at that point of time. If you are unable to resolve it, then you determine, is it possible for you to withdraw from the engagement, and is it permissible for you to withdraw from the engagement? Yes, it is possible to withdraw and it is also permissible to withdraw from the engagement, but fulfill your professional responsibilities before you withdraw from the engagement. So this is what we are already aware of it. The same thing they will try to say here. Next one. Yeah, so once again this is the same point, withdrawal from the engagement. So if you are withdrawing from the engagement, or if you are withdrawing from the client relationship altogether, as I have told, communicate with the appropriate level of management and those charged with governance, because of what reasons you are facing, and check whether they can resolve it. In case if they are not able to resolve it, and if you feel it as appropriate to withdraw from the engagement, but let them know the reasons why you are withdrawing. And also determine whether there is any legal or professional responsibility to communicate regarding your withdrawal to regulatory authorities. Like in the case of a company, if I am withdrawing, if I am resigning from the company, I am required to file form ADT3 with the client. So ADT3 with the MCA, regulatory authority. So check whether any such professional responsibilities are there to communicate with the regulatory authorities. And even all the issues you document, what issues you have faced, what consultations you have taken, what conclusions you have reached, everything you have to document it. So these are the policies and principles which I need to have in the area of acceptance and continuation of the client engagements. Next one. So 3 areas we have covered. What policies and procedures should be there in 3 areas we have covered. Totally how many areas we have? 6 areas we have. Out of that 3 we have covered. What are the 3? Number 1, leadership responsibility for maintaining the quality within the firm. Number 2, ethical requirements. Number 3, acceptance and continuation of client relationship and specific engagements. Now comes the 4th area where you need to have policies and procedures, which is human resources. So in the area of human resources, in the area of your HR department, so basically the way you deal with your personnel, there also you need to have some policies and procedures. Sir, in which areas, when I say HR, in what areas I need to have policies? Like at the time of recruitment, you need to have some policies and procedures. At the time of offering them, deciding their compensation, deciding their salaries and packages, then you need to have some policies. You have to train them, not just recruiting and allocating them the work, give them enough of training. Career development, once they have joined with you, you should show them some opportunities for their career development. And even whether they are working properly or not, you have to evaluate their performance also. Performance evaluation also, you are required to do it. Okay. Right. So there should be emphasis on continuing professional development, not at just one point of time you have given the training and ignored it. On a continuous basis, you have to make the development of the profession. And also you have to assign responsibility for each engagement to an engagement partner. For every engagement, there should be one dedicated engagement partner should be there. And you have to identify what is the role of the engagement partner. You have to determine whether he is having appropriate capabilities, competence and authority. So just like that, to anybody, to the an article assistant, you can't make an engagement partner. So you have to make an engagement partner who is having competence, capability and who is having that authority. And responsibilities of the engagement are clearly communicated to that partner. Boss, if I am making you an engagement partner, these are all your responsibilities. You have to make them very clear about it. Next one. So engagement team also, you should make sure that they have necessary skill and competence and there are suitable people are available, and also groom them for their role. So like this, in the area of your HR department also, you need to have some policies and procedures. Now comes the fifth area where you need to have policies and procedures: engagement performance. When the engagement is actually getting performed, any engagement, be it audit, be it review, be it assurance, when any engagement is getting actually performed, at the actual performance stage of the engagement also, you need to have some policies. Which policies, sir? Like as you could see here, you need to give a briefing of the engagement team. Very important. Just like that, you can't ask the engagement team to jump and do the audit. You have to give them a briefing. Sir, what matters I have to brief? You have to tell them what is the objectives of this engagement. Tell them the processes, how they can comply with the standards. Don't just tell them we have to comply with standards. Tell them how they can comply with the standards, what process they can follow. And tell them processes for supervision and training, how you are going to supervise them, how you are going to train them, let them know, and how to review the performance, and even give them instructions for documentation, what kind of documentation they have to maintain. So before you start the engagement, have an engagement team discussion, and let your engagement team members know that what are the objectives, what is expected from them, how they can comply with the standards, what documentation they have to maintain. Give them a brief meeting there. Next, if you have any difficult or contentious matters, see, sometimes what will happen is when we do some engagements, there will be some difficult matters. Like for example, I'm doing audit of some entity. That entity is going through one big complicated legal case. So there it is a difficult matter. Even we are unable to judge it. Management is not in a position to judge the outcome of that litigation. Even as an auditor, I'm not an expert. So I'm also pretty confused whether that litigation should be shown as a contingent liability or as a provision. Very difficult matter, complicated case. So here what I should do, if there is any internal expert available, some big audit firms, they will have their internal experts who are lawyers. I will try to get the consultation with them. In case if I don't have internal experts, even you can go for the external experts, advisory services also you can get it. So whatever it is, if there is any difficult or contentious matters, you should get the proper consultation regarding it. If internally experts are available, get the internal consultation. If internally resources are not available, get the consultation from the external parties. Whatever it is, in the difficult or contentious matters, get the consultation. And there is one process called engagement quality control review. There is a process called what? Engagement quality control review. And this engagement quality control review is mandatory for conducting audit of financial statements of listed companies. In other cases, it is optional, but while conducting audit of listed companies, the process called engagement quality control review is mandatory. Sir, what is this engagement quality control review? If I put it in simple terms, see, engagement team will be there, right? Now, this engagement team is conducting audit of the client X Limited. Now they have done all the audit procedures, they have gathered all the evidence, they have formed the conclusion also. But they are about to express the opinion. They have done all the audit procedures, they have made all the judgments, they have gathered evidence, they have formed the conclusions, but they did not express the opinion yet. Just before they express the opinion, after they have done all the work, but before they express the opinion, a person called, some person should come and verify whether this engagement team has done the work properly, and he will evaluate whether this engagement team has done all the judgments, whatever judgments they have done during the course of the audit, are they appropriate or not. Before expression of the opinion, someone has to come and review the significant judgments made in the engagement. When? Not after you have expressed the opinion, before you are expressing the opinion. Once you are done with all your work, just before you express the opinion, a qualified person should come and verify the engagements, whatever this judgments, whatever this engagement team has done. That process we call it as engagement quality control review. And this engagement quality control review generally will not be a part of the engagement team. A person who is not a part of the engagement team, such person should come and conduct the engagement quality control review process. Like for example, a partner who is not engaged in this engagement team. So say for example, there is a firm ABC and Co. 3 partners are there. Out of these 3 partners, Mr. A is the engagement partner and some engagement team. So they are doing the audit of the client X Limited. Now, once this entire engagement has been done, just before expression of opinion, Mr. B, another partner who is not a part of the engagement team, he can come and do the engagement quality control review. And this is mandatory. This process must be done in the case of a listed company audit of financial statements. In other cases, it is up to the auditor's choice. And even SEBI regulations say that in the case of listed company, the person whoever is conducting engagement quality control review, that person must be a person who is eligible to act as auditor of a company. That means engagement quality control review should be done by another practicing chartered accountant. This SEBI regulation says it. Clear? And this is what this paragraph says: engagement quality control review. And Sir, you are telling in the case of listed companies, engagement quality control review is mandatory, no? And even in the SEBI regulations, they have told what matters exactly engagement quality control reviewer should check in the audit of listed companies. So SEBI regulations did not just say that in the case of audit of listed companies, engagement quality control review should happen. They have even mentioned that what exact matters are required to be reviewed by engagement quality control reviewer. So what matters exactly the engagement quality control reviewer will verify in the audit of listed companies, like as you could see here, how engagement team has evaluated independence. That means whether engagement team has complied with the independence requirements or not. He will check. Significant risk, what significant risk engagement team has identified and how they have responded to it. He will check the significant judgments made, judgment regarding sufficiency, judgment regarding appropriateness, judgment regarding sample size. So what judgments they have made, that he will verify. Where appropriate consultation has been taken, just in the previous point I have told, if there is any difficult or contentious matter, you have to take the consultation. So engagement quality control reviewer will come and check, did this engagement team face any difficult or contentious matter? If yes, did they get the appropriate consultation? And significance and disposition of corrected and uncorrected misstatements, how the engagement team has dealt with corrected and uncorrected misstatements. And also, have they fulfilled all the communication requirements to the management and those charged with governance? Like yesterday we have discussed SA 260, communication with those charged with governance. There are various matters which are required to be communicated with those charged with governance, whether engagement team has complied with all the communication requirements. Next, did they maintain proper working papers? Is every information, whatever work they have done, whatever procedures they have performed, whatever evidence they have gathered, is everything included in the working papers? And also, whatever report finally they are about to give, is that report appropriate or not? So this is very important, guys. This paragraph they have asked it for multiple times in the examination. What matters exactly engagement quality control reviewer will verify in the audit of the listed companies. Very important. Next, difference of opinion. Now, what they say here is, one main point they say here. See, sometimes differences of opinion will come between the members of the engagement team. Differences will come between the client and the auditor. Differences will come between the engagement team and the experts. Differences will come. So whatever it is, if there are any such differences, those differences should be resolved properly. Those differences should be settled down. But some cases, what will happen is there will be a difference of opinion between engagement quality control reviewer and engagement partner. There will be sometimes differences between engagement quality control reviewer and engagement partner. See, there also what will happen is both should come to one common conclusion. If there is any differences between engagement quality control reviewer and engagement partner, they should also try to resolve the matter. But sometimes what will happen is engagement quality controller is giving some suggestion. Engagement quality control says this is not something which they have to do. He has given some suggestion, but engagement partner is not following it. If there is a difference between engagement quality control reviewer and engagement partner, and if the issue is not sorted out according to the satisfaction of the engagement quality control reviewer, then that means both are not coming to one common conclusion. Both are disagreeing, they are not arriving at the common conclusion. Then what they should do is they should settle that matter as per the policy set by the firm. Generally firms will have policies. Like for example, in this firm they have a policy that if engagement quality control reviewer and engagement partner, if both are not arriving at one common conclusion, they have to go to so and so chartered accountant, senior chartered accountant, whatever he says, that will be final. So like that they have set one policy. That policy they should have followed. So very important here, this point also for MCQs and all. So if you see here, let us see this point. If recommendations of engagement quality control reviewer are not accepted by the engagement partner, engagement quality control reviewer is giving some recommendations, but those recommendations are not accepted by engagement partner, and the matter is not resolved to reviewer satisfaction. That means reviewer is not getting satisfied. Engagement partner says, no, I will not follow that recommendations. Then it should be resolved by following established procedures of the firm, like by consulting with another practitioner or firm or professional or regulatory authority. So every firm will have some kind of policy to resolve matter in these cases. That policy should have been followed. And finally, documentation they have to maintain. The time when the engagement is getting performed, you need to maintain documentation. So you have to assemble that audit file and all. If it is the audit engagement, you have to assemble that within 6 days from the date of auditor's report. And if it is any other engagement, as per the requirement of that engagement, you have to assemble it. But in case of audit, SQC 1 says within 60 days from the date of auditor's report, you have to prepare the audit file. So if you are giving multiple audit reports on the same set of financial statements, audit documentation should be kept separately for both the engagements. Sometimes what will happen is for the same financial statements, you will do 2 audits. One audit for internal purposes, one audit for external purposes. You need to maintain separate documentation for internal purposes, you need to maintain separate documentation for external purposes. Next one. And also the auditor should maintain confidentiality over that audit documentation. You have to maintain confidentiality. That documentation should be kept in safe custody, and you should have integrity. That should be accessible where whenever required you should be able to access it. You should not hide it somewhere where you can't access it. It should be accessible. It should be retrievable. In the case of electronic documentation, it should be retrievable also. You should be able to retrieve it. And particularly when it comes to engagement quality control review, these matters are required to be documented regarding engagement quality control review, like what procedures are applied by engagement quality control reviewer. Has the process been completed? Is review completed before the report is issued? Is the reviewer not aware of any unresolved matters that would have caused him to believe that the engagement team has made inappropriate decisions? That means all the matters are resolved, there are no unresolved matter. So this confirmation should be included in the documentation. And who is the owner of that audit documentation or engagement documentation? The practitioner, that is a chartered accountant himself will be the owner of that audit documentation. It is up to his choice. It is at his discretion. If he want to share the documentation, he will share it. If he doesn't want to share, he will not share it. And these documentation should not be thrown away. Depending on the engagement, there will be a retention period. Up to that retention period, you have to retain the documentation. In the case of audit engagement, the documentation should be retained for a period of 7 years. So for that long, you have to maintain the documentation. Next. And finally, just having that policies and procedures in all the above 5 areas. What are the 5 areas? Leadership responsibility, acceptance and continuation of client relationship, ethical requirements, human resources, engagement, performance. So in those 5 areas, what policies and procedures should be there, we have seen. But just having that policies and procedures alone will not be enough. Whether that policies and procedures are getting followed by the staff, is there any requirement to update them? Is there any requirement to delete any policy? Are we required to do extra training to our staff? This continuous monitoring also should happen. So basically, whatever system of quality control management has designed, is it relevant? Is it adequate? Is it operating effectively? And is it really getting complied with in practice or not? That we need to ensure it, right? Then, sir, how I can do monitoring? What can I do in order to do that quality control monitoring? What I should do? So I need to check whether a quality control system has been appropriately designed and implemented. Is there any new developments in the professional standards? And that means in the standards on audit or standards on review engagements, or in the laws and regulations, any amendments have come which require us to update our quality control policies? That you need to monitor. And even what some firms can do is they will give the responsibility of monitoring to a partner. They will decide one partner, and to that partner they will give responsibility of monitoring activity. And even they need to consider whether the firm or employees are receiving any allegations or any complaints are filed against the firm or employees. That means they might not have proper policies, so they might need a revision of the policies. And you have to take remedial actions, and when deficiencies you have found out, there also you need to take proper rectification actions. So like that, you need to just implementing the policies and leaving them out is not enough. Even you need to monitor them. Understood? So now we have SA 220. As I have told, SA 220 has been built completely in line with SQC1. The difference is, like the way SQC1 spoke about quality control in all engagements, SA 220 also will talk about quality control, but SA 220 will talk about quality control only from the audit engagement perspective. So here also SA 220 more or less says the same thing. While doing the audit also, there are 6 areas where you need to maintain policies and procedures. Same like leadership responsibility, in the ethical requirements also you need to have policies and procedures. Before accepting and continuing client relationship, you need to have policies and procedures. You need to do proper assignment of engagement teams. Nothing but, once again, this is similar to human resources only. And while engagement is getting performed, then also you need to have policies and procedures. And finally, for the audit, whatever policies and procedures you have set, that needs to be monitored. And what are the main differences here? See, in SQC1 they say, for the overall firm, CEO or managing partner should take the leadership responsibility. But for SA 220, they say for at the audit level, who should take the leadership responsibility is engagement partner should take the leadership responsibility. SQC1 says at the overall firm level, either the CEO of the firm or managing partners of the firm should take the leadership responsibility. But when I talk from the audit engagement level, the engagement partner should take the leadership responsibility for maintaining quality of that specific audit engagement. And like CEO or managing director, managing partner, even engagement partner also should highlight the importance of quality. By way of his actions, by way of his communication, he should highlight to his staff how important it is to comply with professional standards, how important it is to comply with the policies and procedures, and how important it is to give audit report, appropriate report, and you should create such an environment where people will be able to raise their fears without any concerns. So basically, this is how you need to fulfill leadership responsibility. As an engagement partner, if you go and announce before your team that I am the engagement partner, I am the leader, your responsibility is not fulfilled. By way of your actions, by way of your communications, you should highlight this information to your engagement team members. And here also we need to comply with ethical requirements. Same 5 ethical requirements will become applicable here. Here also independence will be required. Here also we need to check whether any threat to independence is there. If yes, we need to apply the safeguards, reduce it to acceptable low level. If we are unable to eliminate that interest or activity creating that threat, then we have to withdraw from the engagement. And when it comes to acceptance and continuation of client relationship, when a client has approached us, asked us to do the audit engagement before accepting or continuing client relationship, here also we'll consider the same factors: integrity of the principal owners, competence of the engagement team, compliance with ethical requirements. One more point they will add it here in the case of audit engagement. Even you need to consider significant matters which have arisen during the previous audit engagements. Okay, this one point they have added. And you need to assign proper engagement team members. For the audit, you have to assign those engagement team members who have appropriate competence and capabilities. Once again, HR related point here. And when the engagement is getting performed, then also engagement partner should have some policies, like engagement partner will have ultimate responsibility for directing the engagement team, for supervising the engagement team, even reviewing their work. And he will be ultimately responsible for the report, whatever he is submitting. He is responsible to verify whether the team has maintained proper documentation or not. He is responsible for ensuring whether the team has obtained sufficient and appropriate evidence or not. And like we have seen in SQC1, if there is any difficult or contentious matter, it is the responsibility of engagement partner to make sure in that difficult or contentious matter, consultation has been obtained or not. And finally, even in audit areas also, whatever policies and procedures that are getting implemented, those things are monitored, whether they are working effectively. Is there any requirement to change? Is there any updation required? So that monitoring activity also you have to do. Finally, your policies, your procedures, how you have complied with ethical requirements, what factors you have checked to maintain the quality, all that should form part of my engagement documentation. So documentation also should be there. So this is what two standards, SQC1 and SA 220, which is providing the guidance regarding the quality control. And between SQC1 and SA 220 also, the many times we are seeing the questions from SQC1. So I will tell you guys, this is one such this chapter should be actually an edge for you. Why? Because limited content, compulsory question. And in the recent times, we are seeing from this chapter alone, from such a small chapter, we are seeing even 8 marks of questions, 10 marks of questions also we are seeing from this small chapter. So I would suggest you, very simple only, concept wise, very easy only, will not take much of a time, provided you understood the concept. So if you just like that go and try to mug up the content, you might find very difficult. But if you understand the concept and read it, this chapter will hardly take some 1 hour to 1.5 hours to prepare, but good weightage from the examination perspective. I hope I would have I hope that I have covered comprehensively this SQC1 and SA 220. Please don't leave this chapter before you go for examination. Please do prepare for it perfectly. You will actually add the odds in your favor. Now, apart from this, they have some differences here, and also they have various other mechanisms for quality control. Like we have something called peer review board, which is constituted by ICI, which will also come into the verification which auditors are, which chartered accountants are doing the engagements properly or not. And we also have something called quality review board, which is set up by government, which is set up by central government. These are the people who are controlling the chartered accountants. They will check, they will review whether audits are happening properly or not, and also they provide guidance to the chartered accountants. And recently, recently central government has also created something called NFRA. Now these people are also dancing on our heads. So these people have also started controlling. So here and there some minute points will be there, not that important from the examination perspective. Just give one quick glance of this peer review board, quality review board, and NFRA. So what are their responsibilities, what are their powers, whom they can control, whom they can review. So like little bit of small information they will give it here. Just have a look at that information once. Okay. So that's all. Quality control has been completed. Now, we are going to hit the next most important chapter from the examination perspective, which you guys all might have been waiting for, which is professional ethics. Professional ethics and liabilities of the auditor, that we will try to do the revision now. Yep, perfect. So now we will try to do the professional ethics and liabilities of the auditor. This chapter we will try to revise Very, very important from the examination perspective. Very easy also. Okay, guys, are you all there with me? Right. Okay, so now we will try to do a chapter called professional ethics and liabilities of the auditor. Very, very important from the examination perspective. So we will try to spend some time here on this chapter. Why? Because as I have told you, good weightage from this chapter, and you all might already been well aware of the provisions. So I will try to cover all the important points from where that minute details which students will miss, from where the questions are going to come from. So all that things we will try to cover it. So here we have different parts, like we have one section where it will talk about code of ethics. We have one section which is going to talk about threats. So we have one section which is going to talk about something called NOCLAR. Then we have a section talking about members of the institute. We have a section talking about chartered accountants in practice. And then we have maintenance of branch offices. We have one section. Then after that, corporate form of practice. Then we have misconducts. Then we have misconducts and all. So like that, different parts of the chapter are there. So we will try to revise quickly, comprehensively, everything. Everything we will try to revise it in a quick manner. Right. So we will start with code of ethics. Sir, what is this code of ethics? So just now, as I was saying, even in the quality control chapter also, as I was saying, see, being a chartered accountant, society is having a expectation on us. Society is believing our work. Society is trusting our work. And as I was saying, people are forming their decisions on the basis of the work which we have done, on the basis of outcome of our work, on the basis of the reports which we give, on the basis of the conclusions which we express. People are going to base their economic decisions, and people are going to base their financial decisions. So that's why, as a chartered accountant, it is expected from us to comply with some moral values, ethical values we are required to comply. So as a part of this compliance with the ethical values, see, what is basically ethical values? What are basically ethics? Some moral values which you are supposed to have. If someone is believing you, it is your moral responsibility to maintain that moral values. Like for example, if I give you one simple analogy to make you understand, see, take the medical profession. Medical profession is a very noble profession. We all are aware of it. And since in the medical profession, the patients comes to the doctor and disclose all their health conditions and all. So don't you think when the patient is coming to the doctor and disclosing all his illness, his health profile and all he's sharing with the doctor, don't you think doctor is required to maintain the confidentiality on the patient's health or physical well-being or mental well-being? Yes, that is expected from a doctor. Why? Because people are believing you, people are believing in a doctor, they are coming to you and they are sharing with you all the problems or all their illness and their physical and mental condition. So it is expected, it is minimum expected from the doctor to maintain that confidentiality of the patient's records or mental or physical well-being. So this is something, this is one of the basic moral value which is expected from the doctors, that I call it as ethics, ethics of the doctor. In the same manner, we chartered accountants are dealing with the people in the society. We also do audits, we file their tax returns, we file their GST returns, we do the financial planning for them, we do the tax planning for them, we help them in their investment decisions. So like that, we are offering many services to the society. So people will come and disclose their financial position, their assets, their liabilities, their business. So everything they will come and disclose. It is expected from us when people are believing and sharing all their information with us. It is somewhat there is somewhere a moral responsibility on us to comply with the ethics. And all the ethics which we are required to comply, all the moral values which we have to comply, for giving the guidance on that to make this to make the chartered accountants responsible for their acts, ICA has released a document called Code of Ethics. ICA has released a document called Code of Ethics. Basically, Code of Ethics is nothing but a document, a booklet which is released by the ICA, which will contain the list of ethical values or moral principles or some fundamental principles which every chartered accountant must comply with. So like that, we have a document called Code of Ethics, which chartered accountants are required to comply with. Okay. See, but before I can talk about this Code of Ethics, I have to concentrate on a few things. See, membership of the institute. So first I will start with membership of the institute. Say for example, you are all students. Till now, you are all students. You are all identified by our ICI, by our parent entity, which is ICI, as a student. But once you are qualified, once you give your CFN examination, once you clear your CFN examination, you still have to come under the surveillance of the ICI. But how the ICI will identify is, ICI will identify us as a member. Till the time you are a student, till the time you don't qualify your CFNL examination or you don't complete all that other courses which ICI is expecting from you, like orientation, something will be there, right? Advanced identity and all. So till the time you complete all that educational qualifications, you will be recognized by ICI as a student. But the moment you qualify your CFNL examination, still ICI wants you to come under their surveillance. And how they will bring you under their surveillance is, once you qualify your chartered accountancy examination and once you fulfill all the requirements, you have to make a member, you have to make an application to the ICI. Sir, I have qualified my CFNL examination, I have completed my articleship, I have completed my advanced identity and all that other courses, whatever you have asked me. So now I become eligible to be called as a chartered accountant. And ICI will maintain something called a register of members. ICI will have one register. In that register, they will maintain the details of all the members. After your qualification, even if you want your name to be entered inside that register of members, you have to make an application to the ICI along with the payment of the prescribed fees. After fulfilling all the eligibility criteria, submit an application to the ICI, and if ICI is satisfied, they will enter your name in the register of members. They will enter your name in the register of the members. Sir, you are telling ICI is having the register of the members, no? In that register of members, what and all particulars will be maintained? What and all particulars will be included? So in the register of members, what and all particulars will be included is, they will for each and every member, they will maintain the details of their full name, their date of birth, their domicile, that is country of origin, residential and professional address, date of entry, when that name was entered in the register of members, what are their qualifications? Generally, you will be a chartered accountant. But apart from that, do you possess any other qualifications? So the details of that other qualifications, whether member holds a certificate of practice, and any other prescribed particulars, whatever they might deem fit, all that details will be maintained for every member in the register of members. Okay, next. Okay, sir, once I become a member, okay, I have qualified my chartered accountancy, I have got my name entered inside the register of members, and even ICI will give you a registration number also. Membership number we will give you. Okay, sir, what after that, what I am supposed to do? See, we all are putting this effort, we are going through all this struggle, we are qualifying the examination to get that CA degree. For what sake? For the sake of charity? Definitely not. So we have put all this effort, we have gone through all this to make a living in this society, right? To make the money, right? So once you become a member, now you have two options to make the money. One is go and attend interviews for the company, get selected in the company, join in that company, they will pay you monthly salary, life is sorted. You will be called as chartered accountant in service. You will be called as chartered accountants in service. See, at various places in the chapter, throughout this chapter, at some places they use chartered accountants, at some places they use professional accountant. Both mean one and the same. Okay. So various places they use chartered accountants, various places they use professional accountants, both are one and the same. So once you have got your membership number, you have given your you have attended some interview, some company selected you, they are recruiting you, paying you some monthly salary. Now you will be called as chartered accountant in service, or you will be called as professional accountant in service. Now, other option for making money. What is other option for making money? You don't want to join with any company, you want to have your own business, you want to do your own audit files, you want to help your own clients, you want to have your own client base. Then what you should do is, you will set up your office and you start naming yourself as a chartered accountant, and you start calling your clients, boss, I am ready to offer tax services, I am ready to do audit services. So like that, you will start offering services to the society. But if you want to offer the services to the society, just like that, you can't do it. You need to make one more application to the ICI, pay some extra fees, then ICI will give you something called a certificate of practice. Once you have the certificate of practice, then only you can start running your office. Then only you can start doing your practice. So if you are a chartered accountant, once you become the member, you made an application for the ICI and got that certificate of practice from the ICI. then you will be called as practicing chartered accountant, or even chartered accountant in practice or professional accountants in practice. Everything means one and the same. Clear? So on the basis of their nature, on the basis of the services, or if I put it this way, on the basis of the field which they have chosen, the chartered accountants can be broadly divided into two categories: chartered accountants in service, chartered accountants in practice. Able to understand? Right. Then, okay. So we have seen what will be the particulars. Once you become the member, what will be the particulars of what details will be maintained. And there are some cases where a person will be disabled from becoming a member. Some persons cannot become a member of the ICA. Some person's name will not be entered in the register of the members. Which means what? You qualified CA final examination, you completed articles, you have completed that all other miscellaneous courses, but still, even you qualify all these things, even if you submit the application to the ICA, still you become disabled for the purpose of getting your name entered in the register. That means ICA will not enter your name in the register of the members. Sir, what are the disabilities? What are the circumstances which makes a person disabled from having his name entered in the register of members? The list is there here. So what are the disabilities? He has not attained the age of 21 years. So ICA told, we don't want kids and bachas. So they create a lot of nuisance. So let us do one thing. We will set an age limit. At the time when you are making the application, you should have completed 21 years of age. Then only, sorry, you should have attained, not completed. You should have attained an age of 21 years at the time of making an application for ICA. And if a person is of unsound mind, as we all are aware, if the person is of unsound mind, he will not have any capacity to contract, and he's of unsound mind and stands so adjudged by a competent authority. If people are calling you unsound mind, that is not the disqualification they are saying here. A person should be unsound mind as adjudged by a competent court. That means some competent court should have given a judgment that this person is of unsound mind, then only will be disqualified. If I call some person an unsound mind, I say will not stop that person from entering his name in the register of members. So a person should be declared as unsound mind by a competent court. Next one, if a person is undischarged insolvent, he is insolvent but he is not yet discharged. That means court did not pass a discharge order. If he is an undischarged insolvent, then also you become disabled. And also, if a person is discharged insolvent, court has passed an order that okay, this person's insolvency proceedings are completed. A person is discharged insolvent, but if you have not obtained a court certificate stating that insolvency has been caused purely because of your misfortune, and that insolvency was not happened because of your misconduct. See, sometimes because of some circumstances beyond our control, people will become insolvent. Like a person has started a business, the business did not go well because of industry or because of changes in competition, etc. If the person has gone bankrupt, that is purely out of his misfortune. Another person is there, he has started business, he has taken loans from the company, but instead of using it for business purposes, he started spending on his lavish and luxury lifestyle. That's why he became insolvent. Then that insolvency has been caused by your misfortune. So if you are discharged insolvent, but if you did not get the certificate from the court stating that your insolvency was because of misfortune, not because of your wrongdoings, then also ICA will not enter your name in the register of members. That means if you are discharged insolvent, but if you still want your name in the register of members, you should go to the court, get a certificate stating that your insolvency was purely because of misfortune. If you get that certificate, you become eligible for entering your name in the register of members. Next. Or if you have been convicted by a court, that means some court has convicted you, not just allegation. Court has passed an order. For what purpose? Either within India or outside India. So if you have been convicted by a competent court, some competent court has passed an order against you that you have committed an offense involving moral turpitude, like you have committed some murder, you have committed some moral turpitude offense, and you are punished with imprisonment. You must be punished with imprisonment, then only disqualification, then only disability. If a person is convicted by a competent court of an offense involving moral turpitude, but he was only punished with a fine, no disqualification. A person will become ineligible to enter into the register of members only when he is convicted by a court of an offense involving moral turpitude and he should have been punished with imprisonment. Then only you become disabled. Next one. Or he has been convicted of an offense which is not of technical nature. That means fraudulent acts he has done, not technical error, some big collusion fraud which he has done in his professional capacity. So if a person has been convicted of these offenses, then also you will not be eligible for having your name entered in the register of members unless you have been either granted a pardon. you have got a pardon, or you have made an application and the central government by in writing they have removed the disability. Either you should have got a pardon or you should have made an application to the central government and they have passed an order removing the disability. So then only your name will be entered. Then if he has been removed, if from membership of the institute on being found on inquiry to have been done some professional or misconduct, or you have done some professional misconduct, or you have done some other misconduct. But what is other misconduct, what is professional misconduct, that we will see it in the subsequent part of the chapter. But if you have done, for the time being now, I want you to remember, if you have done any professional or other misconduct, then also your name will be removed from the register of members. Next. So sometimes what will happen is ICA will pass an order removing you for a specified period. They will say that for 3 years you can't, for 3 years they are suspending you as a member. Now for until that 3 years you can't have your name entered once again in the registrar. Okay, next. And if the ICA comes to know that failure to disclose any liability, any disability continues professional misconduct. That means at the time you are making an application for becoming a member, you are actually facing disability. Say for example, you are convicted by a court, but you did not disclose that information. You hidden that information and got that certificate and got your name entered in the register of members. Later, if the council comes to know about it, then they will treat it as professional misconduct. Once again, they will remove your name from the register of members. Clear, everyone? Right. So these are the disabilities when a person can't become a member. But whatever it is, we can further classify members into two categories. We can further broadly divide members into two categories. This I will say depending on your years of experience. So depending on our years of experience, we can broadly divide the members into two more categories. One is associate member, other one is fellow member. Sir, what is associate member? The moment your name is entered in the register of members. The moment your name is entered in the register of members, you become a ACA, Associate Chartered Accountant. Now, after you have become ACA, once you become a member, and if you are for 5 years of continuous practice, if you are an associate chartered accountant and if you are into 5 years of continuous practice, then you have to make one more application to the ICA. ICA will recognize you and change you from ACA to FCA, fellow chartered accountant. You will be called as fellow chartered accountant, and after your name you can use a designation FCA. Or in some cases you are an ACA but you are not into 5 years of continuous practice, but ICA feels that you have done some other work which is equivalent to 5 years of practice, or if you have some prescribed qualification which ICA, if it feels fit that it is equivalent to 5 years of practice, then also they can convert you from ACA to FCA. So either you should be ACA and 5 years of continuous practice, or you are not into 5 years of continuous practice, but if the council feels that you have such an experience which is equivalent to 5 years of practice or which is equivalent to 5 years of qualification, then ICA also will enter, then also they will convert you from ACA to FCA. So like this, depending on the years of experience which a person is holding, the members can be broadly divided into two categories, ACA and FCA, Associate and Fellow. Next, removal from register. See, once your name has been entered in the register of members, that name can be removed also. That name can be removed from the register of members also. Sir, when the name will be removed from the register of members? If a person is dead, if you are a if there is a person who is a member of ICA, if he is expired, no longer his name will be kept in the register, his name will be removed. Or the member himself is making a request, sir, I no longer want to continue as a member of ICA, please remove me from the register of members, then also they will remove your name. They can't forcefully keep any person as a member. And if he fails to pay the prescribed fee, see, as I've told, membership of ICA is not free of cost, you need to pay for that. And if you don't pay the fee for membership, then also your name will be removed. And if he becomes subject to any disability after you have become a member, see, at the time of becoming a member, you don't have any of this disability, but after you have become a member of ICI, and if you have attracted any of the disabilities which we have read above, then also your name will be removed. And council must remove a member's name if an order been passed from, if council has, sometimes in extreme cases, council also will pass an order stating that this person's name should be removed from the register of members, then also they will compulsorily remove your name. And yeah, this point I will try to say, payment of fees. Say for example, you are a member, okay, so 1st of April is there. See, generally you are required to pay the membership fees by 30th of September. You are required to pay the fees. Say for example, financial year 24-25. For this financial year, you are required to pay the fees by on or before 30th of September. So if you don't pay, the government will, the ICA will wait for some time. If you are not paying the fees within prescribed time limit, then what ICA will do is they will remove your name. They will remove your name if you don't make the payment of the fees within the prescribed time limit. But after, if you make the payment, after you have realized your name has been removed, and then you realize that okay, I forgot to make the payment, and if you make the payment once again, payment and arrears and all, if you make the payment, then your name will be restored. Your name will be restored. And ICA has given even one more relaxation. If you are making an application and clearing your dues before the end of the financial year, before 31st of March, the year in which your name has been removed, before the end of the financial year, if you make an application and make the payment of the prescribed fees, then ICA will restore your name retrospectively. ICA will restore your name retrospectively. Say for example, let us have an understanding with the help of dates. So 1st of April 2025, you are required to pay the fees. Say for example, you did not make the payment of the fees within the prescribed time limit. So what ICA has done is on 15th of October, so 1/4/2024, we will make it. Okay. On 15th of October 2024, your name has been removed. So later you realized and decided to make the payment. So what is the end of the financial year, 31st of March 2025? If you realized it and made the payment here only, say for example, on 31st of January 2025, you realized and made the payment of your pending fees. Along with that, you have also made an application. Now your name will be restored, but they will restore it retrospectively. That means from whatever name they have removed, from whatever date they have removed your name, from that date itself, they will restore it. Okay. Now, say for example, if I did not realize it here, I realized it on 10th of April 2025, then I made the payment and made the prescribed fees. Then what will happen is your name will be restored, but it will be restored from the date of payment only. From here only your name will be restored. That means from 15th of October till 10th of April, your name will be removed. You are no longer a member from 15th of April. From 15th of October till 10th of April, your name, you will be not considered as member. Able to understand? So that restoration point is very important here. That's what even they try to say. So if you come here, restoration, effective date of restoration. From the removal date, if application and fees are made within the same year, that means retrospectively, from whichever date your name has been removed, from that date itself, your name will be restored if you make the payment and submit the application within the same year. Okay. In other cases, from the application and fee receipt date, like I've told, if you are making the payment after that end of the financial year, prospectively only they will restore your name. Sometimes your name will be removed as per the orders of the Board of Discipline, Disciplinary Committee, Appellate Authority or High Court. In that cases, in that order only they will mention this person's name will be removed for 3 years, 4 years, 5 years or till that date. If your name has been removed because of order of Board of Discipline, Disciplinary Committee or Appellate Authority or High Court, according to that requirements of the order, they will restore your name. Okay, next. Penalty for falsely claiming to be a member. That means you are not a chartered accountant, you are not a member only, but you are using the designation chartered accountant. You qualified CA final examination, but you did not submit an application. Your name is not yet registered in the register of members, but still you are using the designation chartered accountant. You will be liable for penalty. See, this is what mistake we generally students do. The moment CA final results will get announced, what you will do, guys, what you will do is you will open the WhatsApp, open the status, or you will open the Instagram and post a story from today, your name below chartered accountant. You will write no, you will post that stories and all kind of thing. You are actually committing a misconduct there. Do you know it? So you should not do. Why? Because you are permitted to use a designation chartered accountant only after you become a member. But anyhow, ICA is not noticing it. So they know the excitement of the students, they know you are all hard work and all, and they are ignoring you. But literally, even I have committed this mistake. So the moment we qualify, we will not become eligible to use a designation chartered accountant. We become eligible to use a designation chartered accountant only after we have, only after our name has been entered in the register of members. So if ICA comes to know that a person, even though he is not a member of ICA, but he's using the designation chartered accountant, a person he is not having certificate of practice, but he claims to everybody that he is into practice, on first conviction they will charge 1,000 rupees nominal penalty, they will charge and ignore it. Subsequently, that means you are paying the 1,000 rupees penalty doing that kind of activity again and again. So then what they will do is they can put you in jail for 6 months. That means they can offer imprisonment for 6 months, or even they can charge the fine up to 5,000. Okay, fine 5,000 is okay, but sometimes you might have to face the imprisonment also. You have to go and sit in jail also. So we have to be very careful. So these are the penalties for falsely claiming to be a member. So whatever it is, the moment you become a member, either you could be a chartered accountant in service or you could be a chartered accountant in practice, you all are bound by ICAI regulations. The moment you are becoming a member, that's all. Your time has started now. You will be under supervision. You will be under surveillance of the ICAI. You are required to follow regulations. You are required to follow act. You are required to follow code of ethics. All that things will come and apply here. Okay. So since we understood the provisions relating to membership of the institute, now let us see what are the code of ethics which we are required to follow. Okay. So once we become a member of ICAI, either we are in chartered accountant in service or we are in chartered accountant in practice, we are required to comply with a document called code of ethics. So we have something called overview and structure of the code, not that important from the examination perspective. Just have a look and ignore it. Like in this code of ethics document, there are different parts. There is part 1, which will give you the brief overview and conceptual framework. There is part 2 of the code of ethics, which contains rules and regulations which are applicable for professional accountants in service. There is part 3 of this code of ethics, which will contain the rules and regulations which are applicable for professional accountants in public practice. Then we have part 4, which is talking about independence standards. Then finally we will have glossary. So like that, 5 parts will be there. Part 1 will contain overall view and conceptual framework. Part 2 contain rules which are required to be complied with professional accountants in service. Part 3 contains rules which are required to be complied by professional accountants in public practice. Part 4 contains information regarding independence standards. Part 5 contains glossary. And if you look at the code, if you actually download that code of ethics and see it, in every section you will find 3 parts. There will be something called introduction. That means for every section you will have introduction. For every section you will find requirements, and for every section you will find application material. That means each section will be divided into 3 parts. They will tell you introduction, they will introduce that matter. Then they will tell you requirements, what is expected from you, what are obligations, and they will also give you application material. That means for that section, if they need any extra clarification, extra explanations, that they will give it by way of application material. So whatever it is, for every section we will have 3 parts: introduction, requirement, application material. And here comes the most important point: code of ethics every professional accountant must comply. Whether you are chartered accountant in service, whether you are in chartered accountant in practice, you must comply. It is mandatory. It is not optional. If you want to be recognized as a member of the ICAI, you must comply with the code. And sometimes what will happen is laws and regulations will say something contradicting with the code. If there is a conflict between laws and regulations and the code of ethics, which one should prevail? Which one should prevail? Very important for MCQs. Very important for MCQs. They might ask an MCQ question from this. Sometimes what will happen is laws and regulations prevent compliance with certain parts of the code. That means there is a conflict between the requirements of laws and regulation and the requirements of code of ethics. So now you tell me which one will prevail. Which one will prevail? So the code of ethics say, the rules say that laws and regulations will prevail over the code of ethics. There is any conflict, which one will prevail? The laws and regulations, whatever mentioned in the requirements of laws and regulations, that will prevail, that you have to follow. The code will not prevail, which will have a superior hand between laws and regulations and code of ethics. Laws and regulations will have a upper hand. So this is one important note point from the examination perspective. Now comes the important part here. Okay, so from this code of ethics, in the entire document of code of ethics, the most important thing which we professional accountants must comply with is fundamental principles. There are a few aspects called fundamental principles which every professional accountant, which every chartered accountant, whether in service or whether in practice, must comply with. So there are 5 such fundamental principles. We have already seen it just now. If you remember, in SQC1 I have already introduced it to you with the name of ethical requirements. So they in various ways they use the phrases. Sometimes they use the phrase ethical requirements, sometimes they use the phrase fundamental principles. Everything refers to one and the same. And how many such fundamental principles or ethical requirements are there? 5 such fundamental principles and ethical requirements are there. So what are that 5 such fundamental principles? Integrity, objectivity, professional competence and due care, confidentiality, and then finally we have something called professional behavior. Okay, so important from the examination perspective. So let us try to have a quick look at it. So every auditor, every chartered accountant, whether in service or whether in practice, is required to comply with this 5 fundamental principles. So repeat everyone, what are the 5 fundamental principles? Integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. And as you could see in the code of ethics, if you open subsection, which subsection talks about that ethical requirement, that also we have included here. Now we will take up each ethical requirement, each fundamental principles, and we'll try to understand. Sir, what do you mean by integrity? So integrity means the chartered accountant, the professional accountant must be honest, he must be straightforward, should ensure fair dealing, and he should be truthful. These are the basic qualities which are expected from a chartered accountant. So he should be honest person, he should be a straightforward person, he should do the fair dealing, no inappropriate dealing, and also he should be truthful. And integrity specifically says that as a professional accountant, you should not associate with such information which is false or misleading. Knowingly, you should not associate yourself with such information which is false or misleading, which you know that has been negligently provided, or which omits or obscures essential information. That means you know that in that information some essential things are missing. If you know it well in advance, you should not get associated yourself with that information. Just give me 1 minute, let me charge. Yeah. So knowingly false, or you should not get as a chartered accountant, as a professional accountant, you should not associate yourself with such information that is false, misleading, negligently provided, or omits or obscures essential information. But however, after accepting that engagement, if you got to know that there is a false information, negligent information, or omitting some information, in that cases you should have given a modified report. Then you will not be deemed as guilty. If you have given modified report, okay. But if you know it well in advance, don't accept it. After accepting, if you got to know about it, then you should have given a modified report. And in some cases, what you should do is you might require to get disassociated. In some cases, you might require to withdraw from the engagement after you have got to know about these kind of things. In extreme cases, you have to even withdraw also. This is what the integrity principle says. Then we have objectivity. So objectivity is very simple to understand. So what do you mean by objectivity is you should avoid all kinds of bias, no partiality, nothing. You should avoid all kinds of conflict of interest, and you should not come under undue influence. So you should not change your decisions according to others' influence, especially management or those charged with governance. Under their influence, you should not be changing your decisions. And you should not engage in those activities which affect your professional judgment. If you feel that because of accepting a relationship, your professional judgment might get impacted, those relationships you should not engage into. So this is what objectivity is expected from you. Then coming to the next point, professional competence. The name itself says competence. As a professional, whatever engagements you are doing, you must make yourself capable. You must make yourself competent. And whatever engagements you are doing, that you have to do it with utmost care, which we also call it as a diligence, also we call it. So whatever engagements we are doing, first it is our responsibility to make ourselves competent, capable, because we have to provide relevant services to the client. We have to provide the best services to the client. In order to provide the best services for our clients, first we must become competent. Sir, how we must become competent? By keeping the knowledge current, by keeping your knowledge updated. Like if any amendments are coming, make yourself educated. If any new standards are getting introduced, get yourself educated. Changes happening in the industry, get yourself educated. So you have to keep your knowledge current and updated, and you have to act diligently. Diligently means what? With utmost care you have to do the engagements. And also, you serving the clients require sound judgment. You have to use your best judgment while serving your clients. And you have to have continuous awareness of developments. Like as I've told, amendments and all, you have to have continuous awareness of words. It's not something like you have read something and ignored it and left it. It is not like that. Say for example, if you are reading the GST now, see, I can't tell you how many number of GST amendments will come. Every time GST meeting will happen, every time GST council meeting will happen, they will come up with new circulars, they will come up with new notifications, they will come up with new sections. So don't you think once you qualify, you should update your knowledge on this circulars, notifications and all? Yes. So that is what they say, continuous awareness of the developments. And when I say diligence, that means careful, you should be very careful. Timely performance, within the time as promised to the client, you have to complete your engagements. And not just you must be updated. See, for example, if I am a owner of the firm, if I am the engagement partner, if I am getting educated, that alone will not be enough. Even the people who are working under me, I should also train them, I should also supervise them. And accountants must inform the clients of their limitations. This is something which is expected from you. As we all are aware, if you are doing especially audit engagement, we all have read at CA inter level that so our audit suffers from some inherent limitations, which means no matter how effectively we have done the audit, there are always a chances that some misstatements might not be identified. Yes or no? So this is a thing you have to communicate it to your clients. Boss, these limitations we are suffering from because of those circumstances. So you can expect only from us reasonable assurance. You can't expect from us guarantee. So this is what expected from you when it comes to professional competence and due care. Then comes the most important fundamental principle, which is confidentiality. So as I was saying, client will put the trust on you, client will believe you, and he will share his information, not personal information. He will share all his financial related data. And as you generally watch it in the movies, to the chart accountants, they will disclose all their binami transactions, all their black money transactions, all their shell companies. This information, this information generally will be disclosed to the chart accountant. So they say, you might have heard that you should not hide anything from doctors and lawyers. You might have heard it. I will add one more thing to the list, that you should not hide anything from chartered accountants also. Why? Because if you let the chartered accountant, you should not hide anything means not your personal affairs and all. When it comes to your money related matters, you should not hide anything from the chartered accountant. Why? Because if you let him know, if you let the chartered accountant know your financial holdings and all, then only he can then only he can help you to protect you, right? So that's why people will disclose everything. So when the people are believing you and disclosing the information to you, the thing which is expected from you is confidentiality. So as a chartered accountant, you must respect the confidentiality. At all times, you have to respect the confidentiality. And here they say very interesting things here. You should not disclose your matters even in the social settings also, not just to your business friends and all. Sometimes what will happen is, without our knowledge, in our social gatherings, in our family functions also, we keep on talking about our clients. That you should not do it. So even in your social settings also, you should not disclose. You should maintain confidentiality. And maintain confidentiality within the firm. Inside the firm also, you have to maintain the confidentiality. And prospective client, if some client is about to, if some person is about to become your client, even for that prospective client also, you have to maintain confidentiality. And unless legally required, that means if it is legally required, you have to disclose. Unless legally required, without authority from the client, you should not disclose the information. And not just disclosing, you should not use the client's information for your personal advantage or for your relatives advantage, for your friends advantage. Here they are referring to that insider trading options. Insider trading will happen. No, sometimes while doing audit, you get to know about the internal information of the client. So even that also you should not communicate. Even that also you should not use it for your personal advantage or your relatives or known person's advantage. And not just when that person is your client, even after the client relationship has ended, then also maintain the confidentiality. Not just when the person is your client, you have to maintain confidentiality. Even after the relationship has ended, even after the client relationship has ended, then also you should maintain the confidentiality. And you ensure that people who are working under you also should respect confidentiality. If I have a firm, not just me, even the staff under me also should maintain the confidentiality. So at all times, at all circumstances, in all places, you have to respect the confidentiality. Not just that, in some cases you might be required to disclose. Sometimes you have to breach the confidentiality. Sir, when I am required to share the information regarding my client? Number one, when it is required by law, when there is a mandatory requirement from law or regulation to share, you have to share it. Or when it is not mandatorily required by law, but it is permitted. It is not obligation from the law, but it is permitted from the law to share the information. If that is the case, you can share it only after getting the approval, authorization from the client or your employing organization. Or there is a professional duty. Sometimes there will be a professional duty, or there is a right for you to disclose the information. In those cases only you have to disclose. So three cases they say where you are required, where you can disclose the client information. Number one, when it is required by the law. Number two, when it is permitted by the law and you have approval of the client. Number three, there is a professional duty or right to disclose it. Next, factors for disclosure. If at all, in these circumstances, because of these circumstances, if you are disclosing the client information, before you are disclosing, what factors you have to consider is there should not be any potential harm. From disclosing that information, no one should face any potential harm. Or before you disclose that information, have you known complete information? See, only when you get the complete information, then only you share it. Half-baked information you should not disclose. And what type of communication and who is the recipient? You have to pay attention. Who is that recipient to whom you are sharing the information? And even appropriateness of the recipient. Is the recipient to whom you are sharing the information, is he appropriate? And this point I have already covered. Not just when you are doing some kind of engagement for your client, even after the client relationship has ended, then also you have to respect the confidentiality and maintain the confidentiality of the client. Next. So this is what regarding fourth ethical requirement or fundamental principle, which is confidentiality. Now let us come to the next part, professional behavior. The last fundamental principle is professional behavior. Basically, you have to comply with professional behavior. That means whatever work we are doing, whatever engagements we are doing, that we have to do it after complying with the laws and regulations. We should not engage into any activity which is a discrediting or which is bringing disrepute to the profession. We should not engage into any activity which brings a bad name for the profession, that we should not do. And accountants must not engage in any activities with relating to integrity, objectivity, or reputations. And few other things which you have to take care, like you should avoid exaggerated claims about your services. Like we should not do unnecessary advertisement, which anyhow we will see it in the misconduct things, we will see that. So you should not make exaggerated claims, no unnecessary false claims you have to make. You should not make unsubstantiated comparisons with the fellow chartered accountants. That means you should not go to the client and say, I'm better than so and so chartered accountant, the other chartered accountant is a waste fellow. That kind of unsubstantiated comparisons you should not do. If at all you are doing advertisement, you have to comply with the council guidelines. We'll see it in a short while, what are that advertisement guidelines. And in case if you are permitted to do the advertisement, that advertisement should be truthful, and the institute is not responsible for any of your content. And you must comply with, in case if you have any doubts regarding advertising, you have to consult with the ethical standards board. So advertising is a very complicated area when it comes to the chartered accountants, especially who are into practice and all. So all that we will see it in the schedules. Now, sir, with regard to that fundamental principles, sir, you told 5 fundamental principles are there, no? Integrity, objectivity, professional competence and behavior, professional competence and due care, confidentiality, and professional behavior. Now, what is the responsibility of the professional accountants with regard to this 5 fundamental principles? Is it optional for them, or is it mandatory for all of them to comply? So they say that it is mandatory. So if you read the phrases here, accountant must comply, compulsory, 100% you have to comply with this ethical requirements. It is not something an option given to you. It is a forcefully imposed on you. You have to comply with ethical requirements, whether you are into practice or you are into service. If at all any conflicting position you have come into, sometimes they are in a conflicting position. Complying with one fundamental principle is violating another fundamental principle. In those cases, you can get the consultation. Sir, whom can I consult? Others within the firm. If within your own firm there are any seniors, you can consult them, or you can consult with those charged with governance of your client, or even you can go and consult with the institute. I say you can write it, sir, I am having this conflict, what I am supposed to do. Or even you can go and consult a legal counsel. If you have, if you need any legal advice, you can go and consult the legal counsel also. And however, just because you get the consultation, it will not relieve you from resolving your conflicts. So just you are getting the consultation, that doesn't mean your responsibility has been wiped off. Still you are required to fulfill all your responsibilities to resolve that matters. And how you have faced that issues, what discussions you had, how you have arrived at the decisions, and on what logic you have taken the decisions, everything should be documented. So this is what the professional accountant's responsibility regarding the fundamental principles. Now what the ICA has done is, ICA has identified various threats to the fundamental principles. What ICA has done, ICA has identified various threats to the fundamental principles. So they have identified certain circumstances which are considered as threat to fundamental principles. So what do you mean by circumstance being a threat to fundamental principles? Which means that these are the circumstances which have a risk of violating the fundamental principles. When I call something as a threat to fundamental principles, what do I mean by that? So when I am calling a circumstance or an event as a threat to fundamental principles, so those circumstances, those events have a potential of violating the fundamental principles. Able to understand? So that's what they say here. And what ICA has done is, whatever threats are there, whatever circumstances which have a danger for a professional accountant to not comply with the fundamental principles, those threats they have identified into 5 categories, which are self-interest threat, self-review threat. Sorry, this name I have not changed. This I will make the correction. This is an advocacy threat. This I will change it in the file. So advocacy threat. Then we have something called familiarity threat. Then we have something called intimidation threat. So like this, ICA has classified the threats into 5 categories. What are the 5 categories of threats, everyone? The 5 categories of threats are self-interest threat, self-review threat, advocacy threat, familiarity threat, and intimidation threat. See here, definitions are not the major thing, examples are the major thing. So if you come to the main material here, so this is the main material actually. So if you come to the main material here, yes, for the threats they have given examples. Going through these examples is very important. So my humble request will be, you have to go through these examples. Why? Because from these examples they can frame the MCQs. I have included every example, I have included in my main material. I have already told you in the beginning itself, this concept notes you can download it from the website free. Of course, I'm not charging you anything from you, so you can download it, and I can say comfortably that this is one such concept notes which has not diluted the substance of the ICA material. I did not change the terminology, I did not skip any information, just I have presented in a structured format in the best possible manner which I can. Because if you are missing on the ICA resources, you are doing a grave mistake. So you can compare the content with the ICA study material. I am telling you, you will not find anything which has been missed from this concept notes. So I can say blindly you can go with the concept notes. You can blindly go with it without any second thought about it. Okay. So here the examples are going to be very important. I will explain the meanings now quickly, but it is your responsibility to go through that examples once. So number one, self-interest threat. Sir, what is self-interest threat? When these threats occur, these threats generally occur when the professional accountant is having a financial or other interest that will influence the professional accountant's judgment. So if you are having some kind of financial or other interest either in your client or employing organization, that is definitely going to have an impact on your judgment. Like you are holding the shares in the company, you have given the loan to the company, or you have taken the loan to the company. Since you are deriving a financial interest from the company, definitely there is a possibility on not complying with the fundamental principles. Your objectivity might be compromised here. So that kind of threats, I call them as self-interest threats. Then I have something called self-review threat. See, sometimes what will happen is, in one engagement, you are reviewing the work which has been performed by either yourself or by your team member. Like for example, one of my engagement team member has provided the accounting services to my client. The same client is asking me to do the audit engagement also. But that will result in reviewing my own work, right? So that kind of threats we call them as self-review threat. Like examples for this will be, I have been a director of the company. The same company is appointing me as an auditor. Or I have provided accounting and bookkeeping services for the client. The same client is appointing me as an auditor. So these are the examples of the self-review threats where I am reviewing my own work. The name itself says self-review. You are reviewing yourself. So threats that when the self-review threat will occur is threat that a professional accountant will not properly evaluate the results of a previous judgment or activity which has either been performed by themselves or other within their own firm or organization. Either you yourself have done one task or one of your team member has done that task. Now you have to review the same thing. So then the self-review threat will happen. Then comes the next threat, which is advocacy threat. Advocacy threat generally occurs when the professional accountant is promoting the client's or employing organization's position to such a point that where objectivity is compromised. So when generally advocacy threats will happen is when you are acting as an advocate for the client, when you are fighting the client cases before income tax authorities and all, or when you are acting as a consultant to the issue, when you are promoting the shares of the company, when you are promoting the shares of the company, when you are encouraging everybody to buy the shares of the company. So here you are pushing the company's position to such an extent that your objectivity is getting compromised. Those kind of threats we call them as advocacy threats. And not just that, we have the most important, this I have already addressed it, main focus, more emphasis you have to put it on the familiarity threat. So when does the familiarity threat will happen? When you have some kind of close association or personal relationship with the client. Like you have been conducting audit for the same client for the last 10-15 years, or your relative is in a top level management of the client, or your previous partner is the top level management of the client, or you are accepting significant hospitality and gifts from the client. So these kind of examples are familiarity threats. So they occur because of long or close relationship with the client or employing organization, where the chartered accountants will become too sympathetic for their clients. And then finally, intimidation threat. Intimidation, the name itself says, so you wanted to act in a proper manner, you wanted to genuinely comply with the ethical requirements or fundamental principles, but you are threatened, you are prevented, the client or employing organization is not supporting you, or they are blackmailing you, they are preventing you from acting independently, they are threatening you. That we call it as intimidation threat. So that's what they say here. Here the professional accountant will be deterred. That means he will be stopped from acting objectively due to actual or perceived pressures, including attempt to exercise undue influence. The management is trying to put an extreme pressure on you. They are forcing you, they are threatening you. That kind of threats we call them as intimidation threats. So this is how ICA has categorized the threats into 5 categories: self-interest, self-review, advocacy, familiarity, and intimidation threats. Now what you should do is, as a chartered accountant, what you should do is, if at all you find any threat to the independence, you have to evaluate it. What you should do, you have to evaluate. What do you mean by evaluation? You have to analyze it. How you have to analyze? Sometimes there will be a threat, but we need to check whether that threat is at an acceptable level or not. If at all you face any threat of independence or any threat of fundamental principles, you need to analyze whether that threat is at an acceptable level. What do you mean by acceptable level? Acceptable level means even though there is a threat, that is not having any impact on my independence or objectivity. Like for example, I told that if you accept the gift from the client, that is a familiarity threat. Say for example, I am conducting audit. It is the occasion of Diwali. As an occasion of Diwali, the client is distributing sweet box to all its employees. As an auditor, they have also given one sweet box to me on the occasion of Diwali. So you have accepted the gift, threat to independence, but do you think it is an acceptable level or not? Yes. So like this, you need to analyze whether the threats which whatever you are facing, is it at an acceptable level, and how you have to evaluate whether it is an acceptable level or not by doing related so this we call it as in a third party test, we say. So we have this thing here. Let me give you the full form here. Yes, reasonable and informed third party test, I call it. So that means if any third party is there in your position, that means you have to think from the shoes of a reasonable and a third party. If the third party is in a situation, if he is having all this information, will he conclude that that threat is at an acceptable level or not? So such a reasonable and informed third party test you have to do and determine whether the threat is an acceptable level. So if the threat is not at an acceptable level, then what you should do? You have to address it. Sir, how you have to address it? So first you will evaluate whether the threat is at an acceptable level or not. If you have determined that no, the threat is not at an acceptable level, you have to address it. How you can address it? By eliminating the circumstances which are creating the threat. So whatever circumstances that has led to the creation of this threat, that you have to eliminate it. Or you can apply available safeguards. You can apply even safeguards. Sir, what do you mean by safeguards? Safeguards means preventive actions. So what are that safeguards that I have explained here? Here we will talk about what are the safeguards, but just keep it at the back of your mind. How you can address that threats, either by eliminating the circumstances or by applying the safeguards, or what you are supposed to do is in some cases end that engagement. Don't accept it only. If you feel that even after applying safeguards also, if you are not able to bring that threat to an acceptably low level, don't accept such engagements or decline that engagements altogether. Okay. Now they're asking me to implement the safeguards. No, what are that safeguards, sir? So examples of the safeguards could be spending more time and using qualified personnel. If at all there is any threat to independence, like there might be professional competence threat is there. So in that cases, what you should do, you should spend more time, you should have more qualified person, or you can appoint independent reviewer. If you are facing a self-review threat, you can appoint an independent reviewer, or you can use separate teams for different engagements. For the same client, you are doing assurance engagement and non-assurance engagement. Don't use same engagement team, use different engagement team. Or in some cases, you might be required to involve another firm. Go for joint audit, that will protect the fundamental principles. Or even what you can do is using separate teams for confidential matter. If there is any confidential matter, in that matter, end to end, don't use one single team. Divide the teams so that one team will not have complete information from beginning till the ending. So like this, you try to implement the safeguards and try to bring the threat to an acceptable level. Even after applying the safeguards also, if you are unable to bring the threat to an acceptably low level, then you should quit from the engagement. Right. Next, what else we have? Okay, so this I will try to explain. No CLAR. See, there is something called non-compliance with laws and regulations, which we call it as no CLAR regulations. Now, ICA has brought this no CLAR regulations, which is putting some additional responsibilities on the heads of the professional accountants. Whether you are a chartered accountant in service or you are a chartered accountant in practice, ICA has brought one more regulation called no CLAR regulations, which you are required to comply with. Sir, what do you mean by no CLAR? Non-compliance. The name itself says non-compliances with the laws and regulations. So as a chartered accountant in practice or as a chartered accountant in service, if you are, as a part of your professional duties, if you found any non-compliances with the laws and regulations, either done by your client or done by your employing organization, you have to report them to the respective authorities. So that requirement has been put on you by way of no-clar. First of all, they are defining what do you mean by no-clar. So no-clar means it is either an act of omission or commission. That means either you are doing something or you are not doing something, or they have done it intentionally or unintentionally, and that act of omission or commission is contrary, it is against the prevailing laws and regulations. That means an act of omission, either you are doing something or not doing something, intentionally or unintentionally. The act of omission or commission is contrary, is against the prevailing laws and regulations. That I call it as non-compliance. And who could have done it? That non-compliance can have been done by client or professional accountants employing organization. If you are a practicing chartered accountant, you are client. If you are a chartered accountant service, you are organization, you are employer. Or it could have been done by those charged with governance of your client or employing organization, or it could have been done by management of your client or employing organization, or other individuals working under direction of employment, other people, which means here they are referring to employees. So that act of non-compliance could have been done by directly your client, or those charged with governance of your client, or management of your client, or other people like employees of your client. But however, when I say no-clar, it is not related to personal misconduct. Here we are not required to report on any personal misconduct. Like for example, if a case has been filed against a director for conducting a domestic violence, against a spouse, that is a personal misconduct. This also we are not required to report. We need not go into the personal misconduct. And also non-compliance by parties not listed. See, this no-clar regulations will apply only when the non-compliance is done by any of these people. See, if your client is there, if your client's a customer, if your client's a debtor has committed non-compliance, am I required to report that also? No. Only when the non-compliance is done by these people like your client, those charged with governance of your client, management of your client, or employees of your client, those only I am required to report. If some other party like your client's debtor, your client's customers, your client's bankers, if they have committed any non-compliance, that you are not required to report it. So to whom it is applicable? As I have told, it will become applicable for chartered accountants in service also, it will become applicable for chartered accountants in practice also. But not for every chartered accountant in practice, not for every chartered accountant in service. They say that when it comes to chartered accountants in service, it will become applicable only to the employees of listed companies, that too who are senior professional accountants. Sir, what do you mean by senior professional accountant? If you are a director, or if you are an officer, or if you are a senior employee who is having a lot of influence and who is having the power to take decisions regarding resources, either human, financial, physical and tangible resources, basically key managerial person. If you are a chartered accountant, if you are employed with some company at a top position like a director or KMP position, then only you are required to report it. And that too you are an employee of a listed entity, not other entity, you are a listed entity, that too in a senior position, then only you are required to comply with no-clar. Similarly, if you are into practice, you are required to report on no-clar only on audit engagements. No-clar will become applicable for chartered accountants in practice only for audit engagements. If you are doing audit engagement, that too of a listed company, and that too which has a net worth of 250 crore rupees or more, only while conducting audit of these kind of entities only, if you are doing, if you are a chartered accountant in practice, you are required to comply with the no-clar requirements, not for everyone. And some important facts here. See, the act is expecting you to report the non-compliances. Does that mean as a professional accountant, as a chartered accountant, I need to investigate non-compliances also? Not required. You are not required to investigate. Only those non-compliances which have come to your notice, that only you reported. Sir, does that mean I am required to have expert knowledge? No, you are not expected to have any expert knowledge. Sir, am I required to report on inconsequential matters like personal misconduct? Am I required to report? No, they are completely out of purview. And disclosure of authorities is not required if it is contrary to laws and regulations. You are not required to report if something is against the laws and regulations. Once again, if there is any conflict between laws and regulations will prevail. Sir, we already have a standard SA 250, no, which is talking about non-compliances. Now, what is the difference between no-clar versus SA 250? Very simple. SA 250 applies only to audits, whereas no-clar will become applied to those chartered accountants in practice also, those chartered accountants in service also. And for SA 250, they have divided laws and regulations into two categories which have a direct impact on financial statements or other laws and regulations. Here there is no such identification. Here simply they say that all those laws will get covered which is causing a significant harm. And in SA 250, they did not define stakeholders, but in the no clause, they have told that those laws and regulations which have an impact on investors, creditors, employees, and public, they have defined the term stakeholders. And under no clause, you have a power where you can directly go and report to the authorities. If you came to know about any breach causing substantial harm, they can directly go and report it to the regulatory authorities. Such provision is not there in SA 250. In SA 250, first you have to communicate with management and those charged with governance, then you go to regulatory authorities. But in the no clause, you can skip that management and those charged with governance reporting and directly go and report to the regulatory authorities. So these are some differences. See, I'm going a bit fast here. If you want to know more about this no clause in a detailed manner, I have already done a dedicated video on no clause in my channel. Just go and search in my channel no clause. You will get one detailed video where I have explained somewhere around some 40 to 50 minutes. I have explained on this no clause. Since it is a marathon, I will be covering only important points here. Next, whether you have complied with the no clause requirements or not, even you need to include some things in your documentation. So that documentation requirements also you have to comply with. Clear? Right. So this is what regarding no clause requirements. Now let us talk about chartered accountants in practice. Now they say a few provisions regarding chartered accountants in practice. So let us try to have a quick look of the provisions regarding chartered accountants in practice. See, then when compared with the chartered accountants in service, chartered accountants in practice is having more importance for ethical requirements. Why? Because you are directly dealing with the people. If you are a chartered accountant in service, if you do something wrong, only your employer will be affected. But in case if you are a chartered accountant in practice, you are not working for one employer, you are working for all the clients, you are working for the society basically. So that's why if you are a chartered accountant in practice, if you have done something wrong, not just one entity will get affected, many stakeholders will get affected. So that's why for a chartered accountant in practice, there are so many extra rules and regulations. So first of all, what do you mean by chartered accountant in practice? Whom do we call a chartered accountant in practice? As I have told, in order to be called as a chartered accountant in practice, first you should be a member. First you should be a member of the institute, and one more thing, you should hold a certificate of practice. As I have told, you have to submit an application along with the payment of the prescribed fees. Then ICA will give you certificate of practice. So first you should be a member of the institute, and also you should hold a certificate of practice. And one more thing they say here, sometimes it also includes such members who are deemed to be in practice. Sometimes you will be a member of ICA, but you are not holding certificate of practice, but still you will be deemed to be in practice. If you do some activities, you will be deemed to be in practice, then also you will be called as practicing chartered accountant. See, I will tell you when you will be deemed to be in practice, in what circumstances you will be deemed to be in practice, that we will see it in a short while. But for the time being now, for the purpose of definition, a chartered accountant in practice means a person who must be a member and who must also hold certificate of practice. Number two, it includes even such members who are deemed to be in practice. Sir, but who will be deemed to be in practice? That we will see it in a short while. Next. Okay, so sometimes what will happen is, so what is the significance? Sir, you are telling COP, no? What is the significance of the COP? What is the importance of that COP? So what is the importance of the COP is, a member cannot be a member is not entitled to practice. You can't carry out your practice unless you hold a certificate of practice. Just like any shop or office, you can't rent out the premises and keep a name board outside of your office and start doing practice. As a chartered accountant, if you want to carry out the practice, you must have certificate of practice. Next, annual fee has to be paid. You have to pay the annual fees, which is due on 1st of April, but the due date for paying it is 30th of September. And COP may be cancelled by the council in certain circumstances. Sometimes ICA will give you COP, but if you have done some violations, if you have done something wrong, even the ICA will cancel your certificate of practice also. Next, a member who is not in practice cannot accept engagements to provide services which are typically required for a chartered accountant. See, sometimes some services will be reserved only for chartered accountants in practice. In case if your COP has been cancelled, you can no longer continue to do some engagements. Even for doing it, you are not specifically required to be a practicing chartered accountant. Like one specific case, even we have discussed in our regular classes. Say for example, you used to be a practicing chartered accountant, and on behalf of your client, you used to act as an income tax representative. You used to act as an income tax representative on behalf of your client when you are a practicing chartered accountant. Later, your COP was cancelled. Now, you can't say, even though I don't have practicing chartered accountant, income tax officer will not ask me to show my certificate of practice, still I will go and fight for the income tax case for my client. You can't say that, because in your capacity of practicing chartered accountant, you have accepted this position of income tax representative. When your COP has been cancelled, you can no longer continue to hold that position. So that is what the meaning of the point. Detailed paragraph, you will find it in the main material. You can refer to that once. And even your COP also will be cancelled. Like the way ICAI will remove your name from the register of members, even ICAI can remove your name. ICAI can also cancel your certificate of practice. So when ICAI will cancel my certificate of practice, let us try to understand it. So just give me 1 minute. Right. So when ICAI will cancel my certificate of practice, so like the way as I was saying, like the way ICAI will remove my name from the register of members, in some cases ICAI will grant me the certificate of practice, but later it can cancel my certificate of practice also. So in what circumstances they will cancel my certificate of practice? If I have done something wrong, if my name is removed from the register of members, then automatically my COP will be cancelled. Why? Because if you are, in order to be called as a practicing chartered accountant, you must be a member. If you are not a member only, you will not be able to, if you are not a member, you will not be able to call as COP. You will not be able to hold the COP. Or if the council is satisfied that COP was issued on the basis of false or misleading information, somehow you got the COP, but later ICAI realized that, council realized that you have got that certificate of practice by presenting some wrong information, false information. Later if ICAI comes to know about it, then also they will cancel your COP. Or if a person is no longer practicing, I don't want to practice, I want to go to the industry, then also they will cancel your COP. Or if you have not paid the COP fees till 30th of September. See, even COP is also not coming free of cost. It comes with charge. If you are not paying that COP fees, that too till 30th of September, then also ICAI will cancel. But here also they will restore it back. And here also the same provision. If you are submitting the application within the same financial year in which your COP has been cancelled, and you are making the application and making the payment of the fees within the same financial year, your COP will be restored retrospectively. The same provision, whatever we have seen, restoration of membership, if you are making the application and making the payment of the prescribed fees within the same financial year, the same logic will even applicable for COP also. So because of non-payment of the fees, your COP has been cancelled, and in whichever financial year your COP has been cancelled, before the end of the financial year, if you have submitted the application and made the payment of the fees, ICAI will restore your COP, and that too retrospectively. Next. So these are the few things regarding COP. Now, I want to address one more point here. I told that sometimes you will be deemed to be in practice, right? Sometimes a person will be deemed to be in practice, right? Even though if you don't hold COP, you will be deemed to be in practice. Sir, when I will be deemed to be in practice? If I do which kind of activities, I will be deemed to be in practice. So here they have elaborated it here. In section 2, subsection 2 says, when a member will be deemed to be in practice. So when he will be deemed to be in practice is, if you have qualified your chartered accountancy and you did not get the COP, either in your individual capacity or in partnership with other CA or in partnership with other than chartered accountants, if you are doing certain activities, then you will be deemed to be in practice. What are that activities? If you are engaging yourself into practice of accountancy, that means you have opened an office and you have started providing accountancy services. Not just providing, even if you offer to provide, you have not yet provided, just if you offered to provide the accountancy services, then also you will be deemed to be in practice. Actual provision is not necessary, just offering to provide is also enough. Or if you are offering to perform or performing services relating to auditing, verification of financial transactions, books, accounts and records, or proper preparation, verification, certification or financial accounting and related statements. If you are offering to perform or if you are performing these kind of activities, like you are agreeing to perform audit services, verification services, if you are offering to perform this or if you are actually performing this, then also you will be deemed to be in practice. Then if you are rendering professional service or assistance in relation to matters of principle or detail relating to accounting procedure, that means you are providing assistance to your clients in deciding which accounting policy will be appropriate, which accounting policy will not be appropriate, then also you will be deemed to be in practice. Or if you are rendering such other services as the council may decide. If you are providing any other services, sir, what are that other services? These other services, we call them as management consultancy services. So if you are offering or performing any of this list, the list is very lengthy here, all this we call it as management consultancy services. If you are offering any of these services, then you will be deemed to be guilty of professional misconduct, sorry, then you will be deemed to be in practice. I'm so sorry. You will be deemed to be in practice. Able to understand? So all the services, any of these services, if you are performing management consultancy services, then also you will be deemed to be in practice, and all that provisions which are applicable for a practicing chartered accountant will be applicable for you. Okay, right. So this list, I expect you to go through it once. Yeah, some points you have to be careful. On some points they will ask you a question. Like if you see here, he can perform all, if he is performing any of, he is permitted, a chartered accountant in practice is permitted to perform all these services. And if you are performing, you will be deemed to be in practice, right? But there are certain services which are prohibited. Like if you see here, from here MCQs will come on minute details, they will ask the MCQs. Like it is clarified that activities of broking, underwriting or portfolio management not permitted. A chartered accountant cannot do this kind of services. If you are a chartered accountant holding certificate of practice, you can't do these activities. Which activities you can't do? You can't do broking services, you can't do underwriting services, you can't do portfolio management. That is strictly prohibited, that you can't do it. Very important, on these minute details they will ask the questions, right? Yeah, so that is one thing. But as I have told, my humble suggestion, please go through this list once again. So sometimes they will say on one point they will ask, on one point they will say a chartered accountant is offering this kind of services, whether he will be deemed to be in practice. So like that, a few things which very frequently they ask is, like if he's acting as a recovery consultant, he's acting as a administrative services, like he's providing some administrative services like GST services and all. And very frequently, one more thing what they ask here is, yeah, this one, personal recruitment and selection, then also you'll be deemed to be in practice. And yeah, that's it. So like this, if you are offering any of these services, then you will be, if you are providing any of these services, then you will be deemed to be in practice. And also apart from that, you can also act, if you are a chartered accountant and if you are also holding certificate of practice, you can act as a liquidator, trustee, executor, administrator, arbitrator, receiver, advisor or representative, or you can even take up any appointment made by central government, state government or any court of law, provided your appointment is not on salary cum full-time basis. So you can take up all these positions being a chartered accountant in practice. Next. Yeah, that's it. So this is what regarding chartered accountant who is in practice. Next. Okay. So this one we will see, companies not to engage in accountancy. Companies are not supposed to engage in accountancy. ICAI has strictly prohibited. So say for example, some 4 chartered accountants are there. They want to carry out the practice. So they want to carry out the practice collectively. For that purpose, they have created a partnership firm. They have created ABCD and Co. and they have created a partnership firm. And in the name of the partnership firm, they want to carry out the practice. Can they do it? Yes. Or sir, they want to create an LLP. In the name of the LLP, they want to carry out the practice. Can they do it? Yes. Permitted. Sir, these are 4 chartered accountants. They want to become the directors. They want to become the promoters. They want to incorporate a company. ABCD Private Limited, they want to incorporate the company. And in the name of the company, they want to provide chartered accountancy services. They want to provide audit services, taxation services, etc. Can they do it? No. Corporate companies not to engage in accountancy. ICAI has strictly prohibited that no company, whether incorporated in India or elsewhere, shall practice as chartered accountants. No company shall practice as chartered accountants. It is not permitted for you to practice in the name of the company. If you do it, then you will be liable for penalty. On first conviction, 1,000 rupees. On any subsequent conviction, you will be liable for a penalty of 5,000 rupees. Okay, but however, in one case, chartered accountants in practice can create the company and do the practice. What is that permitted form of corporate practice that I will explain to you in the council guidelines. So after the completion of all the schedules and all, we will do the council guidelines. Once we start discussing the council guidelines, then I will tell you one form of corporate practice is permitted. What is that one form of corporate practice which is permitted, that we will see. One exception is that general rule is companies should not engage into accountancy. Companies should not engage in practice of accountancy. But one exception is there. What is that? What is that one exception? Very important exception from the examination point of view that we will discuss in the council guidelines. Next. Designation and all, I will cover it separately when we take up the clauses. There, this designation thing will get covered. Yeah. I think, shall we go for a break of 2 minutes or something? Shall we go for a break? So we'll do one thing. So we'll take one short break here since we have so many other provisions to cover. So we'll just take 2 minutes of break. After 2 minutes of break, we will resume our revision. Okay. So just 2 minutes of break. We will come back after 2 minutes of the break and resume our discussion. Right. Okay, guys, let us resume. Right. So we are done till chart accountant in practice. So now we are supposed to discuss regarding maintenance of branch offices. This is also one such area where in the recent times they are asking a lot of questions. See, why I am focusing on. See, generally, if you watch regular marathons and all, you will find a lot of discussion has been put into schedules. But if you pay close attention, I have spent a lot of time instead of discussing on schedules. Till now, we have spent a lot of time on discussing the content before the schedules. Why? Because ICA has recently shifted their focus. Previously, they used to ask a lot of questions from schedules, that is personal misconduct and other misconduct. But these days, they have shifted their focus from personal misconduct and other misconduct to these things, fundamental principles and these members. So on these things, they have started focusing more. So that's why I have put some focus there. So we'll go in a short while, we'll go to the schedules. But before that, let us try to quickly cover the other areas. Yeah, we are close to that schedules discussion. So maintenance of branch offices. Sir, what do they say here? Sir, I'm a chartered accountant. I have started my practice. I'm a chartered accountant. I have started my practice. Say, for example, I have started my practice in Mumbai. Sir, I want to open a branch in Delhi. I want to open a branch office in Delhi. Can I open a branch office in Delhi? Yes, 100% yes. Yes, you can open a branch in Delhi. You can have the branch offices. But the condition is ICI says that branch should be headed by a separate in charge who shall be a member of the institute. What does the ICI say? As a chartered accountant or as an audit firm, if you want to maintain a branch office, yes, you can do it. There is no restriction on that. We don't put any restriction. But what ICI puts the condition is that branch office should be headed by a separate in charge who must be a member of the institute. That means for that branch, I have to keep a separate in charge. I should not be handling both the branches. I should keep a separate in charge who will be handling the operations of that branch, and that separate in charge and should not be my paid assistant or someone. That separate in charge should be a member of the institute. That separate in charge should be a member of institute, and that member could be either your partner or that could be your employee. That there is no objection. Either he could be an employee also, not a problem, but that other person must be a member. And even they did not mention he must be in practice. If he is a member, it will be enough. And whether that person could be your partner or even he could be your employee. However, they have given an exception. However, they have told that in some cases you can maintain the branch office without any separate in charge. The condition is if the branch office is located within 50 kilometers. If the branch office is located within 50 kilometers from the municipal limits of the main office. From the municipal limits of the main office, not from the head office, from the municipal limits of the head office. If your head office is there here, from the municipal limits of the head office, if the branch office is located within 50 kilometers, within this distance, if the other office is located, it need not be headed by a separate in charge. So here, very important, guys. Say for example, if there is a head office which is there in Mumbai. Now from the Mumbai, if the branch office is located within 60 kilometers, that should be headed by a separate in charge or not. We should not fix it. We should not directly arrive at the conclusion. Why? Because we should not calculate the distance directly from the head office. We have to calculate the distance from the municipal limits. Say for example, from the head office, the municipal limits are up to 20 kilometers. Now, if I say from the head office, the branch office is at a distance of 60 kilometers, but from the municipal limits, the branch office is located within 40 kilometers only. That branch office need not be headed by a separate in charge. Very, very important point. So if the second office is located, if the branch office is located within 50 kilometers from the municipal limits, of the head office, then it will be from the municipal limits of the head office, then it need not be headed by a separate in charge who must be a member of the institute. And also they have given few more relaxations. sometimes some entities, some practicing chartered accountants might be practicing in hilly areas. In hilly areas, they might be practicing. Say, for example, a practicing chartered accountant is practicing in Shimla. So in the hilly areas, it will be very difficult for them to practice during winters. So what ICA has given the permission is they can have their temporary areas in the plains. They can have a temporary office in the plains for a period of not exceeding 3 months in a year. For a period of not exceeding 3 months, they can move their office premises from the head office to the plains. And there also you need not have separate in charge and all. So you can come for a period of 3 months during winters and all, since you will not be able to practice in the hilly areas. You can come back, you can come to the plain areas and do the practice there. But some formalities you are required to fulfill. Regarding these formalities, there was a recent question, there was a recent MCQ in the ICI, in the recent exam question paper. So what are that things is, so if you see here, exemptions to members practicing in the hilly areas. So those people who have been practicing in the hilly areas, they can open the temporary offices in the city in plains for a limited period of, for maximum duration of 3 months in a year. And during that temporary office, there is no requirement to close your regular office. Both the office, you can keep it open for that 3 months of duration. No need to close your regular office during that winters. And the name board at the temporary office should not be displayed at other times. Only for that 3 months, when during the winters, when you are running that office in the plains, at that point of time only the name board should be displayed. Other times the name board should not be displayed. And the temporary office should not be mentioned on the letterheads, visiting cards, or any other documents. You should not mention that address of the branch office or that office in the plain area in any of your official documents. And before commencement of every winter, you should inform the council, you should inform the institute that you are moving from your main office to the temporary office. Similarly, when you move back to your main office from the temporary office, then also you are required to intimate the ICI by way of a registered post. So follow these formalities, and if you are a person, if you are a chartered accountant or a firm practicing in the hilly areas, you will be given exemption for 3 months to run the temporary office in your plain areas. Next, yeah, as I have told, it should be headed by another member who is either a partner or your employee, doesn't matter. And one more condition they say, see, I am saying that this branch office, if it is located beyond 50 kilometers from the municipal limits, that should be headed by a separate in charge, no? That should be headed by a separate in charge. But ICA says one more condition, that separate in charge must be actively associated with the branch. Just for namesake, you should not appoint a separate in charge. That separate in charge must be actively associated with that branch. Sir, when I can say that the person is actively associated? Sir, when ICA will consider that person in charge has been actively associated with that branch, they have given one criteria. That person in charge should reside in such place where office is situated for a not less than 182 days in a year. In a year, that person should have visited, that person in charge, whomever you have appointed as a separate in charge, that person should have resided. That person should have resided at that place where office is located, not in the office. In that locality, he should have resided for a period of 182 days. Or if he is not residing in that place, at least he should have attended the office for a period of 182 days in a year, or any such other criteria which executive committee might decide. But for the time being now, they have told 2 criteria to determine whether the person is actively associated or not. Either he should have resided in that area for a period of not less than 182 days. If he is not residing there, at least he should have visited that office or attended that branch office for a period of not less than 182 days in a year. Okay, right. And here they have told one more important thing here. Sir, I am having an office. Outside my office, I will keep the name board of my firm, the name of the firm, partners and all. Can I have the name board outside of my residence also? You can have your name plate, your individual name plate you can have, not the name board of the firm. So very important point here. There will be no bar on putting a name board at the member's residence with a designation CA. Outside of your home, you can mention your name. Below that, you can write designation chartered accountant. But name, as it is a name plate or name board of an individual, not of a firm. Sir, I am a partner of a firm, sir. Outside of my office, can I keep the name board of my firm also? No. Outside of your residence, you can only keep your name plate. You can mention your name and designation chartered accountant, firm name and all you can't mention. Next. And a few more clarifications here. Sir, some clarifications here. When there will be no need for separate in charge? When both the offices are located in the same premises. First floor also I have office, second floor also I have office. Do you think I need to appoint separate in charge? Not required. See, within 50 kilometers only, they are not asking you to appoint a separate in charge. If you are in the same building, what is the need for having a separate in charge? Next, if the second office is located in the same city, see, some cities will be very, very big. Say for example, Delhi. Say for example, Delhi. See, just imagine Delhi is very big. The city itself is stretching. The municipal limits of Delhi itself is stretching for 180 kilometers. It will not be that much. Just I am saying. Say for example, 100 kilometers. See, my office is located here. One office is located here. Another office is located within Delhi only. Within Delhi municipality only they have located. But the distance between the two offices is 90 kilometers. Am I required to have a separate in charge? No. You require separate in charge only when you go beyond the municipal limits, that also beyond 50 kilometers. Within the same municipal limits, even if you have more than one office for a distance of more than 50 kilometers also, that need not be headed by a separate in charge. Or second office is located within 50 kilometers from the municipal limits. That's all. So this is what the important discussion from maintenance of branch offices. These days they are asking a descriptive question. If a descriptive question has been missed, they will compulsorily ask a MCQ from here. Then have already explained what do you mean by chartered accountant in service. Then there are some KYC norms. There are some KYC norms for chartered accountants in practice. Nothing but know your customer norms. So if you are a chartered accountant in practice, you need to maintain the database of your clients. You need to know your customers. Who is your client? You have to get the database. So that's why for your clients, you need to maintain one database for your clients. Like if your client is individual or proprietor, some information you have to maintain. If your client is a corporate entity like company or LLP, what details you have to information maintain. If your client is a non-corporate entity like partnership firm and all, then certain information regarding your client you have to maintain. So just give one glance about it and ignore it. So these are the KYC norms for chartered accountants in practice. Now comes the disciplinary procedure. Now we are coming to the schedules, the most important part of this professional ethics, which you all might have been waiting for. So let us try to understand now disciplinary procedure. See, as a chartered accountant, if you commit some acts, you will be considered as conducting a misconduct. Misconducting means what? Doing wrong acts. So as a chartered accountant, whether you are in service, whether you are in practice, there are some things which are expected from you. You should not be doing certain activities. So ICI has specified that activities. Where as a chartered accountant in practice or as a chartered accountant in service, if you have committed that activities, you will be considered as deemed to have conducted the misconduct. That means you have done the wrong act. And ICI has given some activities which will be deemed as professional misconduct. ICI has also given certain activities which will be deemed as other misconduct. See, other misconduct refers to those activities which are not related to my professional matters, but in my personal matters. So here, if I have to put it this way, ICI is even worried about my personal affairs also. Why? Because being a chartered accountant, say for example, there is one chartered accountant. So he has committed some murder. Tomorrow, how the news will come? A chartered accountant has committed a murder. A chartered accountant turned into a cold-blooded murder. So this is how we find the headlines, right? So that's why ICI is even concerned about our personal affairs also. Why? Because even because of some personal affairs of some chartered accountants, entire reputation might get blamed. So that's why ICI has identified certain activities. Some activities they have identified as professional misconduct. Some activities they have identified it as other misconduct. Sir, what do you mean by professional misconduct? If you see here, a member who is engaged in profession of accountancy, whether in practice or service, should conduct or restrict his actions as per the schedules. So ICI has given two schedules, first schedule and second schedule. In the first schedule, they have specified certain activities where misconduct will occur. In the second schedule also, they have specified certain activities where misconduct will occur. So as a chartered accountant, whether you are in practice, whether you are in service, you have to do your activities as per these schedules. And if the member is found guilty of any acts of omissions stated in any of the respective parts of the schedule, he will be deemed to be guilty of professional misconduct. And those professional misconduct activities are specified in first schedule, part 1, part 2, part 3. So part 1, part 2, part 3 of the first schedule will deal about professional misconduct. Similarly, part 1 and part 2 of the second schedule also will be dealing about professional misconduct. Whereas other misconduct, we have part 4 of first schedule and part 3 of second schedule. These schedules will talk about other misconduct. That is something which is not related to our professional work. something which goes beyond our professional formalities. Sir, when they are giving other misconduct, when they are telling the activities which will be treated as other misconduct or professional misconduct, why they have divided these professional and other misconduct into two parts? They could have given all the activities under one single schedule, no? So here, if you see, total under schedule 1, under first schedule, they are giving 12 plus 2, 14, 14 plus 5, 19 activities which will be deemed as professional and other misconduct. Whereas in schedule 2, in second schedule, they are giving total of 15 activities which will be treated as professional or other misconduct. Sir, what is the need for dividing these professional and other misconducts into two schedules? Why can't they have included in a single schedule? Why can't they have included in single schedule is, in the first schedule, if you have been found guilty of misconduct under first schedule, the punishments are little bit what I will say, little bit not so much severe. But in case if you are brought under misconduct under second schedule, here punishments will be very, very stringent. So if you have committed any misconduct which is falling under second schedule, severe punishment will be there. If you have conducted any misconduct under first schedule, I am not telling punishment will not be there. Punishment will be there, but comparatively less punishment will be there. So if I show you here you will get to know. So if you are found guilty of first schedule, if you have committed any of the misconduct given in first schedule, what will happen is the ICA can reprimand the member. They can remove the name from the register of members. And also, they can reprimand the member. They can remove the name of the member for up to a period of 3 months. For 3 months, they can remove your name from the membership register, and they can impose a fine up to 1 lakh. If you have conducted any of the misconduct falling under first schedule. On the other hand, if you have conducted misconduct falling under second schedule, let us see the consequences. Here also they will reprimand the member. They will remove the name of the member permanently also. They can permanently, not just for 3 months, 1 year. They have the power to remove your name permanently. Once again, you cannot call yourself as a chartered accountant in your life again. And not just that, they can impose a fine which can go up to 5 lakh, 5 times of the monetary penalty they can impose. So that is what the main difference between the first schedule and second schedule. First schedule, less stringent punishments. Second schedule, very severe punishments. Okay. So now we will try to read those activities. Now we will try to understand those activities which will be called as professional misconduct, other misconduct, in relation to chartered accountants in practice, in relation to chartered accountant service, in relation to members generally. So like that, we total have 7 parts divided into 2 schedules. So all that I have included it here. So first we will begin with our first schedule. So in the first schedule, we have 4 parts. Part 1 talks about those activities where a chartered accountant in practice will be deemed to be guilty of professional misconduct. Whereas part 2 talks about those activities where a chartered accountant in service will be deemed to be guilty of professional misconduct. Then we have part 3 where a chartered accountant in general means whether you are in practice, whether you are in service, you will be deemed to be guilty of professional misconduct only. Then we have part 4 where chartered accountants in general, whether in practice, whether in service, they will be deemed to be guilty of other misconduct. And under part 1, we have total 20 clauses. Under part 2, we have 2 clauses. Under part 3, we have 3 clauses. And under part 4, we have 2 clauses. Total 19 clauses we have. How many we have? Total 19 clauses we have under first schedule. So let us try to understand each and every clause in a detailed manner. Right. So coming to clause 1, part 1, first schedule, part 1, clause 1. Those circumstances where a chartered accountant in practice will be deemed to be guilty of professional misconduct. So when a chartered accountant will be deemed to be guilty of professional misconduct, clause 1 says, if he allows any other person to practice in his name. What is the first clause? A chartered accountant in practice will be deemed to be guilty of professional misconduct if he allows other person to practice in his name. You are allowing some other person to practice in your name, unless such other person is also a chartered accountant in practice and he is in either partnership with you or he is employed by you. So you cannot allow any other person to practice in your name unless such other person is also a chartered accountant in practice and he must be either in partnership with you or he must be employee of you. Then only you can allow such other person to practice in your name. If neither is there, that means he is not a chartered accountant, and even though he is a chartered accountant, but he is not your partner or your employee, but if you are allowing other person to practice in your name, you will be deemed to be guilty of professional misconduct. You will be deemed to be guilty of professional misconduct. Like say for example, you are a chartered accountant in practice. There is a friend of you who is not a practicing chartered accountant. He did not clear his CA final. He also wants to carry out practice at his location. You are telling him, okay, you use my name and practice. You tell to other people that you are practicing in my name, you are practicing on my behalf, and do the practice on your own. Am I guilty of professional misconduct? Yes. Why? Because the other person is not a practicing chartered accountant, and he's not also he's not a partner or employee of you. That means only which kind of persons I allow them to practice in my name is the other person should be a practicing chartered accountant plus, and he should be either your partner or your employee. So if these conditions are fulfilled, only those persons I allow them to practice in my name. This is clause 1. Next, clause 2, clause 3, clause 4. All three I will try to cover in one go. So clause 2, clause 3, clause 4, what do they say here is, so till now we have been taught that sharing is caring, right? We all believe that sharing is caring. But what ICAI says, no sharing, sharing is cheating, ICAI is saying. By way of clause 2, clause 3, clause 4, ICAI is telling no sharing. If you share, that is not caring. If you are sharing, that is cheating. So it has prohibited sharing certain things. Clause 2 says you should not share your receipts with others. Clause 3 says you should not accept other receipts. Clause 4 says you should not enter into partnership. What they have told? So 3 clauses prohibits the sharing. Clause 2, clause 3, clause 4. Clause 2 prohibits you to pay a percentage or share of your revenue or profits to others. Clause 3 says if you accept a percentage or share of others' revenue, guilty of professional misconduct. Clause 4 says if you enter into partnership with others, you will be guilty of professional misconduct. However, subject to certain exceptions. Subject to some exceptions. So what ICAI has told is, okay, we will not prohibit every kind of sharing. We will permit certain kinds of sharing. We will allow you to share. We will allow you to pay a percentage of your profits to certain people. We will allow you to receive a share of others' profits from certain people. We will allow you to enter into partnership with certain people. So initially they told restriction, but later they gave little bit of relaxation. So let us see with whom I can share a percentage of my profits, with whom I can share others' profits, with whom I can enter into partnership. What has been permitted? Let us to come from these areas only. From clause 6 and clause 7 only the questions are going to come from. Okay, so let us try to understand this clause 6. So what does clause 6 say? This we will have a detailed understanding. So clause 6 says that a chartered accountant in practice will be deemed to be guilty of professional misconduct if he solicits the clients or the professional work either directly or indirectly by way of circular. If you are trying to secure the clients by way of a circular, or by doing advertisement, or by going and doing the personal communication, or even by doing interview, or by any other means, you will be deemed to be guilty of professional misconduct. Sir, everything they have stopped now. How can I get the clients, sir? They are telling me if I try to get the clients through circular, deemed to be guilty of professional misconduct. Basically, I am distributing the pamphlets and trying to get the clients. Guilty of professional misconduct. Advertisement I am doing. I am giving a TV ad. I am fixing a boarding or on the hoarding I am fixing. Guilty of professional misconduct. Personal communication. I am going and meeting the clients personally and asking them to appoint me as their auditor. Guilty of professional misconduct. Or I am doing any interview and getting the work. Guilty of professional misconduct. So then what is permitted? 99% is not permitted. Only here and there some 1% is permitted. What is that permitted? That we will read it now. What is that which is permitted? That we will try to understand now. Sir, if this many things are prohibited, what I can do? So what you can do, that they have elaborated in a detailed manner. So if you see here, provided that nothing herein contained shall be construed as preventing or prohibiting any chartered accountant from applying or requesting work from another chartered accountant. So what is permitted is, if you are a chartered accountant in practice, you can go and request the work from another chartered accountant in practice. That is permitted for you. And a member from responding to tenders or queries. Even there is a permission to respond to the tenders or queries, but here there is one small glitch is there. They have kept one small condition. So what condition they have kept is, when you can respond to the tenders is, so they say that when it comes to tenders, we need to check, is it open only for chartered accountants, or is it open for other professionals also? Is it open for only chartered accountants or is it open for other professionals? If it is for everybody, if that work tender is not just for chartered accountants, if it is for everybody, no issue, you can respond to the tender. You can respond to the tender. However, if the tender has been released by anybody, but that work is only reserved for chartered accountants, that work is reserved only for chartered accountants, then we need to check, is the minimum fees prescribed there or not? Is the minimum fees prescribed or not? So minimum fees is prescribed in the tender, or the fees is not prescribed in the tender. If the fees is not prescribed in the tender, you should not respond. You should not respond. However, if the fees is prescribed in the tender, even though it is reserved for the chartered accountants, you can respond to that inquiry. You can respond to that inquiry. This is what the glitch they have kept it there. So for tenders or inquiries, you can respond provided with these conditions. So that's what even they say here. So if you look at it will not prohibit a member from responding to tenders or inquiries issued by various users of professional services or organizations and securing professional work as a consequence. But as I've told, that tenders and all, that whatever I have explained, responding to tenders, where is it? Okay, so somewhere they will try to keep it, but this is what the explanation I have given it already. Okay, we will come across, anyhow we will come across that. There we will try to elaborate it. Yeah, see here, responding to tenders or advertisements. So a chartered accountant in practice shall not respond to those areas which are exclusively reserved for a chartered accountants. However, if the minimum fees is prescribed, you can respond to it, right? So this is what the conclusion here. Next, sir, now a few more clarifications. Advertisements and note in the press. Sir, can I release an advertisement in the newspaper? No, prohibited. You can't do it. So you can't give an advertisement in the newspapers. You can't distribute the pamphlets and all. That is strictly prohibited. However, some limit, even personal canvassing or canvassing of clients through employees of the previous employer is also not permitted. You can't even go and do the personal canvassing. Like for example, if you know you used to work with some canvassing for clients through employees of the previous employer. So your previous employer is there, or you have some, if I put it in simple way, you have some known contacts. Through known contacts, you are going and doing your personal canvassing. Personal canvassing in the sense you are going and promoting yourself. That is also prohibited. But however, some kind of some small advertisements can be permitted. So what kind of advertisements can be permitted is, what kind of securing of the work is permitted is, this I have already told, a chartered accountant can secure the work from another chartered accountant. So here, if there is any change in the partnership, if there is any changes in the partnership, or a firm has been dissolved, like a firm has been dissolved, some new partner has joined, existing partner has resigned, or there is a change in practice address, change in address of the firm, or change in telephone numbers, for this you can give a limited advertisement that so and so dissolution has taken place, so and so change has taken place, your office has been changed, your contact details have been changed. Just a bare statement of facts only you have to mention. Just a bare statement, this change has happened, our mobile number has been changed from this to this, our address has been changed from this to this. That too you have to give attention to the circulation, where these things are getting circulated. In your locality only it should be circulated. So bare statement of the facts you can mention in case of change in addresses and all. And one more thing here, you can also give advertisement in institutes, journals or newsletters. Institute will have student journal, member journal they will have, and also I say newsletter will come. In that newsletters also you can give advertisement for what? For seeking the partnership or for seeking the employment of accountancy nature. If you are seeking partnership, if you are seeking employment, for that you can give an advertisement in the institute's journal or a newsletter, and you can include in that advertisement your name, your address, your telephone, your fax number, and even your email and social networking addresses also you can provide. Even factual experience and specialization also you can include. Regarding that partnership, what expertise you are having, that also you can include it, where only in the institute's journal. Next one, sir, empanelment. Can I make a request to have my name included in the empanelment? Say for example, some empanelment is there, bank empanelment is there. So now in that bank empanelment, I want to have my name entered. Can I make an application having my name entered in the empanelment? Yes. If the existence of empanelment is in your knowledge, yes, you can make a request asking your name to be included in that empanelment. But however, what is prohibited is roving inquiries you should not do. What is not permitted? Roving inquiries you should not do. That means you should not continuously keep on asking them, sir, have you included by name? I will do audit like this. I will do audit like this. Why don't you assign that project to me? That roving inquiries you can't do. Next. Sir, can I quote the fees while asking my while making a request for entering my name in that empanelment, can I quote the fees? No, directly you can't quote the fees unless it is inquired from. If that respective authority is inquiring, sir, what is the price which you quote, then only you can quote it. Without their request, you voluntarily should not go and quote the prices for the services which you are offering. Next. Sir, can I write the books, articles, presentation? Yes, you can write the books, articles and presentation. So I have even prepared a summary here, what you can include, what you cannot include. Like if you are doing advertisements in institutes, journal, newsletter, or seeking professional work, in the institute journal, you can mention name, your address also you can mention your telephone, fax numbers, factual experience you can mention. Sir, I am writing a book, article or presentation. What I can include in that article, in that book or in my presentation? I can mention the name of the firm. I can mention the designation chartered accountant also. Sir, can I explain the professional attainments in the book? In the article, can I write about my all professional attainments? No. These many years of service I have, this is my project, these are my clients. Can I say that? That is strictly prohibited. Professional attainments, you can't do it. Next. Sir, can I issue greeting cards or wedding invitation, etc.? Yes, you can do it. And in that greeting cards or wedding invitations and all, you can use a designation chartered accountants also. And even firm name is also permitted. But there also professional attainments, you can't do it. And however, one more thing you have to do, that greeting cards or invitations, you have to give it only to your clients, relatives, friends and family members. That's all. Not for everybody. You should not go and distribute that to everyone. So only limited circulation should be there. So that's why if you see here, in the case of greeting cards or invitations, name of the firm is permitted, chartered accountant designation is permitted. Once again, professional attainments are not permitted. Next. Sir, one firm has completed silver, gold and platinum centenary celebrations, 25 years, 50 years, 75 years, 100 years. For that, they can give advertisement. Yes, they can give advertisement. This ICA has considered keeping in mind the requirements of socialization and relationship building. Yes, you can give one small congratulation message or a newspaper advertisement saying that they have completed gold and silver, platinum or centenary celebrations. Sponsorship activities. Sir, can I sponsor? Sir, IPL match is happening. My firm is a very big firm. Can I sponsor for the IPL match? No, you can't do it. So you are not permitted to sponsor any event. However, one permission is there. You can sponsor the event conducted by program organizing unit of ICI, that too with the prior approval of CPE directorate. So you can sponsor any event conducted by ICI, but for that you need to get the prior approval of the CPE. Next. Sir, can I do CSR activity? Can I donate a refrigerator to a charitable institution? Can I donate a bench in the park? Yes, you can do it. Do the CSR activities. Sir, I have donated a bench in the park. On the bench, I want my name, designation chartered accountant, my firm name, when my firm is established, all that, can I place it? No. So in case of CSR activities, what they have told is only use the prefix CA. So for the CSR activities, what you should do, only before your name CA, not even designation chartered accountant, only prefix is permitted. Before your name, use the prefix CA. That's all. Next. Advertisement of teaching, coaching activities by the members. So see, a member who is in practice can also engage in teaching subject to the teaching hours and all. That we will discuss in one more clause here. Sir, but I want to have a hoarding of my educational institution. I am a chartered accountant. I am also running a coaching institute. I want to have a very big hoarding. Can I do that? Displaying my association with a coaching institute. They want to do it. Say for example, I am associated with some big educational academy. Now that big educational academy at the center of the city, they are placing a very hoarding. We are happy to get associated with CA Mahamood Shaik. Is it permitted? No, it is not permitted. Right. So advertising such activities will amount to indirect solicitation. So you should refrain from such advertising. And also, sir, outside my education institution, can I place a name board? Yes. If I am running an education institution on my own, outside my tuition center or outside my coaching center, can I have a name board? Yes, you can have a signboard outside of your coaching premises where you can mention your name, contact details and what subjects you are teaching. But however, when it comes to the board and all, I say guidelines are there. That signboard guidelines you have to follow. Sir, can I share my profile with a prospective client? I came to know that one of the client is looking for some services. Can I go and share my profile with them? No, that is also not permitted. You can't go and share your profile with a prospective client unless they are coming and requesting you. Sir, I am a chartered accountant of one production house. Can my name come in the movie credits after the completion of the movie? Movie credits will come, no? In that movie credits, can my name be displayed? Yes, but however, care should be taken that whatever font that is getting used for all other text, the same font should be used for you. No unnecessary highlighting should happen. Sir, can I make roving inquiries? Roving inquiries is strictly prohibited. Can I seek work from professional colleagues? Yes, you can seek the work from the professional colleague. From another chartered accountant, you can seek the work. Sir, can I give representation? See, under Companies Act, if the company doesn't want to reappoint you, or if the company doesn't want to appoint you somebody else in your place, then as per the Companies Act, you will have a right, to make a representation letter. Sir, in that representation letter which I am giving, can I make a request requesting the shareholders to appoint me once again? No, you cannot do that. But what you can say in that representation letter is, you can say that in a dignified manner, you can say that you have been independent and you have done the audit in a conscious manner, and if at all appointed, you are willing to continue. In this manner, you have to say. You should not request in the representation letter, I have done the work sincerely, I am an independent person, please do reappoint me, I will get appointed as auditor once again. That you should not do. Next, see, there is one client, there is one chartered accountant, Mr. A. Now, this Mr. A chartered accountant is having another chartered accountant friend, Mr. B. Now, Mr. A introduced this Mr. B to the client. Now, this client wants to offer some work to this chartered accountant directly. Can this chartered accountant accept it? No. Why? Because for this chartered accountant, this relationship, he was introduced to this client by Mr. A. So this chartered accountant, being professional, he should ask the client to, if at all they want to offer him any work, they should ask him to come through that another chartered accountant who has introduced them to him. So that's what they have told. Acceptance of original professional work by a member emanating from a client introduced to him by another member. So you should not accept it. You have to ask that client to come through that friend only. Giving public interview. So, sir, can I give interview? Yes, you can give interview, but however, in that interview, no publicity, nothing should happen. You should not go and disclose your professional attainments there. Any information you are providing should be factual. That also only when question has been asked to you. Next. Sir, can I advertise in the box numbers? No, that is also prohibited. Sir, can I do educational videos on the YouTube? Yes, do it. But don't refer to the CA form. You should not mention the name of your CA form. And very important, you should not include the contact details or website address. That is strictly prohibited. Contact details and website address should never be given in your YouTube videos. So firm name you should not give. Contact details or website details also you should not give. So this is what clause 6 is all about. So what does clause 6 say? A chartered accountant in practice will be deemed to be guilty of professional misconduct if he secures the work, if he is soliciting the clients or professional work by way of circular, advertisement, press release, etc. Then 7th one, a chartered accountant will be deemed to be guilty of professional misconduct if he displays his professional attainments or uses a designation other than chartered accountant. See, 5, 6 and 7. These 3 are related to advertisement. How you can secure the work, how you cannot secure the work. This 3 is one cluster. These 3 activities are one cluster. Professional attainments and designations. So clause 7 says a chartered accountant in practice will be deemed to be guilty of professional misconduct if he advertises his professional attainments or uses any designation or expression other than chartered accountant. So you can designate yourself only as a chartered accountant. You cannot use along with your designation other designations, like you can't say I'm a MBA, I'm a MCom. So all that I'm an MBA, MCom. So some exceptions are there. Sorry, I don't want to keep it like this. So say for example, I'm a chartered accountant and also I'm a corporate lawyer. So or I'm something else. Can I disclose that extra designation along with my chartered accountancy? No, subject to some exceptions. Some designations I can use it. So what designations I can use along with chartered accountant? If it is a degree of a university established by law in India, like BCom, MCom, if it is a degree of a university, I can use it. I can designate it. If it is recognized by chartered accountant, if that qualification is recognized by central government, sorry. Or if the title is indicating the membership of ICA or any other institute that has been recognized by central government or recognized by council. So ICA has recognized, ICA is generally having MRA or MOUs with other institutes. If you are also the member of that other institutes which are recognized by the council and the government, or generally with which ICA is having MOU or MRA, those entities membership also you can indicate. Like for example, as I was telling, your ICA is having the MRA or MOU with ICAEW. If you are also a member of ICAEW, you can use along with your chartered accountancy designation that you are a member of ICAEW also. And few more things are permitted here. Sir, can I use a designation corporate lawyer? Prohibited. You can't use a designation corporate lawyer. Sir, I am a member of parliament or municipal councillor. I am a person who is also leading some statutory position, like I am a member of parliament or I am a municipal councillor. I am holding this position. Can I use in my visiting cards or in my official documents along with the chartered accountant that I am a MP, MLA, MLC? Can I use that? No. But one permission is there. If you are also a insolvency professional and also a registered valuer, this you can use it along with your chartered accountancy designation. So if you are also a insolvency professional, if you are also a registered valuer, If you have these qualifications, ICA has given the permission, you can use this along with your chartered accountant designation. So I should have one PDF. Let me share that with you. I have one summary for this also. Just give me 1 minute. Yes, clause 1, clause 7, sorry. Yes, see here. So from here we will try to quickly revise it. So what designations? So I have done what are the permitted actions, what are the prohibited actions, both we will try to cover. So I can use a designation chartered accountant. If any degree of university is there, that I can use it, or I can also indicate membership of ICA or any other institute recognized by ICA or council. What is prohibited? Advertising my professional attainments. Nowhere I have to advertise my professional attainments. And also I cannot use unauthorized designations. Apart from this, I can't use any unauthorized designations. And few specific designations are permitted. What are they? I can use the designation insolvency professional or registered valuer. This I can use it. What is prohibited? Can I designate myself as corporate lawyer? No, prohibited. Can I designate myself as MP or MLA or MLC? No, prohibited. Next, firm and practice details. Sir, on my letterheads, on my official documents, can I mention the date of setting up of practice? No, you can't mention the date of setting up of practice. Or can I mention the date of establishment of the firm? That also you can't mention. So that is strictly prohibited. Date of starting of the practice, date of establishment of the firm, all these things are prohibited. Sir, if I am a chartered accountant, but also I am practicing as, along with the chartered accountancy, if I am also practicing as advocate or company secretary or CMA, if I am doing multiple practices, generally it is not allowed. If at all permission is there, what you can do is, if you are practicing multiple professions, then both designations you can't use simultaneously. Which means what? Say for example, you are practicing as a chartered accountant and you are also permitted to practice as advocate. Then in respect of matters where you are practicing in the capacity of a chartered accountant, for those matters you have to use the designation chartered accountant, and those matters in which you are practicing in the capacity of an advocate, there you have to use a designation only advocate. Both simultaneously you can't use it. Depending on the matter which you are representing, that respective designation you have to use it. That's what they say here. Next, firm name usage. Right. So if you see this here, this we will try to see. Right. So individual member can use the prefix CA before his name. He can make the prefix CA, that you can use it. A firm of chartered accountants shall use a designation chartered accountants. The name below the name of the firm, if you want to designate that firm, you can use chartered accountants. That designation you can use for the firm as well. And you cannot use any logo of your own kind. ICA is having its own CA logo. This logo has also undergone some changes in the recent past. That new logo with the Indian flag related tick mark. So that logo only you have to use it. Any other logo, your own logo, your name related logo, all that is strictly prohibited. Only logo of ICA you can use it. Sir, one of my article assistant, I am an audit firm. One of my article assistant who is working under me, he has achieved a rank in the CA examination. Can the newspaper advertisement be given? Yes. Advertisement regarding success of a person can be given, but in that advertisement details should be restricted. Like you should only mention candidate's name, their address, their school, their local background, their exam passed, in which exam they have passed, with any prize or place gained, name of the principal you can mention, firm you can mention, town of the principal also you can mention. That's it. Apart from this, only because of working in this firm he has secured the rank. This firm is having multiple client base. All that you can't expect it. All that you can't do it. And also you should restrict the circulation of your reports also. Your reports also should be circulated in a restricted manner. Why? Because your reports will be generally given on letterheads. It should not be given to people, those who are not required. Why? Because reports is also a form of advertising. Next, sir, can I appear in the electronic media? Yes, you can appear in the electronic media. You can go and participate in the electronic media, but there also what is prohibited is you cannot make exaggerated claims or comparisons. You can't say I'm the best in the industry, I'm doing that in this, that you can't do. And you also cannot mention the CA firm where you are a partner or proprietor. You cannot mention even the name of the firm. So only you can designate yourself as a chartered accountant. And for the matter on which you have been called to give the interview, for that matter, if you have any special qualification, that you can mention. Special qualification relevant to the subject matter, that you can include it. Firm name can be included, but without without making exaggerated claims and all. Right. Contact details and website address in the educational videos is also prohibited. Then what? Yeah. That's it. All the other things we have covered. Institute membership you have to mention. Members may update educational videos on the internet, but without referring the CA firm name or contact details and website addresses. Sir, can I conduct a training or seminar? For example, GST Act, a new budget has come. On this new budget, I want to conduct a seminar for my staff. Can I conduct it? Yes. Sir, along with my staff in my firm, my friend's firm is there. Their staff also want to attend this seminar. Can I allow them? Yes. But for that seminar, you will give the material, no? In that material, your name, your unnecessary publicity should not happen. So that's what they say here. You can conduct training courses or seminars to your staff and others' staff. But what is prohibited is undue prominence to the CA's name in the booklet or the document should not be given. That is prohibited. Can I write the articles, letters to the press? Yes, you can do it. You can designate yourself as a chartered accountant, but you can't use the name of the firm, and all that things are prohibited. Sir, signboard. Sir, can I use the signboard? Yes, you can use the signboard for your firm. Can I have glowing lights? No, all that you can't do. So you can use the colors as per the discretion and good taste, but what is prohibited is glow signs and large boards are prohibited. Sir, I'm a director of the company. Sir, if I'm a director of the company, generally, if you look at the annual reports of the companies, they do a lot of praising for their directors. I'm a chartered accountant. I'm into practice. I'm also a director of the company. That company has released their annual report. In their annual report, they are telling a lot of things about me. They are saying that this person is an experienced person. He has worked in various industries and all. He's into a lot of years of practice. Is that permitted? No. Even if the company is giving all that information, you will be liable for misconduct. So that's why if you are working as a director of some company, you ask them, sir, before you publish information, anything about me, share it with me. I will tell you what has to be included, what has not to be included. That information only you have to publish. So right, if you see here, then what can be permitted, what can be included in the documents, they can mention along with your name, chartered accountant, they can mention how many directorships he is holding. That is also permitted to be mentioned. And members should notify management. As I have told, members should tell the management, sir, don't mention the name of the firm. Don't do professional attainments display. So better what you do is, before you want to publish any information regarding me, just to show that information to me, I will give you approval, then only you publish it. So that thing you have to do. So this is regarding public announcement of directors. So this PDF also I will share it with you. So, and this is the summary. This is one simple summary if you want. This is one simple summary. What is permitted, what is not permitted. Right. Fine. With this we have completed clause 7 also. 3 clauses we have done. So 3 clauses are talking about advertisements. Number 1, securing the work through other means. Clause 6 says soliciting the clients or professional work by way of circular, advertisement, etc. Clause 7 says display of professional advertisements and using a designation other than chartered accountant. Now 8 and 9 talks about legal responsibilities or professional responsibilities, I will say. Clause 8 says that if you are a chartered accountant in practice and if you are accepting any position as an auditor which was previously held by another practicing chartered accountant, you must first communicate with him in writing. If you are accepting any position as an auditor which was previously held by another practicing chartered accountant without first communicating with him in writing, then you will be deemed to be guilty of professional misconduct. So that's what they have told in clause number 8. So if you see here, a chartered accountant in practice will be deemed to be guilty of professional misconduct if he accepts a position as an auditor which was previously held by another chartered accountant or certified auditor who has been issued a registration. Another certified, these are the people who used to act as chartered accountants before CA Act has come into picture. You can ignore it. So if you accept any position as an auditor which was previously held by another chartered accountant without first communicating with him in writing. So you must first communicate with the previous auditor in writing, then only you can accept your position as an auditor. However, sir, here some clarifications. Is it required for all audits? Yes, for all kind of audits it is required, be it statutory audit, tax audit, income tax audit, GST audit, internal audit, any audit. If the previous position was held by another chartered accountant, you must communicate with him in writing. Sir, is it required to be communicated even if the previous auditor is not a chartered accountant? Advisory, recommendatory, not compulsory. I'm accepting a position as an auditor, but the previous auditor was not a chartered accountant. Am I required to communicate with him also in writing? It is just recommendatory, not mandatory. Next, sir, in government audits, what will happen is I have to give my acceptance in a very short span of time. In the government audits, if I want to get appointed as an auditor, I have to give my acceptance in a short period of time. The government entities will not wait till the time I communicate with the previous auditor, get the response and give the approval. The government entities will not wait. In those cases, what you can do is you can give a conditional acceptance. You can give a conditional acceptance and mention there that this final acceptance will be complete only when he get the response from the previous auditor. So you can give a conditional acceptance in the case of government audits where you don't have enough of time to communicate with the previous auditor. So you can give conditional acceptance, but you have to clarify that appointment will be subject to any professional objections. Sir, I have communicated with the previous auditor. How long I have to wait for his reply? For a reasonable period of time, you have to wait. If within reasonable period of time, if you are not getting response, continue accepting the engagement. Sir, what will be a reasonable period of time? That all depends on the facts and circumstances. Sir, how I have to post it? If I do a registered post, will it be enough? No. Just sending through a registered post alone will not be enough. You have to communicate with him under certificate of posting. You have to send it with the under certificate of post, not under certificate of posting. You have to send it by way of registered acknowledgement due. Yeah, just if you do speed post, registered post, that alone will not be enough. You have to do that. You have to do that communication by way of registered acknowledgement due. If you are doing it through physical form, you have to get it done through registered acknowledgement due, or if possible, you can go and give the physical delivery with that previous auditor, or even you have to get the acknowledgement for the retiring auditors registered with the institute or last known email address. Or if you are sending an email, you ask that other person to give a reply that he has received that communication from me, or UDIN also you can generate it. Now, in some cases, what will happen is I have sent the letter, but that office was found locked. That means it was returned back. It was not delivered because office was found locked. Then it will be deemed as delivered. You have sent it to the correct address, but the office was found locked. Then it will be deemed to have been delivered. You can continue accepting the engagement. You have not done any misconduct there. Sir, I have sent an address. I have communicated with the previous auditor, but the office itself is not found, sir. As per the address available as per ICA records, I have done the post, but that office is not found at the given address. Then also it will be deemed to have been delivered and you can continue accepting the engagement. And one thing they say here, in one case you should not accept the engagement. Say for example, a client has approached you asking you to do the engagement. ICA says in one case you should not accept the engagement. When you should not accept the engagement is if you came to know that your prospective client has not made the payment of undisputed audit fees to the previous auditor. As a part of communication with the previous auditor, you came to know that your client has not paid the payment of undisputed audit fees to the auditor. Sir, what do you mean by undisputed audit fees? The fees for which a provision has been created in the books of accounts. If the company has created provision in the books of accounts, that means they have agreed that they have an obligation to pay the fees, but they have not yet paid it to the previous auditor, then you should not accept such engagement. However, if the client is sick unit, that's why they have not made the payment of that's why they have not made the payment of undisputed audit fees, then you can accept the audit. But if your client is a good entity, not a sick unit, but you are not making the payment to the undisputed audit fees to the previous auditor, don't accept that engagement. ICA has prohibited you from doing it. So this is what regarding clause 8. Then we have clause 9. Clause 9 says that a chartered accountant in practice will be deemed to be guilty of professional misconduct if he accepts the position as an auditor of a company without first checking whether his appointment is made in accordance with the compliance with the sections of the Companies Act. If the chartered accountant accepts his position as an auditor of a company without first checking whether the provisions of section 139 and 140 have been complied with or not, without checking the compliances of the Companies Act, if he accepted the position as an auditor, then also he will be deemed to be guilty of professional misconduct. Like as we all are aware, under section 139, 140, so many regulations are there. Like if you are getting appointed as a first auditor, board resolution will be required. If you are getting appointed as a subsequent auditor, shareholders resolution will be required. If it is a casual vacancy, board resolution. If it is a casual vacancy because of resignation, a board resolution along with the shareholders resolution will be required. So you need to go through various documents. Like if it is a board resolution, go through the board meeting resolutions. Shareholder resolutions you have to check. Special resolution. In case if the previous auditor was removed, central government approval. So all these things, all these requirements are there under section 139 and 140. we need to check that whether our appointment has been made only after compliance with Section 139 and 140 of the Companies Act. We need to check all the related documents to make sure that our appointment has been done as per the provisions of the Companies Act. Next. So that is what clause 9 say. So as I've told, all the formalities you can refer to it. Next. Clause 10. Let us come to the clause 10. So clause 10 says a chartered accountant in practice will be deemed to be guilty of professional misconduct. If I have to tell you one summary to remember, if you are either charging your fees on a contingent basis, or if you are accepting your fees as a percentage of the profits or percentage of the outcome, then you will be deemed to be guilty of professional misconduct. So that's what they say here. If we read it, a chartered accountant in practice will be deemed to be guilty of professional misconduct if he charges, or if he offers to charge, or if he accepts or offers to accept in respect of any professional employment a fees which is based on percentage of profits or which is contingent upon findings. That means the client is saying you do the work, depending on the outcome of your work, I will tell you the fees. Or the client is saying I will pay you 10% of my profits as a fees. Then you will be deemed to be guilty of professional misconduct. However, in some engagements, you can decide your fees either as a percentage of profits or contingent upon findings. Some engagements you can get your fees either as a percentage or you can get a contingent fees. In which circumstances I can get a percentage or contingent fees? Number one, if you are acting as a receiver or liquidator, then you can get a percentage of realization of assets or disbursement. If you are an auditor of cooperative society, then fees can be paid on the basis of a percentage of paid up capital or working capital. If you are doing the valuation for the purpose of direct taxes, this is very, very important. From here also they will ask a question. They will say you are doing the valuation not for direct tax purposes, you are doing valuation for loan purposes, then you can't accept your fees as a percentage. If you are doing the valuation for the purpose of direct taxes or duties, then you can decide your percentage on the basis of property value. Certain management consultancy services. So if you are providing certain management consultancy services, there also you can decide the contingent fees. If you are doing fundraising services, you can get the fees as a percentage of fundraised. If you are doing debt recovery, as a percentage of debt recovered. If you are doing cost optimization services, as a percentage of benefit derived, or any other services, under clause H they have added two new things. If you are acting as an insolvency professional, then also you can get the percentage. If you are doing any non-assurance services to the non-audit clients, for one client you are not doing any audit, and for that client you are doing non-assurance services. So non-assurance services to non-audit clients, in these cases also you can get the fees either as a percentage or contingent fees, you can get it. And recently one council decision is there, they have added one more service where we can get the fees as a percentage of the profits. So one more service also they have given, yeah, this one. It is permissible for a member in practice to charge fees on a percentage of utilization of an educational institution for certifying the amount spent by educational institution. So in some cases you are required to certify the amount spent by educational institution. There you might get a fees as a percentage of utilization amount of that educational institution. This is also one such thing which has been recently added, where you can charge your fees either as a percentage or contingent fees you can charge. So this is what regarding clause 10. Then clause 11. Clause 11 says a chartered accountant in practice will be deemed to be guilty of professional misconduct if he engages in other business or occupation apart from chartered accountancy. So if you see here, if you are a chartered accountant in practice, if you are engaging in any business or occupation other than the profession of chartered accountant, then you will be deemed to be guilty of professional misconduct. However, certain things are permitted. Apart from chartered accountancy, you can also engage in some other activities which will not make you guilty of professional misconduct. What activities I can do? Like you can act as a liquidator, trustee, executor, administrator, arbitrator, receiver, representative for costing or financial matters. You can take an appointment of central government, state government, or even you can act as a secretary in your professional capacity, provided the employment is not on a salary come full-time basis. These engagements you can do. You will not be deemed to be guilty of professional misconduct. However, institute has also given certain activities where you can accept your position, where you can do along with your chartered accountancy these other activities without any permission, which I call it as general resolution. Certain activities has been generally permitted to be rendered by the practicing chartered accountants. Sir, what they can do? Number one, you can act as an employee under another practicing chartered accountant or firm of chartered accountants. Not in the industry, guys. You can be an employee under another CA or another firm of CS. Or you can do private tutorship. What do you mean by private tutorship? One-to-one tutorship that you can do without any permission. You can do authoring of books and articles. You can write books and articles. You can even hold LIC agency only for getting renewal commission, not for selling new policies. You can get renewal commission. You can attend classes, appear for any examination. You can hold elective offices of MP, MLA and MLC. You can also hold honorary office leadership of charitable, educational or other non-commercial organizations. You can also hold honorary office leadership of charitable, educational or other non-commercial organizations. Not for commercial organizations, for other than commercial organizations, you can hold honorary positions. You can act as a notary public, justice of peace, special executive magistrate. You can do part-time tutorship under coaching institute of ICA. Under coaching organization of institute, you can do a part-time tutorship. If you want to do full-time tutorship, you need specific permission. And also if you want to do even part-time tutorship under other than ICA, then also you need specific permission. General permission is there only for doing part-time tutorship, that too under institute. You can also value the paper, act as a paper setter, head examiner or moderator, not just for ICA exam, for any exam. And you can also do editorship of professional journals. If you do editorship of other than professional journals, you need specific permission. Acting as a surveyor, loss assessor under Income Tax Act, if qualified, that you can do. Acting as a recovery consultant, that too in the banking sector. Sir, if I want to act as a recovery consultant, not in the banking sector, for other than banking sector, if I am acting as a recovery consultant, without specific permission of ICA, guilty of professional misconduct. Or if you want to own agricultural land, carry out agricultural activity, that is also permitted. Now they have given few more activities for which a specific permission is required. I will say you need not remember. Just remember these activities which are generally permitted. In the exam, if they give you any activity which is not falling under this list, for that you need a specific permission. That's all. And when it comes to training and all, when it comes to that educational institutions and all, they have put one restriction on the number of hours. So they say that if you can do part-time tutorship under institute without any specific permission, generally granted. With a specific permission, you are doing tutorship under other institute, or you are doing full-time tutorship under institute with a special permission, but there is a subject to a maximum limit. The maximum limit put is it should not exceed 25 hours per week. So council passed a resolution granting general permission for private and part-time tutorship under ICA coaching, and specific permission for part-time or full-time tutorship under other educational institutions. You can do it by getting special permission, but there is a limit there, maximum 25 hours per week. Next, coming to a few more things here. Sir, can a chartered accountant in practice, can he be a director? Yes, he can be a director simpliciter. Other than managing director, but he can't be a managing director. He can only be a normal director. See, director simpliciter he can be. Next, however, Ethical Standards Board has clarified one point. Auditor of a subsidiary company cannot be a director in its holding company. If you are conducting auditor of some subsidiary company, you cannot be a director in its holding company. One council decision they have taken. Sir, can he be a promoter or director? Yes, he can be a promoter or director. No permission will be required. Sir, can he be a member in practice and also be a part of HUF business? Yes, he can do it, but he has to prove that he did not start that business. That business has come to him as a part of inheritance, succession or partition, and he is not actively engaged in the business. That you can prove it, then you can get then you can be a member in the HUF also. Next. Yeah, this is what regarding clause 11. Then we have the last clause in part 1 of the first schedule, which says if you are a chartered accountant in practice and if you are allowing other persons to sign on your behalf, then also you will be deemed to be guilty of professional misconduct. So they say that if you are a chartered accountant in practice, if you are allowing a person who is not a member of the institute in practice or a member not being his partner to sign on his behalf or his firm any balance sheet P&L. So that means you can only allow such other person to sign on your behalf if that other person is also a member in practice and also he is your partner. So only the other person who is also a chartered accountant in practice, that too who is your partner, they can only sign the other documents on your behalf. Other than that, if you are allowing any other person to sign on your behalf, they will be deemed to be guilty of professional misconduct. However, you can't expect the chartered accountants to sign each and every document. Some formalities will be there, some formal documents will be there. So these documents you can allow anybody to sign. Like issue of audit queries, you need not sign it. You can delegate that work to article assistants or paid assistants also. Asking for information or issue of questionnaire, that also you can delegate. Letter forwarding draft observations, not final report, draft observation report, you can allocate that, you can allocate signing to any other person. Initiating or stamping of the vouchers, delegate it to anybody. Acknowledging and carrying out routine correspondence with the client, delegated. Issuance of memorandum of cash verification, etc. You can delegate that power to others. acknowledgements for records produced, raising of the bills, attending routine matters in tax practice. From here questions have come. Even for these routine matter submission to the tax authorities, that also you can delegate the signing power to your staff, and any other matter incidental to office administration. So these are the documents where you can delegate the power to sign, but other documents you can only get them signed on your behalf if the other person is also a chartered accountant in practice or that person is your partner, right? That's it. So this is what regarding clause 12. So with this we have completed part 1 of the first schedule, which says, if I have to tell you one logic for remembering, so how you can remember is 1 and 12, clause 1 and 12, allowing others. Clause 1 and 12 is talking about allowing others. Clause 1 says if you allow any other person to practice. Clause 12 says if you allow any person to sign. That is clause 1 and 12, first and last. 2, 3, 4, as I have told, no sharing. No, you don't pay to others, don't receive from others, don't enter into partnership. 5, 6, 7, it is talking about securing the work. Clause 5 says don't secure by inappropriate means. Clause 6 says don't solicit the work or professional clients by way of circular, advertisements, etc. Clause 7 says don't display the professional attainments, don't use a designation other than chartered accountant. Then 8 and 9 talk about professional formalities. Clause 8 says you have to communicate with the previous auditor. Clause 9 says you have to check the compliance with section 139 and 140. 10 and 11 is talking about greediness. 10 and 11 says to the auditor, don't be greedy, don't show your greediness. Clause 10 says if you are a chartered accountant, don't engage in other, clause 10 says if you are a chartered accountant, you should not accept your fees which is contingent or percentage of profits. And clause 11 says don't engage into any other occupation apart from chartered accountancy. So this is how you can club and remember. So whatever it is, we have completed part 1 of the first schedule. Then coming to the part 2 of the second schedule, it contains 2 clauses which says about when a chartered accountant in service will be deemed to be guilty of professional misconduct. So they say that a chartered accountant in service will be deemed to be guilty of professional misconduct. 2 clauses they have told. Clause 1 they told, when you are as a chartered accountant in service, if you are agreeing to pay a percentage of your remuneration to others. So like for practicing chartered accountant, they have told they should not pay a percentage of their profits to others. Similarly, if a chartered accountant in service is paying a percentage of their remuneration or emoluments to others, deemed to be guilty of professional misconduct. But that doesn't mean that you should not share with your family or dependents. You can share it with your family or dependents. Apart from that, like for securing the job, you have agreed with one person that if you secure me a job, I will pay you percentage of your salary. That is prohibited. Similarly, you can't receive the fees from if you are agreeing to receive a percentage of others' revenue. Like you have a friend who is a lawyer. You told your friend that I will ask my employer to appoint you as a lawyer. My company will pay you fees, no, pay me a percentage. Or I'm an employee of some company. I have a chartered accountant who is my friend. I told to my friend, I will make my company appoint you as an auditor, but I want a percentage of the fees from you. So like this, if you are trying to agree other person share from other percentages, other person's income, then you will be deemed to be guilty of professional misconduct. So these 2 are applicable for chartered accountant in service. Then we have part 3 where they have told 3 clauses where a chartered accountant in general, whether you are in practice, whether you are in service, you will be deemed to be guilty of professional misconduct. So what are the 3 clauses? If you are not a fellow of the institute, if you are not a FCA, but still you are representing yourself as a FCA, you will be deemed to be guilty of professional misconduct. If you are not submitting the information, if you are, this clause I wanted to read it here. So clause 2, if you see, does not supply the information called for, or you are not complying with the requirements asked by institute, council, its committee, director, board of discipline, disciplinary committee, quality review boards, or the appellate authority. That means you are not complying with the requirements of these regulating authorities, or you are not submitting the information, deemed to be guilty of professional misconduct, whether you are in practice or service. Then we have clause 3. So what does clause 3 say is when you are securing the work. See, some modes of work we can secure, no, like we can secure the work from another chartered accountant. So when you are securing the work through permitted means, but you are securing the work on the basis of providing wrong information, you are providing false information and securing the work, then also you will be deemed to be guilty of professional misconduct, whether you are in service or whether you are in practice. So these are the 3 cases where a chartered accountant in general will be deemed to be guilty of professional misconduct. Now we have part 4 where chartered accountant in general, whether in service, whether in practice, is deemed to be guilty of professional other misconduct. So when a chartered accountant will be deemed to be guilty of other misconduct, so they say that if you read it here, if he is held by court, any civil or criminal court, for an offence which is punishable with imprisonment for not exceeding 6 months. If you have committed any crime in your personal affairs, and a civil court or criminal court has passed an order and they have punished you with imprisonment for up to 6 months, then you will be deemed to be guilty of other misconduct under first schedule. Whereas, sir, what if I am punished with imprisonment for more than 6 months? If you are punished with imprisonment for more than 6 months, then you will be deemed to be guilty of other misconduct under second schedule. That means they will give more punishment. They can remove you permanently. If you are punished only for imprisonment up to 6 months, you will be deemed to be guilty of other misconduct under first schedule part 4. Sir, what if I am punished with imprisonment for more than 6 months, then I will be deemed to be guilty of other misconduct under second schedule. There I will have more punishment. And also we have one more clause here under part 4. If you are doing any such activity which brings a disrepute to the profession or institute. See, this is a residuary clause, I will say. That means if you have done something wrong, if it is not getting covered anywhere, what they will do, they will come and make you liable for misconduct here. Other misconduct they will bring you here. So this is something like an residuary clause where they have kept it. Like if you read it, if he does anything which brings a disrepute to the profession or the institute as a result of his action, whether or not related to his professional work, whether related to the professional work, whether not related to the professional work, if you are doing something which is bringing disrepute or bad name for the profession, you will be deemed to be guilty of other misconduct. So as I have told, it is a kind of residuary clause. If you are not getting covered anywhere else, they will come and bring you here and make you liable for punishment. So this is what first schedule. Now we have second schedule. In the second schedule, we have 3 parts. In that part 3, we have already completed. If you are punished with imprisonment for more than 6 months, you will be deemed to be guilty of other misconduct. Now we have part 1 where they are saying somewhere around some 10 clauses they are saying here where you will be deemed to be guilty of professional misconduct if you are a chartered accountant in practice. Then we have part 2 where a chartered accountant in general, whether in service or practice, will be deemed to be guilty of professional misconduct. So we'll start with part 1. So what does part 1 say? Part 1 first point says confidentiality. So as we have just now seen in the introduction part, confidentiality is one of the fundamental principles. So if you are a chartered accountant in practice, as a part of your professional assignment, if you have secured any information from the client and if you go and disclose it, if you have breached the confidentiality, then you will be deemed to be guilty of professional misconduct. That too under second schedule, more punishment you have to face. So that's what they say here. A chartered accountant will be deemed to be guilty of professional misconduct if he discloses the information acquired in the course of his professional engagement to any person other than his client, so engaging him without getting the consent of the client or unless it is required by law. I told already, we have already seen it in the fundamental principle part. When you are permitted to disclose, then only you have to disclose. In all other circumstances, you have to maintain perfect confidentiality. If you are violating confidentiality, then if institute comes to know about it, they will make you guilty of professional misconduct. That too under second schedule, more punishment will be offered to you. See, if you see all these things here, these are all matters. If you see the activities given under part 1, these are all the matters which are breaking the trust of the people. So that's why they are offering more punishment. If you see all the clauses, when we read all the clauses, they are all related to those activities which are breaking the trust of the people on chartered accountants. That's why they are offering more punishment. So clause 1, confidentiality. Clause 2, certifying without verification. If you are certifying any document or financial statements without doing verification, without verifying, either you are verifying, if you are certifying some document, either you should have verified it or your employees should have verified it or some another practicing chartered accountant should have verified it. If none of them has verified and you have certified the financial statements or other document, you will be deemed to be guilty of professional misconduct. That means you are irresponsible there. So if he certifies or submits in his name or in the name of his firm a report of an examination of financial statements, unless such examination has been carried out by him or by his partner or an employee on his firm or some another practicing chartered accountant, someone should have verified it, then only you should have certified. If none of these people have verified but still you are certifying, deemed to be guilty of professional misconduct under second schedule, more punishment. Third one, clause 3, if you are permitting your name to be used in connection with an estimate or earnings contingent upon future, which may lead to the belief that you are vouching for the accuracy. Sometimes the client will bring to you forecast. We will see it in the SAEs. There, sometimes we are required to work upon future financial information. Say, for example, the client is bringing the forecast, next year projection they are bringing you. They have asked you to sign that. So sometimes you might be required to give a report on future financial information, but you should not give your report in such a manner. You should not use your name or firm's name with prospective information in such a manner that it is giving a belief that you are vouching for accuracy. That means in your report, you should not say that this future financial information will happen exactly, or you are vouching for the accuracy, you are saying that this future financial information will happen in the future as it is. That kind of usage if you are doing, then you will be deemed to be guilty of professional misconduct. Why? Because we can't certify the future, right? That's why they have put this restriction. Sir, does that mean I should not get associated with the prospective financial information? No, you can get yourself associated, but make sure that you are not using your name in such a manner that it is vouching for accuracy. You should not let your name be used in such manner. You do the work regarding future financial information, but make sure that you are not vouching for accuracy. So how you can do that? That we will see it in the SAE. But whatever it is, if you are letting your name to be used in such a manner that you are vouching for accuracy of the forecast, then also you will be deemed to be guilty of professional misconduct. Next, fourth point, which says that if you are having a substantial interest, if you are expressing your opinion on financial statements of any business or enterprise in which either you or your firm or your partner in your firm is having a substantial interest. Any of you, either you, your firm, or any of your partner is having a substantial interest. That means you are having a financial interest there, self-interest threat is there, but still if you have expressed the opinion, you will be deemed to be guilty of professional misconduct. So here they bring some provisions regarding Companies Act and all. So I will try to tell you what are important here. Yeah, this one. These are the recent council decisions. Yeah, these are the recent council decisions where they have told that you can't accept the auditorship of college if you are acting as a part-time lecturer there. And also you can't accept the auditorship of a trust if his partner is either an employee or trustee of that respective trust. These are some recent council decisions which have been taken where they have prohibited some appointments. So what are they? If you are conducting auditor, if you are, just a minute. Right. So if you are conducting, if you are a part-time lecturer in a college, for that college you can't do auditor, you can't act as auditor. If your partner is an employee or trustee of a trust, for that you can't accept it as a, for that you can't, for that trust you can't become a auditor. And remaining provisions, some other provisions they have given, these are all related to the provisions of the Companies Act. Just 141 subsection 3 disqualifications, they will try to repeat it here, nothing much. Next after that, so this is what regarding clause 3, clause 4 we have completed. Right. So these three are something relating to my negligence. If I don't do the work properly, then also I say will consider me as guilty of professional misconduct. So what are the activities which they have told us? Like if you see clause 5, there is a material fact which is known to you, which should have been disclosed in the financial statements. There is a material fact which should have been disclosed in the financial statements, but you have failed to disclose it. But disclosure of which is necessary in making such financial statements where he is concerned with that financial statements in a professional capacity. So which means that if you are failing to disclose a material fact, that means management is required to give some disclosure in the financial statements. It is very important. But management did not disclose it. You have to tell it now in your report. If you are also not disclosing that fact which should have been come in the financial statements, that means you have behaved negligently, you will be deemed to be guilty of professional misconduct. That means you did not fulfill your professional responsibilities properly. Then if you read clause 6, if you fail to report a material misstatement known to him in the financial statements, you are conducting audit of financial statements, you got to know that in that financial statements there is a material misstatement, but still you are not giving a modified opinion, then also you will be deemed to be guilty of professional misconduct. Then clause 7 says if you are exercising due diligence, if you did not do the work in a proper manner, if you behaved negligently, or if you are not exercising proper care while doing your duties, then also you will be deemed to be guilty of professional misconduct. And clause 8 is also relating to my professional work only. If you are failing to obtain sufficient and appropriate audit evidence which is necessary for expression of opinion, for expressing opinion you need evidence, but without obtaining sufficient and appropriate audit evidence, if you are expressing an opinion, or if you don't have if you don't have evidence, you should have given a disclaimer. So you don't have sufficient and appropriate audit evidence, you should have given disclaimer, but still you are giving some other opinion other than disclaimer of opinion, even without evidence, then also you will be deemed to be guilty of professional misconduct. So I will say here 5, 6, 7 and 8, all these three are related to my professional work. I think even clause number 9 also will fall under that category only. Like if you see here, fails to invite any attention to material departure from generally accepted procedure of audit. So you are supposed to follow from standards on audit. Say for example, SA 501. I am required to follow some procedures regarding inventory. I did not follow the procedures. I departed from the requirements of audit procedures of SA 501. But I did not invite anybody's attention in my audit report. So if you are failing to derive attention regarding any material departure from the generally accepted auditing principle, then also you will be deemed to be guilty of professional misconduct. So if you see here, all these 5 clauses are there which are relating to my professional responsibilities. Like if I fail to disclose a material fact which was not disclosed in the financial statements, if I am not reporting a material misstatement, if I behaved negligently, if I am expressing the opinion without getting information, or if I am failing to draw the attention to material departure from a generally accepted auditing procedure. And last clause which they say is if you are not handling your client money. So if you are not properly handling your client money, which says that if the client has given you your money apart from your remuneration, not your fees, not your remuneration. If your client has paid you some money, which you have to use it for certain purposes, that money you have to keep it in a separate bank account and use it for the said purposes only. So if you see here, if you fail to keep the money of his client other than your fees or remuneration, or the money which is required to be expended in a separate bank account, or if you are using such money for the purpose for which they are intended within a reasonable time. So if the client has given, like for example, the client has given you some fees to do the investment, to go and invest it somewhere or something. So that is not your fees, that is client's money. He gave you for handling it. Now it is your responsibility to keep it in a separate bank account, and it is your responsibility to use it only for the dedicated purposes. If you are not keeping it in a separate bank account, or if you are misusing it for other purposes, then you will be deemed to be guilty of professional misconduct. However, sometimes client will give you money apart from the fees, but that money will be spent in a reasonably short period of time. Within a very short period of time, I will spend that money. Then it need not be kept in a separate bank account. So that they say here, money is received for expenses to be incurred. For example, payment of statutory fees, purchase of stamp paper, which are intended to be spent within a very reasonably short period of time, that need not be put in a separate bank account. Sir, but what is a reasonable short period of time? That all depends upon the facts and circumstances. So basically, these are all the clauses where a person will be deemed to be guilty of professional misconduct under second schedule. And as you could see, all the clauses are relating to those activities which will break the trust of the people. That's why they offered more punishment for these activities. So what are they? Let us have a quick look. Clause 1, if you are breaching the confidentiality. Clause 2, if you are certifying without verification. Clause 3, if you are vouching for the accuracy of the future information. Clause 4, if you are expressing the opinion where you are having a substantial interest. 5, 6, 7, 8, 9, my professional negligence, like non-disclosure of material fact, not reporting a material misstatement, I am grossly negligent, expressing the opinion without obtaining information, or I fail to draw the attention to material departure from the generally accepted auditing procedures, and I am not handling the client's money properly. And then we have part 2, which says a chartered accountant in general, whether in practice or service, will be deemed to be guilty of professional misconduct. So everybody will, whether in service or practice, for both they have covered it. So they have told here, if he contravenes the provisions of any of the act, regulations or guidelines. So if you are a chartered accountant, whether in practice or service, if you have violated any of the regulations, provisions of this act or guidelines issued by the council, you will be deemed to be guilty of professional misconduct. So samples have been given here, like what are the regulations which you have to comply and all. So any regulation, any act, any guideline you have violated, deemed to be guilty of professional misconduct. And similarly, clause 2. Now clause 2 says that misuse of money once again. So if you come to the summary here, clause 2, confidentiality. Clause 2 we have regarding confidentiality. Sir, confidentiality we have already covered, no sir. But here under part 1 we have covered confidentiality only for chartered accountant in practice. Now here if they say confidentiality, they are specifically referring to chartered accountant in service. If you are not in practice, if you are an employee of some company, your employer's information also you should not get that, you should not disclose it to anybody outside of your employer. So that's why confidentiality breach also will make you professional misconduct. But this is talking from the employee's perspective. Why? Because for practicing chartered accountants, they have already covered it under part 1, clause 1. Then if you are providing false information, see one interesting point here. If you are not providing the information, if you are not submitting the information to the institute or regulatory authorities, you will be deemed to be guilty of professional misconduct under clause 2 of part 3. You are providing the information, but if you are providing wrong information to the ICAI, then more severe punishment will be there for you. You will be deemed to be guilty of professional misconduct under second schedule. So not providing information, part 3. Providing the information but wrong information you are providing, wrong information you are providing, second schedule. If you don't provide the information, first schedule. Next, if you are defalcating or embezzling the money, if you are misusing the client's money, if you are misusing the money of your clients, then you will be deemed to be guilty of professional misconduct. Now you will say, sir, anyhow that they have covered it here. No, sir. Clause 10 they have covered. No. Once again, this is from the perspective of chartered accountants in practice. Here, defalcation or embezzlement, they are talking it from the perspective of chartered accountant in service. Even if you are a chartered accountant in service, you should not misuse your employer's money and all. You have to use it for the intended purposes. You should not do defalcation. You should not do embezzlement. So these are the two schedules, multiple clauses they have given, where they have told when a person will be deemed to be guilty of professional misconduct, when a person will be deemed to be guilty of other misconduct, under first schedule when, under second schedule when. So all this they have covered. So we have revised all of that. Okay, right. So now we have some council guidelines. See, in the council guidelines, I will tell you a few council guidelines which are important. See, networking guidelines is there, but for networking guidelines, I already have a dedicated video on my YouTube channel where I have explained in a very detailed manner regarding the networking guidelines. You can refer to that video on networking guidelines. So, apart from the networking guidelines, what other things which are important here is maintenance of books of accounts. So, every chartered accountant in practice must maintain the books of accounts. So, what books of accounts they have to maintain? Cash book they have to maintain and proper ledgers they have to maintain. See, why I am telling you this is very important. Sometimes I will ask a question. They will say that a chartered accountant is there. He's declaring his turnover did not exceed the limits as per the Income Tax Act. That's why he's not maintaining the books of accounts as per 44AA. So, is he guilty of misconduct? Yes. Why? Because he has violated council guideline. So, irrespective of your turnover, irrespective of your applicability under other acts, every chartered accountant in practice must maintain one cash book and ledgers they have to maintain. Then also we have one council guideline regarding tax audit assignments. How many number of tax audits a chartered accountant in practice can do? So they told that a chartered accountant in practice can do 60 tax audit assignments. Per chartered accountant in practice, you will be eligible to do 60 tax audit assignments per practice for each practicing chartered accountant. Which means, say for example, if in a firm there are 10 practicing chartered accountants, totally how many tax audit assignments they can do? They can do 10 into 60, 600 tax audit assignments they can do it. And here few more things to make you understand here, few more technical points you have to understand here. See, when I say there is a firm in which there are there is a firm in which there are 10 practicing chartered accountants, they can do total 600 audits, 600 tax audits. Now all these 600 tax audits can be signed by one single partner also on behalf of the firm. There is no requirement that each partner should sign only 60, 60, 60. All the partners can sign, any one partner also can sign all the 600 tax audit reports on behalf of the firm. It is not a mandatory rule that every partner should sign 60, 60 only. No, one single partner on behalf of the entire firm can sign all the 60. Sometimes what will happen is a practicing chartered accountant can be a partner in multiple firms. A practicing chartered accountant can be a partner in multiple firms. Say for example, he is partner in 3 firms. Will he get the limit of 60 in all the 3 firms? No. For all the firms and for all the individual practice put together, a limit of total 60 only will be counted. It is his choice how he wants to distribute. He will not get 60 limit for every entity wherever he is a partner. Next, however, if a partner is in employment, they say the specific point. If a partner is a practicing chartered accountant, but he is a part-time practicing chartered accountant, the limit will not be counted for him. If there is a partner in your firm, but that partner is a not full-time practicing partner, he is only a part-time practicing partner, for him the limit of 60 will not be counted. Like say for example, if I have total of 10 partners, out of that 9 are only full-time partners, one is a part-time practicing chartered accountant who is a partner for me. For that one person 60 will not be counted. Even though we have 10 partners, 9 into 60, only 540 tax audit assignments I can do. Okay, next. Company audit assignments. See, when it comes to company audit assignments and all, so they have told 30. All the same rules, whatever they have told for the tax audit, same thing will apply here. But instead of 60 limit, they say that when it comes to company audit assignments, they have told the limit of 30 audit assignments for each practicing chartered accountant. However, in that limit of 30, what will not be counted is one-person company and dormant companies will not be counted. That means for one-person company and dormant company, any number of audits I can do. Apart from one-person company or dormant company, maximum a practicing chartered accountant can do 30 company audit assignments, and whatever we have discussed for the tax audit rules, calculations and all, everything will become as it is applicable here also. Next. Okay, so this one point also I will try to clarify here. See, if you are acting as a statutory auditor of these entities, which entities? If you are acting as auditor of a PSU company, if you are acting as auditor of government company, or if you are acting as auditor of listed company or any other public company having a turnover of 50 crores or more. So if you are conducting audit of this company, apart from audit, can I perform other services? Yes, you can perform other services if they are not falling under section 144 services. See, section 144 is prohibited services, right? So apart from section 144 services, so say for example, there is a company X Limited. For this company, you are acting as a company auditor. For this company, you can't provide section 144 prohibited services, you can't provide. So apart from that, along with doing company audit, can I provide other services? Yes, you can provide other services. But here, council guidelines has put one rule. What rule they have put is whatever fees you are collecting for audit assignments. So let me put it here. For company audit, for providing the company audit, if I am charging 10 lakh rupees of audit fees, but I am providing other services, say for example, I am providing some 4 other services apart from company audit, which are not covered under section 144. For service 1, I am charging 2 lakh rupees. For service 2, I am charging 3 lakh rupees. For service 3, I am charging another 3 lakhs. For service 4 also, I am charging 3 lakhs. Now they say that I will be guilty of professional misconduct. Why? Because whatever fees I am charging for other than company audit is 11 lakh rupees, whereas the fees for my statutory audit is only 10 lakh rupees. So here I will be deemed to be guilty. Here I have violated the council guideline. So what exactly they are trying to say here is, if you are accepting only for these companies, this rule will become applicable. So if you are conducting audit of other above companies, if you want to accept any work or assignment or service in regard to same undertaking on a remuneration which in total exceeds a fee payable for statutory audit, then you will be deemed to be guilty of professional misconduct. Then you have violated the council guideline. That means for the company for which you are rendering the company audit services, if you want to render other services, do it. But the maximum fees, the fees for that other services cannot exceed my statutory audit fees. Able to understand? And yeah, this is what they try to say there. This is one thing you have to remember. Is there anything else? Auditing guidelines and all we know. I have told networking guidelines. I have a detailed video that you can refer to it. Apart from that, CA logo, this is the new CA logo. This logo only you have to use. Yeah, corporate form of practice. See, I told that generally people cannot incorporate companies for the purpose of carrying out practice, right? But ICA has given one exception. What they told is, if you are a chartered accountant in practice, you can become a managing director or whole-time director of the company. Generally, you can only become normal director. If you want to become a managing director or whole-time director, you need specific permission of ICA. But what ICA has told is, as a chartered accountant in practice, without obtaining any permission, you can become a managing director or whole-time director in such a company which was incorporated only to provide the management consultancy services. Only to provide management consultancy services. In the intro part, I have told you, right, what will fall under management consultancy services. The list is very lengthy, So if you are incorporating the company only for the purpose of providing management consultancy services, in that company, you can become a managing director, you can become a whole-time director without any objection. Or say, for example, 4 chartered accountants are there. These 4 chartered accountants incorporated a company ABCD Private Limited, and in the name of that ABCD Private Limited, they want to provide only management consultancy services. Is this permitted? Yes, this is permitted. So corporate form of practice is allowed only for those companies which are providing management consultancy services. You can't say we will incorporate the company and start providing tax audit services, income tax services, or statutory audit services. For that, you can't incorporate the company, but you can incorporate the company exclusively for the purpose of providing management consultancy services. And one more thing here, if you are a chartered accountant in practice, if you are a managing director, or whole-time director in some company, if you are a managing director or whole-time director in a company which is providing management consultancy services, in addition to that, you can also hold certificate of practice. You can practice either in your individual name, or even you can also become a partner in any of the practicing partnership firm. You can do both. You can also be a managing director or whole-time director in this company which is providing management consultancy services, and also you can hold the COP, either practice in your individual name, or even you can also become a partner in a audit firm. So this kind of corporate form of practice is allowed. Okay, right. So that's all regarding this chapter, everyone. So I think we have covered all the major provisions from the professional ethics. Here and there, a few things are left out that you can quickly go through it, but this is where mainly the questions are going to come from. So you have to be very careful about it. And one more small thing I would like to add here. Previously, I was telling that fees limit, previously I was telling that fees limit, right? If you want to provide other services apart from audit, you can do that other services also, but I told that fees for other services should not exceed, right? But however, while calculating that fees for other works, you should not include audit conducted under any other statute, certification work required to be done by the statutory auditors, or any representation before an authority. The fees for these services should not be counted. We calculated that limit, right? So what I was referring is this example. This example I told you. So what they are telling is, this one last example I will do. Why? Because here the chances of MCQs or questions are there. So this one example I will do. Say for example, there is a practicing chartered accountant. Okay. Now he is conducting audit of one PSU. Audit, statutory audit he is doing, for which audit fees is 10 lakh rupees. Now he is providing some management consultancy services. Apart from audit, he is providing some management consultancy services, for which he is charging 2 lakh rupees. He is also providing another management consultancy service too, for which he is charging 5 lakh rupees. He is also doing tax audit. For which he is charging 4 lakh rupees of fees. Now you tell me, did he violate council guideline? What does the council guideline say? If you are providing any other services, the fees which you are charging should not exceed my audit fees. See here, what is the fees I am charging for other works? Practically speaking, for all other works, I am charging somewhere around 11 lakhs, but I should not consider it as 11 lakhs. Here I have to consider it as 7 lakhs. Why? Because in the council guideline, they have told that when calculating this other works, when calculating the fees for other works, you should not include in them audit under any other statute like tax audit or certification work. Say for example, in the same example, this auditor is not doing tax audit, he is doing some certification work. Even that also should not be counted. Or any representation before any tax authorities. Say for example, apart from acting as an auditor, he representing the case before the income tax department, for which he charged 4 lakh rupees. That also should not be considered. So in the definition of other works, you should not include audit conducted under any other statute, certification work which is done by the statutory auditors, or any representation made before any authority. These things should not be included while calculating the fees for that other services, right? So okay guys, that will be for today. So today we have done quality control and professional ethics. Yeah, so we have made a good progress here. So what we will try to do now, so first we will try to pick it up, audit strategy, planning and program. That chapter we will try to revise quickly. Very small chapter, very simple chapter, very what I will say is very routine chapter. Point wise concepts all will be there. Here there will not be much concept for us to learn and understand. So conceptually very less discussion we will have. Most of the questions will be like advantages, benefits, what factors you have to consider, what things you have to pay attention. So these kind of things they mainly talk about it. So let us try to have a quick revision of this chapter, audit strategy, planning and program. And mainly in this chapter, this chapter is mainly going to talk about the planning process, overall planning process. So like the way for any activity which we want to do or which we are doing, which we are supposed to do, for all that activities we do some sort of planning. For every activity we do some amount of planning. So why we basically do the planning is because we want to have control over the process. If any activity we want to do, unless and until we have a proper plan, that activity might not be under our control. control. So if you want to have control over that activity, if you want to make the things happening on time, that too in a planned manner without any disturbances. So in order to make sure that there are no troubles in performing an activity, we spend a lot of time, we spend a significant amount of time on planning. Even audit is also not an exception. Whenever we are supposed to do an audit engagement of the client, for any client, if we are doing audit engagement, directly we will not jump and start doing the audit. Here also, even in the audit also, what we try to do is we try to spend some amount of time in planning that audit of the financial statements. Even in audit also, since it is also a normal activity like any other activity, even in audit also, if we want to do the audit in an effective manner, if we want to have the control over our entire audit process, if we want to make sure that our work is happening in a seamless manner, and if we want to make sure that we are doing the correct things like the way we do the planning for other activities, a significant amount of time we have to spend it even for planning of the audit of the financial statements also. And regarding the planning of audit of the financial statements, SA 300 gives us all the required guidance, what things you have to keep in mind, what factors you have to consider, how you have to do the planning of audit of financial statements. All that guidance has been given under SA 300. And in the SA 300, this standard says that when we say audit planning, when I say planning of audit of the financial statements, they say that from the audit perspective, whenever we are doing the planning of audit, it involves 3 phases or it involves 3 steps. So when it comes to audit planning, there are 3 phases or 3 steps for the purpose of involved in the entire process of the auditing. So what are that 3 steps or what are that 3 activities is? Number one is, first we will work on development of audit strategy. Number two, we will work on development of audit plan. Then number three, we will work on development of audit program. So planning of audit involves 3 phases. It involves development of audit strategy, which is the first and foremost step. On the basis of development of that audit strategy, we are going to develop an audit plan. And on the basis of that audit plan, we are going to work on something called audit program. Sir, what will be there in the audit strategy? Very simple. Audit strategy is the first and foremost step. So generally what we do is we try to decide on resources, how many resources we want to complete the audit, within how much time we want to complete the audit, what is the overall scope of the audit, what is the overall direction of the audit. So on a very broader level, we set one strategy for this audit. Like the way we will have the strategy for entire things. Like for example, if you have an objective of qualifying your CA final examination in the September 25 attempt or Jan 26 attempt, you will generally have that thing in mind. You will have one strategy. Okay, this subject I will concentrate more. This many hours I will subject on this. I will spend on this subject. In this subject I will get the aggregate marks. In the remaining 2 subjects I will try to qualify. So like that, you will have one strategy in place, right? Similarly, even in doing the audit also, we will have one strategy. We need to decide on how many resources we want for completing the audit. Do you want 10 resources, 15 resources, 20 resources? Within what time you are supposing to complete the audit? Are you trying to complete the audit in 10 days, 15 days, 20 days, 1 month? And what is your overall scope of the audit? What is your overall direction of the audit? So those things we will try to decide in a document called audit strategy. See, once we have established the strategy is just scratching the surface of the planning. The planning is not completed with the strategy. The planning has just begun with drafting of the strategy. Now what we will do is, on the basis of that strategy, we are going to work on developing an audit plan. Sir, what do you mean by development of this audit plan? So nothing but in the strategy we have decided on resources, how many resources we want, within what time we want to complete the audit. Say for example, in my strategy I have decided I want to complete the audit with 10 resources with 15 days of time. Now these 10 resources, in these 15 days, which person should do which work, which person should handle which area, each area requires how much amount of time, that allocation of time and resources should happen. The document in which I am going to allocate that time and resources among the different tasks which are involved in the audit, that document I am going to call it as audit plan. Like as I was saying, if I have 10 engagement team members and I have decided to do the audit within 15 days of time, now in audit I will have different areas, like I have risk assessment procedures, further audit procedures. In the further audit procedures also I have compliance. Compliance, I will check the internal controls. I need to check the internal controls in different areas, assets, liabilities, incomes, expenses. Then I need to perform further audit procedures. Now in the further audit procedures also I need to, substantive audit procedures. I need to perform substantive audit procedures in the area of assets, liabilities, incomes, expenses, and then I need to do some coordination. Then I have to arrive at the conclusion. Then finally I have to draft the opinion. So these many tasks are involved in the entire process of the audit. Now I need to allocate who will do this task and within how much time this task will be done. Say for example, risk assessment procedures I have allocated to engagement partner, and the time which I am allocating him for completing the risk assessment procedures is 2 days, for example. Compliance procedures in the area of assets, I am allocating this work to Mr. A, who is an audit manager, and I am giving him 3 days of time. So like that, each area who will handle it and within what time they are supposed to complete, when they have to coordinate with each other, when they have to arrive at the conclusion, when they have to draft the opinion, when they have to sign it. So all this task, whatever are involved in the entire process of the audit, who will do it and within what time they will do it, that I will try to document in a document, that I will try to keep it in a document, that I call it as, that document I call it as audit plan. So then we have something called audit program. Sir, what is this audit program? Now I will say audit program is a much more detailed version of the audit plan. Audit program is a much more detailed version of the audit plan, which is going to contain verification procedures. It is going to contain instructions which are required to be followed by the members of the engagement team in each and every area. Like for example, in the area of purchases, I have allocated a substantive audit procedures to one of my article assistant, Mr. A. Okay, now this person, Mr. A, in this area of purchases, while performing substantive audit procedures, what and all instructions he will require to follow, that I will give it in a document. Like I will say, you are required to take 10% of the sample. B, you have to do inspection. You have to verify internal controls. You have to decide whether you can rely on the controls or not. You have to coordinate with the person verifying the trade payables. So like that, what instructions is required to follow, what verification procedures he needs to apply in that specific area. The detailed verification procedures along with instructions will be contained in a document. That document I am going to call it as audit program. So if you have done audit strategy, if you have built the audit plan, if you have built the audit program, then your planning process will come to an end. And if you want your audit to be effective, and this planning process has to be compulsorily taken care of. Okay. And as I've told, first thing what I will try to do is, first I will try to establish the audit strategy. Now my question is, will I establish the audit strategy after performing risk assessment procedures, or I will perform risk assessment procedures after building audit strategy? When I will perform risk assessment procedures, will I perform risk assessment procedures before establishing audit strategy, or will I perform risk assessment procedures after establishing audit strategy? The answer is, you will try to perform risk assessment procedures before performing audit, before building the audit strategy. Why? Because as I have told, in the audit strategy, we are required to work on timing and resources required for completing the audit. If we want to decide how much time we want for completing the audit, how many resources we want to complete in the audit, how many resources we want for completing the audit, that decision I can take it, not just whatever comes to my mind. I have to take that decision on the basis of size of the entity, nature of the business, their operations, what is the volume of the transactions, what is their to which industry they will belong, what are the requirements of applicable financial reporting framework, what laws and regulations are applicable for them. So like this, unless and until I know all these activities, I can't get the required information to decide on the audit strategy. So first, auditor will perform risk assessment procedures. And also, if you remember, at the beginning somewhere I have told that you will perform something called preliminary engagement activities. Yes, even you will perform the preliminary engagement activities like drafting the engagement letter, communicating with the previous auditor, determining whether it is suitable to accept or continue the client relationship. So that preliminary engagement activities also I will perform. So I will complete my risk assessment procedures. I will complete my preliminary engagement activities. After that, I will start working on development of audit strategy. Directly, I will not jump into the development of audit strategy after performing risk assessment procedures and after doing the preliminary engagement activities. Depending on the outcome, depending on the information, whatever I get from the risk assessment procedures, and depending on the outcome, whatever I get for this preliminary engagement activities, I am going to work on my audit strategy. Then audit plan, then audit program. So that's all, guys. This is what the concept we have in this chapter. Apart from this, we don't have much concept to discuss. Now, what will be there in this chapter is just a list of questions which is talking about when you are developing audit strategy, what factors you will consider. Whenever you are developing audit plan, what things will be included. Advantages of planning, advantages of strategy, what things you have to keep in mind while developing audit program. So like that, a series of point-wise questions are going to be there, which we will try to complete as quickly as we can. Okay, right. Come on. Okay, so first one, as I've told, first and foremost activity is establishing the audit strategy. And if you see here, we have one particular question, one particular concept, very important. Multiple times they have asked it in the examination. So very, very important. So the first aspect is what factors you are required to consider while establishing the overall audit strategy. So as I have told, in the audit strategy, we are going to decide on the time and resources. But as I have told, we will not just like that arrive at whatever things come to our mind. So if we are deciding certain time for completing the audit, if we are deciding these many number of resources are required for completing the audit, that decision should be an informed decision, that in arriving at that conclusion, various factors we have to consider. So what and all are the factors which you have to consider? So this particular standard, this particular essay 300 says you need to broadly consider 5 factors. Number one, first thing, you need to consider characteristics of the audit. Number two, we need to understand, we need to consider, we need to keep in mind reporting objectives. Number three, we need to understand, we need to consider various other factors which I might feel important in my professional judgment. And even as I've told, I will perform preliminary engagement activities. I will consider the results of that preliminary engagement activities, and even I will pay attention to nature, timing, and extent of the resources. Even I will pay attention to nature, timing, and extent of the resources which I have. So while establishing overall audit strategy, I will consider 5 factors. What are they? Repeat everyone. Characteristics of the engagement, reporting objectives, team's efforts, considering the results of preliminary engagement activities, and nature, timing, and extent of resources. And in this question, you will be able to find, in this concept, you will be able to find examples of what will be included in the characteristics of engagement, examples of what will be, you will consider in the reporting objectives, what are that matters which are significant in the auditor's professional judgment, what information regarding preliminary engagement activities you will consider. So like that, we have a few examples. Like if we quickly go through here, like as I was saying, if you are establishing audit strategy, you need to consider characteristics of your client. Sir, what characteristics I have to pay attention? Like you have to pay attention, what is your client's applicable financial reporting framework? And also you need to understand, is industry to which your client belongs, according to that industry, any specific requirements are there. You need to understand what is your coverage, how many number of locations you have to do the audit, how many locations you have to do the audit, if there are branches, separate branch auditors are there or not there. And even relationship between parent and components. If you are conducting audit of consolidated financial statements, you need to even understand the relationship between the subsidiary, holding, associates, etc. And even the extent to which the components are audited by others. Once again, the components have they been audited by other auditors? And is there any requirement to make use of service organization? Is your client making use of services of the service organization? And if previous year's audit evidence is available, if yes, can you use it? And what is the effect of information technology? How far your client is making use of information technology? And even availability of client's data, whether client's data is completely available. If available, what volume of the data is available? Able to understand? So like this, these are the examples of the characteristics of audit which you need to keep in mind while establishing audit strategy. Then we have reporting objectives. Reporting objectives basically means, is there any timeline for reporting? Is there any timetable? If the management has set one timetable for reporting, are they having any deadline for disclosing their financial results to the public? So like that, we need to understand reporting objectives, and the examples which will come here in an area of reporting objectives is, like as I've told, timetable for reporting. Is the entity is following any timetable for reporting? Organization of meetings, when management have planned for their board of directors meetings. And also, is there any type, what type of reports you are required to give, and within what time you are required to give that reports. And you have to continuously communicate regarding the status of the work, and even communicate with the auditors of the components. As I've told, if there are other auditors, try to communicate with them. And nature, timing, and communication. What nature of communications are required? What is the timing? What is the expected time within which such communications are required, or any other expected communication? So basically, you are required to consider all that reporting objectives. And then they say team's efforts, not just the above. If you consider anything other, any other factor which you feel in your professional judgment as significant, consider that factors also. Then comes the fourth aspect. You need to consider results of preliminary engagement activities. Like as I was saying, you would have performed the preliminary engagement activities, like you would have drafted engagement letter, you might have communicated with the previous auditor, and also you would have determined that factors regarding acceptance and continuation of client relationship. So all this information, all these activities will fall under preliminary engagement activities. From that preliminary engagement activities, you have got some information, use that. And also, if you have performed any other engagements for the client, in the past, even you can use the knowledge gained from that other engagements also. Like what kind of knowledge, sir? What kind of information regarding preliminary engagement activities, or what kind of knowledge gained from other engagements I can use? Here also they have given example, like determination of materiality, identification of areas where there is a high risk of material misstatement. Should also pay attention impact of the assess, what is the impact of that assessed risk of material misstatement. And also, is there any need for maintaining professional skepticism? 100% yes, there will always be need for maintaining professional skepticism, but in some clients I need to maintain high level of professional skepticism. In some cases I need to maintain low level of professional skepticism, that I will decide. And also results of previous audits. Firm's personnel performing other services, is your firm performing any other services for the client? Use that information. And whether your client is having strong internal control, and what is the volume of the transaction. Importance to internal control, how much importance you are client is giving to internal control, what business developments have taken place which are affecting the entity, has the industry undergone any significant developments, are there any changes in the applicable financial reporting framework. So if you perform preliminary engagement activities, or if you have performed any other engagement for the client, you will get to know this information. This also you can use it for establishing audit strategy. And one more last factor which you have to pay attention: nature, timing and extent of the resources. So before you establish the audit strategy, you should also select your engagement team properly, and whether you have to properly assign the audit work or not, and also engagement budgeting also you have to do. So keeping these factors in mind, we will decide on the resources. Clear? Next. Then they say, sir, okay, I will establish the overall audit strategy, but what is the benefit of establishing the overall audit strategy? They will say three benefits. The standard has told there are three benefits for establishing overall audit strategy. Number one, you can make better decisions regarding deployment of the capital qualitative resources. Which resources are required to be deployed? Like, do you need experts? Do you need highly experienced team members or low experienced team members? If you need experienced team members, you will go and allocate that to the high risky areas. If you have less experienced team members, that you will go and allocate it to the low risky areas. So by establishing audit strategy, you can take better decision regarding employment of the qualitative resources. Then allocation of quantity, you can also take better decision on quantity of the resources. How many number of resources you want for each area? For inventory verification, how many people I want? For internal control verification, how many people I want? So you can take better decisions regarding quantity of the resources. And also you can take better decisions regarding timing, when resources are required to be deployed. So three questions it will answer. By establishing audit strategy, you will get benefited in three ways. First one, which resources are required to be deployed, that is qualitative or experienced or less experienced. Number two, how many number of resources are required to be deployed. Third one, timing, when the resources are required to be deployed. And not just that, by having an overall audit strategy, you can betterly manage your resources also. Better management of the resources is also going to happen. Then what are the benefits or advantages of planning? So if you do the planning, see, planning is a process. See, I told that we will establish the audit strategy, we will develop the audit plan, we will develop the audit program, no? So the time which we are spending, or the process of this development of audit strategy, audit plan and audit program, this process I call it as planning. Audit plan is different, planning is different. Audit plan is a document which contains the allocation of the work and resources, whereas planning is the entire process. At the beginning of the audit, we all will sit together and establish this audit strategy, planning and program. No, that process I call it as audit planning. Sir, why it is important to do the planning? Why can't we directly jump into the audit and start doing our procedures? Why? Because if you do the planning, you will get benefited. How you will get benefited? So common sense points, you will get to know which areas to pay attention to, which areas require more attention, which areas require less attention. And if any problems arises, in a timely manner, you can resolve them. You can properly organize and manage your engagement team. You can betterly select your engagement team members. You can direct and supervise your engagement team, and even it will promote the coordination. If you do the planning, that will result in better coordination among the engagement team members. Right? Sir, what are the factors which affect nature and extent of planning? What do you mean by nature and extent of planning is, will I spend more time on planning or will I spend less time on planning? That depends on what factors. So the factors which are affecting nature and extent of planning means, am I going to spend significant amount of time in planning or will I spend less amount of time in planning? That depends on what factors? Simply three factors. It depends on size and complexity of the auditee. Audit in the sense client. If the client is very complex, if the client's business is very complex, there I need to spend more time on planning. If the client is very simple, if the client's business is very simple, like it is just a trading entity, wholesale entity, there the business is very easy to understand, I need not spend more amount of time on planning. It also depends on my and my engagement team's past experience and expertise. If all my engagement team members are having enough of expertise, this kind of company, this kind of industry, we have done multiple times audit, no need to spend so much amount of planning. You can spend less amount of planning. It also depends on changes in the circumstances. If the circumstances are frequently changing when compared with the last year to this year, then also we need to spend some significant amount of time in planning. So these are the factors which affect nature and extent of the planning. Now, what should be the contents of audit plan? As I have told, on the basis of audit strategy, you will develop a audit plan. No, in that audit plan, what contents will be there? What you will include in the audit plan? Like what audit procedures we will do, who will perform the audit procedures, who will review the work, when we have to coordinate, when we have to form the conclusion. So like that, all such contents will be there. So if you start reading it here, so it contains nature, timing and extent of risk assessment procedures. It will contain nature, timing and extent of further audit procedures. It will also contain details of other planned audit procedures, And between audit plan and audit strategy, which one is more detailed? Between audit strategy and audit plan, which one is a more detailed document? Audit plan is a more detailed version than audit strategy. So audit plan, in the audit strategy, we just decide on the time and resources and overall scope and direction. But in the audit plan, we actually allocate the work among the different resources. So generally, audit plan is much more detailed than the audit strategy comparatively. And both this audit strategy and audit plan are closely related with each other. Both this audit strategy and audit plan, both are closely related with each other. If you are making a change in one, other thing is also automatically required to be changed. So if you make any, these are not two separate activities. Audit strategy and audit plan are closely interrelated processes. If you make change in audit strategy, that requires change in audit plan. If you make change in audit plan, that requires a change in the audit strategy. Both are closely interrelated with each other. So that's what they try to explain here. Relationship between audit strategy and audit plan. Both are closely related. A change in one will resultantly lead to the change in the other. Next. One more thing they say here, planning is not just one-time activity, it is a continuous process or a iterative process. Iterative process means a repetitive process. It is not just some one-time activity. It is not like at the beginning of the audit, we have done the planning and we have ignored it. It is not like that. Planning is something which is a continuous activity. It happens on a continuous basis. Throughout the audit, it will happen. And in fact, what they will say here is the process of planning will start from the completion of the previous audit engagement and it will continue till the completion of the current audit engagement. Sir, what does that mean? Throughout the audit, will I be doing only planning? No, that's not what I meant there. What do I mean by planning is a continuous process? At the beginning, at the starting phase of the audit, we plan the audit. We will have an audit strategy, planning and program in place. But during the course of the audit, if required, or we should be alert, or we should remain alert to the information which might require us to make changes to your audit strategy and plan. If at all you come across any circumstances which require you to make changes to your audit strategy, planning and program, you should be ready to update it. So that is what the meaning of planning being a continuous process. So planning is not just a discrete phase of an audit, but rather it is a continuous and iterative process. And once again, they say a few more things here. When you are planning the financial statements, when you are planning the audit of the financial statements, what matters you are required to consider? Like I need to analyze what analytical procedures I want to perform, and also I need to keep in mind understanding of the legal and regulatory framework while doing the planning, and also I need to determine my materiality. I need to determine is there any requirement of experts to be involved, and even performance of other risk assessment procedures. I would have performed risk assessment procedures, that information also I have to use. That's why I told first you need to perform risk assessment procedures, then only go for the planning of the audit of the financial statements. Next. Sir, you are telling planning, just now as I have told, during the course of the audit, we might be required to make changes to our planning decisions, no? So generally, at the beginning of the audit, we decide the plan. But during the course of the audit, we might be required to make changes to our planning decisions. What do you mean by making changes to the planning decisions? Changing my audit strategy, changing my audit plan, changing my audit program. Sir, because of what circumstances what are those circumstances which might lead to changes in the planning decisions? So like as you could see here, there could be unexpected events. Sometimes unexpected events will happen which might be required to make my change my audit plan or strategy or program, or there might be change in conditions. Whatever conditions that are prevailing at the time of planning, the same conditions might not be prevailing at the time when I have started doing the audit. Or even when you obtain during the process of the audit, when you have actually started performing audit procedures, sometimes from that procedures you get some extra evidence. That evidence also might necessitate you to go and make changes to your planning decisions. So these are the factors because of which planning decisions might be changed. What are they? Because of unexpected events, because of change in conditions, or because of audit evidence which you have gathered. Next. Sir, who is responsible for preparation of audit strategy and audit plan? So tell me, who is responsible for building that audit strategy and audit plan? So I will say here, the ultimate responsibility for development of audit strategy and audit plan is with the auditor, generally engagement partner. So engagement partner is ultimately responsible for development of audit strategy and audit plan. There is no denial of that. But do you think engagement partner single-handedly, without involving anybody, will he build the audit strategy and audit plan? It's not like that. So yes, what I have told is correct only. So audit strategy, audit plan is the responsibility of the auditor. Engagement partner shall do it, but it doesn't mean he will do it single-handedly. The process of development of audit, in the process of development of audit strategy and audit plan, engagement partner is going to involve different kind of people. Engagement partner is going to involve different kind of people. Sir, who and all will be involved, sir, in the development of audit strategy and audit plan? Do you think engagement team will be involved? 100% yes. So as an engagement partner, while I am establishing audit strategy and audit plan, it is always necessary for me to involve my key engagement team members. Why? Because if you involve the engagement team members, you will get to know about their experience, expertise, and they will also know better understanding about the audit, so that you can allocate the work in a better manner, and you can improve the overall quality of the audit. So that's why in the process of building of the audit strategy and audit plan, there is no doubt at all, I will involve my engagement team. 100% I will do it, because it will improve my effectiveness of audit. Now the question comes, do you think while establishing the audit strategy and audit plan, is there any requirement for the engagement partner to even involve clients, management and staff also? So as a part of that drafting of, as a part of development of audit strategy and plan, is there any requirement for the engagement partner to even involve the client's management and client's staff also? Yes, even you have to involve the client's management and staff. Why? Because if you want to do the audit in a seamless manner, you will need the cooperation of the management and those charged with governance. Without their cooperation, you will not be able to do your audit will not happen in a smooth manner. So that's why auditor must also include the client's management and staff. But you have to be very careful here. You should not, care should be taken that you are not disclosing the detailed audit plan and strategy with them. Why? Because if you discuss with them the detailed audit strategy and audit plan, what you are going to do becomes highly predictable, and the management will take all the precautions to make sure that no misstatement is coming to your notice. So that's why you should involve the management and clients staff. Yes, agreed, but only involve them to the extent their involvement is necessary. Don't discuss the detailed audit plan and strategy with them. That will make your audit completely ineffective. So that is what this question is about. Then we have next aspect, sir, whatever audit strategy we have developed, whatever audit plan we have developed, are we required to document it? Yes. So whatever audit strategy you have developed, that you have to document. Whatever audit plan that you have developed, that you have to document. If you have made any changes to the audit strategy and audit plan during the course of the audit, the changes to the audit strategy and plan, or even if I can put it in that way, revised audit plan and audit strategy, and not just that, because of what reasons you made that changes, that also should be documented. Everything should form part of documentation. Okay, right. So audit strategy, audit plan, and changes to the audit strategy and audit plan, and even reasons why you have made the changes to the audit strategy and audit plan, all these things must be included in my audit documentation. Sir, why the documentation of these things is also required? Why? Because at the planning stage, we are going to take very important decisions. So very significant decisions, like as you could see, we are making very key decisions, important decisions will be arrived at the planning stage. So that's why even documentation of audit strategy, planning and program also required. And even it will also serve as a record of nature, timing and extent of risk assessment procedures. As I have told, at the time after performing risk assessment procedures only we do the planning, no? So that's why if you document the plan, that will betterly document even outcome of the risk assessment procedures also. And also if you have made any changes in the audit strategy and plan, and even that changes, along with that changes, even reasons why that changes are made, that also must be included in my documentation. So this is what regarding audit strategy and plan. So this is one aspect. We are done with the audit strategy and plan. But as I have told, planning process involves 3 steps, not just audit strategy and audit plan. It also involves something called audit program, right? So let us try to understand what is meaning of audit program, and they say a few aspects regarding audit program, that also will try to understand it. So what is the meaning of audit program? Why it will be prepared? So it will be prepared to allocate the work to the team members. But what exactly is the audit? What exactly will be there in the audit program is it will contain audit objectives. For each item of the financial statement, what is the objective? What is your outcome from? What should be your outcome from that audit procedures? And for each area, and have sufficient detail to serve as a set of instructions to the assistants. As I have told, audit program is such a document which will contain instructions, which will contain verification procedures to be applied to the given area, along with the objectives which you are required to achieve. Now, how you have to formulate when you are formulating audit program, what matters you have to consider. See, if I am building an audit program, if I am drafting an audit program, so in the audit program, as I have told, I will include instructions. I will include verification procedures. But how you will arrive at that conclusion? What instructions your team member should follow? What verification methods your team should follow? That how I will arrive at my conclusion? That I will arrive at that conclusion by considering various matters. So whenever you are developing, whenever you are formulating an audit program, there are various matters which you are required to consider, like what is the nature of business in which the organization is engaged. You have to pay attention. What is the client's business? Are they manufacturing? Are they service sector? If they are manufacturing, to which industry they belong? If they are service sector, to which industry they belong? So their laws and regulations and all that things we have to understand it. So you need to draft audit program after considering the nature of the business in which the organization is engaged. And also your audit program must be in line with the audit plan. So say for example, if in my audit plan I have allocated for purchases 2 days of time, now I should also draft my audit program for purchases in such a manner that I should include those instructions and verification procedures in my audit program which can be completed within 2 days. It should not be like in my audit plan I am including 2 days, but in the audit program I am saying I will do verification, but in the audit program I am including such verification procedures which will easily take 5 days. You tell me, if that is the case, is there any purpose of doing the planning? No. So that's why your audit strategy should always be, your audit program should always be in line with overall plan. And also in your audit program, you should give instructions about internal control systems, what aspects they have to verify regarding internal control, and what accounting procedures you are required to verify. That instructions is also required to be given. So in the audit program, you have to include whether there is a existence of system of internal controls to prevent the errors, whether it is there or not. You add the instruction to check it, and even whether accounts are properly authorized or not, and also whether you can place the reliance on internal controls or not, and even review and so this is one more step they will say. So when you are verifying internal control system, it generally has 3 features. So whenever you are verifying internal control system, it should have 3 features. Number one, first we have to do review and preliminary evaluation. That means one basic study we have to do first. Then after that we have to test the compliance. Basically we have to first understand the controls, then we have to test whether they are operating effectively or not. Finally we have to analyze whether the controls are working effectively or not. So when you are drafting audit program, include instructions regarding this internal controls and accounting procedures also. And even you have to pay attention to the size of the organization and structure of its management. You have to draft your instructions after considering what is the size of the organization, what is the management's structure, and also information as regards organization of the business, how the business is getting organized, how the business is getting run, that also you need to consider. And then information as regards, accounting and management policies. So whenever you are drafting an audit program, after considering all these matters, you have to draft the audit program. You have to formulate the audit program. So tell me, what are the matters which you have to consider while formulating the audit program? Number one, nature of the business in which organization is engaged, overall plan, system of internal control and accounting procedure, size of the organization and structure of its management, information as regards the organization of business, and finally accounting and management policies. So consider all these matters into consideration and then formulate the audit program accordingly. Able to understand? Clear and comfortable, everybody? Next. See, like the way we are making changes to the audit strategy and plan, like in the previous part of the chapter we have seen, initially we establish audit strategy and audit plan, but if required during the course of the audit, we make changes to our audit strategy and audit plan, no? Similarly, once we have drafted our audit program also, during the course of the audit, if required, even we can make changes to our audit program also. Sir, when we will make changes? In what circumstances we generally make changes to our audit program? So they say that if the audit procedures were designed for certain volume of turnover, but subsequently volume has increased. Like say for example, as we all are aware, the auditors generally will not wait till the completion of the year to do the audit. In case of big entities, even during the year only we start doing the audit. So when we have started doing the audit before the closure of the financial year, we thought that okay, revenue of the company will be 100 crores only, and keeping that the company is a mid-sized company, I have drafted my audit program. But once the year got closed, I came to know that the actual revenue was not just 100 crores, the actual revenue was 500 crores, more than whatever I have expected. Now you have drafted your audit program that assuming that the turnover of the company will be 100 crores, but now you got to know what is the actual turnover. Don't you think you are required to make changes to your audit program? 100% yes, we will be required to make the changes to the audit program now. Next, one more case where internal controls are less effective. Initially, you thought that on a basic understanding of internal control, you felt that internal controls are effective and accordingly you have drafted your audit program. But later when you actually started performing procedures, you realized that internal controls are not that effective as they look. So now you thought of now you have to revise your audit program. So because you thought internal controls are effective and you might have drafted less instructions for audit program, but now you realize that internal controls are actually not that effective. You have to include more instructions, revise your audit program. And whether in case of extraordinary increase in the book debts or stock value. So then when you have done the planning, now when compared with it now, like the way turnover or volume has changed. Similarly, if there is a significant increase in the book debts or stock value, that too when compared with the previous year, then also you have to make changes to your audit program. And also whenever you have got a suspicion, in case if any suspicion or information you got that assets might have been misappropriated, initially you don't know that, initially you did not felt that need, you felt that there is no chance of misappropriation, but later you realized in this client's organization there are more chances for misappropriation of assets. Now also you have to make changes to your audit program. So basically when the circumstances change, when you get more evidence during the course of the audit, then it becomes necessary for us to go and alter our audit program. Next, so we have one more last aspect from this chapter, so where they will say about how what are the audit execution. So till now we have seen the planning, no, now they talk about overall execution, how audit from beginning to ending is going to happen. So like as I have told, first phase will be planning. We spend significant amount of planning just till now, what that is what we have seen in the chapter. So we draft the audit strategy, we draft the audit plan, we draft the audit program. So first we do the planning. Once we are done with the planning, then we do risk and control evaluation, basically risk assessment procedures, understanding the entity, understanding internal control, understanding environment, identifying the risk of material, identifying the risk of material misstatement, assessing that risk of material misstatement. So that risk and control evaluation we will do. So once that risk and control evaluation is over, basically they are referring to risk assessment procedures. So once that risk and control evaluation is over, then we do the actual testing. Here they talk about actual testing of operating effectiveness of internal controls. Then we do compliance procedures. And then after that, we do the substantive audit procedures also. And from that, we are going to get the evidence. On the basis of that evidence, we will form the conclusion. We will arrive at the opinion. And that opinion we are going to express in the form of a written document. That document we call it as a report. This entire process we call it as reporting. So whatever we know from the beginning, whatever we know, the same thing only they are trying to say it here. But they gave the side headings, that's all. So this is what the entire execution of the audit, this is what will happen in the entire execution phase of the audit. So we spend time on planning, we do the risk and control evaluation, then we do the actual testing, finally we do the reporting. What are our observations are there that we'll try to report it in the form of a written document, which we generally are going to call it as audit report. Understood everyone? So this is what regarding audit strategy, planning and program. So this is why I have included in a second category prioritization is small chapter. They might not ask the question every attempt. They might not ask question. In few attempts they have missed, but in majority of the cases they ask the question from this chapter, audit strategy, planning and program. But in case if they asked it, very few pages, hardly, even if you see in the material also some 6 pages is only there. Small content, limited content, easy to prepare also. And if at all a question comes from this chapter, easily 4 to 5 marks you can fetch it. Okay, so that's why these kind of chapters which generally students will ignore a lot, but this is where you are going to fetch the marks if things goes well. Okay, right. So with this we have completed audit strategy, planning and program chapter. Audit planning and execution, they say the title, so that we have completed. So now as I have told, risk assessment and internal control. So even though I have put it in the third priority, why I am doing it, I have already told you. Why? Because the understanding of the chapter is very important for you to read the questions and interpret the questions. Even if you don't remember the content of the chapter, even if you ignore this chapter from the memorization point of view, but understanding the terminology of this chapter is very important. Why? Because if you don't understand the terminology of this chapter, you are not going to understand the exam questions. So that's why it is highly important for us to have a basic conceptual understanding of risk assessment, internal control and materiality. So I will take a small amount of time and I will try to cover the important concepts from this risk assessment and internal control. Here I will get little bit choosy. So whatever is important for MCQs, whatever is having linkages with the subsequent chapters, so that part of this risk assessment, internal control and materiality chapter, that we will try to have a thorough and a quick revision now. Okay. So once we are done with this risk assessment, internal control, materiality overview of the revision, once we are done, then we go with the group audit, then we go with the internal audit, then we go with SAE and SRE. First we will do SAE and SRS. We will complete very small chapters after completion of risk assessment, internal control. Then we will look into group audit and internal audit. Okay, right. Right. So let us try to have a quick overview of the chapter risk assessment, internal control, and materiality. So three aspects are involved in this entire chapter. Right. See, people are commenting on the chat box. See, I have already told you at the beginning of the video itself, I will do bank audit, NBFC audit, I will get it done. Group audit we will do in this class only. So please watch the video from the beginning. You will get to know what I will be covering, what I will not be covering. So yeah, please. So risk assessment, internal control, and materiality. So this chapter we will try to revise it in a quick manner. So risk assessment, internal control, and materiality. So there are three aspects, as you could see in the title of the chapter itself. We have three aspects of this chapter, three concepts we are required to discuss. One is risk assessment, other one is internal control, and the other one is materiality. So three aspects of this chapter are there, and risk assess, all these three terms, whatever you are able to see here, whatever phrases that you are able to see here, these are nothing new actually. These terms we are all well aware. We know about risk assessment. We have already come across the term internal controls. We have already come across the term materiality. Even if you just look from the marathon perspective also, from day one revision, whatever we have done, at various places we have come across this term risk assessment. At so many places we have come across this term internal control, and at so many places we have come across this term called materiality. At various instances we have come across, and even we have a basic understanding of these three terms also. Even we have a basic understanding of three terms also. Now we need to dig deeper and get a proper understanding, get even a better understanding of these three concepts in a detailed manner. So first I will talk about risk assessment, then I will talk about internal control, then I will talk about materiality. So first let us talk about risk assessment. So guys, if you remember, the first and foremost procedure, which I will do in the audit is risk assessment procedure. Risk assessment procedure I am going to do. So what happens in the risk assessment procedure? If you remember the discussion, whatever we had in SA 500, in the risk assessment procedure, we try to obtain an understanding of the entity, we try to obtain an understanding of the environment, we try to obtain an understanding of entity's internal controls. These three things we are going to understand now. So what is the purpose of understanding the entity, understanding the environment, understanding the internal controls? There we have told that our objective is to identify and assess the risk of material misstatement. So we will come to that risk of material misstatement part later. But in the audit, significant amount of time, we as auditors, significant amount of time we are spending on assessing the risk, analyzing the risk, identifying the risk, doing an analysis of the risk. Significant amount of time we spend in audit on risk matter. So why do you think risk plays such a crucial role in the entire audit? And before I talk about what role risk is going to play in the audit of the financial statements, but first let us try to understand what is the risk in audit. What risk auditor will face by doing the audit? So if you remember the definition of the audit or the overall objectives of the audit, so as an auditor, your ultimate responsibility is to express and is to obtain reasonable assurance whether financial statements are free from material misstatements, and also to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework, arrive at a conclusion and express that opinion, right? This is what my objective. So now you tell me, if there is a chartered accountant in practice and if he has taken up to do some audit engagement for his clients, do you find any risk he is taking by accepting that audit engagement? The chartered accountant in practice, if he has come forward, if a client has come to him and asked him to do some audit engagement for him, and the auditor has told, yes, okay sir, I will do the audit engagement for you. So like this, if the auditor has accepted to do the audit engagement for any client, is he taking any risk there? By doing the audit engagement, will the auditor face any risk? Yes, 100% auditor is going to take some risk. So if I have to put it in simple terms, what is that risk which auditor is worried about is the risk that he might give an inappropriate opinion. The risk that he might give an inappropriate opinion. So whatever opinion auditor has given on the financial statements, that risk, that opinion could be wrong. That opinion can go wrong. That risk that auditor will generally face in kind of every audit engagement, and that risk we give a technical name called audit risk. So what do we call that risk as? Audit risk we are going to call it. So what is audit risk? So if I define it as per the standards, if I define it, They have defined the term audit risk something like this: risk of expressing an, so let me show it here. They say that it is a risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. So what they have told, it is a audit, what is how the audit risk has been defined: the risk that auditor gives an inappropriate opinion when the financial statements are materially misstated. That means financial statements of the client are materially misstated, but if the client is giving but if the auditor is giving an inappropriate opinion there, that risk we call it as audit risk. Sir, what are they trying to say here? First thing they say, financial statements are materially misstated. Guys, you tell me, if the financial statements are materially misstated, if there is a material misstatement in the financial statements, what is the appropriate opinion? What should be the appropriate opinion? You tell me, if the financial statements contain a material misstatement, what should be the appropriate opinion? See, the appropriate opinion should be, auditor should have given a modified opinion, either qualified, adverse, disclaimer, whatever it is. If the financial statements contain a material misstatement, the auditor shall give a modified opinion. But I am saying that auditor is giving an inappropriate opinion. Appropriate opinion is modified, but what I am trying to say here is auditor is giving an inappropriate opinion. That means what auditor is doing? Auditor is giving an unmodified opinion. Instead of giving modified opinion, auditor is giving inappropriate opinion, which is he is giving unmodified opinion. So that means when modified opinion is appropriate, if the auditor is giving an unmodified opinion, when he is supposed to give some negative comment in his opinion, when he is supposed to say that financial statements do not give true and fair view, or accept certain items of financial statements give true and fair view, when he is supposed to give a negative comment, but what auditor is saying is, by giving unmodified opinion, he is saying that financial statements are completely giving a true and fair view. Which is wrong or not? Definitely wrong, when you should have told something is wrong. But if you are saying financial statements are giving true and fair view on the basis of your audit report, if someone invested their money in the company trusting that you have given an unmodified opinion, later if that fraud or error comes into public domain, share price will collapse and ultimately the users are going to suffer the huge losses. So because of your opinion, someone has taken a wrong decision. Don't you think later regulatory authorities will come and question you? You will be held legally responsible. You have to be answerable for your acts. Yes or no? So that risk we call it as, in audit terminology we call it as audit risk. So the risk of auditor's opinion going wrong when the financial statements are materially misstated. That means when modified opinion is appropriate, but the auditor is giving unmodified opinion, that we call it as audit risk. Now let me give you another scenario. Financial statements are not materially misstated. Take a typical scenario where financial statements are not materially misstated. There is no material misstatement in the financial statements, or even though there is a misstatement that is not material. Either there is no misstatement at all, or there is a misstatement which is not material. So if there is no material misstatement in the financial statements, what should be my appropriate opinion? What should be my appropriate opinion? So my appropriate opinion should be unmodified. If the financial statements are not containing material misstatement, my appropriate opinion should have been unmodified opinion. But what auditor is doing is, he is giving a modified opinion. He is giving which opinion? He is giving a modified opinion. Might be he found one small misstatement which is not at all material. If you look from the entire financial statements perspective, that misstatement is not material. But still he is very paranoid auditor. So he is very much worried. He is having a lot of concerns. He is very prudent auditor. Even that small misstatement also he has thought it as very bigger, and he gave a modified opinion. So can this be termed as audit risk? No. The second scenario will not come under audit risk. Why? Because the definition says the risk of expressing inappropriate opinion when the financial statements are materially misstated. That means when modified opinion is appropriate, if you give unmodified opinion, that only will come under audit risk, but not the other way around. If you give modified opinion when unmodified opinion is appropriate, that will not come under audit risk. This, even if you go by the definition, even if you think from practical perspective. Why? Because see here, if unmodified, where you should have told financial statement should have given true and fair view, you are saying that except some items something is wrong. Except some items financial statements are giving true and fair view. See here, you are acting little bit more carefully. By giving a modified opinion, you are acting more carefully. Because of this, the user will not make any wrong financial decisions. He will not fall into loss. But you all might get it out. Sir, if I give modified opinion when unmodified opinion is appropriate, my client will become unhappy. No, let him be unhappy. What he will do, sir? If he feels unhappy, he will not appoint me for the next year. You will lose a client. So losing a client is a business risk. Losing a client is a business risk which is not coming under audit risk. So when I say audit risk, that refers to such a risk which auditor will face from a legal perspective. But if you give modified opinion, when unmodified opinion is appropriate, that is in the second case, you are not going to face any consequences legally. You might lose a client, you might lose your reputation, etc. That is a business risk. Audit risk does not include the business risk. Audit risk does not include business risk. Now, a few more things. What the standard says is, see, this audit risk, assessment of audit risk, all that discussion has been given under SA 315. And SA 315 says that audit risk is comprising of two components. Audit risk is comprising of two components. Audit risk happens because of two components. So one is risk of material misstatement and the other one is detection risk. Audit risk contains two components. Audit risk happens because of two components. One is risk of material misstatement and the other one is detection risk. Now let us try to understand what do you mean by risk of material misstatement and what do you mean by detection risk. Let us try to understand it. So risk of material misstatement. What is risk of material misstatement? They say that risk of material misstatement means the chance of happening of misstatement even prior to the audit of the financial statements. What do they say here? The chance of happening of risk means what? The susceptibility, the probability. The chance of happening of misstatement in the financial statements even prior to the audit, which is something management created risk. Auditor has nothing to do with whether audit happens or not. This risk will always be there. Like say for example, in an organization, in some company, like I am conducting audit of one supermarket, my client company is not having internal control. See, if the client company is not having internal control, don't you think there is a possibility of happening of misstatement? Yes, that I call it as risk of material misstatement. And you tell me, am I responsible for that risk as an auditor? No. Will that risk be there only because audit is happening? No. Whether audit happens or not, if there are no internal controls, there is always a possibility of theft. So that risk, we call it as risk of material misstatement, the chance of happening of misstatement in the financial statements even prior to audit. Whether audit happens or not doesn't matter. This risk will always be there. This risk is something which is created by the management. Auditor is not responsible for the creation of this risk. But what auditor will do, sir? If you are telling it is something, the risk which is created by the management, auditor is not responsible for this risk, then what is auditor's responsibility regarding risk of material misstatement? The standard says that the auditor's responsibility regarding risk of material misstatement is to identify it. You can't control it. You have to just identify it and assess it. You have to find it out and analyze. That too, how can I identify that risk of material misstatement? By performing the risk assessment procedures. By performing what? Risk assessment procedures. So as an auditor, you can't control the risk of material misstatement. You can only identify it. You can only assess it. That too by performing risk assessment procedures. So whatever it is, the risk of happening misstatement in the financial statements even prior to audit, that I am going to call it as risk of material misstatement. And the standard further says that this risk of material misstatement can further happen because of two more components. One is inherent risk and the other one is control risk. Risk of material misstatement once again happen because of two components. One is inherent risk and the other one is control risk. So what is inherent risk? What is control risk? So when I say inherent risk, they define the term something like this. If you look at from the material, they say that susceptibility of an assertion to a misstatement that could be material either individually or in aggregate, assuming that there are no related controls. That means in certain areas there will not be any internal controls to prevent a mistake from happening. Such a risk I am going to call it as inherent risk. So there are no internal controls. Generally these kind of risks are unavoidable in nature. There will be certain areas in the organization where those areas will not be fit for implementing internal controls at all. So such a risk we call it as, because of absence of the internal controls, there is a possibility of happening misstatement. That risk we call it as inherent risk. Like if I have to give you one example, take an industry which is highly sensitive to the changes in the market. Take some company which is highly sensitive to the changes in the market. Like for example, if you take the mobile phone industry. Mobile phone industry is such an industry which is highly sensitive to the changes in the market. If the mobile phone manufacturing company doesn't bring a new product into the market which is having latest features, very soon it will be thrown out of the market. Like Nokia, one example we have, and so many other appliance companies, electrical appliances company, they have also tested the waters in the mobile phone company. Like Videocon, they have tested their grounds in mobile phone industry. LG, they have also tested their market in the mobile phone. But you tell me, are they in the market still today? No, Why? Because they are very sensitive to changes in the technology. The product mobile phone is very sensitive to changes in the technology, which they are not able to accommodate, and that has made the companies to go bankrupt. So like this, there is a risk that some misstatement can happen in the financial statements, and to prevent that risk, we can't implement any internal controls also. Such a risk we call it as inherent risk. Then we have something called control risk. The name itself says there is a control. There is one area where it is fit for implementing internal control. Even control has also been implemented, but that control has failed miserably. Sir, in what aspects the control has failed? The control has failed either to prevent a fraud or error from happening, or even to detect a fraud or error that might have failed, or even that might have failed to correct a misstatement. So there is a area fit for internal control. Organization has implemented internal control also, but that internal control has failed to prevent, detect, or correct a misstatement on a timely manner. That risk we are going to call it as a control risk. So whatever it is, inherent risk and control risk, both put together, they will lead to risk of material misstatement, which is completely management created risk. Auditor can't control it. He can only identify and assess it by performing risk assessment procedures. Then what about detection risk? Now this is something which is under auditor's control, for which auditor will be responsible. So detection risk is a risk that the audit procedures performed by the auditor might not be able to detect a material misstatement which is already there in the financial statements. So basically, as an auditor, if we are performing audit procedures, what is our objective of performing audit procedures? So by performing audit procedures, we want to obtain sufficient and appropriate audit evidence whether there are misstatements or not. Now take a typical scenario where there is a material misstatement in the financial statements. As an auditor, you are supposed to perform audit procedures to find it out. You performed audit procedures, but unfortunately, your audit procedures were not able to identify a misstatement which happened in the financial statements. That risk we call it as detection risk. And if you have understood the concept clearly, you would have realized that detection risk is something which auditor himself has created. There's something which is depending on auditor's ability. If the auditor can plan proper audit procedures, if the auditor is very careful in doing the audit, he can control the detection risk. On the other hand, if the auditor behaved negligently, then his audit procedures will not be able to identify material misstatement, then the detection risk will be higher. So whatever it is, the risk that audit procedures performed by the auditor might not be able to detect a material misstatement in the financial statements, that we call it as detection risk, which is something which is in the auditor's control. Whereas risk of material misstatement is a risk which is created by the management. Auditor cannot have any control over it. He can only identify it and assess it. Clear? And there's one more aspect here. Between the components of the audit risk, there is an interrelationship between the risk of material misstatement and detection risk. We have a relationship. What is that relationship? Is inverse relationship we have. Which kind of relationship we have? Inverse relationship we have. So when the risk of material misstatement is high, the auditor should perform more procedures. When he is performing more procedures, he will detect more misstatements. When he is detecting more misstatements, he will try to when he is detecting more misstatements, he is keeping the detection risk at a low level. So like this, there exists an inverse relationship between risk of material misstatement and the detection risk. So whatever it is, this is what the concept of the audit risk. Now, I would like to talk about one more aspect. The standard says that when you are performing risk assessment procedures, you will identify risk of material misstatement, but the standard says you need to identify that risk of material misstatement at two levels. The standard says what? You need to identify that risk of material misstatement at two levels. So what are that two levels of risk of material misstatement? They say one is you have to identify risk of material misstatement at the financial statement level, and the other one is you have to identify the risk of material misstatement at the assertion level. You have to identify the risk of material misstatement at the overall financial statement level, and also we need to identify risk of material misstatement at the assertion level. Sir, what do you mean by risk of material misstatement at the financial statement level? What do you mean by risk of material misstatement at the assertion level? So risk of material misstatement at the financial statement level means such a kind of risk which is having a potential to cause a material misstatement in the entire financial statements. If there is a risk in the organization which is having the potential to cause a misstatement in the entire financial statements, that risk we call it as a risk of material misstatement at the financial statement level. And if we find some risk in the financial statements which is having a potential to cause a misstatement in only one or two specific assertions, or if I put it in other way around, I found a risk which is having a potential to cause a misstatement in just one or two items of the financial statements, that risk I am going to call it as risk of material misstatement at the assertion level. So whatever it is, after performing risk assessment procedures as an auditor, you need to identify the risk of material misstatement, and that risk you have to classify it into two levels: risk of material misstatement at the financial statement level, which is having the potential to affect the entire financial statements. Other one is risk of material misstatement at the assertion level, which is having the potential to cause a misstatement in just one or two items of the financial statements. Clear? Right. So this much is enough for risk assessment procedures. This discussion is enough. Now what we will try to do is we will try to go to internal control discussion. And one more thing they say here, in the risk assessment part, we will have one more concept. There is something called risk-based audit. So this also we'll try to quickly cover, then we'll proceed with the internal controls. So we have something called risk-based audit approach. So what is this risk-based audit approaches? See, this we already know. Generally, we do risk-based audit approach only, just they are giving a name for this. See, say for example, if you are conducting audit of the client X Limited, and say for example, you have to complete the audit with 10 days and for with the 10 staff, 10 days of time you have, 10 days of staff, 10 people you have for the purpose of completing the audit. Now I will give you two options to choose from. If you have to do the audit of this entity, I will give you two options. I will give you two approaches. Tell me which one you will choose. So X Limited client audit, we have 10 engagement team members and 10 days of time for completing the audit. Approach 1, approach 2. In approach 1, what I will do is, since I have 10 days of time, 10 engagement team members, I have 4 areas to cover: assets, incomes, expenses, liabilities. I have 4 areas to cover. So after covering all the 4 areas, I have to form a conclusion and give the reporting. So what I have done is, since I have 10 days of time, I will do one thing. For every area, I will allocate 2.5 days. Equally, I will allocate 2.5 days of time for each and every area. And also I have 10 resources, no? So 10 resources, I can't divide it to one person, I can't divide it to half, right? So let us say 8 resources I have. 10 days I have, 8 resources I have. So now what I have done is, two persons I have assigned it to each area. Equal allocation I have done. This is approach 1. Then I have approach number 2. In the approach number 2, what I have done is, since I have 10 days of time, first what I have done is, 1 day of time I have performed on risk assessment procedures, and I identified the areas where there is a risk of material misstatement. So I performed the risk assessment procedures. By performing risk assessment procedures, I identified the risk of material misstatement in each and every item of the financial statements, and I identified in which areas risk is high, in which areas risk is low. So I came to know that in the area of expenses and liabilities, the risk of material misstatement is very high, whereas in the area of assets and incomes, the risk of material misstatement is low. So out of 10 days, 1 day is already over. Now I have 9 more days. So now in that 9 more days also, I can't plan the audit. I can't do the audit till last day. So 1 day I want to keep it for conclusions. 1 day we have to discuss all the things. So last day we have to discuss all our findings and we have to give our conclusions, prepare the report. So I have 1 day has gone in the name of risk assessment procedures, 1 day at the end for conclusions. So balance I have 8 days. Now what I am doing is, these 8 days I have to cover 4 areas: assets, incomes, expense and liabilities. And as I have told, expenses and liabilities have a high risk of material misstatement. So what I have thought is, since expenses and liabilities have a high risk of material misstatement, I will allocate more amount of time here. 2.5 day of time I will allocate. So I have balance 8 days. In that balance 8 days, 5 days are over. So 5 days I have allocated it for expenses and liabilities because the risk is very, very high there. Now whatever balance 3 days I have, there 1.5 day I have spent it on assets, 1.5 day I have spent it on incomes. So now totally 8 days I have utilized. After the completion of 8 days, I will have the findings. That last day I will discuss the conclusion and form an opinion. So now I have given you two approaches. Approach 1, what they have done I have told. Approach 2, what should be done I have told. You tell me, if you are in the position of auditor, step into the shoes of the auditor and tell me, if you are in the chair of the auditor, if you are in that position of the auditor, which approach do you think is more better? Which approach will give you better results? Which approach where you, what is the approach where you will go, where you will not go wrong? So which is the effective process? I think you will say this second approach is somewhat better approach. That means we are basically driving our audit. Basically, we are driving our audit procedures, not randomly. We are driving our audit procedures, which areas we have to focus, what should be our attention, how we have to get the evidence, how we have to form the conclusion. Everything is driven on the basis of the risk we have identified. Such a kind of approach of the audit I call it as risk-based audit. That's all. This is what we generally do also. So the second approach is nothing but what? For this they have given technical name, which is the risk-based audit, where our procedures, our decisions, our evidences gathering, everything was driven by the risk which we have identified. So that kind of audit we call it as a risk-based audit, and that's what we generally do there. So even though they give it as a separate concept, risk-based audit, but it is not a separate concept, it is what regularly we do. So what happens in the risk-based audit? First, we analyze the audit risk. Then on that basis, we set the materiality, and on that basis, you can develop audit program. So if you see here, everything is driven by risk analysis. So audit should be risk-based or focused on areas of greater risk to achieve the audit objectives. So remaining all the things they will try to say. And they say here three phases. There are three phases for risk-based audit. First one is you have to assess the risk. Basically, as I have told you, have to understand you have to perform the risk assessment procedures, understand their internal controls, and you have to identify the risk of material misstatement. Then once you have identified the risk, then you have to respond to that risk. How you will respond to that risk? Like as I have told, by allocating time, by performing nature, timing, and extent of the further audit procedures, by doing compliance testing, by doing substantive audit testing, by performing analytical procedures. Wherever risk is higher, there you spend more time. Wherever risk is lower, there you spend less time. So like that, the second stage in the risk-based audit is you have to respond to that risk. Now, the third stage is finally reporting. So once you have performed audit procedures, you will have observations, and depending on that observations, you will arrive at the conclusion. That conclusion you are going to give express in the form of a report. That report we call it as audit report. So that is the third phase. So like this, there will be three phases for risk-based audit. First, we will do risk assessment. Then after we have assessed the risk, we will respond to that risk appropriately. And finally, whatever our findings are there from that we will try to report it. Right. So one aspect we are done. Now let us try to understand internal control. The second aspect of this chapter, which is talking about internal control. So as we all are aware, internal control plays a very crucial role in the organization. Even in audit also, we allocate a significant amount of time towards internal control. Why? Because till now, whatever discussion we had, you could have observed throughout our course of audit, various places, we do some work regarding internal controls. Like if you remember, if you understand the three basic procedures which we perform: risk assessment, compliance, and substantive audit procedures. In the risk assessment procedures, we try to understand internal controls. In the compliance procedures, we will try to verify whether those internal controls we have understood are operating effectively or not. Yes or no? So in risk assessment procedures also, we are doing some work relating to internal control. In the compliance procedures, we are doing work only related to internal control. So out of the three specific procedures, in the two procedures, we are associated with internal control. And even in the organizations also, from the management perspectives also, internal controls play a very crucial role. So from the management perspective also, internal control plays a very crucial role. And even from the auditor's perspective also, internal controls are going to play a very crucial role. Now, what exactly is the meaning of internal control? What exactly is the meaning of internal control? So SA 315 has defined the term internal control. So how they have defined the term internal control is, it is any process which is designed, implemented, and also maintained by whom? By either those charged with governance, management, or other personnel. For what purpose this process has been designed, implemented, or maintained? To provide reasonable assurance regarding achievement of entities' objectives. So every organization, every entity will have an objective, and every entity needs assurance that it is going to achieve its objective. To provide that reasonable assurance that yes, entity, you can achieve your objectives, we need to have some processes which are designed, implemented, and maintained by management, those charged with governance, and other personnel. Those processes we are going to call them as internal control. Like appointment of security guards is a simple example of internal control. Or installing a CCTV camera is a simple example of internal control. Or having an approval mechanism, authorization mechanism, before any entry can be recorded in the books of accounts, it has to be approved. Or the most common internal control which we see in the industry, segregation of duties, not keeping the entire end-to-end responsibility in the hands of one single person. Divide the different tasks in an activity among different people so that no one person will have control over entire activity. Why? Because if a single person is having control over the entire activity, there are more chances for manipulation. So that's why cashier, accountant duties will be separated. Store in charge and storekeeper duties will be separated. Fixed asset record keeper and fixed asset stock maintainer, so that the responsibilities will be separated. So this segregation of duties is also one more important internal control. So like that, any process which is getting designed to provide reasonable assurance regarding achievement of entity's objectives, we call it as internal control. But when I talk about specific objectives, you take any internal control. If I talk about specific objectives, when I look into specific terms, every internal control will try to fulfill at least one of the four specific objectives. Every internal control will try to fulfill at least one of the four specific objectives. Sir, what are that four specific objectives? Number one, reliability of financial reporting. So some internal controls will work with the objective of making the financial statements more reliable. Some internal controls will work with the objective of sorry. So some internal controls will work with the objective of making the client's operations more efficient, more effective. Some internal controls will work with the objective of safeguarding the assets, protecting the assets. Some internal controls will work with the objective of ensuring the compliances with the laws and regulations. So when you look from the specific perspective, any internal control you take, that will try to fulfill at least one of these four objectives, and there will be some internal controls which will try to fulfill all the four objectives also. But we have to remember these are four specific objectives of internal control. What are they? Number one, reliability of financial reporting. Number two, efficiency and effectiveness of operations. Number three, safeguarding of the assets. And number four, compliances with the laws and regulations. Right. Next one. Sir, who is responsible for implementing internal control? Tell me guys, in the organization, it is whose responsibility to design, implement and maintain the internal controls? Generally, management and those charged with governance. Auditor will not be responsible for designing and implementing internal controls. Auditor will only understand and verify them as a part of risk assessment procedures and compliance procedures. The responsibility for the implementation, designing and maintenance of the internal control is always going to rest with management and those charged with governance of the client's organization. And as I have told, when I say scope of internal control, when I say internal control, those are not the control only relating to accounting. Internal controls, it doesn't include only the controls relating to accounting. It also includes, as you could see the statement here, the scope of internal control goes beyond accounting control. They are not just restricted to accounting matters. They go beyond accounting controls, and they also include administrative controls. They also include what? Administrative controls. Like for example, HR policies. Like if a person has to come, if an employee has to come inside the company, he has to show his biometric. He has to scan his biometric and he has to show his identity card. See, this has nothing to do with the accounting, but this is something relating to administrative matter. So like that, when I say internal control, it will not just be restricted to accounting control. The scope goes beyond accounting controls. It even includes administrative aspects also. But as an auditor, we are not worried about each and every control in the organization. We are worried about only the accounting controls. Those controls which have a direct relationship or some sort of association with the financial statements and books of accounts, those internal controls only auditor will be worried about it. Other controls, auditor might not get worried about them. So that's what they say here. And even if you see, that's what the complete summary here. Like if you see, in an independent financial audit, when you are doing audit of the independent financial statements, the auditor is primarily concerned only with those policies and procedures which have a bearing on assertions underlying the financial statements. So if you are doing audit, when I say internal control, many internal controls will be there, but you will not be associated with every internal control. You will only get concerned with those internal controls which have a impact, which have a relationship, which have a bearing on assertions on items of the financial statements, like those internal controls which are relating to safeguarding of the assets, those internal controls which are relating to prevention and detection of the fraud and errors, and those internal controls which are relating to accuracy and completeness of the financial information and accounting records, and those internal controls which are responsible for timely and reliable financial information. So as an auditor, if we are doing independent audit, we are mainly concerned with these internal controls only. And what we expect from internal controls relating to accounting system? Generally, whatever internal controls are there which are relating to accounting system and books of accounts and financial statements, from that internal controls, what are our expectations? So generally, what kind of policy should be there in the internal control relating to accounting system? So they should address the areas like that every transaction must have authorization. Any transaction which has been recorded in the books of accounts, that must have authorization. Authorization means what? Approval should be there. And all the transactions should have been promptly recorded. Every transaction should have been correctly recorded. That too in a timely manner it should have been recorded. Such policy should be there. And all the assets should be safeguarded. All the assets should be protected from unauthorized access. And even those assets should be verified at reasonable intervals. Nothing but physical verification we call it. Think about what do we call this? Physical verification we call it. So you take accounting controls. Generally, we expect accounting controls to fulfill these objectives. Then we have one important concept called limitation of internal control, which means that no matter how effectively organization implements internal control, no matter how effectively organization implements internal control, they might be making use of best resources, the best systems, the best experts they have hired for implementing internal control system. But no matter how effectively an organization implements the internal control system, still internal controls can only provide reasonable assurance regarding achievement of the objectives. Internal controls will not give a guarantee that entities objectives will be 100% achieved. That means, like the way audit can only give reasonable assurance but not absolute assurance, even internal controls also can give only reasonable assurance but not absolute assurance. Even internal controls also can't give absolute assurance. Why? Because like the way audit suffers from some inherent limitations which are unavoidable in nature, even internal controls also suffer from some limitations which are of such a nature that they are unavoidable. No matter whatever you do, those limitations will always be there. Since the process of auditing is suffering from inherent limitations, we can't obtain absolute assurance. Similarly, internal controls are also suffering from some inherent limitations, because of which they can't give guarantee, they can only give reasonable assurance. Now, what are that inherent limitations? What are that limitations of internal control? Why even after effectively implementation of internal controls also they can go wrong? Number one, cost exceeding the benefits. See, implementing internal controls is not a simple affair. It involves a lot of cost in the form of resources, cost in the form of systems, cost in the form of people. So implementing internal controls is not that easy. It is going to be a costly affair. So that's why what some organization will do is, in designing part, they will do a master design for the internal control, but they will not put into action. Why? Because when they start implementing, the reality hits very hard. There they will realize that cost is exceeding much, and whatever they have designed, that they will not implement. Halfway implementation they will do, because of which internal controls can fail. Next one, internal controls we can generally plan usual only for usual transactions. Whatever routine transactions are there, for that routine transactions only we can plan for internal controls. We can't plan internal controls for unusual transactions. So sometimes those transactions which don't happen in the normal course of business, we might have to do it. For that we can't implement internal controls, so that also in those transactions mistakes can happen. Or collusion, one of the most important problem why internal controls are failing in the organization is collusion. Those people among whom the segregation of duties has been done, those people among whom the segregation of duties has been done to ensure that no one will have control, with a very noble intention, we divide the responsibilities among different people. But what these people will do is, these multiple people collude with each other and they might make the internal control fail altogether. Like cashier and accountant might collude with each other and they can make the internal control go wrong. So collusion will always be possible, which can make the internal control fail. Or misuse of authority, generally top level management. Like if you remember, when we discuss the SA 240, there we have read one point. Management in every organization will always have the position to override the internal controls. Since management are the people who design the internal controls, they also can override the controls in whatever manner they want. And in some organizations, some management has misused their power, because of which internal controls can go wrong. Or even manipulation of assumptions and judgments. This we have seen in SA 540. Sometimes the management, because to achieve a desired result from the financial statements, they make wrong estimates, they make wrong assumptions. Because of that also internal controls can fail. Intentionally they will make wrong assumptions and wrong claims, because of which internal controls can go wrong. So these are the limitations because of which internal control can only provide the reasonable assurance, they can't give absolute assurance. So 5 such limitations they have told. What are they? Number 1, cost is exceeding the benefits. Number 2, it cannot handle transactions of unusual nature. It can lead collusion among the people can happen. People can misuse their authority or power. And also there could be a manipulation happening in case of judgments and assumptions. Then we have one broader question which is talking about what is the structure of internal control, or what policies and procedures must be covered in the internal controls. This I will tell you in brief. Generally, when I say internal control, in that internal control, what we generally expect. So if you see here, every one of the most common policy which will be there in majority of the internal control is segregation of duties. One of the most common policy which will be there in every internal control is segregation of duty. So what is segregation of duty? So the work is divided in such a manner that no one single person is having control over the entire task. It will pass among different people. So that activity we call it as segregation of duties, and it is one of the most common feature. It is one of the most common policy and procedure which will be there in every internal control. So segregation of duties. Generally, what kind of duties will be segregated? Number one, authorization of transactions, execution, physical custody, maintenance. So these four activities should never be kept in the hands of one single person. They should be divided. Which four activities? Authorization, execution, physical custody, maintenance. So all these four activities should never be kept in the hands of one single person. They should be divided. So that is one of the most common feature. And when I say segregation, in that also one more aspect will also come: rotation of employees. Even one employee should not be kept in the same job for a longer period of time. After a certain period of time, his job role should be changed. This is typically very important for those people who are engaged in the finance roles. That's why tomorrow, if you become a chartered accountant and go to the industry, go join some company, you will not be kept in the same position for longer. So they will rotate your job after 2 years, 3 years. They will change your department. Why they will change your department is why? Because the longer you are stuck into one role, the better people you control, the more influence you will have, more chances for committing the fraud. So just segregating the duties alone will not be enough. Even you need to rotate the employees also. Next, one more common policy which will be there in every internal control is authorization, approval mechanism, delegation of authority. So you should not make a person just like that pass an entry. If you take accountant should just like that not pass an entry. There should be a mechanism where an accountant can pass the entry and concerned manager can approve. And also that approval powers also you should not keep it in the hands of one single person. There will be something called delegation of authority. If I give you one example, check payment signing authority. So if you look at the organizations, they will have policies like up to 10,000 cashier himself can sign, up to 1 lakh rupees finance manager can sign, up to 10 lakh rupees finance head can sign, up to 1 cr finance director can sign, and more than 1 cr CFO should sign. So like that, delegation of authority should be there, and there should be authorization. That is one more policy. And there should be adequate records and documents. One more aspect of internal control is one more common policy which we find in internal control is maintenance of records. If you are doing any transaction, in that transaction, whatever documents are getting generated, all that documents should be properly recorded. Like for example, if you take a simple example of purchase transaction in organizations, in big organizations, they will have this purchase internal control procedure. So if a purchase is taking place, they will have an internal control where multiple departments will be involved, multiple documents will be generated. Starting with purchase requisition note, purchase order, invoice from the supplier, gate pass, inspection report, GRN, and finally entry. So like this, if you take any transaction, it goes through multiple stages, it goes through multiple departments, and multiple documents will get created. All that document should be adequately recorded. So in most of the internal controls, you will also find this policy where they are making steps for where they are taking steps for recording of the documents. Why? Because tomorrow if something has gone wrong, if we have to find out where something has done, where something has gone wrong or who has done something wrong, with that documentation only we can be able to find it out. Then we have accountability and safeguarding of assets. One more common policy which will be there in any internal control is safeguarding of the assets, protecting the assets of the company. So either intangible assets you take, tangible assets you take. We will have here physical custody like security guards, CCTV cameras, biometric access. So all these are examples of the policies which are related to the objective of safeguarding of the assets. And then finally, there should be independent checks. Just implementing the controls alone will not be enough. Periodical checks also should happen. If I have to give you an example of independent checks, we can give the example of internal audit. Right? So these are the common policies and procedures in most of the internal controls. Then after that, this is one more aspect. What are various components of internal control? From here also many times the question has been tested. So components of internal control, one of the important concept. The standards say that there are 5 components of internal control system. There are how many components of internal control system? 5 components of internal control system are there. So understanding these 5 components is little important. So the standards say that there are, if you want to implement internal control in the organization, any organization, if they want to implement internal control or if they want to make sure that internal controls in their organization are working effectively, then they need to take care of 5 components. Sir, what are that 5 components of internal control? The first one is control environment. The second one is entities risk assessment process. The third one is control activities. The fourth one is information system including related business process relevant to financial reporting. and then finally monitoring. So I will give you a brief of each and every component, what exactly will happen in each of the component. So if an organization wants to implement internal control, it must have control over 5 aspects, or it must go through 5 components or 5 stages also you can call it. So repeat everybody along with me. So what are the 5 components of internal control system? Number 1, control environment. Number 2, entities risk assessment process. Number 3 is control activities. Number 4 is information system including related business process. And number 5 is monitoring of the controls. So let us try to understand what happens in each of the component. What does each of the component mean? First thing is control environment, which means that if you want to implement an internal control in the organization, say for example, I'm a company owner, I'm a CEO of some company. In my company, I want to implement some internal controls. And when I'm implementing internal controls, what will be my expectation? Will I want my controls to work effectively, or will I not want my controls to work effectively? Definitely, I want my controls to work effectively. See, if I want my controls to work effectively, first I should create a good culture in my organization. A culture of honesty I have to create. A culture of ethical behavior I have to create. Unless and until I create a culture of honesty and ethical behavior in the organization, unless and until I have a good culture in my organization, can you expect the controls in my organization to work effectively? No matter how much systems I decide, no matter how much people I recruit, no matter how many experts I involve, if I don't have a good culture of ethical behavior in the organization, will I be able to implement? Will my internal controls produce their objectives? Definitely not. So that is the first stage. Before any organization starts looking for internal control, they need to have a good control environment, good culture they have to create. So how they can create a good culture? Number 1, by way of communication of integrity and ethical values. So as a top level management, you have to communicate to your staff that how important it is to remain integrity, how important it is to follow ethical values. You have to continuously communicate. See, just communication alone will not be enough. Even you have to enforce, you have to put into action also. Then commitment to competence. As a management, you should always show your commitment to capabilities. When you are recruiting, show your commitment to capabilities. When you are promoting, show your commitment to capabilities. So don't recruit incapable people, don't promote unnecessary people. So like that you should not do. As a management, you should always show that you are committed to the capabilities. So that you have to demonstrate. By that, good culture will be created. And those charged with governance should participate more. When I say those charged with governance, they are top level management, right? So when I say someone is a top level management, they should not always sit in their cabins and never coming down on the floor. They should not do it. So once in a while, frequently, they should interact with the people, and from that they have to get the information. The more they participate in the business, the better culture they will get created. And also, the management should have a good philosophy and an operating style to promote a good culture. And they should have proper organizational structure, proper hierarchy should be there. Who is top level management, who is middle level management, who is low level management, who should report to whom, who should create, who should approve. Proper organizational structure should be there. Then you have to properly assign your authorities and responsibilities. So when you are assigning the responsibility, when you are giving the power for authorization according to their roles and responsibilities, according to their capabilities, responsibility assigning and authorization assigning should happen. And even in your human resource policies, even in your HR policies also, the integrity and ethical value should be reflected at the time of recruiting, at the time of training, at the time of promoting. Even in your HR policies also, you have to show your commitment to the integrity and ethical values. So the first step in creating any internal control is creating a good control environment, creating a good culture and ethical behavior. And how that can happen? By way of communication, enforcement of integrity and ethical values, by showing your commitment to competence, by more participation by those charged with governance, by setting management proper philosophy and operating style, by establishing proper organizational structure, by properly assigning the responsibility and authority, and even having HR policies appropriate. So whatever it is, first you will create the good culture. See, once we have created the good culture, then what organization should do is they should do the risk assessment process. See, like the way we auditors will do first risk assessment procedures. No, why we do risk assessment procedures? Because we want to identify the risk of material misstatement. Why we are identifying risk of material misstatement? So that we can perform better audit procedures, right? Like the way we are doing risk assessment procedures to identify the risk in the organization, even management also should study their own organization to find out the risk. Why? Because see, one basic logic we have to understand here, why any organization will implement internal control? To prevent the risk, right? To mitigate their risk. So there is a possibility of something going wrong in the organization. To prevent that thing from going wrong, they implement internal controls, right? See, if an organization wants to implement internal control, first they should know where is something going wrong in their organization. They should study their organization, and first they have to find out where something can go wrong. That means before they can implement internal controls, first they should know what is going wrong in the organization. For that purpose, the client's management themselves should do entities risk assessment process. Study their own organization and find out where there is a risk. And the management should keep in mind that risk can happen because of various circumstances, like sometimes there could be changes in the operating environment, like operating or regulatory environment, that could bring new risk. Sometimes new people might have joined the company because of lack of understanding of their processes, then also some risk can happen. Or sometimes the client might have changed their information system. Sometimes they might have built up new softwares, they have changed their information system from Tally to SAP. This could also bring new risk. Or rapid growth. Sometimes what will happen is some kind of companies grow very rapidly, very altogether from 1x to 10x they will grow. So that rapid growth also will bring new risk. Why? Because the organization is not yet ready. You have grown beyond your capabilities. That will also bring new risk. New technology, when you are using a new technology, like for example, today companies are all adopting to this AI and all, that will also bring new risk. And the risk can arise from new business models, new products, or new activities. When you are launching a new product, when you are diversifying your business, when you have acquired someone, that will result into new risk. Or corporate restructuring. Now this is where mergers and acquisitions will come. Because of corporate restructuring, also new risk will arise. And even expanded foreign operations. When you are expanding your operations to a foreign country, there you might have to face the new risk, like foreign exchange fluctuation risk you might be required to face. Or sometimes new accounting pronouncements, like new accounting standards or accounting standards undergoing amendment. This also can bring new risk to the organization. So whatever it is, the management the management should study about their own organization and identify all the risk. So once they have identified the risk, then they have to start implementing the control activities. So this is where the actual implementation of the internal controls is going to happen. So now you should start implementing various control activities in different areas wherever you have identified the risk. Like number one, first what you can do is performance reviews. In some areas you can implement the controls of performance reviews, like comparing the actuals with budgets, comparing with the last year data. Any huge deviations you have to investigate, ask the concerned person why there are such huge changes. So in some areas you can implement control activities of performance reviews. In some areas you will have controls in the information technology itself. Like we have something called application controls, we have something called general IT controls. General IT controls are protecting the overall IT environment, whereas application controls will work on specific applications. So sometimes you might think of implementing controls in a IT environment. So today everybody is doing that only. Manual controls organization have stopped giving more importance. Now these days the organizations are giving more and more importance for technology related controls. And physical controls, at some places, in some areas you might be required to implement physical controls. Sir, what do you mean by physical controls? Like authorization, approval mechanism, periodical verification, appointment of security guards, installment of CCTV cameras. So in some areas you might feel it fit to implement physical controls, and in almost all the areas you might fit that segregation of duties is required to be implemented. So actual policies, actual control activities will start happening in the third phase of the third component. So first component, creating a control environment, creating a good culture of honesty and ethical behavior. Number two, studying the organization and finding out where there is a risk of material misstatement. Number three, once you have identified the risk, now you have to start implementing the control activities. And also you need to today implement information system, including related business process relevant to financial reporting and communication. So if you want to have strong internal control system, you need to have good information system, especially related to financial reporting. That means you need to have a good accounting software. Why? Because if you have accounting software, through that accounting software itself, we can implement internal controls. And if any lapses are there, proper communications also will happen if you have a proper accounting software in place. So the next component is you have to start exploring or investing in the information technology. So you need to have such an accounting softwares regarding information system, regarding financial reporting, which will identify and record all the valid transactions, and they will do proper classification of the transactions. They can do the proper valuation of the transactions. They record the transactions in the correct time period in which they have occurred, and even they can present properly the transactions. So you should use your client, if they want to implement internal control, they should start investing in such accounting system which can do all these activities. So invest your amounted money in information systems. And then finally, just having this alone, just implementing the control alone will not be enough. Periodically, we need to review whether the controls are working effectively or not. So with whatever objective we have implemented the controls, whether those objectives are met, is there any requirement to make any changes to the internal controls? Is there any requirement to update any policy regarding internal control? Or is there any internal control lapses? Do you require to amend it? So that continuous monitoring also should happen. So just implementing controls alone will not be enough. Only when you do monitoring, then only you will get to know whether controls are working effectively or not. So these are the 5 components of internal control. So if any organization wants to implement internal controls, they have to go through that 5 stages. Clear? Few more, two small concepts. 2 more concepts I will cover from the internal control. Then I will go with the materiality section. Okay. So one concept which I would like to cover is internal check system. From these things also they are asking some questions these days. So what is this internal check system? The internal check system means it is nothing but, if you ask me simply, it is other name for segregation of duties. Internal check system is just an other name for segregation of duties. So they say that even if you read the meaning also, you get the same thing. Organization of overall system of bookkeeping and arrangement of staff duties, so that no one person can carry out through a transaction and record every aspect thereof. And it is a built-in device where checking on day-to-day basis will happen. Which means that internal check system is actually a part of internal control. So internal control is a very broader perspective. Like I have told, in the internal control mechanism, authorization will come, segregation of duties will come, and their proper recording of the accounts will come. So like in the internal control system, these many things are there. One such aspect of internal control system is internal check, which I will say, which is not something new which we have to learn it all together. It is something which is very much similar to segregation of duties. So they say that in the internal check system, what we will do is, if a transaction is there, if an activity has been performed, now this activity will be spread across so many people. So many people will get involved in that activity. This activity will not be kept into control of one person. This work will be divided among different people from the starting to the beginning. And the work will be divided in such a manner that work of one person will be automatically reviewed by another person. So this person's work will be reviewed by this person. Now this person will add some work to that activity. Now this work will go to the next person. Now he will review the work of the previous person. Now he will do his part. Then the work will go to another person. He will verify the previous person's work. He will do his part, and then it will go to the final person. So like that, if the duties are arranged in such a manner that where the work of one person will be automatically reviewed by another person, where no one person will have control of end-to-end activity, that I call it as internal check system. That's why I say this is not just but other name for segregation of duties. Sir, what are the objectives? With what objectives internal check system will be implemented? Number 1, to detect the errors and frauds. If at all any errors or frauds have happened, there should be early detection. You can't detect it after 1 year, 2 years. There will be of no use. So the main objective of internal check system is to detect the errors and frauds as early as possible, and to avoid and minimize possibility of commission and errors, to reduce the possibility of errors, and to increase the efficiency of the staff by not making one person responsible from end to end. Since you are dividing the work among different people, their efficiency will get increased. And also to locate the responsibility. If at all something goes wrong, you should be able to find out who is the exact person responsible for that, and to protect the integrity of the business and to avoid the misappropriation. So these are the main objectives with which internal check system will be implemented. And if you want to make sure that internal check system will work effectively, you need to keep some considerations in mind. So if you want to make sure that you have designed internal check system, you have divided the work among different people in such a manner that work of one person is getting automatically reviewed by another person. But if you expect that internal check system to work effectively, then you need to have some considerations in mind. So what considerations in mind you have to keep? Number 1, everybody in that internal check system should have a clarity of responsibility. What is their task? What is next person's task? That clarity should be there. Number 2, you have to divide the work in such a manner that you are not overly dividing it. See, if you are dividing the work among 3 to 4 people, it is fine. You should not divide the same task among 10-20 people. It will unnecessarily create bottlenecks. So there should be proper division of work. Unnecessary excessive division you should not do. And even standardization. To the extent possible, you have to standard the process. See, generally we achieve that standardization by way of SOPs. Organizations will have something called SOPs. By way of that SOPs, organizations should try to achieve the standardization. And appraisal, periodically you have to review each person is doing the work properly or not, each person is reviewing the previous person's work or not. That periodical review also should happen. Okay, so this is what regarding considerations regarding effective internal check system. Then this is something general conditions pertaining to internal check system. This is once again repetition from all the above things whatever we have read. So that is the one general paragraph. Now one more last aspect which I want to cover from the internal controls is what are the various techniques for evaluation of internal control. So this is also one such important area, techniques for evaluation of internal control. So if you want to evaluate the internal control, if you want to analyze the internal control, just give me one moment. Right. So if you want to evaluate whether internal controls in the client's organization is working effectively or not, so in order to do that evaluation, we have three techniques available. How many techniques we have available? So we have three techniques available for evaluation of internal controls. So what are that three techniques which are available for evaluation of internal controls is, the standard says we have something called internal control questionnaire, and then we have something called checklist, and then we have something called flowchart. So there are three techniques available for evaluation of internal controls. So what are the three techniques which are available for evaluation of internal control? Number one is internal control questionnaire, number two is checklist, and number three is flowchart. So we will try to understand each and every technique in a detailed manner. So first one, flowchart. First we will try to understand the flowchart. Sir, what is flowchart? The name itself says the auditor will try to understand the internal control and whatever processes are involved in the internal control, which and all departments are involved, which and all documents are generating, how the documents are getting circulated. So what auditor will do is, first he will try to get an understanding of the internal control process with all this linkages understood. Then whatever understanding he has obtained, after understanding, then whatever understanding he has obtained, that understanding he will try to do a pictorial representation, graphical representation he will try to do in the form of charts, flow charts we generally say it, right? So in the form of charts he will try to present the overall process of the internal control, whatever he has understood. That method we call it as flow chart. Now the key features of the flowchart is, flowchart is the most concise version of presentation of internal control. It is the most briefest way of presenting the internal control, and it will give a overview. By just looking at the flowchart, you get a one bird's eye view, overall comprehensive understanding you are going to get it by looking at the flowchart. And also it is going to take less time. It will take very less amount of time. You will understand internal control and develop a graphical presentation. So comparatively it will take less amount of time, and not just that, it is very easy to locate the errors in the case of flowchart. If there is any lapses in the internal control system, that we can easily locate it by looking at the flowchart. So flowchart is one common old traditional method to evaluate the internal control system. Then we have the two most commonly used internal control methods, internal control evaluation techniques, which are internal control evaluation is mainly happening through internal control questionnaire and checklist. Now, what is this internal control questionnaire checklist? What is this internal control questionnaire and what is this checklist? We will try to understand it in a one single slot. We will try to understand. We will not have a separate discussion. In one lot, we will try to understand internal control questionnaire and checklist. See, both in internal control questionnaire and checklist, what will happen is there will be a series of questions. There will be a series of questions. Sir, prepared by whom? These series of questions will be prepared by auditor only. In both the cases, in both internal control questionnaire and in both the checklist, who will draft the questions? Auditor only will draft. Regarding what he will draft the questions? He will draft the questions regarding the elements of the internal control. He will draft the questions regarding the elements of internal control. And he will draft the questions in such a manner that answer will be either yes, no, or not applicable. He will draft the questions in such a manner that the answers will be either yes, no, or not applicable. He will not draft the descriptive questions. He will draft small questions where answers should be either yes, no, not applicable. If at all he wants, he can add the remarks column. One extra remarks column he can add, but mainly he will draft the questions in the format of yes, no, or not applicable. Now, Sir, you are telling in both the cases series of questions will be there. In both the cases auditor will draft the questions, and in both the cases the questions will be in the format of yes, no or not applicable. But how come these two methods are getting differentiated from each other is these two are getting differentiated from the perspective of who is going to answer that questions. See, if it is an internal control questionnaire, what I will do is whatever questions I have prepared, those questions I will go and give it to the management. Whose management? Give it to the client's management. Whatever questions I have drafted, those questions I will go and give it to the client's management and ask them to fill the answers and get back to me. Either the client's management will do it or their staff do it. I'm least worried. Just I will take the list of questions and go and give it to the management, hand it over to them, and I will tell them, sir, I need answers for these questions. Please give me the answers to these questions. Now, whether clients management themselves will do it or they will get it done from the staff, that I am least bothered. But someone from the management, someone from the client will fill the answers and give it back to me. And on the basis of whatever responses I have got, on the basis of whatever responses I have got, and on the basis of that responses, I will try to evaluate whether the controls are operating effectively or not. On the basis of responses whatever I have got, I will try to evaluate whether the controls are operating effectively or not. So that I call it as internal control questionnaire. So then what happens in the checklist? In the checklist, what I will do is here also I will have a series of questions prepared regarding various aspects of the internal control, where the questions are either yes, no or not applicable. Here also everything will remain the same. But the difference is in the case of checklist, these questions I will give it to my audit staff. Those questions I will give it to my audit staff, and I expect my audit staff or I expect my audit team to either answer them or follow them as instructions. I will expect in the case of checklist, I will call my engagement team members. I will say, boss, you go to the concerned area. Like for example, I have drafted questions in the area of cash. In the area of cash payments, I have drafted some 10 questions where I have left out one column for answers. So now what I will do is I will call my article assistant and I will say, boss, you go to the cash payments area, try to verify these questions and get back to me with the answers. So this article assistant, either he can treat them as questions to be answered, or even he can treat them as instructions which are required to be followed. Why? Because his partner is telling us to verify these 10 things and get back the answers. So you can call them as either questions to be answered or instructions to be followed. Whatever it is, my audit team will go to that concerned area, verify the aspects of internal control, get the answers to the question and give that answers to me, and depending on that answers, I will evaluate whether the controls are working effectively or not. So that is what happening in the checklist. So between internal control questionnaire and the checklist, the main point of difference is who is going to answer. In the case of internal control questionnaire, the client's staff or management will answer. In the case of checklist, the auditor's staff will answer. Understood? So this is what the brief of the differences between internal control questionnaire and checklist. They have given even examples also how the questions will be drafted in the format of yes, no or not applicable. So just have a detailed understanding regarding it. Okay, clear and comfortable everyone? So this is what relating to internal control questionnaire and checklist and methods for evaluation of internal control. So if you remember this chapter, I have told in this chapter we have three aspects to be covered. One is risk assessment, other one is internal control, and the other one is materiality. So out of the three, we are done with the two. Risk assessment part we have completed. We have completed internal control part. Now we are left with one more last part, which is materiality, fixation and all we have to discuss. And regarding risk assessment and internal control, whatever discussion we had, that is from SA 315, and how to fix the materiality, that discussion we have it in SA 320. Okay. So, but I think it's better to take 2 minutes of break now. So we'll take just 2 minutes of break. After 2 minutes of break, we will continue our discussion with the fixing of the materiality, and then we will try to proceed further with the remaining chapters. Okay. So just 2 minutes of break. We will be back in 2 minutes. Then we will resume our discussion. Okay. Right. Yeah. So sorry guys, my audio was off. Yeah. Thank you. Right. So now we are going to proceed further and try to understand the materiality related discussion. And this materiality related discussion was given in essay 320. So like the way as I was saying, a risk assessment topic is not something new to us, and even internal control topic is also not something new to us. These are the terms which we are already aware. On the same lines, even materiality, the term materiality is also not something which is new to us. This term materiality also we have come across in our earlier discussion. So what do you mean by materiality here? As I have told that materiality is one of the most important consideration. Materiality is one of the most important consideration which we have to keep in mind while doing audit. Why? Because the first and foremost objective of the audit says that as an auditor, you need to obtain reasonable assurance whether financial statements are free from material misstatements. That means as an auditor, we need not be concerned about each and every misstatement. We need to be concerned about only material misstatements. And as I said earlier, what is the meaning of the term material? Something which is significant, something which is major, something which is important. These are all the synonyms for the term material. But what is material? What is not material? It is highly subjective. Materiality is not something which is absolute term. We cannot define materiality in the absolute terms. Materiality is something which is highly subjective in nature. It changes from person to person, entity to entity, facts and circumstances of each and every case. It depends on the nature of the organization, industry to industry. So it will keep on changing. So there is no hard and fast rule. This much amount will be material. This much percentage will be material. There is no such hard and fast rule there. It all depends on the professional judgment of the auditor. And as we have seen that materiality, when we consider a misstatement as material, we consider a misstatement as material if it could influence the decision, if it influence the economic decision of users of the financial statements. So we are going to consider a misstatement as material if it could influence the economic decisions of users of the financial statements. Then we are going to consider that misstatement as material misstatement. If it is not going to influence if it's not going to have an impact on the decision of the users of the financial statements, then we don't consider them as material. See, now the question comes, okay, agreed, the materiality will be determined by the auditor using his professional judgment. Okay, but at least the standard should give me some approach, no? Ultimately, as an auditor, I will use my knowledge, experience and training and will decide what is material, what is not material. But the standard give me some sort of guidance, right? At least they should give me approach how to fix that materiality. Has the standard given that approach? Yes, the standard has given that approach. And what is the approach the standard has asked you to follow is, so for fixing materiality figure, first you need to determine percentage. First you need to determine one percentage. Sir, how much percentage? How much percentage? That is once again your professional judgment. So you use your professional judgment and arrive at some percentage. You can say 2%, you can say 5%, you can say 10%, you can say 20%, whatever it is. Use your professional judgment and determine one percentage. And whatever percentage that you have decided, that percentage should be multiplied with some suitable benchmark. Whatever percentage that you have decided, that percentage should be multiplied with some suitable benchmark. Sir, what could be a benchmark? A benchmark could mean different items. Benchmark could be any item of the financial statement. It could be profit, it could be turnover, it could be net worth, it could be total expenses, it could be total assets, it could be liabilities, whatever it is, any component or any item of the financial statements can be benchmark. So you have to choose one benchmark and you have to choose one percentage using your professional judgment. And if you multiply that percentage with the benchmark, you are going to get one figure. That resulting figure will be the materiality level decided by the auditor. That resulting figure will be the materiality level decided by auditor. Like for example, see once again here you will get it out. Sir, when you say benchmark, you are giving these many options. You are saying profit also could be benchmark, turnover could be benchmark, net worth could be benchmark, total assets liability could be benchmark, total liabilities could be benchmark. So you are telling that benchmark could be any of this, no, but how to choose one from this? Once again, professional judgment. Once again, professional judgment. So basically, in choosing that benchmark, various factors you will consider. In choosing that benchmark, various factors you are going to consider. Like you will consider the nature of the industry, to which industry audit you are doing, and in that industry, what are the users' expectations. Like for example, in the FMCG company, people are more interested to know about turnover. So if I am conducting audit of FMCG company, I will take turnover. It depends on if you are conducting audit of an IT company, people in the IT industry are more interested to know about the profits. There I will take the profits as a benchmark. So it depends on nature of the industry and users of financial statements requirements. It depends on requirements of applicable financial reporting framework. Sometimes there will be an indication the applicable financial reporting framework of what can be taken as a benchmark, or it also depends on volatility of the benchmark. It also depends on relative volatility of the benchmark, which means how frequently that number is changing. Say for example, for one company I am doing audit, I want to take profit as a benchmark. See, profit is somewhat constant. Year on year, it is making a progress. Like for example, for the last 5 years, if I observe, the profits are something like this: 50 crore, 60 crore, 70 crore, 80 crore, something like that. See here, the profits are less volatile. They are following one trend. They are following one specific trend. So here I can take profit as a benchmark. Why? Because it is not that much volatile. Now there is another company. If I look at their profits are something like this. In one year it was 10. In another year it was 40. In another year it was minus 5 crores of loss. In some year, once again, they have made some 25 crores of loss. In next year, they have made 30 crores of profit. So you tell me, if that is the nature of profits of the company, here the profits of the company are very volatile. Here profit might not be a suitable benchmark. I will go to some other benchmark, which is turnover. So like this, auditor will consider various factors. He will use his professional judgment and select one benchmark. That chosen benchmark will be multiplied with the chosen percentage. The resulting figure which you are going to get, you call it as materiality. Like say for example, using my professional judgment, I have decided 5%. And considering all the factors, I have taken profit as a benchmark. Now profit figure I have to take. Sir, from where I will take that profit figure? Okay, so all these factors you have considered. After considering all the factors, you have chosen that you will take the profit as a benchmark. But from where I have to take the profit figure? You all will say financial statements. But from which financial statements I have to take the profit figure? So very simple, guys. If you are doing the audit after completion of the financial year, at the time when you are doing the audit, financial statements are already ready. No need to look for any other sources. From the current period financial statements, you take the profit figure. But sometimes, as I have told, especially in big entities, we don't wait till the closure of the year to start doing the audit. We start it much earlier. During the course of the year only, we start doing the audit. See, if that is the case, in that case, current year financial statements will not be ready. Then you can take that profit figure. Then you can take that benchmark from last year financial statements, or even you can take it from budgets. If the budgets are there, from the budgets you can take, or if any latest interim financial statements are available, if any quarterly financial statements are available, from that also you can choose a benchmark. So once you have considered the factors, chosen the benchmark, now comes the question, from which source you have to select the benchmark. If the current year financial statements are ready, from the current year financial statements only I will pick. If the current year financial statements are not ready, then I will start looking for other sources like last year's financial statements, budgets, or even estimates, or even it could be interim financial statements. Now say for example, I am doing audit of the current year. By the time I am doing the audit, current year financial statements are already ready, and from the current year financial statements, the profit figure is somewhere around 500 crores. The profit figure is 500 crores. Now I have to multiply 5%, which is my chosen percentage. I have to multiply with that chosen benchmark. If I calculate that figure, that will come to 25 crores. So now 25 crores will be the materiality. What I will do is, whatever misstatements I have identified during the course of the audit, either individually or in aggregate, whether they are exceeding that materiality level or not, I will check. Yes, if the items are exceeding the materiality level, if the misstatements either individually or in aggregate, if they are exceeding the materiality level which I have fixed, then I will give modified opinion. On the other hand, if the misstatements are there, but when I calculated the amount, they are within that materiality level, then I will not give a modified opinion, I will give an unmodified opinion. Because misstatement is there, but that is not material. You are required to give a modified opinion only when the misstatements are material. Clear everyone? So like this, I have to select the bench. Like this, I have to decide the materiality level. And also the standard says one more thing. SA 320 says one more thing. You have to decide the materiality at two levels. What does the standard say? You have to decide the materiality at two levels. Materiality level for the overall financial statements, and so which we call it as overall materiality. We have to decide materiality at two levels. One is overall materiality and the other one is performance materiality. So as per the standard SA 320, we have to determine the materiality at two levels. One is overall materiality and the other one is performance materiality. Now, what is this overall materiality? What is this performance materiality? Let us try to have a quick look at it. So overall materiality is the level of materiality which is decided for the financial statements as a whole. for the entire financial statements, for the financial statements as a whole, if you are determining the materiality level, that we call it as overall materiality. On the other hand, if you are deciding the materiality level for each assertion or for each item of the financial statements, that we are going to call it as a performance materiality. Like for example, if I told that entire financial statements, I will consider them as misstated if they have 25 crores of misstatement. But if I keep this materiality level for the financial statements as a whole, sometimes in the individual items of the financial statements, like say for example, assets are there. In the assets, I have different items. Fixed assets are there, inventory is there, current assets are there, trade receivables is there, cash and cash equivalents is there. Now for the entire financial statements, overall materiality I have set it as 25 crores. But sometimes what will happen is in individual items, the misstatements could be smaller. But individually they could be smaller, but in aggregate they could be material. So, but I could miss it out individually when I look at them. Say for example, in fixed assets, I have a misstatement of 2 crore. It might look very immaterial for me, I will ignore. But if I combine with other misstatements in other areas, total misstatement could have gone beyond my 25 crore. So to avoid that kind of circumstances, what I do is for each item of the financial statement, I will keep the materiality level once again. Say for example, my fixed assets figure is 100 crore rupees. For that, I have multiplied 5% of materiality. So I will consider fixed assets as materially misstated if they have a misstatement of 5 crore rupees. So this materiality I have set for fixed assets alone, this I call it as performance materiality. And generally, performance materiality will be lower than the overall materiality. That means between overall materiality and the performance materiality, generally which figure will be higher? Overall materiality figure will be higher than when compared with the performance materiality. And few more things to talk about materiality. So generally at the planning phase, initial phases, we decide the materiality level. Whatever materiality fixation, whatever approach, whatever calculation I have told you till now, see this generally we will do it at the planning stage itself. We decide the materiality also. So we decide the materiality generally at the planning stage of the audit. When we decide the materiality, we decide the materiality at the planning stage of the audit. But during the course of the audit, if required, you might revise your materiality level. No issue. During the course of the audit, if you want to revise your materiality levels, you can do it. Like the way we are making changes to our audit strategy, audit plan and audit program during the course of the audit, in the same manner, even you can make changes to your materiality level as and when the audit progresses. There is no hard and fast rule which says anywhere that whatever materiality that you have fixed at the beginning of the audit that you have to follow strictly till the end of your audit. There is no such rule. This materiality you can revise this, like the way we can revise audit strategy plan and program, even we can make changes to our materiality related decisions also during the course of the audit. SA 320 permits it. And whatever materiality levels you have decided, how you have decided it, what is your overall materiality, what is your performance materiality, have you revised the materiality? If yes, because of which reasons you have revised the materiality, all these things should form part of my audit documentation. All these things should form part of my audit documentation. Clear and comfortable, everyone? So this is what, how to fix the materiality. So SA 320 also we have completed. So we are successfully done with risk assessment, internal control and materiality chapter also, right? So now I will go to special standards. So I will do a revision of SRS first. Standards on related services I will try to cover first. So related services I will try to cover. Right. Fine. So first we will do related services. Then after that we will do standards on assurance engagements. SAE series will do. So first we will do SRS. Then we will do SAE. So first let me talk about SRS, standards on related services. So guys, if you remember, even as I have mentioned earlier, if you are a chartered accountant in practice, you can do different kinds of engagements. One is we can do audit, which is a reasonable assurance engagement, that too of historical financial information. So there standards on audit will become applicable. Number two, you can do review, that too of historical financial information, which is a limited assurance engagement. And for doing this review engagements, SRE will become applicable. Standards of review engagements will become applicable. Then always you might not get associated yourself with historical financial information. We get associated with other than historical financial information also. Sometimes we might be required to do some engagements relating to other than historical financial information. See, when I say other than historical financial information, it could be non-financial information also. It could be future financial information also. Okay, so that engagements we are going to call it as that kind of engagements. For that kind of engagements, what will become applicable? SAA will become applicable. But if you see all these three engagements, be it audit engagement, be it review engagement, or be it other than historical financial information, these all three are assurance. In all these three engagements, we are providing assurance. That means we are giving some form of opinion, some form of conclusion we are giving, and on the basis of that conclusion, users will form their decisions. Yes or no? So even audit engagement, review engagement, or if you're associated with other than historical financial information, in all these three engagements, we give some sort of assurance, some sort of comfort we will give it to the user. We are helping the users in the decision making. But always we need not do assurance engagements. Sometimes as a chartered accountant, we are not giving any assurance. We might be doing some engagement where we are not supposed to express any opinion. We might not be required to express any conclusion. Just we might be required to perform some agreed upon procedures. Sometimes we chartered accountants can do some engagement. Sometimes some clients will come to us and ask us to perform some engagements where we are not required to express any opinion, where we are not required to express any conclusion. Just the client will ask us to perform some procedures. We do the procedures and report our findings. Factual findings only we will report. So those kind of engagements we generally call them as agreed upon procedures, or even sometimes we will do compilation engagement. Like say for example, I'm a chartered accountant. One day a client has come to me and he told, sir, we used to have CFO previously who is a chartered accountant. That person used to look after the financial statements, but that CFO has left the company. And there is no one in our company who knows accounting standards and schedule 3. We have maintained books of accounts. You please help us in preparing the financial statements. We have all our books of accounts. You please help us to prepare the financial statements of company as per the Companies Act and Schedule 3 and accounting standards. Will I say yes or no? I can say it if the client is ready to pay the fees which I have agreed for. I will definitely accept that engagement. So here I am using my expertise to help the client to prepare their financial statements. This engagement I call it as compilation engagement. So I am compiling the financial statements for the client. But you tell me, is this an assurance engagement? Am I giving any assurance? Am I giving any opinion? Am I giving any conclusion there? No. I'm just using my expertise to help the client to prepare their financial statements. So this is one example of related service. Where I don't give any assurance. I will just agree to compile their financial statements. I will give you one more example. Say for example, one day a client has come to me. X Limited, a client is there. I'm a chartered accountant in practice. I'm sitting in my office. One day this client has came to my office and told, sir, we want you to perform some procedures only in the area of not audit. We want you to perform some procedures only in the area of trade receivables. We will tell you what procedures you have to perform. You are not required to choose also. What you are required to do, what procedures you have to perform also, that also I only will say. Like the client is saying that, sir, we want you to perform some procedures. What are that procedures is? Trade receivables are there. We will give you list of all the trade receivables. You have to communicate with the external. You have to get the external confirmation. You please call the customers and give the external. You get the confirmation. Then what you do is, after you get the external confirmation, prepare one Excel sheet. In that Excel sheet, you mention the name of the debtor, and against each debtor, what is the amount as per books of accounts and what is the response you got from the external confirmation. Prepare one Excel sheet and give it to us. And also you do something called aging analysis. Out of this receivables also, you tell us, you prepare one format where you are telling which debtors are overdue for more than 30 days, more than 60 days, more than 90 days, more than 180 days. You do the aging report to us. And after doing all this, whatever your factual findings are there, no opinion, nothing. Whatever you found out, all that results, you put it in an Excel sheet and give it to us. So I said yes. The client is offering some very good amount of fees for doing that engagement. I said yes. So this engagement, I call it as agreed upon procedure. Agreed upon procedure, And even if you pay close attention here also I'm not giving any conclusion, any opinion, nothing. I am giving no assurance. I am giving just the client has asked me to perform some procedures. I performed that procedures as it is. I have some factual findings. I have some factual observations. Whatever my findings or observations are there, that I will report it to the concerned person, whoever has appointed me. Now they will decide what opinion they have to do, what decision they have to take. Let them do whatever they wanted to do. So this we call it as agreed upon procedures. So I told you about two kinds of related services. One is compilation engagement, where I use my expertise to prepare the financial statements, to help the client to prepare their financial statements. And I told you about agreed upon procedures, where the client will ask me to perform some procedures. I will perform the procedures as it is, and whatever my findings are there, those findings I will report it. Factual findings only I will report it. So how to do these two engagements? To provide guidance for that, we have a series of standards called SRS. We have one standard which is providing us the guidance how to do the compilation engagement, and there is one more standard which is giving us guidance how to perform the agreed upon procedures. So that two standards are only we are required to discuss. So if you see here, SRS 4400, it is a standard which is providing guidance to perform agreed upon procedures. I told you, right? What is agreed upon procedure? Just remember this. Just keep this at the back of your mind. Trade receivables are there. Some procedures the client has told you. Those procedures you have to perform as it is. So that procedures you have to perform. Then after that, yeah. So SRS 4400, which is talking about engagement to perform agreed upon procedures. Similarly, if some client is approaching you and asking you to do compilation engagement, have I told you about compilation engagement also? Yes. So when a client is coming to you asking you to use your expertise to help them to prepare the financial statements, how to do that engagements, that SRS 4410 is going to talk about. So if we could complete the discussion of these two standards, SRS 4400 and SRS 4410, this chapter related services will come to an end. And if your time is so good enough, very easy chapter, very small chapter. If a question comes from here, it is very easy to score the marks from this chapter. Why? Because hardly some 5 to 6 pages. If I'm not wrong, okay, some 7 pages of discussion is there. That too simple discussion we will have. No complications at all. And actually you are lucky if you get a question from this chapter. Okay, right. So let us see. First we will address SRS 4400. So if a client is approaching you, asking you to do some agreed upon procedures, what you are supposed to do, how you are supposed to do engagement. So now they have told objective. Why generally client will come to you? What is the objective of agreed upon procedures? In the case of agreed upon procedures, we carry out the procedure similar to audit. Like if you look at here the client has asked us to get the external confirmation, find out the differences, do the aging analysis. Here we are doing procedures similar to audit. But what is the difference here is we give report of factual findings only. We don't express any kind of conclusion. We don't express any kind of conclusion. We just report our factual findings. So an auditor simply provides a report on factual findings. No assurance is provided. We are not going to give any kind of assurance. Just whatever our findings are there, we will report it. And whoever users are there, they will use that findings to form their own findings, to form their own decisions. Okay. Once again, the differences they say, what is the difference between audit versus agreed upon procedures? The main point of difference is assurance. Where there will be assurance, in the audit there will be assurance. In agreed upon procedures, there will be no assurance, nothing. In audit we express opinion, in agreed upon procedures we report our factual findings only, we will try to report it. Next. So in case if the client has come to you and asked you to perform some agreed upon procedures, as per this SRS 4400, what are the things you have to do? How you have to do such engagements, what steps you have to take care, what precautions you have to take, what things you have to be careful. So now the complete guidance they are giving. So even if the client is coming to you and asking you to perform agreed upon procedures, am I required to comply with my ethical requirements? Yes. Why? Because SQC 1 says that in every engagement, be it audit, review, related service, any engagement you are doing, you are required to comply with the ethical requirements. So what are that ethical requirements? So like in every other engagement, even if you are appointed by the client to perform agreed upon procedures, there also you have to comply with 5 ethical requirements: integrity, objectivity, professional competence and due care, confidentiality, professional conduct and technical standards. 5 ethical requirements you have to comply. Sir, is the practitioner required to be independent also? Is the practitioner required to be independent also? Here independence is not required unless the terms of the engagement specifically mentions it. by default, there is no requirement of independence here. Why? Because we need the auditor to be independent, or we need the practitioner to be independent when he is expressing an assurance. But in the case of agreed upon procedures, we are not giving any assurance, right? Just we are reporting on factual findings. So here engagement assurance, here assurance will not be here, since we are not giving assurance, independence will not be required. Independence is not a requirement here. So independence is not required unless it is required as per the terms engagement. Unless client is so specific, there is no requirement for independence. Next, defining the terms of the engagement. Like in any other, like in audit engagement, we define the terms of engagement generally by way of what? Engagement letter. Do you think in the case of agreed upon procedures also engagement letter is required? More required than when compared with the audit. It is more required. The terms of the engagement is very, very important in the case of agreed upon procedures. Why? Because in audit we have standards, we have laws which will tell us what procedures we have to perform. But in the case of agreed upon procedures, the name itself says whatever procedures we have agreed with the client, that only we will perform. If you don't have that agreed upon procedures in the written format, there is going to be a huge scope for misunderstanding. So that's why than in audit, in the case of agreed upon procedures, the requirement of documenting the terms of engagement is very, very high. So that's what they say here. The auditor should ensure with the representatives of the client a clear understanding regarding agreed upon procedures. Basically, engagement letter you have to draft. So what and all terms you have to agree, what and all things have to be included in the documentation. So what is the nature of the engagement? You have to clearly mention that you are not giving any assurance. In the terms of the engagement, in the engagement letter itself, you have to mention it. And you have to include what is the purpose, why this engagement is getting performed. You have to include the purpose. And you have to identify on which information you have to perform agreed upon procedures. Like in the case of example I have given, trade receivables is the information on which I have to perform agreed upon procedures. So you have to specifically mention on which information you are performing agreed upon procedures. And nature, timing and extent of the specific procedures. What exact procedures you have to perform, that you have to include it in the engagement letter itself. And also limitation on distribution of the report. If this report, for whose purpose this report is this report everybody, or it will go to only restricted persons? That also you have to include it in the engagement letter. So it is in interest of both the client and the auditor that the auditor sends an engagement letter and the client will sign it and agree to the terms of the engagement. Next, even what else you can go and include in the engagement letter is a list of all the procedures which you have agreed, and also distribution of the report of factual findings. As I have told, this engagement is not for everybody. Agreed upon procedures will be done only for the requirements of a specific user. So you have to clearly mention in your engagement letter that this report is not for everybody. This report is only for intended users. Next, what procedures you will perform? The procedures similar to audit only we will perform, like inquiry, analysis, recomputation, comparison, and other clerical accuracy checks like arithmetical accuracy, and doing the comparison like analytical procedures. Observation we will do, inspection we will do, or confirmation we will obtain. So like whatever procedures we do in the audit, similar procedures we are going to do even in the agreed upon procedures also. And then finally reporting we will do, and as I have told, reporting one point we have to be very clear. In the final report whatever we give, we will not express our, in the final report whatever we give, in that report we will not give any kind of opinion or we will not give any kind of assurance. Simply we will report on factual findings. But that report also should have one structure, so that report also should have one format. So what is the format for reporting is, there should be proper title, there should be addressee. You have to identify on which financial or non-financial information you have performed agreed upon procedures. That information you have to identify, and you have to mention a statement that you have performed only those procedures which you have agreed with the client. There is no freedom for you to choose the audit procedure. Only whatever you have agreed with the client, that procedures only you have performed. And you have to state that you have performed this engagement as per this SRS. Which SRS? SRS 4400. And also you have to identify purpose for which this engagement is happening. You have to mention in the report. And listing of specific procedures, what exactly you have performed, mention that in your report. And your factual findings, whatever your findings are there, that findings you have to report. And you have to mention one statement that whatever procedures you have performed, that is neither an audit nor a review. Why? Because you are not giving any kind of assurance. And also a statement that auditor performed additional procedures that might have come to light that would have been reported. So if you have performed any additional procedures, generally we will not do it. If at all you have done it, you have to disclose that as well. And you have to also mention that this report is not for everybody. This report is only for the intended users. And also a statement that a report relates only to elements, accounts or items and non-financial information to the extent and it does not extend to entities' financial statements taken as a whole. You have to mention that your audit procedures are restricted to only one or two items, not for the entire financial statements. Then you have to you have to mention the date, put the signature, place of signature along with your signature. You have to complete your report. And like the way we maintain documentation for audit, even for this agreed upon procedures also, we have to maintain a perfect documentation. So this is how we need to perform agreed upon procedures as per SRS 4400. Similarly, if a client is coming to you and asking you to do some engagement for them, asking you to prepare the financial statements for them as per the applicable financial reporting framework, here also we don't give any assurance, but how you will do that engagement, what precautions you have to take, all that we are going to see here. Okay. So first of all, what do you mean by compilation engagement? So compilation engagement is an engagement in which a practitioner applies his, practitioner means a chartered accountant like you and me, we will apply our accounting and financial reporting expertise. So basically we are the experts in accounting and financial matters. No, that's what we are getting all through this education. So in the compilation engagement, what we do is a practitioner like you and me, a chartered accountant, will use his accounting and also financial expertise. For what purpose? So he uses his accounting and financial expertise to assist the management. For what purpose? To assist the management in the preparation and presentation of financial information of an entity, that too in accordance with the applicable financial reporting framework. And here also you will give a report. After completion of your compilation engagement, you will give a report, but once again, in that report, no findings, nothing. Just you will say that you have done the compilation engagement. What are your responsibilities? What are client's responsibilities? That only you will try to mention. And one more thing here one more important you have to remember: compilation engagement is not an assurance engagement. So, say for example, you are a chartered accountant in practice. One day, a client X Limited has come to you. They told that they will give the information regarding books of accounts, and from that books of accounts, you have to prepare the financial statements. So you are doing a compilation engagement here. You are compiling the financial statements for the client. Is there any requirement on you to verify whether the data given to you is correct or not, whether they have given genuine data or not? Is there any obligation on you to check the genuineness of the data given to you? Not required. Why? Because you are not giving any assurance. No, you are not doing any audit. You are not doing any verification there. What the client has told, we will give you data, prepare the financial statements. So that's what you are doing. Client is giving the data, you are preparing the financial statements. You are not doing any kind of verification work. You are not even supposed to verify whether they are giving correct data, fake data, all that you are not supposed to verify. Next. Okay. So, and the management might approach you, the client might approach you to prepare the financial statements. That financial statements might be general purpose financial statements. That financial statements might be special purpose financial statements. Whatever their need is. See, client might have 100 requirements here. If he is coming to us and ready to pay the fees, we will be ready to do the work. So sometimes you might be required to prepare the financial statements as per the Companies Act Schedule 3. Sometimes you might be asked to prepare the financial statements as per some special purpose framework. Whatever it is, it could be any engagement. Next, objectives. So if client has come to you and asked you to do the compilation engagement, then what are your objectives? My first and foremost objective will be, I will apply my accounting expertise, I will apply my financial reporting expertise, and I will help the client and I will assist the client in the preparation of the financial statements. And then finally, I will give a report. Once again, that report will not contain any findings, just my responsibilities, my duties, all that will be there. And what is the scope of compilation engagement? This will vary depending on the circumstances. Generally, in every engagement, one thing which is very common is what? Client will give me data. I have to use my expertise to assist them to prepare the financial statements. In some cases, what clients will do is, clients will even come with a draft copy of the financial statements. That means they have major knowledge, but in some standards and all, they might be lacking. So sometimes what the clients will do is, they might bring the draft copy of the financial statements. Just you have to review it once, modify some, suggest some changes, and make the financial statements ready. So it all depends. But everywhere we are going to use our financial and accounting expertise to assist the client to prepare the financial statements. Next. Now, one more thing you have to be clear. If you are a chartered accountant, if the client has come to you asking you to do the compilation engagement, now we all know that in the compilation while compiling the financial statements, there will be various areas where judgments are required. There will be various areas where judgments will be required, like accounting estimates, how much provision has to be created, all the judgments will be required. If the client is coming to you asking you to do this, asking you to do the compilation engagement, it is whose responsibility to make all that judgments. It is whose responsibility to determine that estimates, assumptions, which assumption will be appropriate. It is whose responsibility to make judgments. As a practitioner, you should do it, or it is the responsibility of the management only. It is the responsibility of the management only. So even though you are only using your expertise to assist them, the ultimate responsibility for making judgments rests with whom? Management only. The ultimate responsibility for determining which accounting policy will be appropriate for them, it will be whose responsibility? Management only. Once the financial statements are compiled, who will be responsible for that information in the financial statements? Once again, the management. So management only will take ultimate responsibility for the information provided. Management only is having responsibility for making judgments. Management is only having responsibility for determining appropriateness of accounting policies. Only as a practitioner, you will give your expertise to help them. That's all. Even after the financial statements are compiled, management only will be responsible for that financial statements, not the practitioner. So that's what they have told here. What will be the management responsibility that they are explaining it here, just like as I have explained. Now, talking about ethical requirements. See, like in the case of agreed upon procedures, we told that the practitioner should comply with ethical requirements. Do you think even in the compilation engagements also, is there a requirement to comply with ethical requirements? Yes. Here also you need to comply with the 5 ethical requirements: integrity, objectivity, confidentiality, all that things you have to comply. Is there any requirement of independence here? In the case of compilation engagement, is there a requirement? Should the practitioner must be independent? No, there is no such mandatory requirement. Why? Because once again, compilation engagement is not an assurance engagement. It is a non-assurance engagement. Independence is not a requirement unless required by the terms of the engagement. Unless the client insists, there is no requirement from the standards to remain independent. Now, here also you need to decide, like the way we do in the audit, before accepting and continuing client relationship, we will evaluate the factors. No. So here also the practitioner, here they have told certain things. If a client is coming to you and asking you to do the compilation engagement, you should not accept that engagement unless he has agreed the terms of the engagement with the management. Nothing but first you should have a mutual understanding. First you should draft here also the engagement letter, understand the terms and conditions between you and the client, then only you should accept the engagement. Like what terms you have to agree, basically what things must be included in that engagement letter, like intended use, what is the use for which you are getting the compilation engagement, and what is the applicable financial reporting framework according to which I have to prepare the financial statements, what is the objective and scope of your engagement, and what are the responsibilities of the practitioner, what are the responsibilities of the management. Like as I have told, management is only responsible for financial information, they are only responsible for internal control, they are only responsible for providing accurate records and information, they are only responsible for making the judgments. So include one paragraph where you will explain all the management responsibilities and even what will be the form and content of the report. All these terms you have to agree with the client, and the practitioner shall record all the terms of engagement even before performing the engagement. That's what we do, right? Engagement letter will be drafted after starting the audit or before starting the audit. Same like even in the compilation engagements also, before starting the engagement only draft the engagement letter and get it signed from the client. And in the case of recurring engagements, now once again I said 210 like that will come into picture. So generally in audit engagements we say that in the case of recurring audit, year after year you need not give engagement letter. If you give it in the first year, it will be enough unless some changes are taking place, like changes in the ownership, misunderstanding of the terms. So if any such exceptional circumstances happen, then only year after year we will give engagement letter, otherwise not required. Then finally, once you have accepted the engagement, you have to start performing the engagement. So while performing the engagement, what precautions you have to take or what steps you have to follow when you have started performing that compilation engagement. First one, you should obtain an understanding of what? You should understand what is the entity's business, what are their operations, what is their accounting system, what kind of accounting records they maintain, and what is their applicable financial reporting framework to which industry your client belongs. Why? Because if you don't get all this information, you can't assist them in proper preparation of the financial statements. Why? Because if you have to judge which accounting policy is correct, how much provisions they have to create, what disclosures they are required to give, if you want to do that, if you want to verify all that, you can get it done. You can give better assistance regarding compilation of financial statements only when you understand your client's business, their operations, their to which industry they belong, what are the requirements of the applicable financial reporting framework. Only when you understand it, then only you can perform the engagement. And also once you have obtained the understanding, then you have to start compiling the engagements. Now actual compilation process will start. And you have to discuss with the management regarding estimates. As I have told, management is only ultimately responsible regarding the estimates. So you have to go and tell them, sir, in these areas you have to make the decisions, you have to create the estimates. So make suitable assumptions and create an assumption. And also, yeah, if you see here, if the practitioner becomes aware during the course of the compilation engagement, if the practitioner becomes aware that the documents which are provided to him for the compilation are incomplete, inaccurate, or otherwise unsatisfactory, he shall bring it to the attention of the management and request additional information. See, if the management is giving incomplete information and asking you to prepare financial statements, can you do that? No. So the management is giving incomplete information. If they are not giving full information for compiling financial statements, go and ask them, sir, without full information, how can you expect me to prepare the financial statements? So get the required additional information. And whatever it is, finally, you will assist the client, compile the financial statements. Now read the compiled financial statements prior to the completion. So once you sign off the engagement, so you should get the copy of the compiled financial statements and read it once. Sometimes what will happen is when you are reading the compilation engagement, when you are reading that compiled financial information, you might you might ask the management to make some changes. You gave the assistance, okay, you told, okay, this should be treated like this should be treated like this. Now management, according to that instructions, they prepared the compiled financial statements and gave it to you. Once I read that compiled financial statements, I came to know that this is not perfect, some amendments are required to be made. So in case while reading the compiled information, if you find that information is not adequately referred, or information is required to be updated, or information is materially misstated or otherwise misleading, what you should do is you should propose the management to make the changes. Tell them, this is not the suggestion what I have given, this is what my suggestions are, but you are not doing it, please make the changes in the compilation engagement. You have to say that. In case if the management declines, if the manager makes the corrections, okay, but in case if the management declines or does not permit the practitioner to make the proposed amendments, then what the standard has suggested is withdraw from the engagement. In that case is what you should do, withdraw from the engagement. You are giving instruction, but they are not following. I am asking to make the changes, but they are not making the changes. Then you should withdraw from the engagement. But in some cases, withdrawal might not be possible. In case withdrawal is not possible, then you determine, is there any professional and legal responsibility on you, like getting the legal advice, communication with the regulatory authorities. So like that, if any professional responsibilities are there, fulfill it. So I will get the copy of the compiled financial statements. I will read it. On reading it, if I suggest any amendments, if the management does it well and good, if the management does not do it, I have to withdraw from the engagement. If a withdrawal is not permissible, determine the professional and legal responsibilities. Next, sometimes you will not be able to complete the engagement. You are asking the information, management is not giving, management is giving incomplete records. So from that incomplete records, you have decided that it will not be possible for you to complete the engagement. Then what you should do? If practitioner has decided that he is unable to complete the engagement, then he shall withdraw. He should resign from that engagement. He should not continue. Next, and finally, after, in case if the compilation engagement are all over, before you wind up your work, what you should do is obtain acknowledgement from the management. Nothing but a kind of written representation you have to obtain from the management that they are taking the ultimate responsibility. So ultimate responsibility for the final version of the financial statements rests with whom? Management only. Why? Because they are only providing the information, they have only made the estimates, they have only determined appropriateness of accounting policies. Just I gave them my recommendations on the basis of accounting standards, that's all. So that's why even I have assisted them in the compilation of the financial information. The ultimate responsibility for final copy of the financial information is always going to remain with the management. Even ask the management to return to accept that in a written format. And then communication with management and those charged with governance. So as a part of your compilation engagement, if you have find any matters which are required to be communicated with management and those charged with governance, fulfill those communication requirements also. And finally, you will give a practitioner's report. But as I have told, in that report, no findings, no reporting, no opinion, no assurance, nothing. Just some formal things like you will mention one title, you will give the addressee, you will say that you have compiled the information depending on information provided by the management. You will explain responsibilities of the management. You will also identify according to which applicable financial reporting framework you performed the compilation engagement. You identify the financial information including title of each element, like what is included in the financial statements like balance sheet, P&L, statement of cash flow, statement of changes in equity. So you describe the title of each element of the financial statement. Then you describe all your responsibilities. Then you describe all your responsibilities, and also mention that you have done that compilation engagement as per SRS 4410, and you should explain that compilation, what is a compilation engagement in a detailed manner, and you should add a few explanations like a compilation engagement is not an assurance engagement, and as a practitioner you are not required to verify accuracy or completeness of information provided to you. So you should mention that you have only done the compilation engagement depending on information provided, and you had no obligation to verify whether that information is correct or not, and you did not verify it. Let the users be aware of it. And practitioner does not express an audit opinion or any review conclusion on that engagement, that also you clearly highlighted. And in case if the financial statements are prepared, in case you are providing compilation engagement for financial statements prepared as per special purpose framework, in that case in your report you have to include for what purpose this information is getting prepared, for whose purpose. Special purpose financial statements are for specific users, no? So for which specific users, for what purpose this engagement has been done, that you have to clearly explain. And then finally date of the practitioner's report, and you have to put the signature along with the place of signature. And even for compilation engagements also you have to maintain the quality. Why? Because once again SQC 1 says any engagement you are doing, be it audit, be it review, be it related service, be it other than historical financial information, for every engagement you have to maintain the quality. So as per SQC 1, even for compilation engagements also you have to maintain the quality control. And like in audit we maintain documentation, whatever related matters for there, whatever important matters, whatever steps you have done, what evidence you have gathered, what conclusions you have reached in that compilation engagement, all that things should form part of your documentation. Clear? This is what regarding SRS. Very easy chapter I will say. And also as I was saying, very frequently they might not ask, but many a times they will ask. If you are lucky enough, you will definitely find a question from this chapter. And in case if you are finding the question from this chapter, it's going to be a jackpot for you. Why? Because easily you can score the marks. So that's why I will say, that's why I put this chapter under second category, where you spend less time but you have a high chance of getting the marks. Next. Now next what we will do is SAs we will do. 3000 series we will do. Right. So chapter number 16 we will try to address now, and the title of the chapter, as you could see here, it is going to talk about prospective financial information and other assurance services. So as I was just now saying, even in for SRS introduction also, as I have specified, so sometimes we chartered accountants might be required by our clients to perform some engagements which are other than historical financial information. We might not be always required to verify only historical financial information. Sometimes the clients might approach us asking us to do some engagements relating to other than historical financial information. And as I was saying, other than historical financial information means it could be a future financial information, or even it could be a non-financial information. So whenever any client is coming to you to do some engagement and the subject matter of that engagement is other than historical financial information, how to do such engagements, that guidance has been given under SAE series. And under SAE series we have three standards to be covered. One is SAE 3400, talking about examination of the prospective financial information, which is future financial information, and SAE 3402, which is talking about engagements to report on controls at a service organization, and SAE 3420 engagements to report on compilation of pro forma financial information. So three kinds of engagements they speak up here. 3400 talking about prospective financial information. 3402 it talks about verification of internal controls at service organization. Then we have SAE 3420 which is talking about pro forma financial information. So all these three standards we will try to cover it. So first I will try to start my discussion with SAE 3402. So SAE 3402 talks about prospective financial information. Sir, what is prospective financial information? So prospective financial information means simply future financial information. Sometimes, being a chartered accountant in practice, clients might approach you asking you to do some engagements where the subject matter of the information is, the subject matter of that engagement is not the historical financial information, but it is a future financial information. But it is a what? Prospective financial information. Like especially these kind of engagements will come when your client wants a loan from the bank will ask them to get some certified projections from the auditor or certified forecast from the auditor. Then the client will come to you and he will bring the next 1 year or how the next year P&L will look like. In some cases, client will bring 5 years of projection. Next to 5 years, what will be your profits? What will be the assets position? He will prepare some statements and he will come to you as a chartered accountant and he will ask you, sir, please do certify this projections or please do certify this forecast. Now you have to sign it. Now you have to verify and sign it. Now how to do such engagements? That guidance is given under SAE 3420. See, but before we can talk about how can we do that engagements, first we need to understand what are the types of prospective financial information. See, we can broadly divide prospective financial information into two categories. One kind of prospective financial information is forecast, and another kind of prospective financial information is projection. There are two kinds of prospective financial information. One kind of prospective financial information which we call it as forecast, and other kind of prospective financial information which we call it as projection. See, forecast refers to such a kind of prospective financial information which is based on best estimates. Whereas projection refers to such a prospective financial information which is based on hypothetical assumptions, best estimate assumptions I will say. And here in the case of projection, these projections are something which are based on hypothetical assumptions. Now, what is this best estimate assumption? What is this hypothetical assumption? See, best estimate assumptions are those assumptions which are more likely to happen. Best estimate assumptions are those assumptions which are more likely to happen. Which means what? Say for example, a company has prepared the forecast for the next 1 year. And how they have prepared the next 1 year forecast is depending on last 4-5 years of data they have analyzed. So from the last 5 years, profits are growing at 10%, revenue is increasing at 20%. Now in the next year also they have taken the same trend. And also at the time of making the forecast, they already have contracts. Whatever sale contracts they have, that they have considered, and whatever commitments they have, that they have considered, whatever expense commitments they have, they considered, whatever capex expenditure they are planning, that they have considered. So everything reasonably they have considered and prepared the forecast for next 1 year. See, this is a best estimate assumption. This is more likely to happen. Even though it is an assumption, it is more likely to happen. Why? Because there is a basis. They have done it on the basis of past, on the basis of the current data, on the basis of pending sales contracts, pending expense contracts. Considering all this information, they have prepared this data. So this we call it as a best estimate assumption. Okay. Whereas hypothetical assumptions are, they might happen, they might not happen. Like company is there, one company X Limited is there. They need funding from venture capital. They need funding from venture capital firm. So now what they have done is they are going for a pitch that they need funding from the venture capital. They have prepared the next 5 years forecast, 5 years projection, where they have told that if the venture capital firm will invest their money in the company, if they give them 100 crores of funding to the company, now these 100 crore rupees they will invest in one big plant and machinery, and they invest their money in the big plant and machinery, their revenue will be this much, their expenses could be this much, they will make this much amount of profit, and coming forward in the next 5 years this industry is looking very prosperous, very future oriented, and all that, depending on all that, they have prepared one projection. This document we call it as projection. Here this we call it as hypothetical assumption. Here this we call it as what? Hypothetical assumption. Which means what? Whether this could happen or this may not happen, there is no guarantee. And more likely that this will not happen only. So those kind of assumptions we call them as hypothetical assumptions, whereas we have in some cases we have forecasts which are based on best estimate assumptions. Now the client might bring the prospective financial information. Either he might bring the forecast to you, or either he might bring the projection to you. Now what you are supposed to verify with regard to that hypothetical assumption, with regard to that forecast or with regard to the projection is, when it comes to forecast, we need to check whether those assumptions are reasonable. We need to check whether that assumptions are reasonable or not, whether they are acceptable or not, that we need to check. For what? For forecast. But when it comes to hypothetical assumptions, we can't even check their acceptability also. Just we need to check whether they are consistent with the purpose. For whatever purpose they are preparing the projection, for whatever purpose they are using the hypothetical assumption, for whatever purpose they are using it, are the assumptions whatever they are made, are they consistent with the purpose or not? We need to check. Are they consistent or not? That only we will check. Whereas when it comes to best estimate assumption, we check the reasonableness. Clear everyone? That is our objective. Now one more thing, one more doubt should come to your mind. Sir, we have read the professional ethics, no? We have read the professional ethics. There in the second schedule, we have seen one clause. Do you remember, guys? If you look at the schedules which we have discussed yesterday, so if you remember this clause, which one? So if you are a chartered accountant in practice, if you are letting your name to be used, if you are permitting your name, or your name of the firm to be used with relation to a prospective financial information, which is giving a view that you are watching for the accuracy. Do you remember that clause? Then you will be deemed to be guilty of professional misconduct. If you are doing some work on future information and you are letting your name or your firm's name to be used in connection with the forecast, and which is giving a belief that you are watching for the accuracy, then you will be deemed to be guilty of professional misconduct, no? Now you should get it out. Sir, here if I do such engagements, I will be deemed to be guilty of professional misconduct, no? But now you are saying I can associate myself with the prospective financial information. Sir, how come, sir? Here I will do the professional misconduct. No, guys. What the professional ethics prohibit is, you should not associate your name in such a manner that you are watching for accuracy. So long you don't watch for the accuracy, so long you are not giving the guarantee that this will happen in the future, so long you are clearly saying that I am not saying anything that this will turn into reality, just I am giving my opinion whether the assumptions are acceptable, whether they have given proper disclosure, that's all. See, when I am conducting the engagement of this prospective financial information, and whenever I am giving my report, in that report I will not say, okay, this future information will turn into reality. On that I am not going to give the opinion. But what I will give the opinion is, my opinion will be about whatever assumptions they have made, whether they are reasonable and whether they have given all the disclosures in the prospective financial information. On that I am going to express the opinion. So if I state clearly what assumptions are made and whether they have made the disclosures or not, if I state clearly in my report, and even if I add a line that I am not watching for the accuracy, I have just checked the assumptions and I have just verified whether they have given all the disclosures or not. If you take that care, then you can do such prospective financial information. Why? Because you have to be very careful that your wording, your phrases, your opinion, your report is not giving a misconception that you are watching for accuracy. You have to be very careful about it. So long you don't watch for the accuracy, there is no problem. You can get yourself associated with prospective financial information. Understood? So this is what regarding the overall structure. Now let us go into the technicalities of the standard. Quickly we will try to cover the important content. So I have covered what is the meaning of prospective financial information. I have covered what is forecast, what is projection, all that we have covered. Now, scope of the standard. So what does the standard talk about? I have already told you the standard is going to talk whenever we are doing the prospective financial information, then this will come into picture. But here they say one important point from the scope. Entirely one point is important. This essay does not apply to examination of prospective financial information which is expressed in general or narrative terms. See, this standard will become applicable only when we are verifying prospective financial information in quantitative terms, in numbers. If the prospective financial information is in numbers, is in figures, if you are doing that engagement, then this essay will become applicable. Say for example, companies will have something called management discussion and analysis. In that management discussion and analysis, they give qualitative statements regarding the future of the company. We will become the largest company in the world. This is also a future, this is also a prospective financial information, but it is a general disclosure, narrative disclosure, not expressed in figures. So for these engagements, SA will not become applicable. Next, sir, who is responsible for preparation and presentation of financial information, prospective financial information? Generally, management is responsible. So management will prepare and present the prospective financial information. And what are their additional responsibilities is they have to identify and give proper disclosures in the prospective financial information. So in that prospective financial information, they have to give proper disclosure, what assumptions they have made, whether those assumptions are best judgment best estimate assumptions or hypothetical assumptions, and for what purpose they have prepared the prospective financial information, who are the intended users. All these are disclosures. Who is required to give? Management itself is required to give. Where? In the prospective financial information. And also they are responsible for explaining the basis of forecast. On what basis they have done the forecast, they have to explain it in the same prospective financial information, and even underlying assumptions, what assumptions they have made, that also they have to explain. Then I have already covered this paragraph. Can a professional accountant be associated with prospective financial information? The answer is yes. So long as you don't vouch for the accuracy, you can get yourself associated with the prospective financial information. Next, now what are the duties of the member? So just in case if you have accepted the prospective financial information engagement, now what are your duties? What and all you are required to fulfill? So what are my responsibilities? I need to obtain sufficient and appropriate audit evidence regarding what? So as I have told, if the management is preparing the prospective financial information on best estimate assumption, I need to check whether they are reasonable or not. Not unreasonable means reasonable. And if it is a hypothetical assumption, I need to check whether they are consistent with the purpose of the information or not. Then I need to obtain audit evidence whether the prospective financial information is properly prepared and it is properly presented and all material assumptions are disclosed. So I will check whether it is properly presented, whether all the disclosures are given or not. I have to check it. And even I need to check whether the prospective financial information is prepared on a consistent basis with historical financial statements. Say for example, 24-25 is just over. The management prepared the forecast for 25-26. Now whatever accounting policies they have followed in the historical financial information, the same accounting policies also should be followed while preparing the prospective financial information. Whether they are consistent or not, that also I will try to obtain the evidence. Next, nature of assurance regarding prospective financial information. See here, we don't give assurance that this will turn into reality. That kind of assurance we are not giving. That means our assurance is not relating to vouching for accuracy of the forecast. We give assurance, but that assurance is not that this future will turn into reality, but our assurance is relating to whether assumptions are reasonable, whether disclosures are appropriate. That is what our assurance is related to. Next, acceptance of the engagement. Precautions to be taken before accepting the engagement. If the client is coming to you and asking you to do the engagement relating to prospective financial information, before you say yes to that engagement, there are various matters which you are required to consider. So what are that matters? What are that matters which you are required to consider? What is the intended use? For what purpose this prospective financial information is getting prepared? And will it be for general distribution or limited distribution? That means, is this information for everybody or only for restricted people? And what is the nature of assumptions? What assumptions the client has made? Is it a best judgment estimate or hypothetical assumption? And elements to be included. What are the elements which are included in the prospective information and for what period they are preparing the financial information? So all these factors you have to consider before accepting that engagement. And further, and this point is important, the auditor should not accept, or if he has accepted, he should withdraw when auditor feels that the assumptions are clearly unrealistic, complete bullshit assumptions they are using. If you know it well in advance, don't accept it. After acceptance, if you got to know about it, withdraw from the engagement. And also, if you believe that prospective financial information will be inappropriate for its intended use, that means they are going to misuse this prospective financial information after my report, then also withdraw from the engagement. Next. And also, you have to decide to what extent they can rely on the historical financial information. Like say for example, company is continuously in losses from the last 2-3 years. Just in the immediately preceding year, one exceptional circumstance happened. Because of that, there was a huge spike in the profits. Now you tell me, if they prepare on this one exceptional year prospective financial information, will it be appropriate? No. Why? Because it is an exceptional item. So you should not base your prospective financial information on this. Why? Because it is a extraordinary year. So you have to see whether in case of prospective financial information, how much they can rely on the recent financial statements. Next, examination procedure. So what procedures and all you will try to perform, the list of procedures they have given here. And according to what, you have to determine your nature, timing and extent of audit procedures by performing the below, by considering below matters. That means what procedures you will perform, how much time you will spend, will you do inquiry, inspection, what you will do. So nature, timing and extent of examination procedures will depend on the following matters. What are they? It depends on what knowledge you have obtained from the previous engagement. You have to keep into consideration whether management is capable. Do the management have enough of competence to prepare that prospective financial information? And what is the likelihood of the misstatement? If the risk is high, more procedures. Extent to which it is affected by management judgment, more the judgment, more will be the risk. And sources from which management has gathered the information, whether that sources are reliable. And stability of the entity's business. In case of stable business, okay, to some extent fine, prospective financial information will be less risky. In case of unstable businesses, like companies continuously facing losses, there a little bit more risk will be there. And engagement team's experience with the business and industry, your past experience also you have to consider. So all these factors you have to consider, and accordingly you have to determine nature, timing and extent of the examination procedure. Next, in performing these procedures, source and reliability of evidence also should be assessed. From which source you are getting the evidence and what is the reliability. And you can from various sources you can get the evidence like budgets, debt agreements, industry publications, etc. And in case if hypothetical assumptions are used, all implications should have been considered. Like for example, company is saying if we get the funding, we will make sales, our sales will increase by 100%. They have increased the sales, but for increasing the sales, you should have spent more money on the plant and machinery. That means your fixed assets and depreciation also should have gone up. So that implication is also considered or not, you need to check. So when you make assumption, all its associated things should be reflected in the assumption, not just you are doing only assumptions in your favorable areas. So all that things also you need to check it. Now finally, presentation and disclosure. So you need to check whether that prospective financial information is presented properly or not. So specifically what you need to check is the prospective information is informative and it should not be misleading, and accounting policies whatever have been followed in the prospective information, that should be clearly disclosed. What assumptions they have followed, that has to be clearly explained. Like I told, whether the assumptions are best estimates or whether the assumptions are hypothetical, that has to be clearly mentioned. And on which date this prospective financial information was prepared, that management has to give the disclosure. And basis for establishing a range. Sometimes what companies will do is they prepare prospective financial information not in exact numbers, in range they will prepare the prospective financial information, which means, say for example, they will say they will prepare prospective financial information something like this. Next 1 year revenue could be somewhere around 250 crores to 300 crores, and expenses, salaries could be somewhere around 100 to 125 crores. So like this, what they are saying, what they are doing is prospective financial information they are preparing, but not as a specific figure, but in the range. You need to check in those cases whether those ranges are reasonable or not. Next, if there is any change in accounting policy from the recent historical financial information, why they have changed it. As I have told, whatever accounting policies which are reflected in the recent financial statement, the same accounting policy should be followed even in the preparation of prospective financial information. If there is any change, I need to understand why that change has taken place. And then finally, after you have completed all your engagement procedures, now you need to give your report. What should be the content of the report? Let us see. There should be title, there should be addressee. You have to identify the prospective financial information. You have to give reference to the essays if applicable, and you have to mention that management is responsible for prospective financial information. And even you have to say that this report is restricted only for limited number of people, and you have to explain what examination procedures you have performed. Then this is very important, you have to give a negative assurance. You have to give a what? Negative assurance. Sir, what is this negative assurance? See, in audit engagements, we give positive assurance. Like if I have to give you one example to make you understand, in audit, if you are satisfied that financial statements are free from material misstatements and financial statements are prepared as per applicable financial reporting framework. In audit, if you have to give unmodified opinion, then how you will phrase your opinion? How we will phrase our opinion is, in case of unmodified opinion, we will say that according to the information and explanation given to us, to the best of our information and knowledge, the financial statements give a true and fair view. The financial statements give a true and fair view. We say our assurance in a positive way. But even in the review engagements also, review engagements we did not discuss, but we have SREs. In the review engagements also, say for example, if you have done the review and if you are satisfied, everything is okay. You want to say that everything is okay. But how you will say is, you will say that nothing has come to our attention which makes us believe that financial statements are misleading. You are saying in a positive thing only. You are saying a positive thing only, but you are phrasing it in a negative way. In audit, what we say? In audit, we say that financial statements are giving true and fair view. We are satisfied that financial statements give true and fair view. But in review engagements, the same thing they say it in a negative way. They say that nothing has come to our attention which makes us believe that financial statements are misleading. Positive thing only they are saying, but they are putting it in a negative phrase. The same negative assurance we have to give even in SAE, we have to give it in the case of prospective financial information. So how we have to use the phrase is, if we are satisfied that everything is okay, how you have to use the phrase is, yeah, this phrase you have to use. State whether based on examination of evidence supporting assumption, anything has come to the attention which causes belief that assumptions do not provide reasonable basis. Which means that if I am satisfied, assumptions are all okay, disclosures are all okay, I want to give an unmodified opinion. But I will not say directly, I have obtained sufficient and appropriate evidence and I believe that assumptions are reasonable. You should not say it like that. You have to put it in a negative phrase. So how you have to put it in a negative phrase is, you have to say that nothing has come to my attention which makes me believe that assumptions are unreasonable. So ultimately you are saying assumptions are reasonable only, but you are putting that phrase in a negative way. Clear? Able to understand everyone? So that's what they try to say it here. So you have to give a opinion, but a negative assurance you have to give. And also you have to express your opinion whether prospective financial information is properly presented on the basis of assumption and whether all disclosures have been given or not. And appropriate caveats concerning achievability, basically whatever assumptions they have made, whether they are achievable or not, and that also you can give a comment. Achievable in the sense realistic or not, that's it. Date of the report you have to mention, place of the signature you have to mention, and then finally you have to sign it. Now what about modifications to the opinion? In the modifications to the opinion, I will try to explain it. Right. So modify these points, I will try to summarize it, what they are trying to say here. Sir, when we have to give the modified opinion, say for example, you have verified the prospective financial information. Very important point, guys. Here most of the students will often get confused. They have a chance of getting tested in the MCQs also. So say for example, you have verified prospective financial information. See, there could be two options. Number one, assumptions are reasonable. Assumptions are reasonable. Whatever assumptions management have made, either if they are best estimate assumptions, they are reasonable. If they are hypothetical assumptions, they are consistent. Or there could be other case where assumptions are unreasonable. There could be a case where assumptions are unreasonable. See, if the assumptions are unreasonable, if you have verified prospective financial information and if you came to know that assumptions are completely wrong, assumption itself is wrong, then what the standard says is directly give an adverse opinion. Directly give an adverse opinion. But there could be a case where assumptions are reasonable. Management has made correct assumptions only, but they have given inappropriate disclosures. They did not present the information properly. Assumptions are okay, but they have made inappropriate presentation. That means they did not present that information properly, or they did not give the disclosures properly. So inappropriate presentation or disclosures. Assumptions are all okay. They made proper assumptions only. But the problem is with regard to the presentation. They did not present the prospective financial information properly. They did not give the disclosures properly. If that is the case, the standard says either give a qualified opinion or adverse. Here they have given the freedom. Depending on materiality and pervasiveness, you choose either qualified or adverse. But if you came to know that assumption itself is unreasonable, directly you have to give an adverse opinion. Here they should not show any concern, directly give adverse. But if assumptions are reasonable, but they have given inappropriate presentation, they did not give proper disclosures, then you have to give a qualified or adverse. There the freedom has been given to you. Next, in some cases what will happen is sometimes you will not be able to perform the audit procedures. Sometimes you will not be able to obtain evidence. In that case, what we should do? There the standard has told either withdraw from the engagement or give a disclaimer of opinion. So like if you read it here, when the examination is affected by conditions that preclude application of one or more procedures considered necessary in the circumstances, the auditor shall either withdraw from the engagement or he shall give a disclaimer. If you are unable to perform the procedures only, first possibility should be to withdraw. If withdrawal is not possible, then you have to disclaim your opinion. Then finally, documentation. You have to include various things in your documentation. Okay, then we have SAE 3402. This I will try to summarize it. This entire standard will not read it from here. I will try to summarize the entire discussion in the form of one quick overview I will give, and I will try to explain it. Okay. SAE 3402, I will try to explain in a quick manner. So just please pay attention. Right. What is the time? Okay, we are done with 3 hours 20 minutes of stream. Fine. So SA 3402. This is an engagement. This is an engagement relating to assurance reports on controls at a service organization. So sometimes, as a chartered accountant in practice, you might be called upon to verify some information and give the report, and that information is not financial information at all. It is not all, ignore whether it is prospective or historical. First thing, it is not a financial information only. Sometimes, as a chartered accountant in practice, you might be called to verify the internal controls only and to give the report only on internal controls. So, what are that engagements is? For that, in order to know what is a specific engagement, we need to understand a few terms. So, there are few terms like user entity. Then we have something called user auditor. See, this discussion, whatever I am saying, in this we will cover SA 402 also. Everything will get covered. Then we have something called service organization. Then we have something called service auditor. Then we have something called service auditor. Now, what is this user entity? What is this service organization? What is this? Who is this user auditor? Who is this service auditor? Let us try to understand it. Now, let us say, for example, there is a Reliance Industries Limited. Okay, now as we all are aware, in the today's environment, companies are outsourcing their activities, their HR operations, their payment operations, their trade receivable operations, all these they are outsourcing. So what Reliance they have done is payroll activity, whatever their payroll activity is there, that they have outsourced. To whom they have outsourced? They have outsourced it to, say for example, one Infosys company, not Infosys company, okay, Infosys BPM is there. In the Infosys company, they have one wing BPM, BPO company is there. So where they will take care of outsourcing services, okay. So now this company, Reliance Industries Limited, their regular payroll operations, what they have done is, they have outsourced this activity to Infosys. That means what actually is the meaning of outsourcing is, every month this Reliance Industries Limited, they will send their employee attendance records and all to Infosys BPM. Now what this Infosys BPM will do is, they will calculate the salary, they will deduct the PF, ESI, and they will transfer the payments to the employees of Reliance. So here, Infosys, we call it as service organization. Why? Because they are providing outsourced services to Reliance. So here Infosys will become service organization. Okay. So Reliance is using the services of Infosys, right? So now here Reliance will become user auditor. User entity. Reliance will become user entity. So Reliance is a user entity, Infosys BPM is a service organization. Now what happened is, this Reliance have appointed auditors. Say for example, KPMG, they have appointed them as auditors. So these are the KPMG is an auditor conducting audit of the user entity. So here KPMG, we call them as user auditor. Now, as we all are aware, payroll activities also will form part of financial statements, employee benefit expenses. These are also forming part of financial statements or not. Now, KPMG auditors told that, sir, payroll activities you are not doing. Payroll activities you have outsourced it to Infosys. Now, if the Infosys BPM did not do the payroll processing properly, if they don't have proper internal controls for payroll processing, that will definitely have an impact on your financial statements. You are giving Infosys audit, Reliance auditors are telling to the company, sir, when it comes to payroll, you have to deduct a proper PF, ESI, gratuity, all these provisions you have to deduct and create proper provisions. If you don't do that provisions, what will happen is, if you don't have proper internal controls in this area, that will cause a material misstatement in the financial statements. But what Reliance has done, you have outsourced it, no. So whatever internal controls Reliance is supposed to implement, now that Infosys BPM has to implement to make sure that they are doing the payroll processing in a correct manner, that salary is calculated correctly, PF is deducted correctly, TDS has been deducted correctly, and these are all deposited with the regulatory authorities. So like that, Infosys BPM should have strong internal controls, then only payroll processing will happen correctly. Now KPMG, this auditor, wants to obtain evidence whether internal controls, whether Infosys BPM is having proper internal controls regarding the payroll outsourcing activities. Whatever activities that has been outsourced by Reliance to the Infosys BPM, in that area, Infosys is having proper internal controls or not, that KPMG wants to obtain audit evidence. that KPMG wants to obtain audit evidence, but they are auditors of Reliance, no, not auditors of Infosys BPM, right? And if you pay close attention, Infosys BPM will not provide this kind of payroll outsourcing to only Reliance. It will provide outsourcing services to multiple companies. Like it might be providing outsourcing services to Tata Motors, it might be providing outsourcing services to MRF, it might be providing outsourcing services to some 100 plus companies. Now, if auditors of every company will come and say, hey, we want to verify the internal controls, we want to go to Infosys BPM and verify their internal controls, then Infosys regular operations will be a problem. Why? Because auditors or user auditors of all the user entities are coming and saying we will verify the internal controls at your organization. It will be a difficult issue for Infosys BPM or not. So in order to tackle that, what Infosys has done is they went to a chartered accountant in practice and they told, boss, we want one favor from you. Not favor, we want one engagement from you. What is that engagement is? For our user entities with related to that outsourced activities, whatever outsourced activities we are doing, in relation to that activities, we already have internal controls in our organization. But user auditors want to have evidence whether we are having strong internal controls or not. But we can't encourage all user auditors to come to our premises and verify the internal controls. That will be an obstacle for our regular operations. So what they are doing is, say for example, they went to Deloitte. They went to the one of the big four entity, Deloitte, and they told, boss, we want an engagement. What you are supposed to do is you verify this internal controls. Whatever internal controls that we are implementing for the activities which are outsourced by our user entities, on that internal controls you have to verify and you have to give a report on that internal controls. You have to give a report on internal controls. So if you could give a report on internal controls, that report we will send it to our user auditors. Like here KPMG wants whether internal controls at BPM is working effectively or no. If Deloitte does the verification of internal controls and if they give the report on internal controls, if any user auditor is asking, this Infosys BPM will forward that report to them. Similarly, if tomorrow MRF auditor is asking, hey, we want to know whether you are having proper internal controls for our client or not, Infosys BPM will send that report to them. Similarly, if tomorrow Tata Motors is coming and asking Infosys BPM, we want to get a cert, we want to know whether controls at your organization is working effectively or not, Infosys BPM will send that report which is given by Deloitte. So here this Deloitte will be called as service auditor. This Deloitte will be called as what? Service auditor, who is verifying internal controls at the service organization which are relevant to the user entity's financial reporting process. Here Deloitte is conducting is doing the verification of internal controls which are operating at the service organization which are having an impact on financial reporting of user entity. So now this engagement, here Deloitte will be called as service auditor. Here Deloitte has been called upon to verify the internal controls and give a report on that internal controls. How that Deloitte should do the engagement, that guidance has been given under SAE 3402. Able to understand? So how this Deloitte is supposed to complete this engagement, how they are supposed to perform that engagement, that guidance has been given under SAE 3402. So let us try to understand what does SAE 3402 say. I will give you a brief, guys. So this standard will contain a lot of information, a lot of information they will say. If I go into line by line reading, so it will not be enough. Even 1 hour I can teach this standard in our regular class and EOB classes. We have discussed this standard in a very comprehensive manner. Students actually love the standard because of the way we teach it. So such an interesting standard it is. But here I can't afford to go line by line. Just I will give you a brief of the standard. So what does SAE 3402 say? So SAE 3402 says that service auditor can give 2 types of report. There are 2 types of report which a service auditor can give. One is, we call it as type 1 report and the other one is type 2 report. So what is a type 1 report? What is a type 2 report? Listen carefully. What will be included here? See, in both the cases, what will happen is, first, management of the service organization, they will give a description. They will give a description of internal control system. They will describe how the internal control system has been, how the internal control system is operating. They will give a description. Basically, they will prepare one document. In that document, they will explain what is their internal control system, what kind of controls they have implemented, so how they have designed it according to some applicable criteria. There will be some applicable criteria. According to that applicable criteria, they will prepare the statement. Okay. So after they have made the statement, now they will make some assertions. They will make some written statements. Management will make some written statements. What written statements they will say? They will say that whatever description they have given, whatever description of internal control system they have given, that they have given genuine description only. If I look at the terminology here, just I want to make you understand terminology. Right. If you see here, So first, the service organization will give a description. Then what they will do is a written confirmation they will give. What written confirmation they will give? Whatever description they have given that represents fairly service organization system as designed and implemented. That means the management of the service organization. In our example, Infosys BPM will prepare a description of explaining their internal control system. Then along with that, they will also make some written confirmations that whatever description they have given, that is a fair presentation. That means whatever is actually designed and implemented, that is only given. And along with that, they will also say that the controls related to the control objectives were suitably designed. They will also make one written confirmation that we have whatever we have described, that we have designed, we have done the proper designing of the controls as at a specified date. Pay attention to the terminology, guys. So what will happen in the type 1 report? The management of the service organization, they will give a detailed description of internal control system as in operation. And after that, they will give some written statement. What written statement they will give? They will say that whatever description they have given, that is a fair presentation. Whatever is really happening, that only they have described. And also they will say that they have properly designed the controls as at specified date. Say for example, as at 31st of March 2025. So our description is fair presentation, and as on 31st of March 2025, we have designed all the controls. Now what the service auditor will do is, now the service auditor will express the opinion whether really description is a fair presentation, and also he will express the opinion, he will also comment whether the controls are suitably designed or not. The management is telling description is fairly presented now, and also they are telling the controls are designed properly now. So whether really the description is a fair presentation as at specified date, and whether they are saying that they have properly designed the controls, whether they have really designed the controls properly or not, that service auditor will verify and give the report. That is a type 1 report. That is a type 1 report. If he is satisfied, he will give a modified opinion. He will give an unmodified opinion. If he is not satisfied, he will give a modified opinion. All that is okay. All that is common. But in the type 1 report, what and all will be there? Management will prepare a description of internal control system. Then they will make written confirmation that whatever description they have given, that is fair presentation. That is fairly they have presented it. And whatever controls they have described in the description, they have suitably designed it as at specified date. And that will be verified by the service auditor, and he will express the opinion on whatever confirmations management has made. So he will express the opinion whether really the description is fairly presenting the system, and they are saying that controls are suitably designed, whether they are really designed suitably or not, that he will give the comment. That is type 1 report. Now, when it comes to type 2 report, here also what will happen is management of service organization will give description. They will describe in a detailed manner what controls they have as per some applied criteria. After they have given the description, they will make written assertions. Regarding 3 things here, they will give assertion. Number 1, first assertion they will make that description is a fair presentation of system as designed and implemented. So whatever is really designed and implemented, that only they have described. Number 2, they will make an assertion that these are whatever controls which have been implemented, whatever controls which have been described, they are properly designed. They have designed it properly. And also they will make a written confirmation that those controls are even operating effectively. Even they will make a confirmation that the controls are operating effectively. This will be done for a specified period. Type 1 report will be as on specified date, but type 2 report will be for a specified period, for a specified duration, for the entire financial year, for this quarter. So like that, it will be for a specified duration. It will be for a specified period. Whereas type 1 report is as on specified date. And if you could have paid attention, what is the difference? In the type 1 report, the management is only making assertions regarding description is a fair presentation and they are suitably designed. They are not commenting on whether the controls are effective or not. But in the type 2 report, management will describe their system and they will make written confirmation that description is a fair presentation and they have designed the controls whatever have been presented in the description in a suitable manner, and they will also make a written representation that all these controls are working effectively. That also they will confirm. not as a specified date, for the specified period, for the entire period they are properly designed, they are properly implemented, and description is a fair presentation. And on all these three matters, service auditor will give the opinion. Service auditor will give the opinion about all the three. Which three? He will express the opinion whether really the management has given a fair description of the system, and whether those controls which are explained in the description are suitably designed, and whether those controls are operating effective, whether those controls are operating effectively or not. Able to understand? So like this, two types of reports. It all depends on the terms of engagement. Whether auditor will give type 1 report or he will give type 2 report, that all depends on the terms of the engagement. So sometimes the client, sometimes the service organization might appoint you only to give type 1 report. Sometimes service organization might appoint you to do type 2 report. They might also ask you to comment on the operating effectiveness also. So which kind of report auditor will give, that all depends on the terms of engagement. But whatever it is, as per SAE 3402, two kinds of reports can be issued, type 1 report and type 2 report. Okay. So this much is enough. I don't want to go into further details. If I, once again, as I've told you, no, I can't afford here. I can't afford the time here to go and read each and every point. Apart from this, if you understand this differentiation between type 1 report and type 2 report, if you refer to the standard, you can easily understand the concept now. See, many students will not read this standard only, but I'm telling you, if you understand the concept now, you will love the standard. You will love the standard. So I have experienced this feedback from the students. So when I ask some other students, they will say they did not read SAEs only. They did not read SAE, they did not read SRS, they will say. But just ask my students who have attended my classes how much they love these other standards, SRS and SAs, because it all lies in understanding the concept. If you could get the perspective of the concept, no, you are going to love it. Right. Fine. See, one student is asking, see, what is the difference between SA 402 and SAE 3402? SA 402 and SAE 3402. This also I will explain. Good question. So, what is the difference here is, SAE 3402 will talk about the responsibilities of the service auditor. No? Now, this user, why the service auditor will give the report? The service auditor will give the report so that the service entity, the service organization will forward that report to user auditor. So this type 1 or type 2 report will be given to the user auditor. Now the user auditor should make use of that type 1 or type 2 report for forming an opinion on the financial statements of Reliance, right? Now when a user auditor making use of the service auditor's report, what precautions this user auditor has to take, what things you need to verify, what precautions you have to take, what procedures he has to perform, that's what SA 402 says. Able to understand? So SA 402 is talking from the perspective of user auditor in relation to audit of the financial statements. So SA 402 is a standards on audit. So here user auditor, while conducting audit of Reliance Industries Limited, if it decides to make use of the service auditor's report, what precautions, what things you have to consider, that's what SA 402 will give the guidance, whereas SA 3402 will become applicable for the service auditor. I hope the difference was clear now. Good question, excellent, very good. Able to understand the student who has asked that question? So just reply back. Super, nice. Good. Okay. So we are done with SAE 3402 also. Now let us try to proceed further and understand one more last standard from this SAE series. Just give me a minute. Just give me 1 minute. Yeah, sorry. Yeah. SAE 3420, this is the standard which is going to talk about how to conduct audit of the pro forma financial information. So here also first we have to become clear what is the meaning of the pro forma financial information. If we could understand the pro forma financial information, then understanding the standard becomes relatively easy, right? So what is pro forma financial information? Let me try to explain that in a brief manner, then we will proceed further. Right. So what is pro forma financial information? See, pro forma financial information is such an information which is generally included in terms of, which is generally included in the case of issue of shares and all. So in two major cases, they prepare pro forma financial information. One is at the time of issue, shares issue, and the other one is at the time of acquisition. At the time of acquisition, in the prospectus or in that merger document, they prepare this something called pro forma financial information. So now what is this pro forma financial information is? Say for example, the company is about to issue the shares on 30th of September 2026, 2025, the company is about to issue the shares. Now the management has taken that decision. The management, as on 1st of June 2025, the management has taken the decision that on 30th of April, they will make the issue of the shares. Some quantity of the shares they are going to issue. So now what the management will do is, when releasing the prospectus, what the management will do is, they will take the last year's balance sheet. They will take the last year's balance sheet. Say for example, last balance sheet is 31st of March 2025. As on this date, balance sheet is prepared, P&L is prepared. Now they will take this information, and as on this date, as on 1st of June 2025, they will determine what if this issue of shares has taken place as on 31st of March only, how the financial statements will look like. They will redraft the financial statements. What they will do, they will take the financial statements as per the last audited balance sheet date or last balance sheet date, 31st of March 2025. They will take this balance sheet and P&L, and they will imagine the issue is going to take place as on 30th of March. No, what if this issue has been taken place as on 31st of March 2025 only? How the financial statements will look like, how the balance sheet will look like, how the P&L will look like, what will be the impact on dividend and EPS and all, that they will prepare one information that we call it as pro forma financial information. That we call it as what? Pro forma financial information. So now if you see the entire process, how the pro forma information is created. So first they will take something called unadjusted financial information. What they will take? Unadjusted financial information. In our example, unadjusted financial information is financial statements as on 31st of March of 2025. Now to that unadjusted information, they will make something called some adjustments, which we call them as pro forma adjustments. They will make some adjustments which we generally call them as what? Pro forma adjustments. So they will do some pro forma adjustments. Nothing but, as I have told, they will imagine what if the issue has taken place now only, as on the balance sheet date only, if the issue has taken place, how the financial statements will look like. They will make some pro forma adjustments. So by making that pro forma adjustments, they will get one resulting information. That resulting information, we call it as pro forma financial information. And this pro forma financial information, generally they will include it in the prospectus document and all. Now sometimes some clients might approach you asking you to do the verification or to conduct the audit of that pro forma financial information. However, this is also not a historical financial information, right? This is also some information which is relating to other than historical financial information. So if you are a chartered accountant and if some client is approaching you asking you to do the verification of the pro forma financial information and give your assurance on it, how to do that engagements, that is what covered under SAE 3420. That is what covered under SAE 3420. Most of the things are going to remain the same, like whatever we have discussed in the previous standards. So let us try to quickly revise this standard also, in case if the client is coming to you and asking you to do the audit of or verification of that pro forma financial information, how you are supposed to do, what and all steps you have to take care, how you have to do the reporting and all. So reporting part is a little bit tricky here. Rest of all the things are going to remain common. So let us try to understand what they are trying to say here. So first of all, what is the meaning of the pro forma financial information? They say that pro forma financial information refers to financial information which is shown together with adjustments to illustrate impact of an event or transaction on unadjusted financial information as if the event has occurred or transaction has been undertaken at an earlier date selected for the purpose of illustration. So some transaction is about to take place in the future, but they will imagine as if the transaction has taken place at an earlier date, what could have been the impact, that they will do the adjustments to the unadjusted financial information, and from that you are going to get the resulting information. That resulting information we are going to call it as pro forma financial information. And where generally we use this pro forma information is in the offered documents, like in the prospectus in the case of issue of shares, or before acquisition, after acquisition, how the entity will look like. If the acquisition has taken place at an earlier date, how the information, how the financial data would have looked like. So especially in the case of that documents, offer documents or acquisition related documents, this information will be included. Now, if a client has asked you to do the engagement relating to pro forma financial information, what will be your objective? My objective will be to obtain reasonable assurance whether this pro forma financial information has been complied as per applicable criteria. Same like audit, guys. In the audit, what they say here is, as an auditor, you need to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting criteria. This is what they say, no? Generally in the audit engagement, what is our objective? As an auditor, we need to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework. Now what they say here is, just they will replace the phrases. They will say whether practitioner, in the case of this engagement, practitioner should obtain reasonable assurance whether pro forma financial information has been prepared as per applicable criteria. That's all. Everything will remain the same. Whatever we read in the audit, everything they will try to repeat it here. Just they will replace the terminology. In audit, they say auditor needs to obtain reasonable assurance whether financial statements are prepared as per applicable financial reporting framework. But here they will say the practitioner should obtain reasonable assurance whether pro forma financial information has been prepared as per applied criteria. That's it. That's the only difference here. Right. So compilation of pro forma financial information. Oh, okay. So this how they will compile. I have all this how they will compile. Who will compile the pro forma financial information? Management will compile the pro forma financial information. How they will compile it? First, they will identify the source. Basically, they will identify the source in the sense unadjusted financial information. So they will identify to which unadjusted financial information they are going to make the adjustments. So they will identify the source. To that source, they will make the pro forma adjustments, and finally, whatever pro forma financial information you get, that pro forma financial information they will present it. Next. So who will compile? Management will compile. Will the practitioner has a responsibility to compile the pro forma financial information? No, practitioner will not compile the pro forma financial information. Who will compile the pro forma financial information? The pro forma financial information will be compiled by the management only. Next, what else? What are the steps involved? So here also, first you need to determine whether you can accept such engagement or not. So here they say that generally you will accept that engagement only when you decide that whatever criteria which is used by the management in preparation of that pro forma financial information is acceptable. If the applied criteria is not acceptable, you should not comply, you should not perform that engagement. Same in the audit, they will say. In audit, generally what they say here is you should accept the engagement only when the applicable financial reporting framework is acceptable. Now on the same lines, they will say here, you should accept this engagement to perform pro forma financial information only when you find that this applicable criteria which is used in the preparation of that pro forma financial information, if it is acceptable, then only you accept it, otherwise you don't accept it. So who will establish that acceptable criteria? Generally, we will see whether there is any criteria for that as per the standards on audit, as per some accounting standards, as per some regulatory bodies. Is there any framework that we will decide? If there is no such established criteria, management itself will decide the applicable criteria. If the applicable criteria is decided by some regulating authority or standard setting body, that they will follow. If there is no such applicable criteria which is determined by regulatory authority or standard setting body, management itself is going to decide that applicable criteria. Next. Yeah. So here also, like in audit, before accepting the engagement, what and all you will consider, same they will say here. Here also will consider whether practitioner is competent and capable or not. Then on the basis of your preliminary understanding, you need to determine whether applicable criteria is suitable or not. Determine what kind of wording management is expecting from you, whether you can give that kind of wording, whether you can use that wording depending on the evidence or not. You need to determine it. And from which source you are getting the unadjusted information. Is it audited or unaudited? If unaudited, sometimes this applicable criteria will not permit you to use unaudited information. So you need to check it. So the source to which you are making adjustments, is it audited or is it unaudited? If it is unaudited, is there a permission from the applicable financial reporting framework? Sorry, is there a permission from the applicable criteria to use that unaudited information for pro forma financial information? You need to get that thing. Next, what else? If you came to know that if the adjusted information, if the unadjusted information has never been audited, then you need to perform some extra procedures to obtain understanding of that unadjusted information's accounting policies also. Then you need to obtain responsible parties agreement. Nothing but in audit we get the agreement, no, regarding management responsibilities, that they are responsible for preparing the information, they're responsible for internal controls, they're required to provide access to all the information to the practitioner, they should provide additional information, they should also provide access to the people within the organization. Like the way we get the written confirmations in the audit, same written confirmation regarding management's responsibility, we should get it even in the case of this pro forma compilations also. And you have to plan and perform the engagement. Then finally you should plan your engagement, you have to perform your engagement. So how you will perform the engagement? Like you will determine once again whether applicable criteria is suitable, and you should also determine materiality, what is material, what is not material. Then you need to obtain understanding how responsible party has compiled with the information. Then you need to obtain evidence whether the source is appropriate or not, the source from which you are getting the information, is it appropriate or not, we need to check. And if the source is unaudited, or if there is no review report also, it is neither audited not reviewed, then we need to check whether it is suitable for me to use that source or not. Next, the practitioner shall determine whether responsibility has appropriately extracted, whether that information has been appropriately extracted or not, that we need to check. And even you need to obtain evidence regarding appropriateness of the pro forma adjustments. Next, what else? So all this is common, everything is same. So this is also written representations you will obtain, like the way we obtain written representations in the audit, we need to obtain written representations even from even in this case also. Then finally you will give the opinion. So if you are satisfied that pro forma financial information has been compiled in all respects by the responsible party on the basis of applicable criteria, basically like audit, if you are satisfied that financial statements are prepared as per applicable financial reporting framework, we give unmodified opinion, no. On same lines, if you find that pro forma financial information is prepared as per applicable criteria, then also you will give unmodified opinion. Then comes next, modified opinion. See, sometimes what will happen is, so here is where some little things they will try to say here. So this modified opinion we have to understand. After that everything is common. This all we have already covered in other essays. Only one point which we need to cover here is modified opinion. So here what they say here is, say for example, you have verified the pro forma financial information. You came to know that this pro forma financial information is not prepared as per applicable criteria, and you are not satisfied with it. Why? Because this pro forma financial information was not prepared as per applicable criteria, you did not prepare it. That means management has not fairly presented the pro forma financial information. Now generally what you are supposed to do, you are supposed to give a modified opinion, right? But sometimes this rules and regulations says that if the pro forma financial information contains modified opinion, that information should not be included in the prospectus. Sometimes regulatory authority will say, if the pro forma financial, any information which contains the modified opinion should not be included in the prospectus. Like that, law will put a restriction. In case if the law has put such a restriction and you felt that modified opinion is appropriate, first you should go and request the management, sir, I am supposed to give modified opinion. But even if I give the modified opinion also, you can't include that in the prospectus. So please do the corrections to your pro forma financial information. I will go and request to the management. In case if the management rectifies is well and good, then I will give unmodified opinion. But in case if the management is not changing, in case I have to give modified opinion, but the law or regulation is prohibiting to include the modified information in the prospectus, and the management is not ready to change. Now what I should do, sir? I can't give modified, no. Even if I give the modified opinion also, no use. That will not be included in the prospectus, right? So what I should do in that case? So if you read it here, where relevant law or regulation prohibits publication of a prospectus that contains a modified opinion with regard to whether pro forma financial information has been compiled in all material respects on the basis of applicable criteria. That means law or regulation is prohibiting you to include this modified pro forma financial information in the prospectus. In that case, but practitioner concludes that modified opinion is appropriate, then what you should do, go and discuss the matter with the responsible party. If the responsible party does not agree to make necessary changes, I went and requested the management, sir, I have to give modified opinion. But if I give modified opinion, you can't include it in your prospectus. Please make the changes, sir. But even after requesting also, they are not making the changes. Then what the standard says is, if possible, withdraw from the engagement. Withdraw, unnecessary, no. By continuing the engagement there, so withdraw from the engagement. If withdrawal is not permissible, then you go and get the legal advice. Go and get the legal advice. However, if there is no such restriction from the law did not put any restriction. Even if the pro forma financial information contains modified opinion, that also can be included in the prospectus. When such a restriction is not there from the law or regulation, what you can do is you can continue the engagement and give the modified opinion. No need to withdraw. You can continue the engagement and modify the opinion. Understood? Clear and comfortable, everybody? Then they have told about emphasis of matter paragraph, like the way in the case of audit, if we find any information is already presented or disclosed, but which is fundamental to users' understanding of the financial statements, we highlight it in the emphasis of matter, right? The same thing, even you can do it in the prospective financial information also. And finally, you have to give the report. In your report, various contents should be there, like title should be there as a addressee, and you have to include an introductory paragraph, which is similar to the opinion paragraph. Then you have to explain a statement regarding what is the responsible party's responsibilities, and responsible party in the sense management will come here. And also you have to explain in a detailed manner what are your responsibilities, like your responsibility is to express an opinion, and you are not responsible for updating or issuing any reports on any historical financial information. And the purpose of pro forma financial information in the prospectus is to illustrate the impact. So what is the purpose of the pro forma financial information, that also you have to explain. And you have to mention that you have performed this engagement as per this particular standard SAE 3420, and also a statement about what is a reasonable assurance engagement, and whatever applied criteria, whatever applicable criteria which has been used, is that acceptable or not. And also related pro forma adjustments give appropriate effects, whether pro forma adjustments have been given proper effect or not, and whether they are doing a proper application or not. Reflects proper application of those adjustments in the unadjusted financial information. Basically, whether they have properly presented that pro forma financial information or not, that assurance you have to give. And also you should mention that these procedures are depending on practitioner's professional judgment, and you have to express your opinion and use one of the following phrases: pro forma information has been complied in all material respects on the basis of applicable criteria. Or even alternatively, you can use the phrase the pro forma financial information has been properly complied. So here we are giving positive assurance only. Like the way in audit we give positive assurance, here also you can give positive assurance. You can say whether pro forma financial information has been compiled as per the applicable criteria or not. So you can give a positive assurance. Finally, you have to sign the document. You have to mention the date of the report, and even you have to mention the place of signature. And like the way we maintain documentation, here also we are supposed to maintain the documentation. Understood? So this is what regarding SAE 3420. Very interesting standards actually. So in the regular and DOE batches, we spend a lot of time here. So very interesting standards. Practically, this is where the money is there in the industry. So this you have to learn it not just from the examination perspective. For your practical, for your practice also, this will help you out. So this is where a lot of money is there. Yeah. So whatever it is, we have covered SAE and SRE. I am now going to quickly revise the most asked chapter. Even in the comments section also, many students have been asking me to do the revision of mainly two chapters. One is Audit of NBFC and the other one is Audit of Banks. So in this session, we'll try to quickly revise the content of Audit of Special Features of Audit of NBFC. So we'll try to revise that chapter, and in the upcoming sessions, we'll try to take up Audit of Banks also. We'll try to take it up. So but this session is dedicated for revising the content of Audit of NBFCs. And if you see here, this entire chapter, I have summarized it in the form of 5 pages, which is very comprehensive, which will contain all the content which is suitable for your examination. Okay, so I will say this content, whatever I have summarized here, hardly in 5 pages you will find all the content. But once again, I'm telling, this is not a complete version. This is only the summarized version, which will help you for revising the content. So I always say summary books are not for direct preparation. Summary books should be only for revision. So I stick to my word. So you should refer to this summary material only for the purpose of revision. This is not something which is a first hand source for your complete preparation, that you have to do it from your main material only. This summary material, this summary version, whatever I have here, this I will be using it for quick revision of the entire concept. Okay. And where to find these resources, where to find the summary, you better know it. So as usual, go to our website, the link of which will be provided in the description of this video. go to the free resources section. In that, go to the CA final, advanced auditing and assurance. So there you go to the summaries folder. There you will find this summary of audit of NBFCs, right? So having said that, let us start our revision now. So first of all, sir, what does this chapter talk about? This chapter is going to tell us about when you are conducting audit of an NBFC, what and all are the special features you have to keep in mind. And as a part of this chapter, they talk about operational aspects also, and they also talk about audit aspects. In this chapter, they tell us a few things about their operational aspects, like as we all are aware, banks and NBFCs create the financial sector, and these financial sector is regulated by RBI, and this financial sector plays a very crucial role in the economy of any country. So that's why so many compliances will be there. So banks and NBFCs, they can't do their business in whatever manner they want. They can't do the transactions in whatever manner they want. They have to follow certain rules and regulations. So like NPA norms, asset classification. So like that, various operational aspects will be there. So in this chapter, there is a significant amount of discussion talking on operational aspects, and there is a significant amount of discussion on audit related aspects. Both we will try to comprehensively cover it. And the question might come from operational aspects. The question might come from audit aspects. The question can come from anywhere. Okay, so now first of all, let us try to understand what is the meaning of the term NBFC, how the term NBFC has been defined. So this term NBFC has been defined under the RBI Act, and how they have defined the term is, in order to be called as an NBFC, first that entity must be a company registered under Companies Act. Either it might have been a company registered under Companies Act 1956, or it might have been registered under Companies Act 2013, whatever it is. First, the entity should be registered under the Companies Act, and it must be engaged in any one of these businesses. So they have given a list of businesses. It must have been engaged in any of these businesses. Sir, what are that businesses in which the company must be engaged into? Either it must be in the business of giving loans and advances, or it might be in the business of acquisition of shares, stocks, bonds, debentures, securities issued by government, etc. So blah blah blah, if I have to call it. So if it is into the business of acquisition of the financial instruments, or it is into business of leasing, it is into business of hire purchase, or even if it is carrying out the insurance business, or even if it is a chit fund business. So first, number one, it must be a company registered under Companies Act. Number two, it must be engaged in any of these businesses. See, sometimes what will happen is there will be a company which will do these activities, but only minor portion of their business is concentrated on these activities. Like say for example, there is one entity which is a manufacturing company. Along with the manufacturing, it is also doing some part of leasing. Just because it is doing leasing activity, can we automatically classify it as NBFC? No. The major business should be this. The major business should be any of this, then only we classify it as NPA. So then only we classify it as NBFC. That's what they say in the next line. If you read it here, it excludes institution whose principal business, whose main business is agriculture or any industrial activity or sale or purchase of the goods or providing services or dealing with the immobile properties. See, if the main business is any of this, only minimal activity or marginal activity is this any of the above activities, then we can't classify them as NBFC. So we can classify an organization as an NBFC if their principal business is this. It is only an ancillary activity, but if the main activity is either agriculture, industrial activity, purchase or sale of the goods, or providing services, or dealing in immobile property, then we don't classify it as NBFC. Next, it also includes those non-banking institutions which are accepting deposits. Under any scheme or arrangement, either in lump sum or in installments. So those kind of entities which are accepting deposits, that also will fall under NBFCs. Now there might come a confusion. See, the term NBFC has been defined in such a manner that it might lead to various confusion. Sometimes people often fall into confusion because there will be some companies which will be doing these kind of activities. Along with that, they might also be included in agriculture, manufacturing, these activities also. So many a times the industry has faced a struggle in order to bifurcate whether a company into NBFC or not. So that's why they have given one thumb rule, a final test they have provided. They have asked us to check one important thing. They have given one criteria. If an NBFC fulfills that criteria, if an entity fulfills that criteria, it will be automatically classified as NBFC. Sir, what is that identification? How to ultimately identify that NBFC? So they have asked us to check two conditions. Number one, the company in which their financial assets are more than 50% of the total assets, excluding intangible assets. So you have to take the total assets. From that, you have to exclude the intangible assets. So in that assets figure, more than 50% of the assets should be in the form of financial assets. Sir, what do you mean by financial assets? So financial assets means loans and advances, investments, shares. So those kind of financial assets should be there. How much amount? More than 50% of the total assets. And not just that, it should also fulfill the income criteria. What is that income criteria? Income from financial assets should be more than 50% of the gross income. That organization will have gross income, right? In that, more than 50% of the income should be from income from financial assets. Like that income should be in the form of interest, that income should be in the form of dividend. So like that, out of the total income, more than 50% of the income should be in the form of income from financial assets. So if any company fulfills these two conditions, if you are getting confused, this is the ultimate test by which we can determine whether an entity is NBFC or not. So two conditions, what we will check: the financial assets should be more than 50% of the total assets, and income from that financial assets should be more than 50% of the gross income. Both the conditions, if an organization fulfills, then that entity will be classified under NBFC, and it will be governed by RBI rules and regulations. Now, one more important point here, sir. What are the main differences between NBFC and banks? You are telling banks and NBFCs both constitute the financial sector of the country, no? But how do they majorly differ from each other? So a few differences are: if you take NBFC can accept any kind of deposit. They can accept demand deposits, time deposits, everything they can accept. But the problem is NBFC cannot accept demand deposits. They can never ever accept demand deposits. Okay, in some cases, some NBFCs can accept term deposits, but NBFCs cannot accept demand deposits. Banks can accept everything. NBFCs are not a part of payment and settlement system, and they can't issue checks. See, banks will form part of that payment and settlement system like NEFT, RTGS, IMPS, but NBFCs will not form part of that payment and settlement system. They can't issue checks also. And whatever deposit insurance facility of DICGC which is available for the banks, that insurance facility is not available for NBFCs. And in the case of banks, there will be some rule that they have to do minimum exposure to priority sector. So government will identify certain sectors, they will make them priority sector. Banks are required to give some funding for a certain percentage to this priority sector. There is no such restriction when it comes to NBFC. There is no requirement for giving minimum funding to the priority sector. So these are the major ways by which NBFCs and banks differ from each other. So since we got to know how to identify NBFC and how to differ from the banks, now let us come to the next part, registration and regulations of NBFC. So once an entity has been classified as NBFC, it will come under RBI rules and regulations. So when it comes to NBFCs, RBI has given strict rules and regulations. Why? Because their public trust is involved. They're dealing with the people's money and confidence. So that's why so many rules and regulations will be there. Sir, what are that rules and regulations? So one important rule which RBI set is NBFC cannot constitute no NBFC is allowed to commence business. If you want to carry out NBFC business, you can't do it unless you get a certificate of registration from RBI. Number one, you have to get the registration certificate from the RBI, and you have to maintain something called net owned funds. You have to maintain something called net owned funds. You have to maintain. In some cases, from starting from 25 lakhs, it can go up to 100 crores, or even in some cases, they have prescribed 300 crores of net owned funds also. So whatever it will be, if you want to commence your business as an NBFC, two conditions you have to fulfill. Number one, you must first get the registration certificate from the RBI. Number two, you must fulfill with the net owned funds criteria. And that net owned funds criteria, they have given for different NBFCs, different amounts they have specified. Like if I give you a few examples here, in case of NBFC P2P, NBFC AA, and NBFC with no public funds and without any customer interface, since they don't have so much of public exposure, for these NBFCs, they have prescribed as minimum as 2 crores of NOF. Whereas when it comes to NBFC, IFC, NBFCs which are into this infrastructure debt funds and all, for these NBFCs, they have specified 300 crores of highest amount of net owned funds because they have more risk exposure. So like that, depending on the risk exposure, depending upon the people or common person involved, in some cases they have prescribed as low as 2 crore rupees. In some cases they have prescribed as high as 300 crore rupees. And also, one, not just getting the registration certificate, not just maintaining the net owned funds, even you are required to comply with the prudential norms. Like banks, you are also required to maintain the prudential norms. And these prudential norms could be relating to acceptance of public deposits. Not all NBFCs are allowed to accept the public deposits. Only certain NBFCs can accept public deposits. And even they have norms relating to capital adequacy. They have to maintain certain minimum capital ratio, and they have to follow income recognition rules, asset classification like standard, substandard, doubtful loss, NPA, non-NPA, that asset classification they have to follow. And even they are required to maintain certain provision. So for every category of the asset, they have specified a certain percentage of provision, that much provision they have to create, risk exposure norms, and various other measures relating to financial solvency and reporting requirements. So running a NBFC business in India is not easy. So you have to comply with these many requirements. Not just this, there are plenty which we are about to see in the rest of the chapter. Now, what are various categories of NBFCs? See, depending on the business, first of all, depending on acceptance of deposits, we can broadly divide NBFCs into two categories. What are they? Those NBFCs which are deposit accepting and those NBFCs which are not accepting deposits. So on the basis of the NBFC's ability to accept the deposits, we can broadly divide NBFCs into two categories: deposit taking, non-deposit taking. And by the kind of activities which they do, depending on what kind of funding they are doing, in what kind of activities they are involved, we can divide NBFCs into various categories. Like if you see here, ICC, investment and credit company, infrastructure finance company, systematically important core investment company, that is CIC, non-deposit taking and systematically important, and infrastructure debt fund and microfinance institution, NBFC factors, and NBFC non-operative financial holding company, asset finance company, investment company, loan company, mortgage guarantee company. So depending on the entity, if I have to put it in this way, simple way, depending on projects which they are funding, we can broadly divide the entities into NBFCs into these many categories. Not just that, even RBI has classified NBFCs into 4 layers. RBFC has classified NBFCs into 4 layers: base layer, middle layer, upper layer, and top layer. How many layers, guys? 4 layers. What are they? Base layer, middle layer, upper layer, top layer. That means higher the layer, higher will be the rules and regulations. Very simple, guys. So we have some NBFCs in the base layer. Then after that, there will be upper layer called middle layer. Above that, we will have upper layer. Above that, we will have top layer. That means higher the layer of the NBFC, more will be the restrictions. That means those NBFCs which are there in the base layer, they will have minimum restrictions. They will not be subjected to so many compliances. Little bit freedom will be there for them. But when you go to the top layer, no, if any NBFC is falling into the top layer, they have more strict rules and regulations, more compliances, more strict environment they have to operate. So higher the layer of the NBFC, more will be the compliances. So let us see which NBFCs will fall in the base layer, which NBFCs will fall in the upper layer, which NBFCs will fall in middle layer, which NBFCs will fall in the top layer. So if you see here in the base layer, NBFCs which are non-deposit taking and that too which are having a asset size less than 1000 crores, they will fall under the base layer. So these are not deposit taking and even their asset size is also less than 1000 crores. Whereas NBFC P2P, AA, NOFHC, NBFCs with no public funds and no customer interface and even government owned NBFCs. So these will fall under base layer. Why? Because they don't have customer interface, they don't directly deal with the customers, they don't deal with the public funds and they have little bit less risk. So that's why RBI has classified these NBFCs into base layer. Then comes the middle layer. Sir, what will come in the middle layer is all NBFCs which are deposit taking. If you are NBFC non-deposit taking, if you have an asset size less than 1000 crore, it has come to base layer, no? On the other hand, if you are an NBFC non-deposit taking, if you are having an asset size of greater than or equal to 1000 crores of asset size, then it will fall in middle layer. And something called SPDs, IDF NBFCs, CICs and HFCs and even NBFC IFCs, all this will fall under middle layer. So when compared with the base layer, NBFCs in the middle layer will have some little bit stricter rules and regulations. So then which NBFCs will be there in the upper layer? See, upper layer, there is no such criteria. RBI will identify. Out of the NBFCs, RBI will identify and they will decide, okay, this NBFC will go to the upper layer. So those NBFCs which are identified by RBI, there is no specific criteria. RBI, depending on some risk factors and all, they will identify a NBFC and they will choose, okay, this NBFC should go to upper layer. Those NBFCs will come there. So NBFCs which are specifically identified by RBI, and generally what normally will happen is top 10 NBFCs, top 10 eligible NBFCs will generally remain in the upper layer. Then comes a top layer. In most of the cases, it will remain empty. Generally, top layer will remain empty. Once again, if RBI identifies that there is a substantial risk, there is a very bigger, major potential risk for that NBFC, then what RBI will do is from the upper layer, they will move it to the top layer. So if I have to put it in simple terms, in the base layer and middle layer, they have given criteria. But when it comes to upper layer and top layer, RBI will choose which NBFC should go to upper layer, which NBFC should go to the top layer, purely on the basis of risk criteria. And as I have told, higher the layer, higher will be the compliances. Higher the layer, higher will be the restrictions. Next, how and what one more thing RBI has told is, currently for NBFCs, for many NBFCs, we have net own fund criteria of 2 crore rupees, but this RBI wants to streamline. They want NBFCs to increase their NOF from 2 crores to 10 crores, but they can't say from now onwards, from today onwards, your NOF should increase from 2 to 10. They can't say it, right? So they have given a glide path. So what do you mean by glide path? They have told that by 31st of March 2027, we will give you time. We will give you time till 31st of March 2027. By the time of 31st of March 2027, you have to slowly increase your net own funds from 2 crores to 10 crores. So what is that glide path? So if you take this, NBFCs which are ICCs, current NOF is 2 crore. By 31st of March 2025, they have to increase it to 5 crore. By 31st of March 2027, they have to bring it to 10 crores. Similarly, MFI also, currently it is 2, whereas in Northeast region, it is 2 crores only. By 31st of March 2025, they have to increase it to 7. And by 31st of March 2027, they have to increase it to 10. Same with NBFC factor, currently it is 5. By 31st of March 2025, it is 7. And by 31st of March 2027, it is 10 crore rupees. So slowly over a period of time, they have to increase their net own fund criteria from 2 crores to 10 crore rupees. And for that, they have given a time till March 31, 2027. Then I have given a list of those companies which are also engaged in financial businesses only, but still they can run their business without obtaining any registration under RBI. So as a general rule, as I've told that if someone wants to run NBFC business in India, they have to get certificate of registration from RBI, right? But however, RBI has identified a few companies, they might be doing activities similar to NBFC, but still they are not required to obtain any registration from RBI. They have given exemption. The main logic here behind exemption from registration is whatever entities that we are going to read now, those are already governed by other entities. Those are already governed by other statutory corporations. So RBI doesn't want to have double compliances on them. So they have identified few entities which are also doing business similar to NBFC, but they told, okay, even if you don't get registration from RBI also, it is fine. Why? Because you are already regulated by other entities. Like what? Like if you see here, housing finance institutions, because they are already regulated by National Housing Board, etc. And merchant banking companies, they are already regulated by SEBI. Stock exchanges, they are also regulated by SEBI. Companies which are engaged in business of stock breaking or sub-broking, they are also regulated by SEBI. Venture capital fund companies, these are also regulated by SEBI. Nidhi companies, these are all regulated by MCA, Government of India. Insurance companies, these are all regulated by IRDA. Chit companies, they are also regulated by some Chit Funds Act. And then we have specified microfinance companies, securitization and reconstruction companies, mutual benefit companies, CICs, alternative investment funds, and CICs with specific criteria. So RBI told these entities, you need not get your registration once again under RBI because you are already regulated by other statutory corporations, right? So till here, we spoke about the basic types of NBFCs which are requiring registration, which are not requiring registration. Now we come to little bit on prudential norms. Now we talk about prudential norms, like what will be the capital requirement in the case of NBFC, how much amount of capital they are required to maintain, how they have to classify their assets, the prudential norms on asset classification, and even we will have a look at provisioning requirements, how much amount of provision they are required to create in the case of NBFCs. So from these three, from capital requirements, from asset classification, and even from provisioning requirements, we have a chance of getting an MCQ. In the recent times, they are asking MCQs on these prudential norms, and many students are committing a mistake there. So here we will focus now, because this is going to be important for MCQs. So first we will talk about capital requirements, capital adequacy ratio also we call it. So what is the minimum capital requirement? So RBI told that in case of major NBFCs, for tier 1 and tier 2 capital, there will be two kinds of capital. Number one is a tier 1 capital, then we have tier 2 capital. What will come in tier 1 capital, what will come in tier 2 capital, we will see in a short while. But both tier 1 capital and tier 2 capital, both put together, it should be greater than or equal to 15% of the aggregate of risk weighted assets on the balance sheet date and risk adjusted value of off balance sheet items. So if you open the balance sheet of the NBFC, you will have some items in the balance sheet, assets you will have. For each asset, they have given a risk weightage. So you have to multiply the value of the asset with given risk weight percentage. You will get the risk weighted assets. Similarly, for off balance sheet items, those items which are off the balance sheet, for that also they have given one percentage. If you multiply that value with the percentage, you will get something called risk adjusted value of off balance sheet item. So you have to add it both. From that, you will get the total value of risk weighted balance sheet items and risk adjusted off balance sheet items. On that, you have to multiply 15 percentage. You will get one resulting figure. That much amount of capital must be there for NBFC. Both tier 1 and tier 2, both put together, you must have that much amount of capital. So 15% of risk weighted balance sheet items and risk adjusted off balance sheet items. And tier 1 capital. Now extra condition is there. Tier 1 and tier 2 both put together, it must be greater than or equal to 15%. No. Now within that, tier 1 for NBFCs other than NBFC MFI and other than NBFCs which are primarily into gold loans, their tier 1 capital should be minimum 10%. 10% of the risk weighted assets. Whereas for NBFCs which are into the gold loan business, primarily into the gold loan business, they need to have tier 1 capital of 12%. This is only for tier 1. You have to remember it, guys. So tier 1 plus tier 2 put together greater than or equal to 15%. Only tier 1 for NBFCs except NBFC MFI and NBFCs which are primarily into gold loans, minimum 10% of tier 1 capital they should have. For NBFCs which are into primarily gold loans, they should have a minimum tier 1 capital of 12%. So this is what minimum capital ratio. Now you will get a doubt, sir, what will fall under tier 1 capital, what will fall under tier 2 capital? See, this we have done comprehensive examples. We have even solved something like problems in our EOB class. So if you are someone who have already watched that, this will look very easy. If you are not someone who has taken up my EOB classes, I will say one thing. Just download our question bank. In the question bank, we have included some questions on calculation. Please try it out. If at all they ask a question, you should be able to answer it. But if you are such a student who have already attended our EOB sessions, we have done comprehensive problems for that. If you have not done it, please download the question bank once and have a look at those answers. Okay. Sir, what will fall under tier 1 capital? So in case of NBFCs other than base layer, that means what will come here? Those NBFCs which are in middle layer, those NBFCs which are in upper layer, those NBFCs which are in top layer. For these NBFCs, how to calculate tier 1 capital? So what will be included in the tier 1 capital is, first you have to take the figure of owned funds. Sir, what do you mean by owned funds here? Here share capital, reserves and surpluses will come. So you have to take owned funds, share capital, mainly share capital and all will come here. So you have to take the owned funds. From that owned funds, you have to reduce investments. Sir, how much investment value you have to reduce? Over 10% of your owned funds in shares, bonds, loans, debentures, deposits with group entities. If you are an NBFC, if you have made investment in the shares, debentures, bonds or other debentures, etc. in your group entities, and that too, which are over 10% of your owned funds. Say for example, if owned funds are 100 crore rupees. If you have made investment in your group companies, you made 20 crores worth of investments in the group companies. Now on 100 crores, if you calculate 10%, you will get 10 crore. Now you have made investments in group companies in excess of 10% of own funds. How much total you have made? 20 crore. 10% of the net own funds, 10% of the own funds is 10 crore. If you take it out, 10% excess you have, this 10 crores excess of 10% you have made. At 10 you have to reduce from the own funds. So but whatever it is, as I have told, please look at the questions, you will get better clarity. Just I will do a revision here. So if you see how to calculate the tier 1 capital, you have to start with the owned funds. From that you have to reduce the value of the investments over 10% of your own funds. That to those investments which you have made in the shares, bonds and debentures of group entities. From that investments which are exceeded 10% of the own funds, that you have to reduce it. To that you have to add perpetual debt instrument up to 15% of the total tier 1 capital as on 31st of March of the previous accounting year. So you have to take the 31st March of the previous accounting year. As on that date, you have to calculate what is the tier 1 capital and you have to multiply 15%. Up to that much value, you can add the value of perpetual debt instruments. So whatever it is, if you solve the problems, you will get to know about it. How to calculate tier 1 capital, owned funds, minus investments which are over 10% of the, minus investments which are made in the shares, bonds, loans and deposits with group entities which are over 10% of the own funds. To that you can add perpetual debt instrument up to 15% of the total tier 1 capital as on 31st of March of the previous accounting year. Sir, you told that this is how you had to calculate tier 1 capital for other than base layer. Then what about NBFCs in the base layer? There how to calculate tier 1 capital? There how you have to calculate the tier 1 capital is everything will remain the same, but only one thing, you can't include the perpetual debt instruments. For base layer, you can't include the perpetual debt instruments, everything else will remain the same. Whereas when it comes to middle layer, upper layer, base layer, you can even include the perpetual debt instruments. So that is what the difference here. So whatever it is, this is how we will calculate tier 1 capital. Now what will be included in the tier 2 capital? Here a lot of things will come. Number 1, your preference shares will come. That too, those preference shares which are non-convertible to equity. You can take revaluation reserve, but it should be discounted at the rate of 55%. You can take general provisions and other reserves, other general reserves up to 1.25% of the risk weighted assets. You can also take hybrid debt capital instruments. You can take subordinated debt and excess perpetual debt instruments. See, up to 15% of the tier 1 capital as on 31st of March, that you are including it in tier 1 capital. If any excess perpetual debt instrument is there, that you have to bring it in the tier 2 capital. So whatever it is, including all this, you have to calculate what is the tier 1 capital, what is the tier 1 capital, both you have to add, and that must fulfill the criteria of 15% or more. Clear? So capital requirement very, very important here. Next, asset classification. Sir, how to classify the asset? Here also we have NPA norms, like the way we have in banks NPA norms. Here also we have NPA norms in NBFC. In case of NBFC, they say that any loan that could be a term loan, demand loan, bill, short-term advance, due from asset sales, services, lease or hire purchase, outstanding credit balances, anything for any kind of asset, if any interest or installment, if it remains overdue for more than 180 days, it will be classified as NPA. What they have told us, any loan you take, any kind of asset you take term loan, demand loan, bill, receivables, whatever loan you take, leasing receivable, whatever it is, if installment or interest, if it remains overdue for more than 180 days, it will be classified as NPA. But here also, what RBI has told us, for banks, we are going with the rule of 90 days. No, if they remain overdue for more than 90 days, it will be classified as NPA. Even RBI wants a similar NPA norms for NBFC also. But like as I have told, they can't say from today onwards, you have to stop that 180 days and follow that 90 days rule. They can't say it. So they have given time. So by 31st of March 2026, they have to slowly adopt to that 90 days overdue rule. So by 31st of March 2024, if they remain overdue for more than 150 days, it will be classified as NPA. By 31st of March 2025, if they remain overdue for more than 120 days, it will be classified as NPA. By 31st of March 2026, if they remain overdue for more than 90 days, it will be classified as NPA. Clear everyone? Able to understand? So they can't say from tomorrow onwards, you have to follow that 90 days rule. They have given us a glide path over a period of time. That is by 31st of March 2026, even NBFCs also are required to classify their assets into NPA if they remain overdue by more than 90 days. Next, even in now if we talk about asset classification, generally standard asset, non-NPA. Non-NPAs will be called as standard. Sir, what are standard assets? An asset in which there is no default in the principal or interest. That means principal and interest, everything you are getting within the due dates, and they carry normal business risk. There is no major risk in that. Whereas substandard, doubtful, loss, these are all the categories of NPAs. Sir, when an asset will remain in the substandard category, if an asset has been classified as NPA, that means if it remained overdue for this period, then it will become NPA. No? Once it has become NPA, up to 18 months, it will remain in the substandard category. If it is NBFC middle layer and above, that means for only base layer, if it remains up to 18 months in NPA category, it will remain in the substandard. But for NBFCs of middle layer and above, the condition is 12 months. That means from the date it has become NPA, up to 12 months, it will remain in the substandard category. For which NBFCs? For middle layer and above. For base layer, once it has become NPA, up to 18 months, it can remain in the substandard category. And also an asset which has been renegotiated, rescheduled, or even it is restructured until 1 year of satisfactory performance. If any loan has been renegotiated, rescheduled, that means due date have been changed or some discount has been given. So like that, if any rescheduling, renegotiation or restructuring happen, up to 1 year of satisfactory performance, it will remain in the substandard category only. Next, what about doubtful? So I have told here, in case of base layer, up to 18 months, it will remain in substandard. No, after 18 months, if it still remains NPA, then it will go to doubtful for base layer. In case of middle layer and above, up to 12 months, it will remain in the substandard. After 12 months, it will go to doubtful category. That's what they say here, which remains substandard asset for over 18 months in case of base layer, 12 months for NBFC middle layer and above. Then what about loss assets? An asset which has been identified as a loss by either NBFC or auditor and which has not been written off. So if auditor or management, they will identify, okay, this asset is not at all recoverable, then those assets will go to loss asset category. and also an asset with potential non-recoverability either due to security erosion, unavailability, or borrower has committed some fraud. Because of these reasons, if an asset has become completely irrecoverable, then also they will classify it as loss asset. Sir, why this classification is important? Why? Because depending on this classification only, provisioning requirements will depend. So what is a provision? So in case of standard asset, if the NBFC is falling in the base layer, you have to create 0.25% of the provision. For other NBFCs, that means which are in middle layer and above, they are required to create 0.4% of the provision. Even for standard also, we have to create a provision. For substandard, 10% of the outstanding balances. For doubtful assets, which are unsecured, complete 100% provision you have to create. If they are secured, which are up to 1 year in the doubtful category, 20%. 1 to 3 year secured, 30%. Greater than 3 years, 50% of the provision you have to create. If it is a loss asset, completely 100% you have to write it off. Very important, everyone. So this is where questions are going to come from: capital requirements, asset classification, and provisioning requirements, especially important for MCQs. Right. So we are done with the prudential norms. So till here we have understood regarding different types of NBFCs and their registration requirements. Then we have seen prudential norms. Now comes the audit related matters. Now comes what? Audit related matters. So as an auditor, if you are conducting audit of NBFC, what and all are the procedures you are required to perform? What will be your duties? What will be your reporting requirements? So they speak about certain things. Let us try to understand. First of all, on a broader perspective, they will say here. So if you are conducting audit of NBFC, what are broad audit procedures you have to cover? Number one, first thing, they will say you have to know the business of the company. Why? Because why we have to know about the business of the company? Because we have to determine that criteria, no, whether financial assets are more than 50%, whether income from financial assets is more than 50%. If you want to know it, you have to get to know about the business. And also, depending on the nature of the business they are doing, classification of the NBFC will depend. So that's why it is very important for us. The first and foremost thing we need to do is we have to understand the business. Sir, how can we understand? As they have told us here, you have to scan through the MOA and AOA, get the copies of MOA, AOA, go through it. See, generally MOA will be very broad. In MOA, they include, if you read the objects clause, you will find so many activities, but still they might concentrate only on few activities which are there in the MOA. And you have to carefully study the business policy. You have to understand what is the business policy of them. And you have to go through the minutes of the board or committee meetings, and even the discussions which you have to hold the discussions with the top level management. Go and sit with the top level management, read the minutes of the meeting, read the minutes of the shareholders meeting, board of directors meeting, read it. Verify findings by comparing with financial results. Whatever you have read in that all the documents, whether the same thing is reflected in the financial results or not, try to do a comparison. And even ascertain what is the principal business activity. Why? Because depending on that only classification will decide. So as we have told, depending on the activity you are doing, classification will be determined. And even which layer you will fall, that also will depend on that only. So that's why it is very important for you to determine what is your principal business activity. And based on classification, whether they are accepting the deposits within the limit or not, that also we need to check it. In case if they can accept the deposits, even on accepting the deposits also there will be limits. We need to check whether they are accepting the deposits within the limit or not. Next. Once you have understood the business of the company, like in any other business, here also we try to evaluate the internal controls. So what we will do here with regard to internal controls. Number one, who is primarily responsible for maintaining accounting system and internal control? Like in every other organization, management is having the primary responsibility to implement internal controls and even to maintain the accounting system. And sound internal control system helps the organization in detection of frauds. If NBFC is having strong internal control system, that will help them to identify the frauds. And you have to get a complete understanding of their accounting system and internal control system. Not just getting the understanding, you need to check whether internal controls are operating effectively. So here you will understand, but just understanding alone will not be enough. You need to test that control. So basically you need to perform test of controls here. And ascertain whether effective system of periodical review of the advances also are existing or not. Periodically they have to review their advances regarding recoverability. If there is no such periodical review, it will result in non-detection of sticky advances. Problematic advances, they will not be able to detect it if they don't periodically review their advances, like once in 3 months, once in half year, they have to do that. Next, registration. As I have told, every NBFC they have to comply with this. They have to comply with one requirement unless they are exempted. We have seen the list of entities also which are exempted from registration. Unless your entity falls in that exemption category, if you want to carry out the NBFC business, you must get the compulsory registration. So that's what they say here. Ask the management to give you a copy of certificate of registration. So obtain a copy of certificate of registration. If they have not yet got the registration, if they have newly started, they have not yet got the registration, but they have made the application, ask them to submit a copy of the application. And NBFCs which are incorporated after 9th Jan 1997, they must get the RBI registration. And not just that, you have to ensure compliance with NOF requirements. And in case if you are holding public deposits, they need to maintain certain percentage in certain liquid assets. That also we need to check. Like in the case of bank, we have CRR, SLR, no? Similarly here also, if you are an NBFC accepting public deposits, certain percentage you have to make investment in certain assets, we need to check it. And even you need to submit quarterly reports to the RBI. RBI requires quarterly reports on liquid assets. And even auditor should confirm liquid asset investments and regular quarterly return submissions to RBI. Next. Even we have a responsibility to check the prudential norms, like as just now as we have understood, capital adequacy ratio, provisioning norms, asset classification, whether they are complying with all these prudential norms or not, that also we need to check. So if you see a few things here, so what they say here, verify adherence to prudential norms relating to asset classification, income recognition, provisioning, capital adequacy, all prudential norms you have to check. And even we need to check, is there a proper policy in case if the company is granting demand loans, whether they have a proper policy for that or not. Proper classification we have to check into standard, substandard and all. If there is any unrealized income from NPA, it should not be recognized on accrual basis. Why? Because we know once an asset has been classified as NPA, we have to recognize it on cash basis. That is realization basis. That's what they say in the next point. Income from NPA should be accounted on a realization basis. And check NPS from the previous year. What is the status of the NPS from the previous year? In case if they are reclassified from NPA, they have been classified to normal loan. If reclassified, examine the account to ensure it meets the performing criteria. If they have reclassified it, why they have reclassified? Did they fulfill that criteria? You need to check it. Next, in case of NBFCs accepting public deposits, this is a few extra reporting requirements here. In case if you are conducting audit of such NBFC which is accepting public deposits, then there are so many things which we are required to check. So let us see what are so many things which we are required to check in the case of NBFC which is accepting public deposits. So they have given some directions, public deposit directions. We need to check whether this NBFC is properly classified. If it is deposit accepting, it will go to middle layer, right? So we need to check that classification. If not classified by RBI, if RBI directly is not classifying NBFC, then the classification will be done on the basis of registration, application, MOA, financial results. NBFC management itself will do it on the basis of all this criteria. Generally, RBI only will classify. In case if RBI is not doing it, management will classify depending on this registration requirements, financial results, etc. Next, especially in relation to acceptance of public deposits, these are the things you need to check. Number one, public deposits will be linked to credit rating. How much public deposits an NBFC can accept, that will be linked with its credit rating. Companies will have something called credit rating, like we have CIBIL, CRISIL. These entities will give a credit rating, and according to that credit rating, if you have higher credit rating, more deposits you can accept. If you have low credit rating, low deposits you have to accept. So like that, public deposits acceptance will be linked with the credit rating. So we need to check so public deposit ceiling is linked with NBFC's credit rating. So we need to check whether that public deposits are aligning with the assigned credit rating or not. And in case if there is any upgrading or downgrading of the credit ratings, accordingly deposits are also required to be adjusted. And if the downgrading has happened below the minimum investment grade, see there will be certain minimum investment grade will be there. If your credit rating has fallen even below that minimum investment grade, and if you are a ICC or factor, then you are required to take some actions. You have to stop accepting or renewing deposits. New deposits you should not accept. Existing deposits you should not renew. Existing deposits must run off to maturity, and you have to state your position within 15 days to the RBI. What is your deposit position within 15 days? You have to report it to RBI. So in case if your credit rating has been downgraded to even the minimum level, this is what you are supposed to do. Next, along with that, interest, commission, brokerage on deposits, interest is paid at proper rates or not. If there are any commission and brokerage expenses, that also we need to verify, like test checking interest and expense calculation. If there is any out of pocket reimbursement expenses, cross verify with the bills and supporting documents. And written application. Before you can accept deposits, you have to give one written application which should contain all the required details, including the category of your depositor. Only after written application you can accept the deposits. And even you have to verify the deposit register. So verify accuracy of deposit register, receipts, and even check timely payments, whether within time they are making the payment of interest and principal or not, that we need to check it. Liquid asset investment, as I have told, if you are an NBFC accepting public deposit, certain percentage you have to keep it in the liquid assets. We need to even check that investments in the liquid assets also. Timely returns, if you are an NBFC accepting public deposits, you are required to submit timely returns with the RBI. We need to check whether that timely returns are filed on time or not. And if you are an NBFC which are not accepting public deposits, if your client is an NBFC but it is not accepting public deposits, you must check whether there is a board resolution confirming that they will not accept any public deposits. And non-public deposit NBFCs, so as we have seen here, so ensure board resolution which specifies investments in the group company securities, and undertaking that it would not trade in shares or securities, and it will neither accept any public deposits. So these confirmations you have to get in the case of NBFCs which are not accepting any public deposits. So this is what we need to specifically check in case of those NBFCs which are accepting the public deposits. So these are our responsibilities. Then we have the next part which says, in NBFCs, if any fraud has taken place, those frauds can fall into different categories. So these are the different categories of the fraud. So they have told some frauds will be in the nature of misappropriation and criminal breach of trust. There will be fraudulent encashment, unauthorized credit facilities, or negligence and cash shortages, cheating and forgery, irregular forex transactions, or others category. So broadly into the 6 categories you have to divide the fraud. And one important thing here, these 2 frauds, this one, negligence and cash shortage, and irregular forex transactions, whether intentionally done or unintentionally done, they will always be treated as fraud only. So that's why I have specifically mentioned here in the brackets whether intentional or unintentional. So they will be always classified as fraud. In the remaining cases, we have to check the intention, but when it comes to negligence and cash shortage, and even when it comes to irregular forex transactions, whether intention is there or not there, we have to classify it as fraud only. And mainly they say something about cash shortages. If the cash shortage is more than 10,000, it will always be treated as fraud and reported, even if fraudulent intention is not suspected. Even there is no intention, without any intention, by mistake some cash shortage has come, and if the amount of cash shortage is more than 10,000, it should always be classified as fraud. If the cash shortage is more than 5,000 and it was not reported by cash handler, without any intention, only 5,000 cash was missing, but the person whoever is handling the cash, he has not reported it, that also need to be treated as fraud. That means if the person himself has reported, and if the amount is more than 5,000 but less than 10,000, no need to classify it as fraud. So cash shortage of more than 5,000, but it is not reported by the person whoever is handling the cash, then it will be treated as fraud and reported if detected by management, auditor, or inspecting officer. Next, one more important note point here. If you are an NBFC, if your client is an NBFC having overseas branches, then also they have to report the frauds which have taken place at the overseas location, not just a fraud happened in India. If your client NBFC is having a overseas branch, at that overseas branch, if any fraud has taken place, that also should be reported to RBI. Then we have something called audit checklist. Nothing but broadly they will say what and all we need to cover it. This is just like a list here. Even if I do the revision also, it will be just like reading it out. So quickly I will try to cover the highlighted points here. So main checklist. Number 1, if your client NBFC is dealing in shares and securities, you have to physically verify them. How to physically verify them? Just get the share scripts or bonds, etc. You have to verify them physically. No loans are advanced against its own shares. The company should not be giving the loans against its security of own shares. That they should not do it. Dividend income and interest income is accounted for except in case of NPAs. And if NBFCs want, they can recognize a dividend income on accrual basis. So generally dividend we recognize it only when right to receive the dividend has been established. But here they have told in case of dividend income for NBFCs, they have given the option to recognize it even on accrual basis. If there is any income from bonds, that you can recognize it only when they are regularly serviced. That means without any default, you are getting paid on time, then only you recognize it. Bills and contract notes you can check to know the prices. If you want to know whether really the shares are valued at proper prices, what you can do is you can get the bills and contract notes from the brokers. And for every purchase or sale or investments, board approval will be required, that you need to check. Prudential norms, this we have to check. Prudential norms for investment valuation and provisioning, that we need to check. And if there are any investments in subsidiaries and group companies, that we need to check at what price they have taken place, whether they have been valued properly or not. If this is very important. If your client has invested in unquoted debentures or bonds, that means unlisted. if your client NBFC, they have invested money in unquoted debentures or bonds, that you should not treat it as investments, that you have to treat it as loans, that you have to show it as loans. Important point. Next, apart from that, you have to check the compliance with relevant accounting standards, particularly when we talk AS 13, you need to check regarding investments, respective Indias also we have to check. And even you can get the confirmation from depositories, NSDL and all, from them you can get the confirmations. And in case if the securities are getting returned along with all the corporate benefits, you have to return it back, like bonus, dividends and rights. And if there are any charges relating to security lending, that also we need to verify. And even you can get the confirmation from the intermediary like brokers and all. And if loans are getting sanctioned, check whether there is a proper sanctioning of the loans, like what are the terms, what are the limits, what is the security accepted, how the interest is calculated, repayment schedule, that you need to verify. For giving that loans, what securities they have accepted. In case if they have discounted the bills, for that proper records are there or not. If NBFC does not lend, invest beyond prescribed limits, even for lending also they have prescribed limits, within that only they are lending it or not. And system for loan appraisal and recovery, how they are doing the loan appraisal, how they are recovering, that we need to check. And even check proper loan classification like standard, substandard, doubtful loss, and against each classification you need to check the adequate amount of provisions also. So broader checklist basically in every NBFC, all this we have to cover. Next, duties of auditor of NBFC. Now here they talk about the reporting requirements. As a part of this paragraph, they talk about reporting requirements. So let us see what are they. So compliance with NBFC auditors report. When it comes to auditors of NBFC, how to do the reporting, for that they have given some directions. That directions you have to comply. So auditor must report to board of directors. So you will report to the shareholders. You will give the report under 143 subsection 1. You will report on matters under 143 subsection 3. You will give the report to the shareholders. And also you will comply with CARO. In addition to all that, even you are required to submit one report to the board of directors. Sir, in that report to board of directors, what and all matters I have to include, that we'll see it in the short while. For that they have given the directions. But one thing you remember here, in addition to your reporting to the shareholders, even you are required to report to the board of directors also. And even you need to check whether company provided required deposit related information to RBI. Whether your client company is submitting proper information to the RBI or not, that also we need to check. And if the auditor is not satisfied with the compliance, they must report the aggregate deposits. So here you will check whether your client has submitted to the RBI deposit related information. And if you came to know that no, your client is submitting inappropriate information to the RBI, then you mention in your report that figure of deposits. And auditor must include their report to the RBI in company's audit report under section 143 of the Companies Act. So in addition to 143 section, in addition to reporting to the RBI, you have to even report to the board of directors as well. So now, as I have told, you have to report to the board of directors, no? So in that board of directors report, what and all you have to include. So this is the material which is required to be included in the audit report to the board of directors. Now they have given some points which are required to be included for all NBFCs. Then they have told us some points which are required to be included in the report of the board of directors in case of those NBFCs which are accepting or holding public deposits. And they have told some points in case of those NBFCs which are not accepting public deposits. And also in case of those companies which are engaged in business of NBFC but which are not required to hold the certificate of registration. So depending on the type of your NBFC, you have to include the material in your audit report to the board of directors. First we will talk about in case of all NBFCs. Generally in all NBFCs, there are some common points which are required to be included in the audit report which is provided to board of directors. What are that common points? Number one, NBFCs must have a certificate of registration from RBI to conduct non-banking financial activities. So as an auditor, you need to verify whether it is valid or not. Whatever certificate of registration they have obtained, whether it is valid or not, we need to check. And not just that, you need to check whether it is entitled to hold COR based on its principal business criteria. I have told that principal business criteria, no, fixed assets more than 50%, income from fixed assets more than 50%. So if they, so long they continue to fulfill the criteria, till that point of time only they are required to hold the certificate of registration. If they have violated that principal business criteria, they are no longer required to hold the certificate of registration. So you need to check whether they are entitled, whether they continue to hold that certificate of registration or not, that we need to check. And even you need to comment whether NBFC meets the required NOF criteria. And also this is one mandatory requirement. RBI told that NBFC must submit a certificate from the statutory auditor confirming compliance with the COR requirements. Regarding that certificate of registration, RBI told every NBFC from their statutory auditor they have to submit one certificate. And what is the time limit within which it is required to be submitted? That certificate must be submitted within 5 working days of signing the audit report, but maximum they can do it up to 31st of December. So if you read this phrase above certificate, which certificate? Certificate from the statutory auditor. It should be submitted to the RBI regional office within 5 working days of signing the audit report and no later than December 31st. Maximum they have time till 31st of December. Next, in case of NBFCs which are accepting the public deposits, these are the matters which are required to be included in the report to the board of directors. Number 1, whether public deposits are within the limits. So for every deposit taking NBFC, depending on their credit rating, there will be a limit. We need to comment whether the deposits they have accepted are within the limits set by RBI. And also, have they, in case if they have accessed excess public deposits, whether they are regularized or not, whether they are made good or not, we need to check. Check whether NBFC accept public deposits without required minimum investment grade criteria. As I have told, credit rating will be there, no? So minimum investment grade will be there. If they have that much credit rating, then only they can accept deposits. So we need to check whether they have that minimum investment grading or not. Then we need to comment on capital adequacy ratio, like tier 1, tier 2 capital 15%, tier 1 capital 10%. That ratio we need to comment. Credit rating for fixed deposit scheme are in force. In case if your client is offering fixed deposits, for that they have got the credit rating from a approved credit rating agency or not, that we need to comment. Compliance with restrictions on public deposits. Some NBFCs face restrictions on acceptance of public deposits. We need to check whether that restrictions have been complied with or not. Any defaults in paying interest or principal? Has the NBFC made any default in the payment of interest or principal? Compliance with income recognition, asset classification, provisioning. Did they comply with the prudential norms? Did they comply with the liquid asset requirement? All this I have told. NBFC is accepting public deposits, certain percentage they have to keep it in the liquid assets, whether they have complied with that condition or not. And submission of required deposit returns, whether they have submitted the proper returns to the RBI or not. Timely submission of quarterly prudential norm return to the RBI. And even we need to check opening and closing branches or appointing agents. If they have opened any new branches, if they have closed any new branches, have they appointed any agents? For that also we have rules whether they have complied with or not. All that we need to check. So these are the matters which we are required to report in case of those NBFCs which are accepting public deposits. Now, in the case of NBFCs which are not accepting public deposits, here what we need to check. Number 1, whether board of directors has passed a resolution that they will not accept any kind of public deposits. That resolution copy we need to check. And even after passing resolution also, have they accepted any public deposit? They should not have done it, no. Have they done it? You need to check it once. Compliance with income recognition, accounting standards, asset classification, everything you have to check. Capital adequacy ratio, that also we need to check. Timely submission of capital funds and risk ratios to RBI, and also correctly classified as an MFI. If it is classified as MFI, for that separate directions are there, whether they have correctly classified as MFI as per that directions or not, that also we need to check. And then finally, in case if your client is doing NBFC activity, but they are exempted from registration subject to some conditions. Like say for example, here I have told you list, right? There are some NBFCs which also do NBFC business, but they are exempted from registration. No, these NBFCs. So in case if your client is falling under this NBFC and they are exempted from registration, but to enjoy that registration, to enjoy that exemption, RBI will tell you some conditions. I need to comment if your NBFC is falling into this category, which are enjoying exemption from registration, whether they are fulfilling that conditions for that exemptions or not, that I need to mention in my report. So if you see here, so the auditor shall include a statement that the company is complying with such conditions to enjoy that exemption. And for any of the matters, if you get any unfavorable or qualified statements, you have to even explain reasons also. If you are unable to express an opinion, for that also you have to explain the reasons. And then as an auditor, you are required to submit an exception report, which means from the above details, if you find any non-compliances specifically with any of the above point, those exceptions, that means if everything is okay, you are not required to report to RBI. If something is wrong, those exceptions you are required to report to the RBI also. And the report which you are submitting to RBI, that only focus on contravention. If any mistakes are there, that only you are required to report. No commenting on overall compliance. You need not say overall company is doing good and all that you should not comment. If you find something wrong, only those exceptions or only those contraventions you are required to report it to the RBI. Next, sir, are NBFCs required to comply with CARO? Yes, they are required to comply with CARO. Special focus, mainly which clauses are very important in the case of companies which are in NBFCs. Generally all clauses will become applicable, but more attention has to be paid to clause 3, which is talking about issuing loans, advances and deposits. There we have 6 points. Out of that 6 points, clause A and E will not become applicable for NBFC. Why? Because there in those respective points we say this point will not become applicable in respect of those entities which are whose principal business is to give loans. You can go and refer to that. So clause 3 requires special attention, and clause 16 also specifically talks about NBFCs. These two clauses are very, very important. All other clauses also will be reported, but these two require special mention. Then what about Ind AS, sir? Sir, our NBFCs are also required to comply with Ind AS? Yes, NBFCs are also required to comply with Ind AS. And in Schedule 3, we have Division 3. In Schedule 3, we have Division 3. Division 2 actually prescribes financial statements for normal companies other than NBFC. Whereas when it comes to Division 3, this specifies what are the financial statements, what is the format for financial statements of NBFC that is mentioned in Division 3. Division 2 talks about other companies. Now you might get a doubt, sir, Division 2 you are telling for normal companies, Division 3 you are telling only for NBFCs. What are the differences between Division 2 and Division 3? That differences in brief they have told. So few relaxations have been given for NBFCs in their financial statements. What is that is, NBFCs can present their items on the basis of their liquidity. Companies don't have that option, but NBFCs they can present their balance sheet items on the basis of their liquidity. Whichever is more liquid, they can present it at the top. Next, in case of NBFCs, any other income or any other expenditure which exceeds 1% should be disclosed separately. Whereas in normal companies, they say 1% of revenue or 10 lakhs, whichever is higher. But in NBFC, they only say 1% of total income requires separate disclosure. And NBFCs must disclose debts due from any LLP where its director is a partner or member. Such condition is not there for a normal company. And also NBFCs must disclose revenue from operations and other comprehensive income on the face of the P&L, not in the P&L notes. Normal companies can do it in the notes, but in the case of NBFCs, they have to disclose those revenue from operations and other comprehensive income on the face of the P&L itself. And you need to have separate disclosure for trade receivables with significant credit risk or impairment. No such conditions for normal companies. And even in case of NBFCs, what conditions are there, what restrictions are there regarding the statutory reserves, that also must be disclosed in the notes. That means restrictions attached with the statutory reserves also you have to explain the notes to accounts. That restriction is not there in the case of normal companies. So these are the major differences between Division 2 and Division 3 of Schedule 3. Division 2 talks about format of normal companies. Division 3 will talk about format of NBFCs. So this is what the entire chapter of NBFCs, guys. So you guys have been asking me regarding this from a very long period of time, and I have done it. So in this video, we will try to revise in a very comprehensive manner. So the all important concepts and aspects relating to the chapter Audit of the Banks. So as you could see here, when compared with the Audit of the NBFCs, Audit of the Banks chapter is very huge in syllabus. So that's why we will not be going through each and every aspect of this Audit of Banks, the things which are relevant for your examination, and where there is a chance of testing the MCQs and all those areas we will focus more. But at the same time, we will try to make sure that I am trying to cover each and every important detail in this chapter. So I will try to do it. I will try to ensure it from my side. So just pay attention, watch this video till the end so that you don't miss out on any important details from this particular chapter. So having said that, let me proceed further now. So first of all, a few aspects I will try to cover here. First, what are the characteristics? First heading, as you could see here, first they are talking about what are the various characteristics that distinguishes a bank from other commercial enterprises. See, like any other commercial enterprise, like we have various kind of business entities, we have this manufacturing entities, trading entities, service sector, like any other commercial entity. Even bank is also a commercial entity. But what differentiates the bank from other commercial enterprises? How do the banks differ from other commercial enterprises? So they have given here a few points, like as you could see, number one, they are custodians of large values of monetary items. See, banks are basically custodians. They are safeguarders of the monetary items like cash or your assets, financial instruments, etc. So they are the custodian of large volumes of the monetary items. Number two, they deal with a huge volume of transactions. Just imagine the volume of the transactions which will take place at the SBI on a daily basis. So we don't see this volume of the transaction in other commercial enterprises. So the main distinguishing feature of the banks from other commercial enterprises is that huge and large volume of the transactions. Then wide geographical spread. Today we have the banks which are having the most wide geographical spread across all over India. Not just all over India, in the entire world they have their geographical spread. Then there are commitments without transfer of funds. See, this is very important here. Banks will not involve only in those transactions which involve outflow of the funds. even they incur some commitments without any outflow of the funds. The funds transferring and all will not happen. A single rupee will not move from the bank account, but still bank will engage in certain transactions like bank guarantee, letter of credit. So these are the commitments which banks will generally accept even without transfer of the funds also. Next, and also the transactions will happen at multiple points. See, as a customer of a bank today, today at my place, I'm sitting here at my business place, I'm sitting here, and with the help of the mobile phone, I can initiate a transaction. So at this point, I can initiate a transaction. I need not go to the bank physically. So transaction can be initiated at multiple points, and no intervention. And in the banking transactions, no manual intervention. See, if I have to transfer the money from my bank account to my family, there is no involvement of the bank staff here. I can do it myself. There is no manual intervention. International settlements, even they will undertake international settlements also, as we all are aware, and even they operate in a very strict regulatory environment than when compared with the other kind of business organizations. So running a banking business in India is not easy. There are various kinds of laws and regulations which you are required to comply the moment you initiate a bank. So if you see here, what is that regulatory framework? So here we have the list of laws and regulations which banks are required to comply with. So I told you, strict rules and regulations, right? They operate in a very strict regulatory environment, right? Sir, what are that laws and regulations which a bank has to comply with? So here we have the regulatory framework. Here I have given the list of all the legal framework. What is the legal framework? What kind of laws and regulations will become applicable for a bank? So that legal framework I have given here. This you can refer the entire list of laws and regulations which you are required to comply with. And sir, why special audit considerations are required in a bank? So in the previous heading, we have seen what kind of transactions will differentiate a bank from other commercial entity. So depending on these transactions, you might have already concluded that when we are conducting audit of a bank, we need to pay some special considerations. We need to consider some special things in our mind than when we are conducting the audit of other entities. So why we need to pay special audit consideration while conducting audit of the bank? They are not telling what are the special audit considerations. Instead, they are asking why special considerations will arise. Why special audit considerations will arise in the audit of the banks. So if you read the first sentence here, the special audit consideration arise in the audit because of. So why they are not telling what are those special considerations, but instead what they are saying here is because of what reasons we are required to undertake special audit considerations. Like as you could see here, a few items they say nature of risk associated with transactions, because depending on the transaction which banks are undertaking, it is giving rise to new kind of risk. And the scale of banking operations, the large scale of banking operations, and because of that, basically once again volume of the transactions, and from that significant exposure that is arising. And banks are depending exclusively on IT today. The biggest sector which is relying on the information technology is a bank. So that huge dependence on the IT is also giving rise to significant audit considerations. And there are various laws and regulations which they are required to comply with, just now as I have told. And even they are developing new products on an everyday basis. They are developing new accounting, new products and all. But for these new products, there are no new accounting models. So the pace at which the banking business is expanding, at the same pace accounting standards are not expanding. And also introduction of this net banking and mobile banking, they have brought new risk once again, and they carry huge operation and financial risk. And banks use multiple applications for different transactions, like they use something called Swift, they use something called core banking solution. So they use multiple applications, and between them interface controls also paying a more attention nowadays. So these are the various reasons because of which special audit considerations will arise in the case of audit of the banks here. Understood? Next. Sir, how do you prepare the financial statements of the bank? So as we all are aware, we have a Banking Regulation Act. In that Banking Regulation Act, we have a format for balance sheet, a format for P&L account, and there are various disclosure requirements. So all that we need to comply. And most important thing here, RBI has deferred implementation of Ind AS for all scheduled commercial banks. So for all the scheduled commercial banks, RBI has a deferred implementation of Ind AS. That means for the time being now, they are not required to comply with the Ind AS. At a future date, they will notify. From that date, they will be required to comply with the Ind AS. But currently, the Ind AS applicability has been deferred. Important for MCQs. Right. Like any other entity, they also prepare standalone financial statements, consolidated financial statements, and not just that, the banks will have someone called statutory central auditor. And apart from that, for every branch, they also have someone called statutory branch auditors. Even branch auditors also will be there in the case of the bank. So that is one more differentiating feature. Generally, in normal commercial enterprises, we only, in majority of the cases, we have central statutory auditor. But since banking transactions are happening only at the branches, but volume of the bank is very high, so what banks will generally do is they will have someone called statutory central auditor who will give a report on the entire company. Whereas for branches, they have separate statutory branch auditors also. Next, Sir, how about the appointment of auditor? Sir, who can get appointed as an auditor and who will make the appointment of auditor? If I have to put it very simply, sir, who is eligible to act as an auditor? They have simply told a person, an entity which is eligible to conduct audit of companies as per the provisions of the Companies Act, they become eligible to conduct the audit of a bank. Basically, if you are an individual, a chartered accountant in practice, if you are a firm, the firm in which majority of the partners are practicing chartered accountants. So those who are eligible, those who are duly qualified to act as the auditor of a company, the same people will be eligible to act as auditors of the banks also. Sir, who will be making the appointment in the case of normal banking company? That means, or let me put it this way, in the case of nationalized banks we have, right, which are under government control. So for those nationalized banks, the auditor will be appointed by their board of directors. Whereas in the case of a banking company, like we have this private banks like ICICI, Axis Bank and all, in case of these banking companies, the auditor will be appointed by the shareholders at the AGM. Whereas in the case of nationalized banks, it will be appointed by board of directors. But in both the cases, you need an approval of RBI. You need approval of RBI. So either in the case of banking company or in the case of nationalized bank, in both the cases, respective authorities will appoint, but in every case, approval of the RBI will be needed. And one more thing here, there is one common practice which generally banks will follow, especially in nationalized banks or public sector banks. They will appoint generally 4 or more firms of chartered accountants to act as a joint auditors. I told there will be central statutory auditor, no? But since volume of the banks are very high, so what they will do is, this is statutory central auditor, especially in the case of nationalized banks and public sector banks, they don't appoint one single firm as statutory central auditor. They generally appoint 4 or more chartered accountants of audit firms for as their statutory central auditors to conduct the joint audit. Next, and here also, like in any other entity, they will have the appointment letter, basically engagement letter kind of thing will be that, which will contain period of appointment and who will be the other auditors. Like as I've told, joint audit, if you are the joint auditor, who will be other joint auditors, and previous details of the previous auditors, what are the procedural requirements which they have to comply, and how the work has to be divided in the case of the joint audit, what is the scope of the assignment, what and all you are required to cover as a part of this audit. And in case of statutory branch auditors appointment also, there will be similar kind of appointment letter. But generally, statutory central auditors will be appointed as joint auditors, but branch auditors, but there is no concept of joint audit, so there will be no division of work and all, which will be generally there in the appointment of statutory central auditors. Now they will give a brief what are the various stages of conducting the bank audit. So what and all will happen in the entire bank audit, what and all various stages it will go through. Like you have different stages here. Stage 1, we have something called initial considerations. Basically what things you will do before we actually start doing the audit, what are the initial considerations. Then after that, the next phase of the audit is understanding, like the way we do it in normal entities also, we try to understand their business, their accounting process. So that process will follow. The stage 2 will be understanding. Then we do risk assessment. As we all are aware, risk assessment procedures is a primary audit procedure. And then we do execution. Actually, we start performing the audit. So that is the execution phase. And finally, we have something called reporting phase. So there are 5 stages of conducting the bank audit. So what are the 5 stages of conducting bank audit? We have something called initial considerations. Then we do something called understanding phase. Then we do the assessment of the risk phase. Then we actually execute the audit, and then finally we do the reporting. What are our findings are there? Those findings are required to be reported. So now what and all are the various steps which are involved in each of this stage? If we have a look at it, like number 1, acceptance and continuation of the client relationship, like the way we do it in other audits. Here also we do acceptance and continuation of the client relationship. And specifically RBI has required, in the case of bank audit, the banker will get from you a certificate of indebtedness, a declaration of indebtedness. That means whether you are indebted to the bank, has your account been classified as a willful defaulter. So that declaration you must give, requirement of the RBI. And if you are conducting audit, you should make sure that you are not doing any internal audit assignments for the same entity. And also terms of the audit engagement, basically you will draft a engagement letter, what and all are the terms and conditions, you will include it in the engagement letter, you will sign it, you will ask the bank management to sign it, so that engagement letter you will get it done. And even you have to fulfill one of the professional ethics related requirement, communication with the previous auditor. If the previous position was held by another chartered accountant, you must communicate with him in writing, so that requirement I will fulfill. And then we will spend time on proper planning. And even we establish our engagement team. Who and all will be our engagement team? Who will be doing this particular engagement? We establish our engagement team. So these are all part of initial considerations. Then comes understanding phase. Sir, what and all I will understand? I will understand about the bank, its environment, including its internal control. So that's what we do in every entity. Then even I will try to understand their accounting process. Then also I will try to understand their risk management process, how they are managing the risk. If I have to put it in simple terms, risk management process is nothing but other name for the internal controls. So I will try to understand about their entity, environment. I will try to understand their accounting process. I will also try to understand their risk management process, how they are managing the risk. And regarding the risk management system, what things specifically you will check. So this is one important aspect. So as a part of understanding phase, they told that you will try to understand the risk management process, but what specifically you will try to understand in the risk management process. Sorry. So what basically you will try to understand in the risk management process, number one, whether those charged with governance are having a oversight, whether those charged with governance are having proper monitoring of the risk management process, and whether they are properly measuring, identifying and monitoring the risk. Have they implemented proper control activities, basically internal controls and all, and not just implementation alone will be enough, whether they are monitoring it properly or not. And whatever information systems, as we all are aware, today banks are the biggest users of the technology. So whatever information systems the banks are using, are they reliable? So that also we'll need to check it. So this is what specifically I will try to evaluate regarding the risk management function. Then after that, risk assessment we will do. So we will try to identify and assess the risk of material misstatement as per SA 315, and we will try to analyze the risk especially relating to money laundering. Since banks have a chance of involving and engaging in the money laundering transactions, I will try to particularly assess whether there is any risk of fraud relating to money laundering, and especially there I need to check whether banks are complying with the KYC norms or not. That I need to specifically pay attention. And whatever risk which are at financial statement level, if it, as we all are aware from the risk assessment chapter, we need to identify risk of material misstatement at two levels, at the financial statement level, at the assertion level. If you find that there is any risk of material misstatement at the financial statement level, then you have to pay more attention. And today banks are outsourcing their operations, whatever their regular operations are there, that they're outsourcing it to the PPOs and KPOs. I need to check from outsourcing whether any new risk is arising. And this is what risk assessment phase. Then comes the execution phase. Sorry. In the actual execution phase, what and all will happen? Number one, engagement team discussions will happen. And whatever risk you have identified, to that you have to respond. How do you respond? By implementing, by performing the substantive audit procedures and compliance procedures. So you need to respond to that assessed risk. You have to establish your overall audit strategy as per SA 300. Then on the basis of that strategy, you have to develop your plan. You have to determine audit materiality, what is material, what is not material as per SA 320, determine the materiality, and even evaluate whether going concern assumption is appropriate. Once again, SA 570 requirements, you have to fulfill it. And then finally, after that, what and all your findings are there. There are various reporting requirements are there. All that reporting requirements, we will see it in the subsequent part of the chapter. You need to fulfill all those reporting requirements. So one more distinguishing feature of audit of banks is, than when compared with the other entities, in the case of audit of banks, there are plenty of reporting requirements which we are required to fulfill. Not just one or two, we have a hell of a lot of reporting requirements which are required to be fulfilled, which we'll see it in a short while after some time. So all that reporting requirements also we have to fulfill. So these are the various stages of conducting of the bank audit. Then some important IT information which banks should share with their auditors. Since banks are highly dependent on the technology, there are some important IT environment details which banks should share with the auditors, because the management of the bank are the people who will implement the IT systems and all in the organization. So as a bank management, you need to share some important IT environment details with the auditor. Sir, what are that important IT environment details which banks must share with the auditors? So here is the list here which you can refer. They have to share their overall IT policy, what IT structure they have, what kind of environment of the bank's IT system, that this information they have to share, and how they are doing data processing, what kind of interface is there, data integrity, how they are making sure of data integrity and data security, how the data is getting protected, what kind of business continuity plans or disaster control plans they have, like backup plans and all, what plans they have, and accounting manual, critical accounting entries, and in that how much involvement of IT systems are there, let the auditors know, and controls over key aspects like especially accounting head, expense booking, overdue identification. In these areas, what kind of controls they have, and controls on recording various e-banking and internet banking products. Today, as we all are aware, so today transactions are happening by way of e-banking, electronic banking. How the bank is identifying and recording these transactions, definitely with the help of technology. Ask them to share that information. And also MIS reports, what kind of MIS reports are getting generated, any exception reports are there, those exception reports they have to share, and process of generating various information related to various disclosures.
So this is some important key IT environment details which banks should share with their auditors. Next. So especially this is extension of the previous question. So bank will share this information. The management of the bank will share all this information now. Now on the basis of that information, what are the key things which you will check? What are the key security control aspects which you will address? So if you see this thing here, key security control aspects an auditor needs to address when undertaking audit in a computerized environment. So management and all will share with you the information. Now, once you got the information, once you are doing the audit in a computerized environment, what are the key security control aspects which you will consider? What are the key security related things which you will consider? Basically, what internal control aspects which you will try to verify in a computerized environment? So very simple, authorized, accurate and complete data is made available. So today all the transactions are happening within the IT system. You need to check that whatever data that is inputted into the system for the purpose of processing, is it authorized, is it accurate and is it complete? And if there is any interruption due to power, if there is any power failures, any mechanical issues, you need to ensure that if there is any power failure, if there is any hardware failure, the entity should be able to revive its operation without any distortion. That means from wherever it has stopped, from there it has to resume. No loss of data, no interruption of the operations. So you have to ensure that. And unauthorized amendments, system should not allow unauthorized amendments. Only those people with the with authorization, they can only make changes to the programs. Access control, only authorized people are having the access to the data and program, and unauthorized people are not having the access. Proper segregation of duties are there or not, and did they make any changes, and whether that changes are authenticated. If there is any manual calculations which have taken place, whether those manual calculations have done correctly, and why the need has arisen to do the manual calculation. And also exceptional transfer, if there is any exceptional transactions, whether they are authorized or not, you need to get the accounting master data and balance which is there in the master data that cannot be modified. You can only get view data. And all GL account codes which are getting used should be authorized by the head office, and whatever balance is there in the general ledger, that should tally with the subsidiary books. Then inside the audit, there will be a department called Central Audit and Inspection Department. In every bank, you will find one department inside the organization called Central Audit and Inspection Department, which is headed by a person called Chief Audit Executive. So what is the name of the department? Central Audit and Inspection Department. Like this one department will be there in the banks, and this department will be headed by a person with a designation Chief Audit Executive. So now what this department will do? What is their responsibility? The main responsibility of the department is they are responsible for undertaking risk-based internal audit. What is the main responsibility? They are responsible for undertaking risk-based internal audit, and their main responsibility is to identify the branches, which branches are required to undergo revenue audit, and also they look after the concurrent audit related matters. They will make an appointment regarding the concurrent auditors, and they will give them the guidelines, what areas are to be covered, what branches will have to be covered in the concurrent audit. They even deal with all the concurrent audit related matters. So primary function of this department is to ensure that audit function is handled smoothly, efficiently and effectively. So, and what is the risk assessment process? This we already know it. So this Central Audit and Inspection Department, on the basis of this, they will identify the risk based areas, and accordingly they will make an appointment of concurrent auditors and make sure that risk based internal audit has been carried out in the organization. Next. Coming to the next aspect, what kind of internal controls will be there generally in the bank? See, here we have so many various things here. First, they will talk about some general controls which cover all areas of the organization. Generally, as a bank as a whole, in all areas, what kind of general controls they will have. Then they talk about internal controls in each and every specific area, like in cash, what controls should be there, in clearings, what controls should be there, in bills for collection, what controls should be there, in bills purchased, what controls should be there, loans, credit card operations. So like that, multiple points we will have. So we'll try to focus on the few important points, because even if I try to do a quick revision line by line, it will be just like reading the content only. So we will try to focus on the key aspects here. First, talking about general controls. What are the general controls which you should have? This is important. This we need to remember. Number one, employee should be shifted from one position to another. This only we call it as a rotation of duties, which we have learned in the risk assessment chapter. So there should be proper rotation of duties. Number two, work of one person should always be checked by other. Basically, internal check. This is what we call it as internal check system, right? So that should be there. And number three, arithmetical accuracy. Whatever transactions which are getting performed, all the transactions should have arithmetical accuracy. Bank forms, basically checks, traveler checks, DDs, unused documents should be kept in the safe custody. That means it should be kept in the possession of a responsible officer. And there should be signature check. Whenever any documents are submitted for clearing, they should get it done only after checking the proper signatures. And signature and telegraphic code, they should be kept in the proper custody. And we need to verify they have taken insurance policies against the loss, like cash loss and all. For all that, insurance policy should be there. And financial powers are separated. You should not keep all the financial powers in the hands of one person. That financial powers should be delegated, like branch manager only up to this amount, regional manager up to this amount, area manager up to this amount. So like that, you need to divide the financial powers. And also surprise inspections has to take place. So these are all some general controls which are operating over all the areas. Now if we talk about specific controls, and even we have some extra points also, like mail should be opened by responsible officer, and if any irregularities are there, they should be promptly rectified. Then in the area of cash, what should be the important internal controls? The first important internal control, the cash should never be kept in the custody of one single person. The cash should always be kept in the custody of two persons. It should be in joint custody of two responsible officers. Very, very important point here. And in addition to normal checks, even you need to do surprise checks also, and we need to check that on the day of checking, whatever balance you have counted, that matches with the books or not. And segregation of duties should be there. Cashier should not have access to customer ledger accounts. Basically segregation. The person whoever is handling the cash, the same person should not have access to the records. And whatever counterfoils are there, they should be signed by the proper person and they should be properly stored at. And every payment should be supported by vouchers. Proper vouchers should be there. And every payment should be authorized by the responsible officer. If there is any high value cash receipts and payments, they should be verified by a higher officer. Now coming to the clearings. So what is the most important thing in clearings is, here some important points are there for MCQs. Now today we have something called check truncation system. That means if any check has to be cleared for payment, there is no physical copy of the check being transported. So what they will do is, they will take an image of the check and that image will be transferred to the concerned bank. They will approve it, then the payment will happen. So that electronic clearing of the check, we call it as a check truncation system, where physical check will not be traveled, where physical check will not travel from one place to another place, only electronic image will get traveled. And one important point for MCQs, in case if the payment is for more than 5 lakhs, if the check payment has to happen for an amount of 5 lakhs or above, before they clear the payment, they have to call the customer or either email him. If any check payment bank has to clear and in the amount is more than 5 lakh rupees, they have to either call the customer or send him an email. Sir, we have got a payment request for 5 lakh rupees. Should we do the payment or not? We have to call them, and the signatures and all should be verified. So all this is general point. This is very important, where we need to directly call or email the customer before clearing the payment. Then bills for collection, as we all know, banks doesn't do only this financing activities. They also provide some agency services, and bills for collection is one such agency service, where whatever bills that you are supposed to collect, you can hand it over to the bank. Bank will collect on behalf of you and they will get some commission for that. And once again, this is not a financing activity. This is purely a agency service. And most important thing which here you have to pay attention is, in case of bills for collection, bank will transfer the payment to the concerned customer only after they have collected it. That is the main point of difference between bills for collection and bills for discounting. In case of bill discounting, even though the bank did not receive the payment, they will still transfer the money to the respective drawer. Whereas in the case of bills for collection, the bank will credit the party's account only after they have collected the payment. Why? Because it is not a financing activity, it is just a agency service. Next, one important point from here is, the bills which are sent for collection from one branch to another branch, as on the balance sheet date, they should not be double recording. It should be only in one branch, it has to be recorded. So if one branch has got the bills for collection and that branch is forwarding the bill to another branch for bills for collection, it can't remain in both the books. It has to be eliminated at the time of preparation of the balance sheet. So these are the few important points regarding bills for collection. Now we have bills purchased. Now this is a financing activity. So in case if the bank has discounted any bills, there what we need to check is whether what kind of controls should be there is, all documents of title are properly assigned. So whatever title related documents are there, they should be handed over to the bank. Always sufficient margin should be maintained. And if the bank is unable to collect a bill, steps should be taken to recover the amount from the drawer itself. And if there is any outstanding balance, that should be reported to the head office. In case if the bill is extending over 2 years, whatever that discount income is there, that discount income should be apportioned between the two respective years. Then in the area of loans and advances, this is important. This we will go through line by line. So what kind of internal controls should be there in the area of loans and advances? Number one, before granting any loan, they have to grant the loan only after getting satisfied with the credit worthiness. Credit worthiness means basically repaying capability. Only when the bank is satisfied, okay, this customer will be able to repay the loan, then only loans should have been sanctioned. All necessary documents like loan agreements and all should have been executed. In every account, you have to maintain margin, not just at the time of giving the loan. On a continuous basis, margin should be there. And whatever securities are there, which are received and returned by responsible officer, whoever is receiving the securities, that should be under the authority of a proper officer. And the securities which require registration, they should be registered. Basically, they are talking about immobile properties here. They require registration. That registration should have taken place. And all the accounts should be kept both within the drawing power and sanction limit, especially in the case of CC loans and all. And all accounts which exceed the sanction limit or drawing power, they must be brought to the notice of management or head office. So these are a few areas of internal controls which must be there in the area of loans and advances. Then in respect of DDs, what kind of internal control should be there? Here mainly the focus on the signature, checking of the signatures and all. Next, inter-branch accounts, we need to check inter-branch accounts between the branches if any outstanding balances are there. For that, we need to get the advice. Advice basically in the sense confirmation. You need to get the confirmation from the other branch, then only entry should have been recorded in the books of accounts. If something is outstanding for a very long period of time, try to understand the reasons. And once again, one more important question which is tested multiple times is what kind of internal controls should be there in the area of credit card operations. This also will go in a detailed manner. So in the area of credit card operations, what kind of internal controls should be there? So let us see. Number one, effective screening of application. Same like credit worthiness only. You should not sanction the credit card to each and every person. There should be proper screening. Whose salary is how much, whose revenue is how much credit limit we have to give, whether this person deserves a credit card or not. So like that, we need to have an effective screening system. After that only credit cards would be sanctioned. And there should be strict control over storage. Unissued cards, whatever are there, they should be stored properly. They should be under proper control. And merchant confirm status of unutilized limit. If any customer is coming and swiping his card at the merchant, he should be intimated whether there is a limit or not, whether there is a still limit is there or not. That kind of communication mechanism should be there. So system of prompt reporting by the merchants. Merchants also should report all the transactions which they have accepted on a credit card on a timely basis. And reimbursement to merchants will happen only after verifying validity of the transactions. All reimbursement should be immediately charged to customer. The moment you are giving the money to the merchant, you have to charge that respective customer. And also statements should be sent regularly. Credit card statements on monthly basis you should get it. And there should be a proper system to monitor and follow up the customer's payments. You need to banks, that's why they send you reminders. Your due date is in 2 days, your due date is in 3 days. Kindly make the payment. That proper follow up should be there. And also if there are any payment beyond the reasonable period, they should be attended carefully. If any customer is not paying the amount from a long period of time, for that you need to have specific instructions. And also there should be a system of periodical review of credit card holders account. So generally they will give you credit card, but on a continuous basis they have to do the monitoring and they have to take actions. Like in some cases it will be necessary to reduce the credit limit. In some cases they will try to extend the credit limit. So like that, you have to monitor that customer's account on a regular basis and either increase or decrease the credit limit as per his credit worthiness. So very important aspect. Many a times I have tested in the RTPs, MTPs. So this is very important. So out of all that discussion, two things are very important: loans and advances and credit card operations. So basically these are the internal controls which must be there in different areas. Everybody able to understand, comfortable, right? So now let us talk about the next aspect, which is relating to responsibilities of the auditor regarding compliance with CRR in this. So going forward, we will have the concepts which will be talking about auditors' responsibilities. So till now, whatever we have spoken about, those are all relating to operational aspects. We did not speak about the management. We did not speak about the auditor's responsibilities. So till now, whatever concepts we spoke about, those are all something which managements of the bank have to take care of. Now going forward, whatever aspects we are going to see, these will actually talk about auditors' responsibilities. If you are conducting audit of any bank, these are your responsibilities in different aspects that tell us about our responsibilities. Now first thing they talk about, what are the auditors' responsibilities regarding CRR, SLR. So as we all are aware, if you are doing banking business in India, you must comply with these two ratios, which is CRR, SLR. CRR stands for cash reserve ratio, which is nothing but a specified percentage prescribed by RBI, which you have to hold it either in cash or in the form of deposits with the Reserve Bank. So CRR is nothing but a percentage where a bank is required to maintain certain percentage of their demand and time liabilities. See, both CRR and SLR will be calculated as a percentage on DTL, demand and time liabilities, we call it. So a certain percentage of demand and time liabilities they have to keep, if they're required to keep it either in cash or in the form of deposits with the central bank, that we call it as CRR. On the other hand, SLR is also a certain percentage on demand and time liabilities which the bank is required to invest in some liquid assets which are in the form of gold, cash, government approved securities before providing credit to the customers. So there is a main differentiating factor between the two. CRR is something which will be there in the form of cash or deposit with RBI, whereas SLR is a percentage which will remain invested in the highly liquid assets. Now every bank has to comply. If any bank tries to violate the CRR and SLR requirements, then RBI might call for closure of the bank altogether. So that's why maintaining that CRR and SLR is very important. And regarding that CRR and SLR, whether the bank has complied with the CRR and SLR requirements on a continuous basis or not, that how we can obtain audit evidence. So let us see how we can perform, what kind of audit procedures we have to perform. First of all, how much percentage of CRR they have to maintain, how much percentage of SLR they have to maintain, and how to calculate the demand and time liabilities, all that they will explain in the master circular. RBI will release master circular. In that master circular, they will tell us the rules, instructions, how to calculate the DTL position and what should be included, what should be excluded. So all that details will be provided in the master circular. So before we can perform audit procedures, first we have to get the copy of the master circular, read it, what instructions have been given for the calculation of demand and time liabilities. So first is that we need to obtain an understanding of relevant circulars or instructions given by RBI. And see, since the CRR and SLR will be calculated at the overall bank level, so the branch auditors will send their weekly trial balance. See, the CRR and SLR will be calculated on a fortnightly basis. Once in 15 days, they will calculate, as on Friday, they will calculate. So branch auditors will send their weekly trial balance on Friday, and these branch related trial balances will be consolidated at the head office level, and based on that, DTL position for the entire bank will be determined. So now as a statutory central auditor, you should request the branch auditors to verify whether the branches are sending the correct trial balances to the head office. Why? Because if the branch related trial balance is correct, then only consolidated detailed position will be correct, then only correct CRR and SLR will be maintained. So as a statutory central auditor, you can request a branch auditor to examine that weekly trial balances. And also check out you should test check, that means on a sampling basis you have to check the consolidation process or against that branch returns whether the DTL position has been properly consolidated at the head office level or not, so that you can test check on a sampling basis. Then they have given a few items here which I would request you to go through once, just have a look once, no need to remember it. So they have given certain list of items which have to be excluded from the DTL position. As I have told, from on the DTL only you will multiply that percentage, right? Now, while calculating that demand and time liability position, what are the components which are required to be excluded? A list of items they have given, what are required to be excluded, and what are specifically required to be included in the demand and time liabilities, that list also they have given. And also exempted, what are that exempted categories of DTL on which CRR and SLR need not be multiplied. So they have even given that exempted categories of the items also on which you need not maintain that CRR SLR requirement. So three categories they have given here. So what is required to be specifically excluded from the DTL position, what is required to be specifically included, and what are the categories of the deposits which are exempted from CRR or SLR requirements. I request you to just have a look at this list of items once. Next, then after that, once you do that calculation part and all, then we need to check whether consolidation prepared by the bank include all the relevant information. So as I have told, consolidation will happen at the head office level, whether they are including all the information for the consolidation or not without leaving out anything, that we need to check. And balance in the branch adjustments accounts or foreign branches also should be taken into account. And a considerable part of information required is flowing from the branches. So you can do one thing, you can ask the consolidation of this information at the regional level and ask that at regional level consolidation should be countersigned by regional manager. This also you can do. See, at every region wise you can ask them to consolidate and ask the concerned regional manager to authorize it, to approve it. Then this regional level trial balances will be consolidated once again at the head office level. That also you can ask for. And today they are using something called automated data flow, where manual consolidation is not happening. In the core banking solution software itself, they have brought some new feature called ADF, automated data flow, where the software itself will calculate the total consolidated detailed position, and automatically CRR SLR ratios will be calculated. So today they are using that automated data flow system. You need to perform some audit procedures around that automated data flow also. Understood? So these are the points which you are required to verify regarding compliance with the CRR and SLR requirements. Now the next aspect which they speak about is how do you verify investments? Investments? No. Yeah, they talk about assets. They talk about different kind of assets. First they talk about cash, bank balances, money at call, and short notice. See, cash balance is something which will be there with the every branch, whereas a bank balances, this information might not be there at every branch. Why? Because treasury operations are only handled by the treasury branch, so there only you will find the bank balances and money at call and short notice. But in every branch you will be able to find something called cash. In every branch you will find cash. Whether you will have bank balances and money and call and short notice, whether this will be there or not, that depends on the nature of the branch you are conducting the audit. Now what should be your audit approach? You need to check existence and completeness, whether cash and bank balances are existing, have they been completely recorded. And as I have told, cash will appear in almost all the branches, whereas every branch might not have a bank balances, but that will highly depend. Why? Because all these operations are handled by treasury department, and these balances should be reconciled periodically. Now what are your audit procedures regarding cash? What you will do, the only audit procedure which we can do regarding cash is what? Physical verification. And try to do it as close as possible to the balance sheet date. And if the branch is maintaining some balance with the RBI, how can you verify? You can get the ledger balances with the bank confirmation certificate from the RBI. You can get the external confirmation, and you can prepare a reconciliation there. And review reconciliation, pay special attention to the following terms. That means if there are any differences between the two, that will be reflected in the reconciliation statement. So in that reconciliation statement, you have to pay attention to what are the cash transactions which remain unresponded, which revenue items are not at written off or adjusted, or any other credit or debit entries which are there in the statement provided by the RBI but not there recorded in the bank's books. So that you need to do the reconciliation. The same thing even for balances with other banks also. If any bank is having a balance with other branch or other bank, for that also you will prepare the reconciliation statement, and under the reconciliation statement you can have differences under multiple headings. Try to obtain evidence regarding all that differences. And money at call and short notice, this also every bank can't do, only specified branches, especially treasury branches only can do. And for doing that also they need proper authorization. So check whether if the bank has given any money at call or short notice, there is a proper authorization for that. And for that money at call and short notice, there will be various instructions or guidelines. Check the compliance with that instructions. And even you can get external confirmation in the form of certificates also, you can get it. And even you have to check subsequent payments. If you want to know whether balance sheet, as on the balance sheet date, the amount is correct or not, that you can even verify it by way of subsequent repayments also. And also whether on all these accounts interest has been properly calculated or not, we need to check it. So this is what we need to verify regarding cash, bank balances, money at call and short notice. Then how do you verify investments? So here also if you see the audit procedure, what audit procedure you will verify regarding investments. Here we check internal control system and investment policy. So every bank will have an investment policy where they can make investment, how much portfolio allocation they will do. For government bonds, how much allocation they will do. For mutual funds, how much allocation they will do. So like that, every company will have one investment policy. So that investment policy you have to understand. Not just that, they will also have various internal controls surrounding the area of investments. So try to verify that internal controls, try to understand that investment policy. And also separation of investment functions, basically segregation of duties. The person whoever is doing the investment, the same person should not be given access to the records of the investments. Reconciliations, here also if the balances are not matching, if the investment balances and all are not matching, here also you need to prepare reconciliation statements also you have to prepare. Then all related documents relating to investments you have to verify, like whether all investments are made within its authority, within its power. Any covenants or conditions which restrict, qualify or update the right of ownership have been complied with. Sometimes when they make the investments, they come with some conditions. Whether they have complied with that conditions or not, we need to check. And acquisition or disposal, that you can verify with the contract note. Broker will give you a contract note. With the contract note you can cross verify. And even you can do physical verification. Basically that investment scripts and all will be there, right? If you invested in mutual funds, that the mutual fund statement will be there. If you invested in FDs, fixed deposit certificate they will do. If you do investments in bonds, they will give the government bond, physical copy of the bond you will get. So try to verify all that investments wherever possible. Physical verification you have to. So verify the investment scripts. If it is a government related investments, you can get the investments with the public office, public debt office of RBI. From them you can get it. You can get the balance confirmation. If you are getting the external confirmation, try to comply with the requirements of say 505 also. And more attention you have to pay for the bank receipts. In our regular class, we have understood this bank receipts in a very excellent manner with the help of even practical scenarios. We discussed about the Harshad Mehta scam and all. So their bank receipts are there. So that bank receipts are very, very important. You need to cross verify the bank receipts, get the confirmation from the other banks. If any bank receipts remain outstanding for a very long period of time, so you need to ask them why that bank receipts has not yet been settled yet. And generally, whatever investments which are held by the bank, they will be broadly divided into three categories: held to maturity, held for sale, and available for sale. So like that, in three categories, they will try to classify the investments. We need to check the proper classification. And if they are shifting something, they are shifting from available for sale to held to maturity. Initially, they told that they are holding these investments for the purpose of sale, but later they have classified it to HTM, held till maturity. So now I need to understand the reason why they have done that shifting. Is it valid or not? Then you need to check valuation. So whether all these investments are properly valued or not. Once again, the valuation will depend on the classification. Held to maturity will be valued in a different manner. Held for trading will be valued in a different manner. And available for sale will be valued in a different manner. So we need to check that they are classified into proper categories, and according to the classification, valuation has been done or not. And in case if the investments are classified as non-performing investments, then also we need to maintain proper valuation for that. And income from investment should have been properly accounted for. Dividend income, interest income should have been properly accounted for. And any method of valuation, if any valuation method has been changed when compared from the last year to the current year, give a proper disclosure. And if the investments are sold, profit or loss arising from the sale of investments has been properly accounted for. And the TDS on the investment income, on the dividends, on the interest, also sometimes the TDS will be deducted. Check that whether that TDS has been properly declared in the income tax return. If any excess is there, that has been got as a refund or not. So we need to check that. And sometimes the banks will do the investments on their own, and on behalf of their clients also they will do the investments, which we call them as portfolio management services, PMS we call it. So in case if the client is dealing in securities on behalf of others, there should be prior approval, and income from that should be recorded properly, and any undisclosed liability, if any is there, that also has to be communicated. And a special purpose certificate relating to investments. So this is once again for in case if you are holding the investments on behalf of others, you need to maintain one separate account. If the bank is doing investments for their own purposes and also they are doing the investments on behalf of their clients, both they cannot do it in a single account. They have to divide it. And as per RBI guidelines, banks are required to get their investments under PMS separately audited. Nothing but portfolio management services. Under that, if any investments are done, that has to be audited separately. And then finally, some reporting requirements they are asking you. Auditor must take half yearly review. So when it comes to investments, every half year they have to do the review. It should not only cover operational aspects, even they have to verify whether amendments have been made to investment policies and all. And even they can do concurrent audits of the treasury operations, and they need not forward every report to the internal audit, every report to the RBI. Only whatever major discrepancies are there, that if you report to the RBI, that will be enough. Next, then comes the most important activity which will be done by the bank, giving of advances. In the area of advances, what and all you will try to verify. First, we can divide the advances into different categories on the basis of nature of advances, like short-term loans, long-term loans, like that we can divide. And nature and extent of security, secured, unsecured, and place of making advances, whether local advances or foreign advances. So like this, on different basis, we can divide the advances. Now, what is your approach? What mainly you will try to obtain audit evidence? If you are conducting this aspect is many a times attested. So in case if you are conducting audit of advances, what are the major items? What are the primary items regarding which you will try to obtain evidence? So if I am conducting audit of advances of a bank, I am primarily concerned regarding obtaining evidence of the following matters. What are they? Whether amounts included in the balance sheet, are they really outstanding as on the balance sheet date? Nothing but existence. And advances represents amount due to the bank. Whatever advances that have been reflected, they are only showing those amounts which are due to the bank. And they are supported by proper loan documents. Every loan should have an appropriate loan document. And there are no unrecorded advances. Completeness assertion. I need to obtain evidence. And stated basis of valuation is appropriate. They have been done valued properly or not, nothing but valuation assertion. And they are classified, described in accordance with recognized accounting policies, right? Classification: secured, unsecured, long term, short term, NPA, non NPA, standard, substandard, that. An appropriate provision has been made properly. So proper provisions has been made or not. So if I am conducting audit of advances of the bank, these are the main items regarding which I will try to obtain evidence. Now, what audit procedures you will verify? So what are the suggested audit procedures? When it comes to internal control, first I need to check in the area of advances whether internal controls are working effectively or not. Sir, what kind of controls I will verify? This we have already seen. Previously, if you remember, I have told you what kind of internal controls should be there in the area of loans and advances, right? So whether those internal controls are there or not, that only we will verify. So this I am not once again going through. Why? Because what kind of internal controls should be there in the area of loans and advances, that we have already covered is a concept in the previous discussion. So whatever internal controls are there, whether they are actually there or not, that we will verify. So basically you will first try to evaluate the internal controls. So once you have done that, once you are done with the compliance procedures, now you perform substantive audit procedures. So what you will do there? So you will verify the correctness of master data of the loan accounts. So there will be one master database of all the customers. You will try to get the copy of that master data. And every customer account should be tagged under single customer ID. You might have multiple loans, but all that loans should be tagged to one single customer ID. Customer ID only one will be there. Under that one single customer ID, you can tag multiple loans. And you need to check whether proper classification has been done for SMA1 and SMA2 advances. See, what is this SMA1? See, we all know NPA, right? So before generally an account will be classified as NPA if it remains overdue for more than 90 days. So then it will become NPA, right? But before an account becomes NPA, there will be one more classification: SMA1, SMA0, SMA1 and SMA2. That means which are not at overdue for more than 90 days, which are overdue for less than 90 days only. Like if I have to give you one scenario, let me give you one, let me give you a scenario on what basis we will do the SMA0, SMA1 and SMA2. So, so in SMA also we have three classifications. So we have SMA0, just a minute. Yeah, SMA0 refers to those accounts where the account has remained overdue, but if it remains overdue within 30 days, then it will be classified as SMA0. If it remains overdue for 30 to 60, it will be classified as SMA1. If it remains overdue for 60 to 90, it will classify as SMA2. If it remains overdue for more than 90 days, then it will become an NPA. So like that, even we need to identify when we are performing, when we are verifying the advances, we need to pay more attention to SMA1 and SMA2 advances. Why? Because they have a more chances of falling into NPA category. And even we need to go through the concurrent auditors report, internal inspection reports, RBI reports, to see whether in any of the reports they have given any negative comment regarding the advances. And if there are any restructured advances, we need to get the list of all that restructured advances. And if there is any quick or early morality, sir, what do you mean by that? If an advance is turning into NPA within 12 months of its sanction, have sanctioned the loan. So within 12 months of sanctioning the loan only, that has been classified into NPA, there might be wrong credit worthiness and all. Checking credit worthiness is might not be getting checked properly. So you need to pay more attention where there is a quick or early mortality. And also completeness and accuracy of interest, whether on all that loans and advances interest has been properly provided, and even you try to perform analytical procedures. Then periodical statements submitted by the borrowers, especially in case of cash credit loans and all, or short-term loans, you need to borrowers will send quarterly stock statements that you need to verify, and you need to get the copy of latest financial statements, and inspection of security, that reports also we have to get, and even auditors report in case of borrowers having credit facilities from the bank. So even you have to get their auditors reports also. So these are the few audit procedures which I will try to perform regarding the advances. Then they say about what procedures you will try to verify regarding asset classification, income recognition and provisioning. So guys, here more than audit procedures, instead of learning how to do the audit of asset classification, income recognition and provision for NPA, these days they are asking the questions on MCQs on provisioning requirements. They're asking the questions on provisioning. From CA Inter, they're asking the questions. So let me give you a brief here. Let me just take you through the provisioning requirements as per the RBI. So that we will have a look. Why? Because this content is not given at the CA final material, but they're asking the questions from the CA Inter level. Provisioning norms they're asking. So just we will have a look once. Yeah. See here. So first of all, when an account, this we will understand, audit procedures are simple. Whether this has been followed or not, those are only our audit procedures. So the most important thing is when asset will be classified as NPA, when what are the different categories of the assets, for each category of asset, how much provisioning. So these questions are getting tested a lot. We will focus. See, this content will not be there in your CA final material. This is the extract I am showing it from the CA inter material. This you will not find it at the CA final. First of all, when you will classify an account as NPA, so they say that an asset will become NPA when it ceases to generate the income. But the condition they have given is if an interest or installment remains overdue for a period of more than 90 days, then it will be classified as NPA if it is a term loan. If it is a cash credit or overdraft facility, if it remains out of order for more than 90 days, then it will be classified as NPA. Then you will get a doubt, sir, when a cash credit or overdraft facility will be classified as out of order. So see here, when a cash credit loan or overdraft loan will be classified as out of order. See, if it remains out of order for more than 90 days, sorry, the account remains out of order, not for more than 90 days. If the account remains out of order, then it will be classified as NPA. Sorry guys, I was in a hurry. Yeah. See, if it is a term loan, if the interest or installment remains overdue for more than 90 days, it will be classified as NPA. If it is a cash credit loan or overdraft loan, if it remains out of order, then it will be classified as NPA. Now you will get a doubt, sir, when it will become out of order. Like if you see here, if an outstanding balance remains continuously in excess of sanction limit or drawing bar. So for working capital loans, there will be sanction limit or drawing power. If the account's usage balance remains in excess of sanction limit or drawing power on a continuous basis, then your account will become out of order. Or the outstanding balance is within the sanction limit or drawing power only, but there are no credits continuously for 90 days. Sometimes in the OD account, the amount utilized will always be within the sanction limit and drawing power, but that there are no credits for continuously for 90 days, then also it will become out of order, then it will go to NPA category. And they say one more thing here, credits are there. Account is used within the limits. There are some credits also, but whatever credits are there, they are not even enough to cover the interest. Credits are there, but they are not even enough to cover the interest for a period of 90 days, then also it will be classified as out of order. So this classification is very important. And once you have classified the assets, then depending on that, you have to create the provisions. You have to create the provisions. Sir, how much provision for which category of asset? And one more thing also should be there. Just give me 1 minute. There should be asset classification. Asset classification will be more or less similar to the thing whatever we have seen in the NBFC. Right. See here. Sir, what is a substandard? See, standard is something which is good. No overdue, nothing. Standard is something which is everything is in good format. Sir, substandard. When an asset will become substandard, it will be one which has remained NPA for a period less than or equal to 12 months. So up to 12 months of NPA, it will remain in the substandard category. For that, we need to create 15% of the provision. When it will turn into doubtful, would be one which has remained in the substandard category for a period of 12 months. Up to 12 months, it will remain in the substandard. After 12 months, it will go to doubtful. Sir, once it has gone to doubtful, how much is the provision? If it is unsecured, if it is totally unsecured, 100% provision you have to create. For unsecured, you have to create 100% provision. If it is a secured component, if it is up to 1 year, 25% doubtful. If it is remained in doubtful category 1 to 3 years, for secured component 40%. If it remained overdue for more than 3 years, it will remain 100%. For unsecured component, always 100%. For secured component, depending on the duration for which it is remaining in the doubtful category, the percentage of provision will change. Then loss asset, always 100% of the provision should be created for. Clear? And one more most important thing you have to remember here, the NPA classification should be borrower wise, not facility wise. NPA classification should be what? Borrower wise. Like for example, there is one customer, he has taken 4 loans. Say for example, he has taken housing loan, he has taken personal loan, vehicle loan, credit card is there. See, on the housing loan, it remained overdue for more than 90 days. On personal loan and vehicle loan and credit card, he is making all the payments on due date, but only in respect of housing loan, it remained overdue for more than 90 days. If that is the case, not just housing loan, all loans will be classified as NPA. All loans will be classified as NPA. That is what the meaning here. The asset classification should be borrower wise, not facility wise. Even if one loan has been classified as NPA, the entire borrower, all the loans in the name of that borrower will be classified as NPA. Understood? So this you remember. Once you remember this audit procedures are nothing but just checking the compliance and all. Then The next most important thing here from here is this one, sale or purchase of the NPS. This aspect is very important. So now what banks have, or what RBI has given the flexibility is, if you are a bank, if you are having an NPA, that NPS you can sell it. That NPS you can sell it. But there are some conditions which have been given here. This aspect is also getting tested multiple times. So let us try to focus here. What is the procedure? What are the conditions in the area of sale or purchase of NPS? So a few important things I have to say here. So first thing, only such NPS should be sold which remained in the NPA category in the banks for at least 2 years. If an account has remained NPA in your bank account for a duration of 2 years, minimum duration 2 years, that has to remain in your books as NPA, then only you can sell it as, then only you can sell it. Condition number 1, only such NPS which have remained NPA for at least 2 years, they only can be sold. And these NPA should be sold without recourse. That means entire consideration you have to receive well in advance. Conditional consideration should not be there. And once you have sold NPS, all the risk and reward will get transferred. You should not carry any risk there. So without any recourse, you have to sell it. And once you have sold the NPA, the bank will not assume any legal, operational or any other kind of risk with regard to that sold NPAs. And NPA should be sold only on cash basis. As I have told, entire consideration you have to receive upfront. And one more important thing here, the bank has not purchased an NPA which has originally sold. Say for example, Axis Bank is there. It has sold one of its NPA. It has sold one of its NPA to ICICI Bank. Now from the ICICI Bank, once again, they can purchase the same NPA. Can the Axis Bank once again purchase the same from ICICI? No. So whatever has been sold once by the bank, that can't be purchased again by the same bank. Next. What about the accounting treatment? Say for example, if NPA has been sold, if the selling price is less than the book value, say for example, NPA value in the books is 100 crores, but you are able to sell it only for 80 crore rupees. 20 crores of loss is there, no? So what should happen to that loss? That loss should be debited to the P&L account. Sir, what if there is a gain? Say for example, book value is 100, but I was able to sell it at 120. Sir, what about this 20? Can I reverse my previously recognized provision? Can I recognize it as income? No. Why? Because if you have made any surplus from the sale of NPA, that surplus should be used for knocking off the loss on other sale of NPAs. You can't reverse the provisions. You have to use that excess surplus amount for adjusting the losses on sale of other NPAs. So that's what they say here. If the value is higher, excess provision shall not be reversed, but that excess amount will be utilized to compensate for the loss from the sale of other NPAs. So, okay, sir, I'm a bank. I have purchased an NPA for 80 crore rupees. Now I will make a recovery out of that. Sir, how I have to adjust for that recovery? So they say that if you have started recovering from the NPA you have purchased, initial amount will go to offset my acquisition cost. After that, if I collect anything extra, that only will go to my income. Say for example, I purchased NPA for 80 crore rupees. Till the time I recover 80 crore rupees, it will go and adjust my acquisition cost. Beyond that 80 crores, any excess amount I have recovered, that I can recognize it as income. So that is what they say here. Recovery in respect of NPA purchase is first adjusted against the acquisition cost. After that, whatever is there, that will be classified as profit. Understood? Right. Next. Then the next aspect which you will verify is fixed assets. So banks also will have fixed assets here. So mainly we can divide them into two categories. One is a premises and the other one is others. Sir, what will come in the premises? In the premises, what will come is those assets, those immovable properties which are either taken on lease or owned by the entity. So basically, which are basically owned by the entity. Like if you see here, premises wholly or partly owned by the banking company for the purpose of business, including residential premises used by the banks of bank as shown under premises. That means whatever immovable properties are there which are getting used by the bank for the purpose of carrying out their business, or if they are using it for the purpose of residential purposes of their employees, like SBI, if you take SBI, quarters will be there, no? That is also getting used for the business only. Either the bank is holding an immovable property where they are running their branch operations, or the bank is holding one immovable property which is getting used as a residence for the employees. Those only will come under premises heading. Say for example, I am a bank. Okay, I have given one loan to the customer. Again, as a security of some immovable property. If that customer did not pay the loan, this property will get transferred in the name of the bank. There is one customer. This customer is having one house. That house he has given as security, took 1 crore rupees of loan. Customer is not paying. Now what will happen? This house will get transferred in the name of the bank. Now this house which has been transferred as a settlement, it is not getting used for banking business. It is also not getting used for the purpose of residence of the bank employees. Now this property will not go to the premises heading, it will go to others heading. It will go to others heading. And also there is one more rule here. RBI says that if you have acquired any property as a settlement, acquired any mobile property as a settlement, and if you are not using it for your business purposes, you have to dispose it within a duration of 7 years. Within 7 years you have to sell it. You can't keep it like that. Why? Because as a bank your business is to give loans, not to hold immobile properties, right? So if you have got any loan, any asset as a settlement of the loan, if you are using it for your business purposes, well and good, fine. If you are not using it, you have to dispose it within a duration of 7 years. You have to dispose it off. And for that 7 years also, it will not go to premises category. It will remain in the others category only. So broadly two categories, premises and other fixed assets. So I have told you what will go to premises, what will go to other fixed assets. Next, so few more important points from here. Suggested audit procedures, yeah. So first we need to verify internal controls. So what kind of controls we need to verify regarding fixed assets? Number one, there should be proper control over expenditure. Any expenditure which is getting incurred on fixed assets, either acquired or self-constructed, we need to have proper control. Accountability, that asset should be in the proper possession of some responsible officer. And information controls for ensuring reliable information about fixed assets. How many fixed assets are there, where they are located, proper records they need to maintain. And ascertain whether accounts and respect are maintained at the branch office or at central. Generally fixed asset records will be maintained by the head office. You have to verify where the records are getting maintained. And location of documents of title, where the ownership documents are maintained, whether at head office or local offices. And also whether any acquisition, disposal, everything have been properly communicated to the head office. If at all any acquisition, sale is taken by the branch, taken care by the branch, whether it is intimated to the head office or not, that also we need to pay attention. So regarding premises, especially when it comes to premises, what and all you will verify? We will verify opening balance has been carried forward correctly. If any new premises are acquired, check whether there is proper authorization approval mechanism. And if any self-constructed assets are there, you can cross-verify with the contractor's bill, work records, etc. And even you have to reconcile them with the ledger balances. And leasehold premises, capitalization, amortization of the lease premium, especially finance lease accounting treatment has been done properly or not. And if title deeds are held at head office or other location, so you can communicate you can tell the statutory central auditor to verify them. If you are a branch auditor, your branch is holding some immobile property, but title documents are there with the head office, you can intimate to the statutory central auditor, he will do the verification for you. So if for premises under construction, you can use a separate heading, premises under construction, and whatever advances you have made, whatever advances or payments that you have given to contractors for the purpose of construction of the fixed assets, they should also go under the heading fixed assets. If any revaluation has been done, you need to understand what is the basis for that revaluation, and also whether any surplus or deficit has been given proper treatment as per accounting standard. And no immobile properties other than those required for use of bank have been included in fixed assets. This I have already given you example. Only those immobile properties which are getting used for business or getting used for residence of the employees should be included in premises. All other assets should go to other fixed assets. Then, so what are procedures which you will perform regarding other fixed assets? Same, whatever we have done for previous, all that will equally apply to other fixed assets also. And in respect of mobile fixed assets, if the assets are getting moved from one place to another place, there is a proper record maintained for tracking that movements or not, that we need to check. If any discrepancies are there, whether they have been properly dealt with in the books of accounts. If any transfer of asset has taken place, one asset has been moved from one branch to another branch, even its accumulated depreciation also should have been transferred. And if there are any intangible assets, check the requirements of the compliance with AS 26. And fixed assets have been properly classified, proper classification has been done or not. And whether expenditure incurred on fixed assets has been brought to its working condition. So all the expenditure which has been incurred till the time it has been brought to the stage of intended use, everything should be capitalized. And at the head office level, examine if the proper consolidation of all the fixed assets is taking place or not. Next, if any assets are sold, check that sale deed, receipt of sale value, and profit or loss has been properly accounted for. If any leased activity is there, try to check the lease agreement and check the compliance with the AS 19. And if any impairment has taken place, try to check the compliance with the AS 28 also. So this is what regarding the verification of fixed assets. Fixed assets basically includes premises and other fixed assets. So now going forward with the further discussion. So once we are done with the verification of fixed assets, now we have some other assets. So we have a broader category where they say all other assets which doesn't fall under specified categories. So that all other assets, they have given one heading and they are giving us few steps which are required to be verified, which are required to be taken into mind when auditor is verifying that other assets. See, here I will not talk about all the things. All these things are very repeated things like intra-office adjustment, interest accrued, all this is fine. Few things I will talk about it here. Like if you see stationery and stamps. Now you all will get a doubt, sir, how come stationery and stamps will be a asset? You generally will feel that, sir, whenever stationery expenses are incurred, that will be charged to the statement of P&L, no? So stationery and stamps is something which should be going for expenses. Why you are saying it as assets? Now here, when I say stationery and stamps as an asset, which kind of stationery and stamp they are talking is, see, generally they will purchase something called a bulk stationery. Head office will purchase in large quantities. Like if I give you one example, so it includes exceptional items like bulk purchase of security paper. Like for example, SBI is there. Now SBI is having all over India various branches. For all the branches, they need one stationery called security paper. Now they will not buy as and when required. So they purchase some very bulk quantity. Say for example, some 5 crores amount of security paper they have purchased. So now it will not be consumed immediately. It will be generally kept at the head office, and wherever required, they will start distributing it. Now this kind of stationery will be considered as assets, not regular stationery expenses. This kind of security paper which has been purchased in bulk quantities, generally kept at the head office, that will be recognized as an asset, and as and when it is issued for consumption, then it will be charged to the statement of the P&L account. Able to understand? So that is what the stationery they are talking about it here. So when I say stationery and stamps as a other asset, I am referring to only exceptional items like bulk purchase of security paper. And if normal expenditure is there, normal expenditure of stationery, it will be charged to the statement of P&L account. It will not be recognized as an asset. So exceptional items we will treat it as asset. Normal items we will charge it to the statement of the P&L account. And this item will generally not appear at the branch level. As I've already mentioned, this is something which you will see it at the head office level, not at the branch level. And when it comes to this kind of stationery and stamps, which is included in other assets, we need to verify existence, effectiveness, continuity of internal controls over these items. And wherever suitable, you need to physically verify this stock also. And as I have told, whenever this stationery and stamps are getting consumed, then it will be charged to the statement of the P&L account. Clear? Next. See, this point I have already covered. Non-banking assets which are acquired in satisfaction of claim, like bank will give a loan, but if they are unable to recover it, as a satisfaction of the claim, they will get that property registered in their name. And one important point I have already told you here, that rule within 7 years you have to dispose it off. So that rule somewhere they will try to specify it here, right? Yeah. So one important point here, this one. Ensure that as whenever that asset has been acquired as a satisfaction of the claim, at the date of acquisition, that asset should be recorded at lower of net book value or net realizable value of the asset. Why? Because it will not go to the fixed assets, it will go to other assets, right? Why? Because and even bank will have a condition that these kind of assets are required to be settled within 7 years from the date of that acquisition. So that's why, as on the date of acquisition, how you will value that assets is you will calculate what is its net book value, and also you will calculate what is its net realizable value. Whichever is lower, at that value we will try to include it in the bank's books. Then apart from that, yeah, so these are the two major items from other assets which have a high chance of getting tested in the examination, from where questions are going to come from. Now we will proceed with the next item, which is capital, verification of capital. Guys, regarding capital discussion, we had significant chunk of discussion in our NBFC. Here also they will say in order to strengthen the balance sheets of the banks and all, they specify some minimum capital ratios which contain tier 1 capital, tier 2 capital. Tier 1 capital is a high quality capital, tier 2 quality is a comparatively less quality of the capital. So like that, all the things will remain same like NBFC audit. So only one thing extra, only one thing which you have to remember is, here RBI has given, in the case of NBFCs, they have given different percentages of CRAR, right? But here, if you see, in the case of banks are required to maintain a minimum CRAR of 9% on an ongoing basis. So there they have told different ratios in the case of NBFCs. In the case of banks, the RBI's requirement is minimum 9% CRAR they have to maintain. And while calculating that ratio, you have to consider tier 1 capital, tier 2 capital. Tier 1 capital is the highest quality capital, tier 2 capital is comparatively less in quality. And how do you verify the capital and all as per RBI rules and regulations? So all the provisions are going to remain the same. So all the verification steps are going to remain the same. Only the percentage of maintenance of CRAR is going to change here. Then also banks also will have reserves and surpluses, and those reserves and surpluses also they have to fulfill some disclosure requirements for every kind of reserve, They need to include some disclosures. Broadly, we can divide the reserves into various categories, like some are statutory reserves, some banks are required to maintain certain percentage of their profits in specified reserves, and capital reserves, share premium, revenue and other reserves, and even the balance in the P&L account. And one requirement of the RBI in respect of statutory reserves, capital reserves, and securities premium, talking about these three things. For these three reserves, they have to show what is the opening balance, what is the addition or deletion during the year, and what is the closing balance. That disclosure they have to compulsorily give for these three kinds of reserves. Which reserves? Statutory reserves, capital reserves, and share premium. And while verifying these reserves and surpluses, what will be your audit approach? First, we will verify whether last year opening balance has been carried forward. If there is any addition or deletion, we will check, we'll cross verify with the board resolution. In respect of reserves and share premium, especially share premium, you can't use it for whatever purposes we want. We have section 52, which is giving guidelines for which purpose we can use it. So we have to check the compliance with section number 52. And as I've told, some banks are required to maintain certain percentage of profits to a reserve fund. Check whether that requirement applies for your client bank. If yes, whether they have transferred that certain percentage to that reserves or not. And if the bank has been granted exemption, if certain bank has been granted exemption, okay, you are not required to transfer that percentage to reserve fund. Check whether that conditions are complied with or not. And as usual, from share premium, if any amount has been utilized, we need to check for what purpose it has been utilized. In case if you are having foreign branches, according to the foreign laws, you need to maintain some extra reserves. Check the compliance with the foreign laws and regulations as well. Then deposits. Here comes the most important part. Here also, when you are verifying current and savings account, as we all are aware, banks will accept deposits. We can broadly divide the deposit into multiple categories. One is savings deposit. Banks will accept from the customers. Then they will accept current deposits, and also they have something called fixed deposits. They also have something called recurring deposits. And the most common kind of deposit which will be there with the bank is savings deposit and current deposits. Savings deposits are something which are for personal purposes. Current accounts are maintained for something for business purposes. On savings account, you will be entitled for interest. Generally, on current accounts, interest will not be paid. But in today's environment, some private banks are paying a minimal rate of interest, but majority of the banks will not pay any interest on the current accounts. But on savings bank, you will be entitled to receive the interest. So many a times I have asked the question, what are the audit procedures? How you will verify the current and savings accounts? This has been tested multiple times. We will see the audit procedures in this area quickly. Then, so you have to take a sample from the current and savings accounts. You have to take a sample. You have to check the KYC norms. So today, if you want to go and open the bank account, you have to get your KYC done, your Aadhaar card, PAN card, all that KYC things they will do. No, so whether that KYC norms banks are following or not before opening an account for the customer, that we need to check. And as I have told, current accounts are not for business purposes, whereas savings accounts are not for business purposes. Business transactions can be conducted through current accounts. And in individual accounts, you have to verify the balances, that too on a sampling basis. And interest calculation has been properly done or not, especially on the savings accounts, interest has been properly calculated and posted to the accounts or not, that we need to check. Even you can get confirmation on a sampling basis, you can get the balance confirmation. And debit balances in the current accounts should not be netted on with the liabilities. They have to be shown separately. If there are any inoperative accounts, that for that account you have to pay very much attention. Why? Because if an account remains inoperative for a very longer period of time, bank can use them as a channels for committing the fraud and money laundering. Sir, when an account will be treated as inactive account or inoperative account or dormant account, if an account remains, if there are no transactions for over a period of 2 years, for 2 years, if there are no transactions in the bank account, that will be classified as inoperative or dormant. Next, so on a sampling basis, inoperative accounts revived. If any inoperative accounts are once again taken back to normal, or if any account has been closed from that inoperative accounts, from that you have to take a sample and verify it. If inoperative accounts are revived, that means from inoperative it has been made operative, then we need to check whether that has been done with only proper authority or not. Then when it comes to term deposits, so on term deposits, generally the customer will be entitled for a higher interest than when compared to the saving deposit. So generally, whenever the customer comes and purchases a deposit, fixed deposit certificate will be given to them. So check whether that certificate has been provided or not. In case of bulk deposits, sir, what do you mean by bulk deposits? When the deposit is more than or equal to 2 crore rupees, then we need to check correct rate of interest has been offered or not. Why? Because higher the amount, higher will be the interest rate. Then if term deposit has been closed, there will be something called foreclosure penalty. Say for example, FD has been taken for 10 years, but within 5 years only customer want to cancel the FD. Yes, you can cancel, but from your interest some component will be deducted. That we call it as foreclosure penalty. We have to check that. And even recurring deposits also more or less the same kind of fixed deposits. What is the main difference here is fixed deposit, once you will invest, recurring deposit on a recurring basis you are going to invest the money. Next, correctness of rate of interest we have to verify. Then they talk about deposits designated in foreign currencies. Sometimes Indian banks can have even deposits in the foreign currencies also. They talk about two accounts here, NRE accounts and NRO accounts. See here, NRE accounts and NRO accounts. So non-resident, where are the full forms here? See, I will tell you what is the difference between the two. Difference between NRE accounts and NRO accounts. So somewhere we have included here. See, in case of NRE accounts, see, it is generally non-resident NRE accounts will be opened for NRIs who are outside of India. Okay, NROs can be opened by anybody. The difference between the two is, in case of NRE accounts, there will not be restriction. Repatriation restrictions will not be there. Money can easily come in and go out of the NRE account. But when it comes to NRO account, there will be repatriation restrictions. In NRE accounts, since these are the accounts held by NRIs, so there will be no restriction on repatriation. You can bring the money, you can take the money out. But in case of NRO accounts, which are not NRI related accounts, so there will be repatriation restrictions will be there. So yeah, here itself it is there. NRE accounts are repatriable, whereas NRO accounts are not repatriable. Next, what else? So this is what regarding major things regarding deposits. Now talking about borrowings, sir, will banks also get the borrowings? Yes. From where they will get the borrowing? Mainly they will get the borrowing from RBI, if not from other banks or financial institutions. And they might get the borrowings within India, and even they might get the borrowings from outside of India. And they might get secured borrowings, or even they might get unsecured borrowings. So we need to obtain evidence regarding that borrowings also. So what audit procedures I have to perform? Number one, you can get the external confirmations from the borrower. You can ask the external confirmation certificate as per SA 505. That's what they say. You can comply with SA 505 requirements. And rediscounting, refinancing, you have to pay more attention. See, refinancing is a liability, rediscounting is a off balance sheet item. So I can't go into the details to make you understand here. So one difference here between rediscounting and refinancing, you have to be very careful. Why? Because refinancing is something a liability, whereas a rediscounting, it is not a liability, it is a off balance sheet item. So this much you remember. And especially if they have borrowed money at call and short notice, they can do it only with proper authorization. It is not a general transaction. So that's why if you find in the bank's balance sheet, they have borrowed some money which is repayable on demand, check whether they have got that borrowing only after concerned person's authority. And even you have to cross verify that transactions have been approved by head office. And even the amount shown in the branches is also properly classified on the basis of security or otherwise. And apart from that, there could be other liabilities also. There could be provisions also. So here mainly I will talk about the provisions. So mainly provisions are nothing but see, for as per the asset category, we will have the provisions. Just I have told you, for standard asset there will be provision, for substandard also there will be provision, for doubtful also there will be provision, for loss also there will be provision. So these and all provisions will be there. This we call it as prudential norms. In addition to that, there might also be provisions for expenses, provision for bad debts and also like that. Other provisions also would be there. And so when I say other liabilities here, broadly they speak about various things like bills payable, nothing but whatever bills payable. When I say, it is a broader term, it includes checks, drafts, traveler checks. So all that will get included here. So that will be one major liability. Next, inter-office adjustments will be there. Interest accrued, interest which they have to pay to their deposit holders, and also others including the provisions. So these things also we have to verify. Then we have contingent liabilities. Like the way for every organization, contingent liability will be there. Even in banks also there will be various kinds of contingent liabilities, and those contingent liabilities in the banks, we can broadly divide them into 6 categories. The 6 categories of contingent liabilities you have to remember. So what are the 6 categories of contingent liabilities? Claims against the bank which are not yet acknowledged as debts. Liability for partly paid investments. Sometimes you might have paid the shares partly. Bank has invested money in the company, they have paid only part of the amount. One call is still pending. Then you might be called upon to pay that amount whenever that call has been raised. And similarly, liability on account of forward exchange contracts and derivative contracts, nothing but on options, futures, right, swaps, forward contracts. On all this also there might be outstanding liabilities. Not outstanding liability actually, whether it will result in an outflow or not, that we can't decide. So that's why it will go to the contingent liability. And banks also will act as a guarantor, like in the case of letters of credit, bank guarantees, they will act as a guarantor. That will also form part of contingent liability. And acceptances, endorsements of other obligations, and any other item for which the bank is contingently liable. So like this, in the case of banks, contingent liabilities, we can broadly divide them into 6 categories. So repeat everyone, what are that 6 categories of the contingent liabilities? Claims which are acknowledged by bank, claims against a bank which are not currently acknowledged as debts, liabilities for partly paid investments, liabilities on account of derivative contracts, guarantees given on behalf of the constituents, acceptance, endorsements, and other obligations and other items in which the bank is contingently liable. So all this we need to verify. So most of the things it will be general points only. You will try to find it, like any law legal opinions you have to get. You have to consult with the external lawyers. You have to go through the legal documents, confirmation, comfort letters. So like there's some common points I will try to say in every subheading. You can have a look at it once. Next comes the most important part now, reporting requirements. Sir, what will be the reporting requirements of the auditor? As I have told, then when compared with other commercial organization, in the case of banks, the auditors are going to have so many reporting requirements. So what and all are the reporting requirements? First of all, if you are an auditor of a nationalized bank, or if you are an auditor of SBI and nationalized bank auditors, in addition to their normal audit report, they are required to submit one report to the central government. Not every bank auditor, guys, only auditors of nationalized banks and SBI, they are required to submit an extra report to the central government. And in that report, what they will mention, whether in their opinion balance sheet is full and fair, containing all the particulars. Basically, whether balance sheet is giving a true and fair view, and also whether auditor has called for any explanation. As an auditor, did you need any information explanation, and have you got it? And whether transactions of the bank are within the powers of the bank or beyond the powers of the bank. Whether or not returns from the branches has been received or not. Did the branches send you the required returns or not? And whether P&L account gives a true and fair view or any other matter which he considers necessary. So these are all the matters on which the auditors of nationalized bank and SBI are required to submit the report to the central government. And normal audit report also will be there. Sir, how do I prepare the normal audit report? You have to comply with the standards on audit like SA 700, 705, 706, 710, 720. So all this, whatever we follow in the case of normal audit report, all that standards are required to be followed here also. And in case if you are mentioning any unaudited branches, this point we have already covered in other matter paragraph. So here also what you say is, if you are a statutory central auditor and if there are some unaudited branches in the entire bank, so that you have to mention in the other matter paragraph, you have to mention how many number of such branches were unaudited. Say for example, 100 branches are unaudited. Just mentioning the branch number alone will not be enough. Even you have to quantify what is the advance and deposit, interest income and interest expense for such unaudited branches. So for these 100 branches which are unaudited, what is the total interest income? What is the total interest expense? What is the total deposits? What is the total advances? So that cumulative figures, that quantification also you have to do it. Generally we do it in the other matter paragraph. And in addition to that, you are required to comply with all the requirements of section 143 reporting requirements, like 143 subsection 1, subsection 3, but 143 subsection 11 is not required. CARO is exempted for a banking company. In addition to that, you are also required to submit something called LFAR, long form audit report. Both branch auditors as well as statutory auditors are required to do it. And what is the time limit within which it is required to be given? So this LFAR is required to be submitted to RBI within 60 days of submission of LFAR by the statutory auditor. Generally, statutory auditor will submit the report to this LFAR to the management. Management will submit that LFAR to the RBI within 60 days of submission by the auditors. Next. In addition to that, you are also required to fulfill some other reporting requirements, like especially there was a RBI circular which says that if you are a chartered accountant, if you are a professional, either as a part of your internal audit or external audit or any other professional work, if you came to know about any fraud, you are required to report the matter to the RBI. If you fail to do it, you will be liable for action. So as per this circular, if you find out any fraud, then you are required to report even to RBI. In addition to that, you need to comply with requirements of SA 250, checking the compliances with the laws and regulations, SA 240, reporting of the fraud and all. And even if the amount involved in the fraud is 1 crore or more, reporting to the central government also will be applicable. As per 140 subsection 12, that fraud reporting requirements also will become applicable. Next. Apart from this, the statutory central auditors are also required to give a lengthy list of reports, as you could see here. These are not just the reporting requirements. You will give a normal report, LFAR you will give, and if you are a nationalized bank auditor, you will give a report to central government. In addition to all that, there is a very lengthy list of reports which are required to give in the case of Audit of Banks. So that list has been given here. You can have a look at it. Okay. So even if I explain it also, that will be just like reading. So just list of reports which are required to be given by auditors of statutory central auditors, not branch guys. Statutory central auditors are required to share all this information. Then apart from that, we have one more concept called concurrent audit of the banks. So in banks, now one more concept has come. See, regularly after the end of the financial year, statutory audit will happen. But as we are all aware, since bank is dealing with lot of amounts of monetary consideration, monetary items like cash and all, public trust is involved. So industry thought that there is one more need for one more mechanism of audit, which is concurrent audit, where the time gap between the happening of the transaction and its verification has to be reduced. See, generally in the statutory audit, throughout the year transactions will happen. After the transactions have completed, after the year has closed, statutory auditor will come and verify. So if you see here, there is a gap between the happening of the transaction and its verification. There is a gap. Now they want to reduce this gap. They want such an audit which will happen on a recurring basis, on a continuous basis, where as and when the transaction happens, immediately that has to be verified. So in order to do that, they have brought this concept called concurrent audit. So as you could see, verification of transaction or activities as and when the transaction or activity takes place. So the main objective here is to verify the transaction within the shortest time possible. Okay, so that has been the main objective. And some banks, what they will do is they will have their internal staff, they will have their own internal inspection staff sorry, who will do the concurrent audit. Whereas some banks, what they will do is they will not have any internal employees. They will appoint external auditors to act as a concurrent auditors. They will appoint audit firms to act as their concurrent auditors. So any option they can choose it. And as we have told at the beginning of this chapter, there will be a department called Central Inspection and Audit Department will be there. In addition to that, Audit Committee of Board of Directors also will be there. These both will together decide the scope of the concurrent audit. So who will decide the scope of the concurrent audit? Central Inspection and Audit Department, along with that Audit Committee of Board of Directors. They both will collectively decide the scope, and while deciding the scope, they give importance to high risk transactions. They pay more attention to high risk transactions, and they do risk based internal audit, risk based concurrent audit. They will decide. And what and all will be covered as a part of the concurrent audit? They will verify cash also, deposits also, advances also, investments also, forex, housekeeping, other items. All the items will form part of their scope. Yeah. And apart from that, so what things you will verify regarding cash, what audit procedures you will perform in each of the area, everything will be repetition only. See, whatever the normal auditors will do, all those activities will be done even by concurrent auditors also, but only the difference is they will do it on a continuous basis. Standard auditor will get it done only once in a year. He will do it on a regular basis. That is what the difference, but the things which are required to be verified will remain the common. That will just be a repetition. And who will appoint the concurrent auditors? As we have seen now. So that inspection and internal audit, inspection and that team, inspection and investigation team, along with that audit committee of bank, audit committee for board of directors will be there. So they both will decide the maximum tenure of the concurrent auditor. And there is one restriction also, as per RBI norms, the concurrent auditor's tenure should be maximum 5 years. And within that also, for one branch, he can't act as a concurrent auditor for more than 3 years. So maximum 5 years he can be appointed for a bank. In that also, for more than 3 years, he can't act as a concurrent auditor of the same branch. So that restrictions have been put. So remuneration, who will fix it? ACB, Audit Committee of Board of Directors, will fix it. Reporting system. So in order to fulfill his reporting requirements, there is a structured format. So once again, this management and concurrent auditor both will sit together. They will prepare one format. According to that format, they will report it. And major deficiencies or aberrations, it should be highlighted. What and all major deficiencies you have found out, that should be highlighted. Quarterly review containing key features brought out during concurrent audit should be even placed before audit committee also. And there will be zone wise reporting. So concurrent auditors will do the zone wise reporting. So important issues will be discussed with the branch manager. Minor irregularities, you need not focus on them also in a so comprehensive manner. So if any minor irregularities are there, that will be pointed out to the respective branches, and they can get it rectified. But if there is any serious irregularity, that should be brought to the head office or controlling offices. If you find any fraudulent transaction, then you have to report it to the inspection and audit department and also chief vigilance officer. Not just reporting, even you have to follow up action also you have to do. So you have reported the findings on that, what actions are taken by the management, that follow up action also you have to monitor. And this is something regarding audit committee. So generally in the banks, audit committee also will be there, who will look after the audit function. So they will give a brief about that creation of the audit committee in the case of banks and all. Clear? So this is what regarding the audit of banks chapter, guys. Once again, important for MCQs, keeping in mind the size of the chapter, somewhere around 39 pages of the content is there, but you will hardly get 4 marks from this chapter. But if at all any MCQs get tested, I don't want you to lose the marks on that. So that's why I have done the revision. Okay. Hope you guys have benefited out of it. Bye everyone. Take care.